De Silva dials Prime Minister Modi to discuss the fallout of Donald Trump's 50% tariffs on both countries. The two leaders pledged to deepen bilateral cooperation in areas ranging from trade and energy to defense and technology. Russia's President Putin will visit India later this year, says National Security Advisor Ajit Doval, who is on a visit to Moscow. Prime Minister Modi will visit China for the first time in 6 years on the 31st of August. Chinese embassy calls both nations to deepen trust and widen cooperation. And in key earnings today, SBI expected to report a stable quarter with loan growth outpacing industry, while Tata Motors is expected to report a weak quarter. Also watch out for numbers from Grasim. Good morning in the Mumbai News Centre. I am Vamakshi Doria. You're watching Power Breakfast. Well, it's the last trading session of what has been an action-packed week. There's a lot lined up. But first, let's take a look at what the Asian markets are doing this morning. It's a mixed-looking screen for now. The Hang Seng is down almost 0.7%. The Taiwanese index, on the other hand, is doing fairly well, up almost 0.2%. On the other hand, the Topix in Japan has hit a record high, has crossed the 3,000 rupee mark, the $3,000 mark for the first time. Apart from that, when you look at, the Kospi, that is not doing too well in trade today, down almost 0.4%. The Nikkei, though, on the other hand, is one of the markets that is gaining the most in today's trading session, up almost 1.9%. But let's take a look at what happened in Europe. Markets in Europe ended the trading session largely higher after the Kremlin says Russian President Vladimir Putin would be meeting with US President Donald Trump soon. The German DAX climbed 1.1%, while the French CAC added 74 points. The British FTSE ended 63 points lower. Well, that's all the global market action, but how will all of these overnight cues impact our own Indian markets? We now have our research team joining in with how the trade setup looks like and the stocks that are likely to be in the news. First up, let me start off with how the trade setup looks like. Now, yesterday's trading session marked a phenomenal recovery from the day's lowest point. The market recovered almost 300 points and closed in the green. And the trigger for that was renewed hopes of diplomatic dialogue between the US and Russia and reports of Putin's visit to India. Apart from that, when you look at the mid-cap as well as the small-cap end of the market, that too saw a very good recovery. In fact, they outperformed what the benchmark indices did in yesterday's trading session. Sectoral indices, most of them ended in the green, and the gains were led by Nifty Media, IT, Pharma. On the other hand, Nifty Energy as well as Realty were the only two indices which were in the red. Now, the handover that came in from the US markets, it's a little mixed. We did see the Dow Jones as well as the S&P 500 close in the red, but on the flip side, the Nasdaq did quite well, up almost 0.4%. As far as today's trading session is concerned, we'll be watching out for a whole host of stocks reacting to their numbers that came in post-market hours yesterday. Take a look at Cummins India, HPCL, BSE as well as Godrej Consumer. Today, we'll be watching out for numbers from SBI, Tata Motors, Siemens, Hindustan Aeronautics as well as Grasim. Other than that, a cabinet meeting is scheduled at 1 p.m. PM Modi will be discussing the impact of tariffs with ministers. Watch out for Nestle as well, because the stock goes it's the X date for their bonus issue, which is in the ratio of 1:1. The GIFT Nifty will also come up for you on the screen. For now, it's a mild start in the negative for the Indian market. So let's see where the session goes. But over to Upasna now, who will list out all the stocks to watch out for in trade today. Good morning, Upasna.
Good morning. First up, let me start with LIC. It's a beat to our poll. The new business premium up 5%, and VNB margins also saw an uptick of nearly about 146 basis points at 15.3%. Next up is Titan. Revenue and margin is a beat versus poll. The revenue is up about 25%. Margin stood at 11.1% versus 9.4% on a YoY basis. Next up is Godrej Consumer. Revenue is in line, while PAT and margin is a miss as compared to our poll. Revenue is up 10%. Margin stood at 19% versus 21.7%. Next up is Biocon. It's a slight miss in terms of numbers. Revenue growth saw an uptick of nearly about 14.8% versus estimates of 19% growth, and margin stood at 19% versus 11.9% on a year-on-year basis. Metropolis Healthcare is the next one on our radar. Strong revenue growth, but margins lower due to high employee cost. Revenue saw an uptick of 23%. Margins stood at 23.2% versus 25.2%. Schneider Electric is the next one. Net profit is down about 15%. Revenue is up just about 5% on year-on-year basis. Next up is Cummins India. It's a beat across the board. Revenue saw a growth of nearly about 26%, and PAT is also seen an uptick of 40% on year-on-year basis. Crompton Consumer is the next one. It's overall a weak quarter. It has missed the street estimates, and revenue is down by 7% on year-on-year basis. AU Small Finance Bank also in focus as the bank receives in principle approval from RBI to become a universal bank. And lastly, according to sources on Bharti Airtel, promoter entity, that is Indian Continent Investment, is likely to sell 0.8% equity of the company via block deal. So overall, it's quite an exhaustive list today, Vamakshi.
Well, thank you so much for that, Upasana. An exhaustive list indeed. But finally, we now have Sudarshan joining in with cues from the F&O space. Sudarshan, good morning. What are you watching out for?
Good morning, Mamakshi. So yesterday we saw big intraday recovery, and that helped both Nifty and Nifty Bank closing above the major key levels. But for today, GIFT Nifty is indicating again start with minor cuts. Now, if you look at the flows in the cash market, you will see that FIs have sold nearly 5,000 crore and DIs have bought almost rupees 11,000 crore. But do factor in, yesterday we saw two major block deals of Kotak Mahindra Bank, where FII was a big seller, and that selling amount was of rupees almost 2,100 crore. And in DIs, if you have seen this buy figure of almost 11,000 crore, that includes also Kotak and Zomato block deals of almost rupees 8,500 crore. So do factor in that. But now we did see intraday recoveries, but if you look at the in the index futures, FIs continue to sell. Yesterday also they have sold more than rupees 1,100 crore. Again, they continue to add positions in the short side. Yesterday they have added more than 6,800 contracts on the short side, and now FI's long exposure remains around 9%, and on the short side it's 91%. So if there is any positive news, there is a chance that we might see a big recovery again. Now, what's happening on the option front? Again, action happening between 24,500 to 24,800, and that's the reason support remains around 24,470 and resistance remains around 24,800. Now, what about the stocks? One stock that remains in the band, that is PNB Housing. One stock that was expected to go in the band was RBL Bank, but it did not go. Apart from this, keep an eye on two more stocks, that is Lupin. Yesterday we saw short covering because company had reported Q1 earnings. Earnings were in line, and also commentary was positive. And apart from that, NCC has been in focus after the commentary because company has managed to retain the guidance that it had given for FY26.
Well, thank you so much for that, Sudarshan. The Bulls would be hoping, fingers crossed, toes crossed, everything crossed to end the week with a bang. But let's move to a very short break. Up next, we get you a whole host of global updates, so stay tuned. Welcome back. You're watching Power Breakfast on CNBC-TV18. US President Donald Trump has said that there will be no trade negotiations with India until the dispute over tariffs is resolved, following his administration's decision to double down tariffs on India. Well, we also spoke to economist Surjit Bhalla and diplomat Vikas Swarup on the tariffs imposed by the US on India. Listen to what they had to say.
We should be opening up. I think it is a win-win. Agriculture, we are now in 2025. We have surplus grain. We are exporting, and our exports to the US in terms of agriculture has been a success story in recent years. So why not try and open it up? So I think the big mystery to me is this projected belief that opening up of agriculture will be bad for India or bad for the farmers. I think it's just not supported by any empirical evidence whatsoever.
I think he's miffed at our repeated snubbing of his role as the chief architect of the ceasefire between India and Pakistan. Because now Trump has, I think, repeated about 25 times that he was the one who got India and Pakistan to agree to a ceasefire. He was the one who got India and Pakistan to stop a so-called nuclear conflagration in the subcontinent. And contrast the approaches of the two countries. On the one hand, you have Pakistan, which has publicly acknowledged Trump's role in bringing about the ceasefire and has nominated him for a Nobel Peace Prize. And on the other hand, you have India, which has declared in its parliament that there was no external mediation at all and that the ceasefire was mediated directly between the DGMOs of India and Pakistan. So obviously Trump would be miffed.
Do you expect increased trade negotiations, since you've announced the 50% tariff?
No, not until we get it resolved.
Well, and in a bid to strengthen ties amid Trump's trade threats, Brazil's President Lula da Silva dials Prime Minister Narendra Modi. Remember, this comes as both countries get hit with the highest tariff rates from the US at 50%. The two leaders agreed to enhance cooperation in trade, technology, energy, defense, agriculture, health, and people-to-people ties. They also exchanged views on regional and global issues of mutual interest. While separately, Brazilian president also said that he saw no room for direct talks with Trump as US tariffs of 50% on Brazilian exports took effect. In an interview from his presidential residence in Brasilia, he said, and I quote, "My intuition says that Trump doesn't want to talk and I'm not going to humiliate myself." The leader also said that Brazil is not about to announce reciprocal tariffs. Well, India's National Security Advisor Ajit Doval has said that Russian President Vladimir Putin will visit India soon. According to a Reuters report, the Russian leader could visit by the end of the year. Speaking in Moscow alongside his Russian counterpart, Doval said that the high level of engagements during his visit was substantial and fruitful.
We have got a very special relationship, a long relationship, and we highly value our strategic partnership. We have had high-level engagements, and these high-level engagements have contributed very substantially. We are very excited and delighted to learn about the visit of His Excellency, the President of Russia, President Putin, to India. I think that the dates are almost finalized now. The more important thing is this, that is, these summit meetings have always been the watershed points.
Meanwhile, the Chinese embassy spokesperson has responded to Prime Minister Narendra Modi's visit to China that is scheduled for later this month. The spokesperson said, and I quote, in today's complex landscape, it makes far more sense for both nations to deepen trust, manage disagreements, and promote peace in Asia and globally, end of quote. Remember, the Prime Minister's trip to China will be the first one since the Galwan clash in 2020. And in the US market, Wall Street ended mixed. The Dow tumbled over 200 points. S&P 500 ended just below the flat line, while the tech-heavy Nasdaq was the outperformer, ending with gains of 0.3% 0.5%. CNBC's Angelica Peebles gets us a wrap of all the action on Wall Street.
U.S. markets were mixed across the major indexes in Thursday trading, giving up early gains from a tech surge after President Trump unveiled new chip tariffs with broad exemptions. The Dow tumbling 224, the S&P 500 down 5, and the tech-heavy Nasdaq climbing 73. President Trump signed an executive order Thursday that seeks to allow new investments and potentially riskier options for your 401k. That includes private equity, cryptocurrency, and real estate. The order directs the Labor Department to work with Treasury and other federal agencies to determine what regulatory changes need to be made to expand private market access to the plans. Shares of chip-making giant Intel were down 5% Thursday after President Trump called on the chipmaker's CEO to resign immediately, arguing that he's conflicted over alleged ties to China. The demand came after Republican Senator Tom Cotton wrote to the company's board about new CEO Lip Butan's reported investments in dozens of Chinese entities. Intel has yet to comment. That's what's happening here in the U.S. Back to you in Mumbai.
Well, thank you so much for that update, Angelica. But let's hear out what Timothy Mole of Goldman Sachs had to say on how the market is reacting to Trump's 100% tariff on chips and his take on India's total tariff rate at 50%.
First, there's been a great deal of uncertainty about the tariff environment for reasons I think which are pretty clear. The fact that we actually have hard numbers, maybe there's need some fine tuning, as Lynn was just mentioning, but they're hard numbers pretty much across the board, means that the uncertainty level has diminished. And you can quantify that with publicly available economic policy uncertainty indices. The market really, I think, is wanting clarity, not just the market, but actual manufacturers. Because in an environment where you don't know what the rules of the game are, it's very hard to commit capital and make investment decisions. And that's especially true for the very large, big ticket investments, such as is the case for semiconductors. Our economists have quantified the risk here that if the full 50% tariffs are implemented, then that could mean an additional 0.3% downside to our GDP forecasts. And we've tried to quantify that in terms of the risk to earnings, which could be in the order of 2-3%, perhaps a bit more, to our MSCI India earnings forecasts against a baseline expectation of 11-12% growth this year. So I think that the Indian market, which is expensively valued, still at 22 to 23 times forward earnings, now faces an additional headwind, and I think that supports our somewhat less immediately positive view on the market, where we're market weight as opposed to overweight China, Japan, and Korea.
Well, on that note, let's slip into a very short break. Up next, we get you cues from the commodities market, so stay tuned. Thanks for staying tuned into Power Breakfast. Let's first look at SBI. That company will be reporting its Q1 earnings today. What are the key expectations? Gaurav joins in with more details. Gaurav?
Well, yes, SBI will be the last big bank to come up with the earnings, and when we talk about expectations, we're expecting good set of numbers in terms of loan book growth. Now remember, SBI has the largest loan book, but even after that, Street is expecting around 12% growth on a year-on-year basis for SBI, and when it comes to deposit, they're expecting 10% growth. As a result, now net interest income, they're expected to grow at around 1% on a year-on-year basis. This will be a flattish, and this is because of the repo rate cut, and this will actually add some pressure on the cost of funds. PPOP, which is pre-provisional operating profit, there we may see a growth of around 2 to 3%. And after that, when it comes to profit, we may see a decline of around 2% on a year-on-year basis. So let's understand these numbers in details. When it comes to net interest income, they are expected to decline on a sequential basis because there will be some pressure on cost of funds. And as a result, net interest margins are also likely to decline almost by 10 basis points to around 2.9%. In fact, management has said that they will be maintaining their net interest margins, or they will try to maintain their net interest margins somewhere in the range of 3%. So definitely all eyes will be on the net interest margins. Other than that, lower operating expenses can actually lead to the operating profit increase of around 3% on a year-on-year basis. When it comes to provisions, Q1 is usually seasonally weak for the agri segment, and as a result, provisions may see a little bit of uptick. And that is the reason why profit is likely to decline almost by 2%. So definitely, these are the numbers. Flattish number is what we're expecting, but no negative surprise specifically from SBI is expected in this quarter.
Well, thanks so much for that, Gaurav. So muted quarter is expected from SBI this time around. But moving on, we now have Manisha Gupta joining us with all the updates from the commodity space. Good morning, Manisha. I guess you have your hands full today.
Oh, well, absolutely. But I'll start with the gold prices because we've seen COMEX hit an all-time high at 3515 an ounce. Interestingly, when you look at the COMEX gold and the spot gold prices, which we see from London, there's $100 an ounce of a difference into this one. So while the spot gold is trading at 3380, COMEX gold right now is trading at 3490. The US is known to have imposed tariffs on import of 1 kg gold bar and 100-ounce gold bar as well. 1 kilo bar is the most traded form on COMEX, and much of this is imported from Switzerland. There would be a tariff impact on Switzerland quite strongly on this because that is the world's largest gold refining hub. So very, very volatile gold prices is what we are dealing with right now as markets learn to understand the impact of this and the clarity upon this as well. On the other side, you have the crude oil prices, which are trading at a one-month lows, down 5% on this week. This is going to be the worst weekly decline since the month of June. The street is now watching out for the US and Russia presidents that could meet in the coming days, and that seems to be impacting the prices right now.
Well, thank you so much for that, Manisha. That's all we have on this edition of Power Breakfast. But first, before we go on to the next story, let's take a look at what the Gift Nifty is indicating. It's a negative start. It's almost 27 points lower. So it's where we started off the show with. Nevertheless, we will be hoping for a recovery. At least the bulls will. Take a short break then. Bazaar Morning Call comes up next.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning, hello and welcome to a fresh edition of Bazaar Morning Call. We're coming to you, as always, from the CNBC-TV18 Motilal Oswal studios. There's been plenty of tariff talk, plenty of geopolitical headlines, but finally, it's a Friday. I'm Surabhi Upadhyay, with me as always, Nigel D'Souza, and Rima keeps us company this Friday morning. Hi, guys.
Hi, with the lingering trade tensions and the cautious optimism, I think the only good thing is that it's a Friday. We've wrapped up the week. Flat so far. We've underperformed the rest of the Asian markets, but today's a new day.
Absolutely.
Well, indeed, and we get into this weekend. I'll tell you what, guys, we need to pull through another 4 sessions, and then we have the longer weekend. And I'll tell you what, and if you want to travel anywhere, you know, even to a nearby hill station, everything is chock-a-block. I'm trying. There are three consecutive days, and everything is blocked, you know. So that's
you're going to be here.
That's good. No, I'll make something happen. I have to. The 2 little kids are not going to let me do that. But you know, so people are looking forward to that mid-August holiday, a long weekend. After a while, I think.
And this weekend is Rakhi also, right?
Yeah, special.
Festivities started.
The festivities have started,
yes,
right?
Yes,
the feel-good factor.
Absolutely. And I've been speaking of festivals, so much rides in this festive season for the market as well. And we'll talk about that as we go forward. You've heard that from corporate commentary throughout first quarter. All hopes pinned on this festive season. But before we get to that season, we have to still get through a lot of the global headlines. So let's straight away get to it. Now, the headlines this morning, to begin with, the most important of them all is that President Trump was asked whether there will be any immediate near-term further negotiations with India on tariffs. He's saying no, not until that issue is resolved. It seems like he's referring to, obviously, the oil purchases. Take a look, and then we'll take it from there.
You expect increased trade negotiations, since you've announced the 50% tariff?
No, not until we get it resolved.
So there you go. Straight talk, plain speak, whatever you want to call it, coming in from the US president. Clearly, there are issues out there. But do remember that yesterday, this whole talk of a meeting between the US president and Mr. Putin, and then, the word that came in from Mr. Zelensky about looking to end the war, all that triggered the short covering. So we'll see if something more can come out of it. Now, I'm going to continue with the geopolitics before I come to markets. What else do we know? Prime Minister Modi received a call from the Brazilian leader, from the Brazilian President Lula da Silva yesterday. And these overtures are important. Remember, we had comments from the Chinese supporting Brazil, now Brazil calling India. Very, very interesting overtures happening between the BRICS nations. And, of course, now it is official that President Putin will be visiting India. The date is not yet clear and final, but it's being worked out. So very, very interesting geopolitical sort of adjustments, perhaps, between the BRICS nations, looking quite interesting. And then Prime Minister Modi travels to China as well for the SCO summit later. Now, amidst all of this, let's get back to some inputs that we're getting on China. On China, as the market has been believing, it seems that this 90-day window of a tariff pause, that's going to be extended. And how do we know that? Because we had the U.S. Commerce Secretary, Howard Lutnick, speaking to Fox News yesterday. And he says, and I quote exactly, I think we're going to leave that to trade team and the president to make those decisions. But it feels like they're going to come to an agreement and extend that for another 90 days. So the Chinese seem to be the only major trading partner where the U.S. is willing to give in a little bit and negotiate. Otherwise, it's been pretty much a 0 or 1 from the U.S.'s side. So this is where we are with respect to trade. Now let's talk markets. Yesterday was a mixed session for Wall Street, but it was a very choppy and volatile session as well. You had the Dow ending about 0.5% lower. The S&P was all over the wild ride, but then it recovered to finally close flat, and the Nasdaq managed to eke out some gains. A lot of chatter in the market about the next people who will come into the Federal Reserve itself. And Trump yesterday finally announced the successor to Adriana Kugler, a gentleman by the name of Stephen Mirren, who's known to be a close Trump aide. But he's only taking over till January, till Ms. Kugler's term actually officially ends. So therefore, there was not too much of reaction in the bond markets. In fact, the yield was hardly changed, 1-2 basis points here and there. And the US 10-year, this morning actually it's climbed up a little bit. It was 4.24 till last evening. Now it's 4. 1.25. The bigger guesswork continues on who will be the next Fed chair. And that's where Christopher Waller's name has come up. This is as per a Bloomberg report. He's, of course, one of the current Fed governors, and he's widely respected in the market as someone who really understands monetary policy and the way financial markets work. So that was taken very well. That indication was taken well by the market. The dollar managed to move up slightly, but not too much. The dollar is still continuing around the 98 handle, the dollar index, that is, around that pivot. So a little bit of an increase coming in from lower levels. And we have seen that narrow range continue. Now, for India, where do we stand tracking all these geopolitical headlines? Yesterday, we had a great helping hand from the short covering bounce. Very, very sharp recovery as geopolitical, overtures indicated that maybe there's some breakthrough, in the coming days on the Ukraine war. But we have to see. Now, today is a fresh day. The expiry factors would be behind us. So let's see if some of these issues will linger. But what we know right now is that these geopolitical worries, these tariff issues, they're not out of the way. And FPI selling is going to be the key watch point. And we'll talk about that. Rima will mention numbers in just a bit. But as that FPI selling continues, and it has, DII flows remain extremely crucial, and Monday we'll get the flows. And you heard Nilesha speak to us on this show just a couple of days back that expect record flows in July, and that's where the market will keep its faith. Rima.
Well, let's just quickly take stock of Asia this morning. Broadly lower, barring a Nikkei. The Japanese markets have surged close to about 2% in opening, and that's because we've had some strong earnings from SoftBank. SoftBank is currently trading with a gain of about 12%, and even Sony is higher by nearly 4%. So that's boosting Nikkei, but the rest of the markets are a bit subdued. So Hang Seng's down close to about 0.5%. The Korean markets, that's Kospi, also lower in trade. Back home for our own markets, we had that smart intraday pullback in the last 1 hour of trade. The Nifty recovered about 250 points from the day's low and finally ended around the 24,600 mark. Now, technically, just in the immediate term, resistance could be around 24,700 to 24,800. That's a level that you can see, that's the intraday high. We've tested a couple of times just in this week itself. Now, week to date, the Nifty is absolutely flat, and given the lingering trade tensions, the escalation, we have underperformed our Asian market peers, where Taiwan is up close to about 3%. Japanese markets have soared over 2%. In terms of flows, big buying seen by the DIIs yesterday, about 10,800 crore. The FIs sold 5,000 crore in the cash market. They've net sold 16,000 crore in August. And remember, this is after dumping nearly 48,000 crore in the month of July. Lots and lots of stocks to watch today, but some of the important ones, one of them is Titan, strong margin beat. On Bharti Airtel, promoters are looking to sell in a deal which is in excess of $1 billion, so about 0.8% equity. AU Small Finance Bank, and this is a stock which is down 10% in the last 1 month. So you should watch for this. It's got an in-principle approval to become a universal bank, and big number is expected. SBI and Tata Motors in particular will announce their results. So that's on my radar. Nigel, what are you looking at?
Well, yesterday we had a good bounce, right? It was a weekly expiry, and we highlighted a couple of oversold levels, and from there the Nifty went ahead and bounced. But it could be a count of weekly expiry as well. And two factors that stood out. One was intraday, the PCR went to around that sub 0.7 odd, which is normally the indicator where you get a bit of a bounce. And as we have been saying for the last many trading sessions, that the FIs, well, they are net short as well on the index. So, moving to what the FIs did though, by the end of the day, you were wondering whether or not they were covering their shorts. Actually, on index futures, they didn't cover their shorts. They added, shorts yet again. They added close on 6,000 contracts. And on stock futures, well, there was a mix of activity out there, some long addition, some short addition as well out there. The good news is even X of that block yesterday, it appears that the FI selling has gone down, quite a bit. And X of that, there could be some mild buying as well. So I'll be looking at today's, block deal very closely. That's with regard to Bharti Airtel. And then trying to strip out what is the core FI number looking like, because that selling has reduced, which is good news. The FI positioning though on the stock, on the index futures, well, that's aggressively net short. 91.5% positions on the short side in absolute contracts, around 1.75 lakh contracts. So we're closer to the peak levels that we have seen. In the past, we've seen a number a little over the 92%, and we've seen the contracts, and after adjusting, it's closer to around 2 lakh contracts. So the FIs are net shorts, not such a bad thing, but this market needs to stop falling. Once it stops falling, then these shorts will start getting nervous in the system, and that's what could cause a bit of a bounce. Moving to, the other important point. For the last 5 trading sessions, the Nifty is making lower highs. So for today's trading session, you'll at least wanted to get first past this level, because otherwise, as that chart is telling you, on a day-to-day basis, you're making lower highs, and that trend needs to be broken. The PCR, as I said, yesterday had moved to around 0.7. That's popped back up. It's around the 1 mark, so that's around the mid level. And there are, aggressive call writing that we have been seeing, and that continues as well. Now, in yesterday's trading session, you had the 24,500 call, added close to around 20 lakh shares. 24,600 call as well, did add close to around 12 lakh shares. Both of them, you punch in the premiums, and you get a rough number in terms of the near-term resistance mark, which comes in at around 24,750 odd mark. That's the important mark. For today's trading session, you'll want the Nifty to get past that. And then, in fact, you'll be looking at the 20-day MA. So that's the important resistance levels that come up for you on the screen. On the put side as well, there's been a fair bit of addition. At around the 24,500 put, 24,400 put, and just punching in the premium out here. You're looking at yesterday's low as an important support zone and the 100 MA. And from here is when we bounced, in yesterday's trading session as well. So that's going to be the important mark. Just one stock, Bharti Airtel. Last few months, the stock has been a little bit in a consolidation phase. Today, once that block gets out of the way, it'll be interesting to see how Bharti Airtel does, because the last few months, in fact, it's not done much. I'll keep an eye out on this one.
Okay, all right, absolutely. So let's watch out for that block on Bharti and a lot of those levels. And for starters, let's see if the Nifty can at least defend that zone of 24,400, 450 thereabouts. Well, let's kick it off then. The equity call of the morning coming in, and this is a call coming in from Herald van der Linde of HSBC. He says that at this juncture, we find India to be more of a stock picker's market than one driven by top-down macros. He says they are less worried about tariffs than weak demand and elevated valuations in India. They're neutral from a regional perspective with a 2025 end target of 85,130 for the Sensex. He says their top 5 stock ideas are Trent, Infosys, Godrej Consumer Products, SBI and Phoenix Mills.
Okay, let's move on and get some opinion on how you should navigate the current tariff chaos. Neeraj Seth, founder, CIO at 3R Investment Management, is now joining us on the show. Mr. Seth, thank you very much for joining in. Give us your initial thoughts. What have you been doing with your portfolio? Have you been making any ins, any outs? And how should one, there's so many there's so many signs one needs to juggle with.
Sure. So I think overall, there's certainly a lot of noise, and it's extremely important as an investor. First thing to do is you try to separate noise from what matters. And I think on your point about tariff, I do think there is an impact, obviously, whether it's from the overall growth impact from the export side or the sentiment impact from a relationship perspective. Looking at the markets, I'm not sure the market impact is that big. So not a huge lot to change here, to be honest. And there's still a lot of more news to come. There's still obviously follow-up discussions before the 27th of August comes and the additional 25% kicks in. So I'm not sure you want to actually have knee-jerk reactions in terms of changing a lot in your portfolios other than just making sure that you're not overexposed to certain sectors which are impacted by tariff.
Neeraj, hi, good to have you on. So what's the sense? I mean, has the market seen the worst of this tariff hit? Does it get better from here, or is this actually just the beginning of perhaps greater FII outflows?
So I think the worst of the noise, which was in the April 2nd week, the Liberation Day, I still believe that's behind us. Obviously, the noise is not going to go away, which is an important aspect to keep your eye on. From an FII perspective, I do think we have seen a significant amount of selling and outflows, but given the markets have been rather stable on a relative basis, and if I take a step back and look at the last 12 months, market is still below in case of India compared to September last year. So you've seen an implicit correction, and I do think you will see the stabilization in FII flows here once a lot of the weaker hands or the initial knee-jerk reaction is over.
Neeraj, you think by going by what Trump has to say in the last few months and the kind of, data, etc., we're getting from the United States, do you think actually all this activity by Trump is going to swiftен the pace of de-dollarization? The dollar as has been weak, but all this, talk could swiftен the process. What do you think?
I do believe it actually, if not significantly accelerate, it certainly puts a zoom focus from a lot of people on the whole idea of de-dollarization, or more importantly, diversification. Now, if you look at whether it's the foreign central bank reserves or the trade or a number of other aspects, dollar still is the reserve currency of the world. I don't think that's changing or going away, but the diversification has already started. If you look at the incremental flow of dollars in the world, that incremental allocation is slowing down, and I do think that's going away anytime soon. The world will have to think about a more diversified way of keeping your currency exposures rather than being overexposed to dollar, whether it's your reserves or the risk assets.
Neeraj, is India still the preferred market in emerging markets or in Asia Pacific, or has that changed now? Because what were geopolitical tailwinds in the past have turned into headwinds.
Yeah, so there's certainly an impact of that you will see both in terms of the data and sentiment. Obviously, there's a growth impact. As I said, you can have a 1/4 point to a 1/2 point growth impact because of the export sectors taking a hit. The sentiment impact that you are seeing more from a technical standpoint in terms of the FII selling, I do see that obviously having some impact from a capital flow standpoint. But again, if I take a step back and look at the next decade or 2 decades, is there going to be some shift in the structural story from a growth perspective in India? I'm not sure about that. And if anything, this is a good wake-up call when you think about the economy from the 4-engine perspective of government, corporate, consumer, and exports. If you're seeing weakness in exports because of these, well, you need to find new products, new destinations for exports, but more importantly, deepen the corporate and the consumer side and keep the government spending stable. I do think the equation still works from a long-term growth perspective for India.
So, Neeraj, what are you buying in India now?
Well, I still like some of the sectors which are more domestic focused. The financials are still looking good. The domestic consumer sectors are still good. So I don't think there's a lot changing on that front. If anything, they continue to obviously grow more competitiveness as you see the growth in these sectors. So I don't think you have to change a lot other than, as I said, zoom in, look at which sectors, which is a small subset of the markets when you think about the exports aspect, specifically the one that gets impacted. You don't want to be too exposed to those at this point.
Neeraj, final question before we let you go. What are you expecting since we're going to be looking inward, monetary and fiscal? What kind of moves are you expecting? Because the economy is a little bit soft, but the hope is now we're getting into that festive season. Things start improving. There's going to be more more money in the hands of the consumers. And hopefully, if this economy gradually gets kickstarted, what are you expecting?
So I still think given the consumer is still, I wouldn't say weak, but on a relative terms weaker, and the corporate capex hasn't picked up, and there's some softness that can come from the standpoint of these geopolitical tensions. I do think the path forward is further cuts from RBI. I'm more in the camp of looking at a 4 handle as a terminal rate rather than where we are at 5.5. And from a fiscal standpoint, a little less so, given I do think the fiscal room is limited from a government perspective to expand too much. So that I, in fact, believe and hope that the fiscal path will be more towards consolidation and monetary more towards easing in the next 12 months.
Okay, all right. We'll leave it on that note. Thanks, Neeraj, very much for joining in. And we look forward to another conversation soon. Well, with that, let's quickly tell you what else is lined up on the show today. It's a packed next couple of hours coming up at 8:35. The management of Gokuldas Exports will talk about not just their Q1 numbers, but life in this new 50% tariff world. What are they thinking in terms of business continuity? We discuss that with Mr. S. Ganapathy. At 9 a.m., we'll have the management of Kalyan Jewellers joining in on the company's Q1 performance. At 9:20, Krishna Sanghvi of Mahindra Manulife Investment Managers joins in. He's our market master of the day. At 9:30, we get chatting with Uno Minda. The company will talk to us about their Q1 performance and, of course, how their export business is impacted, if at all, in this fast-changing world. After that, we'll have Ashok Santhalia of Titan joining in. Looks like a pretty good quarter at Titan, so we'll discuss some of the details with him. And at around 9:50, we'll have Nissan Joseph of Metro Brands talk about consumer sentiment, demand, and how the first quarter has been for them. And then we get to Crompton. Crompton, like a lot of other electrical appliances and cooling products companies, has had a rough Q1, tough start to the year. Does it get better? We'll ask the management. And finally, in our special segment, It's the Economy, Lata will be talking to Mukesh Kumar Surana, former CMD of Hindustan Petroleum, to understand the dynamics of Russian crude versus US crude.
Well, time to slip into a quick break, but a lot of stock-specific action to track. We get at that in just a bit in our special Top 10 segment, but we're looking at AU Small Finance Bank, Titan, Cummins, LIC, BSC and Kalyan Jewellers. All of them will be reacting to positive news flow, while you have Bharti Airtel, HPCL, Biocon and Godrej Consumer that will be reacting to negative news flow. Take that break, come back. We get into further detail on all of these names.
Welcome back. The Indian markets have been showing resilience this entire week. Yesterday, there was a bit of a weakening bias intraday, but thanks to short covering, we managed to stage a smart recovery and ended absolutely flat around the 24,600. But let's prep you up for today's trading action. It's a Friday. Our entire research team is standing by with CNBC-TV18's list of top stocks for the day. And let me do the honors today. It's Bharti Airtel right on top. And here, the news is that according to sources, there is a large block expected in Bharti Airtel. The promoters, which is Indian Continent Investment, ICIL, is likely to sell a 0.8% stake equity. The floor price is at 1862, about a 3% discount to yesterday's close. The deal value is in excess of 9,000 crore rupees, and the promoters will have a 90-day lock-in. In fact, in the last 1.5 years, or nearly 2 years, this is the third instance of the promoters selling part of their equity in the company. They still have a majority stake. As of June, they had 51.26. So even if they sell about 0.8%, which is expected in today's block, they will still have a majority holding. But you know what people have been saying is that ever since they bought that BT acquisition, the promoters at the Sunil Bharti Mittal level, the company has been slowly paring down their stake in order to, fund that. But we don't know. But for now, what we know is a large block, 9,000 crore plus in terms of value.
So it's a big one, and these blocks have been really skewing the way the flows are shaping up as well. And that's an interesting trend you highlighted. They've bought additional stake in BT, and then,
I mean, not additional. They had bought it 2 years back, and then since then, we've started seeing them pare down their holding
some in the Indian list.
This is the third instance.
Yeah. Okay, interesting trend there. We'll keep it on the radar. Let's bring in Mangalam then. Titan's numbers, at least optically, look really good, Mangalam. Tell us more. Morning.
Well, operationally, it's a very good performance. Remember, we know the revenue of the company already because of the first quarter update that they had given us. So the street was looking at just the operational performance and the commentary. And out there, it is positive. The jewelry business margin has expanded and there has been a stellar performance in the watches division itself. So what's good? The EBITDA coming in at 1,632 crores versus street expectations of sub 1,500 crores. The margins coming in at 11.12%. Street was working with a number of 10.5%. And the net profit as a result of which a good 100 crore beat at 1,030 crore versus a poll of 930 crores itself. What is it that led the margin expansion? It was gross margins that improved by over 100 basis points and watches EBIT margin, which actually doubled with a near 150% jump in the watches operating profit itself. The company has, however, said that there was a one-off, an element of a one-off in the jewelry business, which improved their margin by 50 basis points. So that may not happen going forward. So the street's adjusting for that. But studded ratio at 29%, not a bigger decay than what we saw last year. International jewelry growing at roughly 50%, and the market share maintained at 8% with an eye on that double-digit mark. Expect the stock to see some green today.
Yeah, and I remember, categorically that Titan, when the Q1 update had come out, the stock had really fallen very, very sharply. So maybe now that the operational performance looks good, maybe some recovery today, we'll see. Mr. Ashok Sonthalia will join in to take a couple of questions and give us their outlook on the rest of the year.
Okay, all right. Let's hop across to Sonal. She's here to tell us about HPCL. Morning, Sonal.
Good morning, Nigel. Well, for HPCL, yes, there is a quarter-on-quarter improvement, but there was a refining miss that came by. If we talk about the overall numbers, revenues were up 1%, EBITDA up 31%, margins improved on a quarter-on-quarter basis, and profits also came in higher by 30%. However, refining throughput declined 1% on a sequential basis. GRMs at $3.1 per barrel is lower than the estimates and also lower than the benchmark GRMs by around $2.5 per barrel. Also, 21,500 crores of LPG subs under recoveries, they have not been given back to the company. So that continues to remain an overhang. Jeffrey says that they see likelihood of lower refining profitability as Russian crude consumption could drop going forward. And that remains to be seen for all these oil marketing companies.
Thank you very much for that. Let's talk about Biocon. Ekta, numbers are a miss. I think I saw profits down nearly 90% year on year.
Well, yes, definitely. But you have to compare it to estimates. That's what's most important. So, yes, there is a profit miss, but compared to estimates of around 102 odd crores, it's not as drastic. Now, in terms of the revenue growth, it was up around 14.8%. The street was anticipating 19% growth. The margins came in at 19%. The street was anticipating close to 21% and the profit of around 89 odd crores. Generics business grew around 6 odd % year on year. So that's probably where a little bit of the dampener came through. Biosimilars was strong. It was up around 17.4% year on year. And the research business, which is Syngene, was up around 10.8% year on year. So the generics business was a bit subdued this time, and that seemed to have pulled down the entire set this time. The call is at 9 a.m., so more details from the top management of Biocon. But I expect the stock, based on just these numbers, to be in the red. Maybe the commentary could change the sentiment.
Okay, we'll watch out for the commentary then for sure. Thank you for that, Ekta. Let's get in Vamakshi, figure out how Cummins has fared in the first quarter. Vamakshi, morning, tell us.
Well, good morning, Surbi. A good set coming in from Cummins India. Keep in mind that this is the fourth quarter since the implementation of the CBCP4 plus gensets. Keep in mind that the revenue saw an uptick of almost 26%, came in 12.5% higher as compared to what the street was anticipating. And the growth in revenue is largely being driven by the exports business, which is up almost 34%. The domestic business too is quite healthy for the company, up almost 25%. The margins too have improved to 21.45%. Which is the highest level that we've seen since quarter 4 of FY24, and the company has also reported a 40% uptick in the net profit. And keep in mind that this net profit has come in at a record high. So overall, a good set of numbers coming in from Cummins India. The management says they are cautiously optimistic about their growth going forward. There's a con call scheduled at 12 p.m. So more details on that.
Stock closed at the day's high yesterday. It was up nearly about 1%. But let's talk about Godrej Consumer. Mangalam now joins in with the details.
Well, Godrej Consumer, if you look at the numbers, again, the revenue was revealed in their consolidated update itself. But importantly, the stock ended at the high point of trade yesterday. And there has been an EBITDA miss. The company said that it's the second half where they are likely to see normalized margin. So for the first half, and this is something that they had called out earlier as well, that margins would be below normative levels. But maybe the analysts were expecting a little more than what the company has delivered. Revenue at 3662 crores, street expectations 3665 crores, bang in line. The EBITDA actually has come in at 695 crores, a lot lower than street expectations of closer to 750 crores. And that implies that the margins at 19% are also a good 120 basis points below expectations, and that has flown down to the bottom line as well. 450 crores on the bottom line with expectations of 480 crores. The underlying volume growth, 5%, higher end of the 4 to 5% band that the street was working with. And consolidated volume growth has also come in at 8%, so that's a positive. It's been led by home care business, which is up 16% at 946 crores. But personal care, which is where the pressures are on account of the palm oil price inflation, and soap business, which is under transition, which saw only a growth of 1%. I expect the stock to open in the red, but that decline should be shallow because the consumer sentiment is looking up and margins are likely to recover from here on.
Okay, all right. Thanks a lot for that, Mangalam. Well, let's hop across back to Vamakshi. Vamakshi, tell us about LIC and BSE.
Well, let me first start off with BSE, Nigel. The revenue from operations saw an uptick of 13% quarter on quarter. This was largely led by a jump of almost 21% quarter on quarter in the transaction charges. The revenue was more or less in line with what the street was anticipating. The EBITDA margin, though, saw an improvement of 812 basis points, coming in at 65.3%. This is, slightly lower than what the street was anticipating. Nevertheless, it's still an improvement. Largely, the margin improvement was driven by the clearing and settlement expenses, which declined by 10%, and more importantly, the other expenses saw a dip of almost 51% quarter on quarter this time around. The company reported a net profit of 538 odd crores, an uptick of 9% quarter on quarter. It's a beat, and this beat is largely being driven by proceeds from divestment of a wholly owned subsidiary, which is BSE Institute. It included a net profit of almost 12 crores. So on the given the kind of growth that we've seen in the net profit, going with the green for BSE. Other than that, keep an eye out on LIC as well. The new business premium saw an uptick of almost 5%. It has come in higher than what we were expecting. The total APE is also up 2%. There's a slight miss out here, but look at the VNB. The VNB has seen an uptick of almost 21%, strong beat here, and the margins too have improved by almost 150 basis points to 15.37%, and a beat here as well. So going with the green for BSE as well as LIC.
Okay, so give me some green, as they say. And Vamakshi's got plenty today with Cummins, LIC and BSE, all are three stocks. Let's go back to Mangalam. Let's see if he can give us some green. Kalyan Jewellers, sparkling or not, Mangalam?
I can give you gold and diamonds because 1% revenue growth that the company has reported. They've given us the first quarter update already. So the street was bracing for that 31% growth. What they weren't bracing for is a 38% jump in the EBITDA. So the margins have actually improved by about 30 basis points. Obviously, gross margins have come down because there's been a higher share of revenue coming in from franchise stores, but that's pretty much understandable. The profit after tax up nearly 50% from 178 crores all the way up to 264 crores. And this time around, South India showed a revenue growth of 30%, whereas non-South showed a revenue growth of 33%, and Middle East grew by about 27%. Same store sales growth came in at 18%. And there as well, South was 20%, non-South 16%, because obviously South has a higher salience of gold. And the studded share absolutely flat at 30.3% versus 30.4%. And non-South, where the company has been diversifying, grew at is now contributing about 51% to their overall sales. So that's a positive. See some green on Kalyan Jewellers, especially after the big beating that the stock has taken from the top.
All right, Mangalam, thanks a lot for that. And in fact, we'll be joined by the management of Kalyan Jewellers later on at around 9 a.m. to talk about the past quarter's performance. But another big mover today is going to be AU Small Finance Bank. Gaurav joins us to tell us more about that. Gaurav?
Well, it's definitely a positive news for AU Small Finance Bank after 11 months of waiting, because now they have got in principle approval for the transition to universal banking. Remember, this is the first small finance bank to get this approval from RBI, and they had submitted this application in September 2024. So 11 months is what it took to RBI to take this decision. When we talk about this decision, this also comes up with many benefits in the likes of improved brand acceptability, lower cost of funds, lower PSL requirement, which is priority sector lending. Remember, RBI has cut down the priority sector lending requirement for small finance bank from 75% to 60% already. But with the transition to universal banking, it will cut down more to 40% for AU Small Finance Bank, or rather we can say AU Bank. Increased avenue for fee income is also something that we will be looking out for, and it will also aid the customer growth. In fact, when we talk about management commentary earlier, management had said that the 25% growth trajectory will likely to remain until the loan book reaches around 3 to 4 lakh crores. So definitely management also seemed optimistic in the last few quarters when it comes to universal banking license. When we talk about some other comments, they are also optimistic given that they will get more position for the loan book growth, and also they will open up the avenues for revenue. So it is going to be positive for AU Small Finance Bank definitely, but at the same time it also sets a benchmark for other small finance banks like Ujjivan and Jana, because both these banks have also applied for the license of universal banking. So all in all, definitely a positive news for AU Small Finance Bank, and as a result keeping the stock in green today.
Okay. All right, got that, Gaurav. Thanks very much. So adding AU to our radar as well. Let's quickly, in fact, recap our list of stocks to watch today. The ones that have positive news flow are indeed AU Small Finance Bank. Then there's Titan, Cummins, LIC, BSC and Kalyan Jewellers. All of them, those four on the back of earnings. Stocks with negative news flow on your screens now. Bharti Airtel, expected block deal there. HPCL, Biocon and Godrej Consumer, slightly weak set of earnings. Okay, with that, let's move on. It's not just about all the earnings. We also have to look at stocks in focus on the back of the MSCI India Index rejig. Hormuz is here to tell us who's in and who's out. Hormuz, morning.
Morning, Survey, and unexpected lines pretty much, and 4 additions to the standard index, the India Standard Index, and 2 of them have been removed. So let's talk about the inclusions first, and the inclusions include names like Vishal Megamart, Vishal Megamart and Swiggy, Vari Energies and Hitachi Energy India. These are the 4 names that have been included. The ones that have been dropped are Sona BLW and Thermax. They have been excluded, and the rebalancing will take place on the 26th of August. Now, if you talk about the inflows as a result of this inclusion, IIFL Alternates believes that you can see inflows of anywhere close to $300 million, with Swiggy being the lion's share here. Vishal Megamart may also see inflows of close to $260 million, Vari and Hitachi too around about $230 million each. Now, when it comes to the outflows, Sona BLW and Thermax can see outflows of anywhere between $120 to $160 million. Now, both of these names that have been excluded have been moved to the small cap index, and as a result of which they may see some inflows of close to $30 to $40 million as well. But when it comes to the standard index, the weightage of CG Power has been increased, and that can be resulting in inflows of around $55 million, while names like Asian Paints, Eternal, JSPL and Havells has been reduced, and Eternal can see a largest amount of outflow here of close to around $600 million as a result of this. Now, for the small cap index, we've seen 15 inclusions here, 6 names have been dropped. Well, notable inclusions here are, aside of Sona BLW and Thermax, include the likes of Nexus Select REIT and a lot of other smaller names as well. But among the exclusions, a notable name here is Bharat Dynamics. That has been removed from the small cap index, and as a result of this exclusion, you can see outflows of around $30 million, and the rest can see anywhere between $4 to $14 million worth of inflows. So on expected lines mainly, but keep an eye out on Vishal Megamart, Swiggy and Bharat Dynamics.
Thank you very much for that. And gold is also making headlines. It's COMEX Gold, which has hit a fresh record high. Manisha is now joining in. Manisha, it looks like Trump hasn't spared tariffs on gold too.
Oh, well, absolutely. You know, we've been discussing for some time on how gold has been importing record numbers. U.S. has been importing record gold numbers in the first quarter of this calendar year. So January was a record ever import, and Feb and March were stronger numbers as well. And while, of course, there have been these conversations that gold and silver as precious metals would be spared because U.S. doesn't produce much of it. It usually imports many of these, including diamonds as well. But with Switzerland and with the kind of reading between the lines is happening, the codes for gold import also seem to be included, especially 1 kilobar and 100-ounce gold bars are included on tariffs here. So Switzerland at this point in time has 39% tariffs. So if you start calculating that, this is exactly what the street seems to be reacting to. So when you look at the U.S. COMEX gold prices, they hit an all-time high at 3,515. While the LME, the London spot is trading at around $3,400 an ounce. So we are trading with a $100 premium in the COMEX gold right now. Yesterday, during the New York session, Indian markets for gold also hit an all-time highs, and the expectation is that you could be looking at opening today around those levels as well. Well, tariffs will impact Switzerland the most because it's the world's largest gold refining hub, and that really seems to be supporting not just gold, but silver prices are trading quite in the positive at this point in time.
Okay, all right. But I guess, Manisha, move aside gold and silver. Now it's what? It's cryptos for US 401k, right? I think he's just signed that into an order this morning.
It has, yes. It happened in the U.S. markets, and we're looking at crypto prices as well, seeing a lot of support because of that as well. You know, Surbhi, this has been an amazing year when it comes to cryptos, and all because of the kind of legislations that we've seen U.S. pass. The Bitcoin ETF spot is doing very, very well. We've seen that Genius Act being signed by the U.S. president as well. There are two more acts, Clarity and Anti-CBDC Surveillance Act, which also has been passed by the House, and Senate is now looking at it. But yes, with 401k retirement plans, it's a broader band of investments now. Earlier, it was only about stocks and bonds and cash. Now it's about real estate, private equity, and crypto as well. And this is exactly where the crypto market seems to be taking a lot of support from.
Absolutely. Cryptos for your retirement. I don't know. Any takers over here in the studios? I'm not too sure. But Manisha, thank you so much for that. We'll catch up with you again soon in a couple of hours. Take a quick break on that note, come back on the other side. And we have the management of Gokuldas Exports joining in the all-important conversation on the Q1 earnings. And now, life as it stands with 50% tariffs. We'll get some perspective with Mr. S. Ganapathy. And after that, we have Siddharth Khemka joining in. He'll give us some fundamental stock ideas for Friday.
Welcome back. Well, let's connect with the management of Gokuldas Exports. They reported their numbers, and also there is suddenly been a big scare because of these heightened tariff worries. We have with us Mr. Ganapathy, the Vice Chairman, as well as the MD at Gokuldas Exports, who joins in. Hi, sir. Good morning. Always good to have you on the show. Morning. Well, your shareholders will be waiting to hear from you because, these tariffs have suddenly weighed on the business. So give us a few details. Have you had any discussions with your customers? Have there been any cancellations that have come about? And do you see this big risk of business that was supposed to come to India now goes to competing nations?
So, with tariff, nothing is settled, so nothing can be predicted as well. That's the reality, right? So we had this incremental 25% tariff imposed just recently, and we need to see how that plays out because that's just so new that discussions are on with various stakeholders as to how do we deal with it. But if you look at the tariff before that, which is the 25% on India, vis-a-vis like 20% on Vietnam, Indonesia, Bangladesh, and other competing countries, I think that was something which we could still manage. 20% is the minimum tariff on most of the large apparel manufacturing nations. So 20 is the new zero in many ways, and 25 was just 5% above. We could have handled it. But an additional 25% is something which we are, watching. We are seeing, how long is this going to be before some normalcy could come in. It's very early to speculate on what is the impact of that on business. Suffice to say that India exports about 5 billion to United States. And it's not possible for brands or retailers to move 5 billion out of India to other countries overnight, because that kind of capacity may not be available. So this may take some time before capacity realignments can happen. In the meanwhile, the whole system will be under stress on account of that incremental 25%. And I think we have to deal with it. It's a very big number and a very big stress point. But that said, in the longer run, if this persists, we will see a significant erosion of business. But in the short run, I feel that there could be some normalcy or rational thoughts that can come in over the next 3 months or 4 months.
Indeed, sir. We hope for a rational Trump. We keep hoping, but some of the comments keep getting more irrational. So let's live in that hope. That said, so as you're clearing out, 25% is maybe manageable, but this additional 25% hits you hard. But there's now people are looking at risk mitigation. You have presence in Africa, Kenya, as well as Ethiopia. Will you consider moving a higher amount of your operations there, since they are, the tariffs that's levied out there is relatively lower? Is that something that you're looking at?
So obviously the business that on that side is growing because brands themselves are seeking out those regions where tariff is lower. For instance, Kenya and Ethiopia have only 10% reciprocal tariff. So it's going off a small base. So we export about $100 million out of that region, and that part will grow faster. As far as India is concerned, we let us still find a solution. But natural progression of things would be that business would seek regions with competitive tariff, and for us, it means that with manufacturing capacities there, we would see a higher growth.
Mr. Ganapathy, hi, good morning, sir. So let's try to sort of wrap our heads around this, because we do have numbers till they change. Now, let's assume that the 25% stays, and you're saying that could have still been managed and handled. So in that scenario, if you do a scenario analysis, in that scenario, would you have to shift any of your current production to markets like Ethiopia and Kenya or other countries? What are you thinking in terms of just a shift in manufacturing, if at all, at 25%?
So at 25%, I wouldn't foresee a huge amount of shift. Of course, the arbitrage will play, right? With Kenya and Ethiopia at 10%, with vis-a-vis 25% for India, there will be a larger growth there. And that growth will come at the expense of multiple nations, not just India, because almost all other nations are at 20% or higher. So from that perspective, that region will grow. But I don't think it is only at the expense of India.
I understood your point. So you're not immediately looking to shift out at 25%, but in general, those markets will see good growth. I absolutely take that point. Now let's talk about at 25%. Now this 25% obviously has to be borne by the retailer, by the customer, maybe to an extent by you. So your conversations over the last couple of weeks, I mean, where do they leave the split? Because I think in the call, you did mention that there will be some pressure on margins going into Q2 and the rest of the year.
Right. No, that's absolutely sure. So this 25%, if we look at it, 20% seems to be that new normal, right, across the world. And that will come with eventually, I'm saying, not in the short run, maybe a year from now, or maybe the next financial year, more likely, that, it will get passed on to the retailers, the end consumers. There are certain brands which are looking at increasing pricing for the end consumers. there will be de-speccing of garments or shrinkflation as FMCG industry looks at it, where the value of the garment will be protected, but some features can be removed or reduced so that the pricing can be managed from a consumer standpoint. So multiple methods will be used by brands to keep the consumer pricing more or less less inflationary, and yet reduce the cost of buying, and thereby tariff kind of offsets it. So strategies will be adopted. As far as value chain or supply chain is concerned, initially over the 10% which was in place, the supply chain was absorbing a portion of it. I don't think when it goes to 25%, the supply chain has as much ability to absorb any further. So rest has to be managed in terms of pricing or in terms of product spec changes.
Got it. Mr. Ganpati, we're out of time, so very quickly, did you speak to any of your customers yesterday at the current 50% tariff? Have they cancelled the orders? What is Q2 and Q3, Q4 going to look like in terms of top line? And again, coming back to the question about margins, at 25% tariff, for the sake of simplicity, what will be the extent of sharing of the burden, and how much could your margins get compressed?
So for Q2, those orders were placed long back, so I don't see any problem as far as Q2 business is concerned. For Q3, those discussions are yet to begin. So we have not seen any customer cancel any order so far, but discussions are on as to how do we deal with it, and it will play over the next 2 weeks, I think, for Q3. As far as the burden share for 25% is concerned, it's also speculative. As I said, our net profit margins are in single digits, net profit margin. So there is a limited room for us to absorb. I think the rest of it will have to be absorbed by the others in the supply chain, including the retailer.
Okay, all right. Thanks a lot, sir, for joining in. We'd like to have a longer chat, so we re-invite you in the next couple of weeks and understand how things pan out. But as you said at the start of in your initial comments, hoping for a more rational President Trump that'll make doing business, globally much better. Have a good day, and we'll chat with you soon. Well, let's hop across to Sid Khemka, Head of Research, Wealth Management at Motilal Oswal Financial Services, who joins in. Sid, morning, Friday morning. First comment on these textile makers. Gokuldas is down more than 20% in a month. What's your view on it? These are good companies, and this too shall pass. But what would you recommend at current levels?
Good morning, Nigel. Yes, happy Friday. I think the uncertainty, especially for these exporters, that continues. We saw a sharp rally when initially Trump announced a lower tariff for India compared to some of our neighboring and competing countries, the likes of Bangladesh, Vietnam, Indonesia. So that was a big positive for some of these companies. But now, with the additional tariff, as we just heard the management, 20% tariff was something that they could live with. But at 50%, it becomes really non-competitive for them. So I think market would react to these news developments, but we are overall hopeful of some resolution coming out over the next few days. We have seen that the President Donald Trump using these as a hard negotiating tactics for some of the other countries. Otherwise, the other option for India is to look for other trading partners in other regions like the EU, some of the other regions where they can build the business from a long-term sustainable basis.
Okay. Siddharth, hi. AU Small Finance Bank, that will be the stock in focus, universal banking license. Buy the stock today?
Yeah, Rima, hi. So first of all, AU Small Finance Bank, no longer a small finance bank, will be converted to a universal bank. But yes, a big approval for them. I think it is the first small finance bank to get a universal license under the voluntary framework. This is a major milestone, not only for AU, but for the entire banking industry in India. What we believe is that this is expected to not only enhance the brand positioning, it will improve a lot of business parameters, be it CASA ratio, the cost of funds can come down, it will increase access to urban affluent customers. The loan size restrictions will go away, and hence they can scale up to larger ticket secured retail, SME, mid-corporate lending. What it also will do is the PSL mandate will come down from currently 60% to 40%, and hence looking at a better yield on their overall funds. So near-term positives, what we see, credit costs could come down, strong loan book growth, potential to raise capital, and more importantly, a stamp of approval from RBI on the current management. So overall, very positive. We believe AU is well placed to capitalize on this transition, and near-term earnings recovery, potential capital raise, and continuity of leadership would reinforce this positive outlook. So we maintain a positive view on AU. We have a buy rating with a target price of 875.
Okay. All right. Positive view on AU. Got that, Siddharth. We'll take a quick break. Come back to you in just a minute. On the other side of the break, we, of course, have our technical experts joining in as well. We have Mitesh Thakkar as well as Shrikant Chauhan with ideas on today's trade setup.
Welcome back. Awaiting the pre-opening rates, the picture across Asia is mixed. The Chinese markets have opened absolutely flat. Hang Seng, though, has a downtick going for itself. That's down close to about 2/3 of a percentage point. The big headline coming out of Asia this morning is that perhaps the trade truce with China will get extended. Remember, otherwise tariffs on China would come into effect from 12th of August. But now the latest seems to be that this is going to get extended. So the negotiations will continue. So Hang Seng is subdued, China's flat, Japan's the one which is surging, and the Gift Nifty is suggesting a slightly muted open, 32 points lower. Get into break, we'll come back with the pre-open. And we'll also get in some technical trades as promised with Mitesh and Shrikant Chauhan.
Welcome back. 16 minutes to go. Let's quickly get to our technical experts and look at the trading advice for today and, of course, the stock ideas as well. Shrikant and Mitesh, good morning. Great to have both of you in. Mitesh, what's the approach going to be today? I mean, index, stocks, and yesterday we got that great short covering bounce, right? But the issue is, what do you do now? Do you just stick to stocks?
Good morning, sir. Yesterday was very important in the sense that, yes, there was a bounce back towards the end of the day. We closed near the day's high, and also is the fact that we managed to defend the 24,500, 550 range. Very important technical level. So with that, I think, one, in the short term, it kind of gives a floor to the downside. But for a reversal, for a proper uptrend to develop, there's still some more time. The level which I'll watch on the upside is around 24,740, 750, and then 24,950. And the way to trade the index would be, if you get a mild decline during the session, let's say a 30, 40 point kind of a decline from current levels, which is around close to 24,560, 550. That's the time to buy with a 80, 90 point kind of a stop loss and try to take profits around 24,750. And then if it goes higher, around 24,900. So we'll trade with a long bias, but on mild declines. And on the stock side also, I think the bias will be more aggressively on the long side.
Okay, we'll come to your stocks. Shrikant, yesterday, quite the V-shaped recovery, but is there more strength in this up move?
Yeah, good morning, Rima. Good morning, Surbhi and everyone. See, for Nifty, it is tinkering with the level of 24,450, which is not good because the market has spent nearly 3 months above these levels. Yesterday's V-shaped recovery is definitely encouraging, and we need to keep a stop loss at 24,450 for creating any fresh long position on the market, because markets are deeply oversold and almost all the news flows are out in the market. So now again, we need to see that how actually market performs from here, whether it sustains above the important level or not, because quarterly earnings are also almost over, and news flow related to tariff is also almost known to everyone. Despite all this, market manages to sustain about 24,450, then we can expect rally towards 24,800 sort of levels. But yes, we need to be more and more stock specific in this market. Still, the market is not going far away from the levels of 24,450. And for the day specifically, look for adding long position if there is any lower opening with a stop loss at 24,450.
Okay, all right. Hi, gentlemen. Mitesh, you want to run us through your stock picks for the day?
Morning, Nigel. As I said, I have more of buy calls. So there's a buy call on Jindal Steel and Power with a stop at 988. Look for targets of around 1,040. Blue Star is something which I've recommended a couple of times in the last few days as well. Now is a fresh buy with a stop below 1,800 for a target of 1,885. Also a buy on Maruti with a stop at 12,515 for a short-term target of 12,850. Beyond that, we'll look at a bigger target. And one sell call, that's REC Limited. Keep a stop at 390 half. Look for targets of 372.
Okay, buy Maruti, sell REC. Shrikant, your picks?
See, I would like to go with Cummins India, which has reported decent number yesterday. The stock was into a strong pullback mode, but while looking at its entire setup, I am of the view that it is going to surpass its previous high of 4,000. So at this level, also around 3675, 3700 level, it looks very strong candidate to buy for with a stop loss at 3625. And we can expect 3,900, 4,000 sort of levels in the near term. The other stock which we like is Indigo, and it is mainly because the stock is consolidating. It is very close to its all-time highest level. Also, if we go through with crude prices, then they are drifting lower. Based on its overall technical formation, I think the stock is heading for at least 6,250 in the near term. We can keep a stop loss somewhere close to 5,900 for the same.
Okay, all right. Thanks a lot for that, gentlemen. Well, let's do a quick question with Siddharth before we let him go. Sid, from the jewelry companies, what do you like?
Yeah, I think we had the numbers from Titan. The blue chip continues to shine. Very strong start to FY26. Consolidated revenue grew 25%. The standalone jewelry business saw a growth of 17%. We also saw strong contribution from other segments. The eyewear segment posted 24%. The eyewear segment posted 13%. Watch segment saw strong growth of 24%. margins were higher, and I think across segments, overall EBITDA margins expanded 170 basis points due to better mix and also some of the gains. So I think Titan is well positioned to sustain its strong growth, supported by the robust brand equity that it has, continues to do the store expansion, as well as the formalization of the jewelry industry. There has been some hiccups and there is some concerns with regards to the rising gold prices, but I think jewelry in India that continues to shine, and with a strong brand like Titan and a consistent growth that they are able to deliver, we continue to like Titan from a long-term perspective. We have a buy rating with a target price of 4,150, giving more than 20% upside from a one-year perspective.
Siddharth, thank you very much for joining in. In fact, we have the management of Kalyan Jewellers joining in. Strong quarter, more than 30% revenue growth, same-store sales growth of 18%. Kalyana Raman, Executive Director at Kalyan Jewellers, is now joining in. Thank you very much. This is Rima here. Can you sustain this high teens kind of same-store sales growth for the rest of the year? And considering the strong performance, did you gain market share in Q1, and what would it stand at?
Yeah, thank you. So yeah, the revenue growth was good. Q1 revenue growth was 31% consol and in India. PAT also grew by 49% consol and 55% India. SSGs were very strong in the range of 18%. And if you look at the same-store sales growth over the last maybe 6-8 quarters, it has been consistently in double digits, and we don't see anything majorly changing for the SSGs to change drastically. But yes, we are starting from a high base because last year there was a customs duty reduction in Q2, which had a bump in revenue in the last Q2. But we have more number of festive days in Q2 when compared to last year. So we hope that it gets negated partially because of that.
Okay, all right. Hi, Ramesh. Good morning. Good to see you, Ben. Congratulations on solid numbers. So put in some numbers then. What kind of growth should we work with for the year? What kind of margins and SSG? If you could tell us the FY26 guidance.
Yeah, so not as a guidance, but yeah, SSGs are strong in Q1, and Q2 also started off very well. But July last week and August first week are not comparable to the last year because we had a huge revenue bump in the last week of July and August onwards because of the customs duty in the cut last year. But markets, walk-ins are vibrant and store expansion is also happening. So we don't see anything which can change the momentum this year.
% market share percentage as a percentage of the organized market? What is your market share?
So yeah, so organized market share is growing every year. You have seen it consistently. So now we are at what, 7-8% of the organized segment is Kalyan's market share.
7-8%.
Okay, all right. A couple of more factors then besides the operational performance. The promoter entity, a year or so ago, the stock had gone into a bit of a tizzy. You all came in there, showed some faith, bought more than 2% in the company. Do you all intend to increase your stake from these levels? Point number one. And point number two, I recall you all had some land that you all sold and the debt number was supposed to come down. So have you all received the money, and what is the updated debt number?
So debt now we have we have not received any collateral for the amount which we had repaid. Now we have started the paperwork with banks to release the collateral, the land collateral. And when it comes back, then we dilute it again and then repay the loans further. So now, as far as now, we have reduced loan by around 500 crore. And now we have taken a pause because now we are in discussions with the bank to bring back the collateral to us. And once we receive the collateral, then we go to the next stage of reduction of loans again.
So you're talking about
started for the 200 crore worth land from the banks.
So no, you're talking about that the shares that are pledged, is it? You're looking at releasing shares that are pledged, or what is the collateral you're talking about?
No, so first of all, let us separate the company versus the promoter. Promoter pledge has nothing to do with company because it was done only to be a part of the last exit from Warburg. We wanted to increase stake in the company, and Warburg was doing their last block of exit, and we also took part. That was the only area where the promoter pledge was there. That has nothing to do with the company. So company loans, we reduced by 500 crore because company have lot of land collaterals, which was mortgaged with the banks, which we wanted to take it out because the balance sheet is looking heavy.
So what is the updated net debt in the books then? If you could tell us that. And you had sold that plane, right? 100 crores was to be received. That money has come?
Yeah, that is 2 years before, 1.5 years.
That has come.
Yeah. So that's
an updated net debt number, and where is it headed?
So last year we ended at 1,900 crore debt in India.
Okay. And will that number come down by the end of FY26? What's the number we're looking at?
No, as of now, we have taken a pause because we want this land parcel to come out.
Sure,
Once
got
it
it.
comes out, then we go for further debt reduction.
Got that. Your non-South revenue contribution is now 51%. What is the growth between South and non-South, and what could this revenue contribution inch up to?
So the non-South revenue is growing more than South because our expansion is predominantly in the non-South region. We are into a FOCO model of expansion where it's an asset-light expansion. The majority showrooms are coming outside South India. So the outside South India revenue is growing more than South. But the South SSGs are 18-20%, and it has been consistent over the last 6-8 quarters now.
Okay. And talking about your expansion plans, could you tell us the overall store expansion plan over the next 2 to 3 years in India and Middle East? And if in India, if you could break up in South and non-South.
So again, our plan is to open 90 Kalyan showrooms, which out of which 85 will be in India and 5 or 6 will be in international markets. And out of that 85 in India, maybe 9 or 10 will be in South. That is for this year. And this expansion will continue for the next 2 years, almost in this plan only. And over and above that, we have one more format. It is Candier. It's lightweight jewelry. We will open 80 showrooms in India for that also.
Fantastic growth, Ramesh, and the market is really liking everything that you're saying. The stock in the pre-open itself is up about 4%. So congratulations on a good quarter and good luck for the rest of the year. That's Kalyan Jewelers. Let's pull up the stock. We're getting some interesting, early reactions. That's Kalyan. Kalyan is one. Look at AU Small Finance Bank, by the way, as they get all set to become a universal bank here in India. Stock is rocketing higher, 7% up on AU. Otherwise, the market is quiet. I mean, that's exactly what you'd expect. I mean, the day after digesting that big tariff hit, the expiry factor is also over. So the start is very, very quiet. Let's see. For starters, if the Nifty can protect the 24,500 level, that'll be a good start. We'll get back to our technical experts on that note. Mitesh, 9-10, what's the call you'll go with?
I'll go with the buy on Blue Start for targets of 1885.
Okay, all right, Mitesh, got that. Thanks very much. By the way, since I was calling out AU right now, and the stock is up 8% now actually in the pre-open, 7.5%. Let's go back to Gaurav and figure out what are all the benefits that a bank gets by becoming a universal bank, the transition from a SFB to a universal bank. Market is very excited for AU, Gaurav.
Well, definitely, it looks like market is very excited for AU, and there are many reasons for that. Now, AU Small Finance Bank has got a in-principle approval from RBI to become universal bank. Remember, this is the first small finance bank to get such approval, and bank had actually applied for this in September 2024. So it took 11 months for RBI to review and approve AU Small Finance Bank to become universal bank. When it comes to benefit, there are multiples. First is that it will improve the brand's acceptability. It will also help the bank to bring their cost of funds lower, because usually small finance bank, they offer higher deposit cost to attract more deposit. When it comes to the PSL requirements, which is priority sector lending, earlier RBI had pushed the priority sector lending requirement for SFBs to 60% versus 75%, but now for AU Small Finance Bank, it will further come down to 40%. They will also see the capital adequacy ratio requirements bringing down from 15% to 11.5%. There is also going to be increase of avenues in terms of fee income, and also it will aid the customer growth. In fact, the bank was also very optimistic when it comes to growth. They said that until the base reaches around 3 to 4 lakh crores for the loan growth, they will actually sustain 25% growth as they had given earlier. When we talk about brokerages now, they are also being a little bullish on the stock. Goldman Sachs, they have maintained their target price of 979 rupees. They believe that the ROAs can expand somewhere in the range of 10 to 30 basis points. We also have Investec. What they are saying is that with this, there are other benefits as well. First is that this also brings in this also actually eradicates all the doubts around the tenure extension for the current CEO, Mr. Sanjay Agrawal, and this also pushes the potential book value per share accretive fundraising for the bank. When it comes to other brokerages, they are also being bullish. They believe that ROEs can increase somewhere in the range of 300 to 400 basis points in the next 3 to 4 years. So definitely a positive move for AU Small Finance Bank, and we are also seeing this reflecting in the stock price.
Okay, all right, Gaurav, got it. Thanks very much. Let's bring Mitesh back in. Mitesh, very quickly, levels on AU and any of the jewelry stocks, anything looks interesting? Because most, including Titan, Kalyan, most have reported pretty good numbers.
AU Bank is definitely it's done a good correction. It's now at weekly support levels, and in the last 2.5-3 weeks, we have time and again seen the stock bounce back from levels of 720. That being the base, the reversal happens about 756, and I'm then looking at 780 kind of a target. So I think it's definitely heading higher. I don't know how much the opening gap is, but yeah, I think the setup is definitely on the positive side. And on the jewelry stocks, Kalyan Jewellers could be interesting. Again, a stock which rallied to 615, came down to 570, appears to have completed one leg of a correction. I think the stock could bounce back to 610, 615 again. And if it crosses that, then we'll look at further.
Okay, that's a photo finish. The bell goes off. Let's take a look at how we're starting this Friday morning. Starting a little cautious, 30 points lower, 27 points lower. But like I said, it's not too bad. Considering the market defended critical levels yesterday thanks to that short covering bounce. The Bank Nifty is already flashing a little bit of green. The mid-cap index is very quiet at this point, 0.2% lower. The Nifty is just, around that pivot, 30 to 35 points lower. That's what we have. Let's get the stocks board up just to get an at-a-glance view. It's still more declining stocks than rising stocks. I mean, that's something you have to give. But it's not too bad. Bharti Airtel is the one in focus. Rima has been telling us about the prospects of a large trade that we're expecting, in which perhaps the promoters are going to offload some equity. That stock's down about 2%. There's some more weakness in banks and IT. Titan's looking good, 1% higher. But yeah, Rima, I think Bharti Airtel is the stock of the morning. Is that we're seeing it happen now. 1% equity exchange. Stocks lower about 3%.
It's a large size, right? Like 9,000 crore plus in terms of the total exchange. And that's weighing on the stock. And as I said, this is the third consecutive time, the third time that they've done in about 1.5 years. So who knows if more is coming. But that's Bharti Airtel. That's the top loser. Other losers include HDFC Bank. So that's dragging the banking pack overall. Axis Bank is open in the red. Eternal has a cut of about 1%. Hindalco, Sun Pharma, Shriram Finance are a couple of the other heavyweights with a red tick. On the way up, you've got green on the screen for Tata Motors and Hero MotoCorp. Bajaj Finance has opened with strength. Trent has reversed some of yesterday's losses. Nestle is higher in trade. But it's still very, very quiet. I think all the action is in individual stocks, where an AU, LIC, Max Financial, Nigel, these are the ones all reacting.
Well, that's right. Actually, AU Small Finance, from the first tick, it's seen a sharp downtick, actually. It's up only around 3% or thereabouts right now. The news is positive, but there is some selling from the top. As is the case with Kalyan Jewellers, it was up more than 3% in pre-open. That is up only 1% right now. So some of those good numbers, they opened in the green, but they've come off a little bit. A good news flow as well with regard to AU Small Finance Bank. Best Agro, that's one stock that's lower, much lower, with a sharp cut from the broader market. So just keep an eye out on that one, BEST Agro. We have Kitex as well that's selling off. So a big downtick on both those two names. Not sure what's gone on there. But on the flip side, you've got some, I think, favorable reactions as well. You have KRBL, stock is moving higher on very, very large volumes. So just pull up that stock out there. Good move is what we are seeing. LIC as well is doing quite well. You should pull up that stock as well. LIC, KRBL is flying away. That's up close to 10%. LIC, one of those underperformers post its IPO. That one as well has found its way back. And you have Kalpataru Projects. That stock, in fact, is doing well, up more than 5%. GSFC, that's another one that's moving higher on very, very large volumes. So keep an eye out on that name as well. So the market's a little bit lower. Can we take out the yesterday's high is going to be important. Comes in at around 24,635 ballpark.
Absolutely. I've got some more stocks, just spotting them on the screen right now. Look at Coforge.
Yeah.
Pretty weak start for Coforge, almost 4% lower. We'll dig a little deeper into this. There's Page Industries that reported numbers yesterday. Not getting the kind of follow-through, 3% lower on Page. Data Patterns is yet another company which has a defense linkage, which has reported, a weak quarter, actually really weak. Data Pattern, the revenue is down some 75%. Margins have fallen about 500 odd basis points. Stocks down 5%. So that's what we are getting. There's some selling in Shakti pumps. It had rallied, of course, earlier. But today it's opened down. Bharti, even Hexacom is lower, actually, not just Bharti Airtel. Hexacom is also down. Blue Star is losing some more ground, 2% lower. So these are stocks on the lower side. But then on the flip side, PVR Inox, I'm not sure if we have an interesting release today or not, but a nice Friday flavor with PVR Inox, 4% up on that stock. Yeah, looking good this Friday morning. That's PVR. What else? There's Ujjivan Small Finance Bank. Some of the smaller financial names, watch for them. There's a AU rub-off effect as the market, picks up hope that maybe the others will eventually also get their universal bank licenses. So Ujjivan is an interesting one to look at. From the insurance space, GIC, the reinsurer, 6% up on GIC. So on the heels of LIC itself is up 4.5%, GIC is up 5.5%, and even Max Financial, 3.5% higher. So yeah, some up, some down, but net index level, we don't have too much action this morning.
Max Financial also came out with their numbers. So that's, one of the factors behind the stock that's up close to about 3.5%. Vishal Mega Mart, one of the stocks which is going to get impacted by MSCI, that has opened with a cut of about 1.25%. Biocon, numbers have missed expectations. Generics was weak. The generics growth was just about 5.5% on a year-on-year basis, lower than estimates, and that stock has taken a bit of a knock. One of the new listings, Sri Lotus Developers, it had a blockbuster listing, but today it's given up some of those gains, and stock is down close to about 0.5%. KRBL is an earnings reaction. Kalpataru Project is an earnings reaction. These two stocks are moving up on very, very large volumes.
I think NSDL, Rima, talking about new listing, just take a look at that. First day it was up 10%. Some were disappointed. Then yesterday it had a 20% move, and today it's up another 10%. So, for the time being, at least those that had bought in the pre-IPO that were very, very nervous about it, I think they'll still be locked in. But, the stock is up 10%. So, in this, from the listing price, I think it's up, 50%, I think. So
800 was the
800,
issue price.
right?
800 was the issue price, 41% subscription. But just the kind of money, right? DIIs yesterday bought more than 10,000 crore rupees. And these are large IPOs. JSW Cement is open. Yes. Knowledge Realty Trust got the highest ever subscription for a REIT. NSDL saw such strong subscription. Yes. And yet, when primary market is sucking out so much money with oversubscription for large issues, even then for the secondary market, you still have a buy figure of 10,000 crores. That's the power of retail.
I'll tell you what, let's get to a couple of those big numbers. LIC is buzzing on good earnings. Vamakshi joins us to help us recap those numbers. Vama.
Well, absolutely, Nigel. A fabulous set of numbers coming in from LIC, and you're seeing how the stock is reacting in trade today, up almost 4.5%. The new business premium was up almost 5% at 60,262 crores. This has come in higher than what the street was anticipating. Apart from that, when we look at the total APE, which is the annualized premium equivalent, that too saw an uptick of almost 2% this time around. It's a slight miss, but nevertheless, it has come in at 12,652 crores, and this growth is largely being driven by the retail APE, which again has come in better than what we were penciling in. Now, the value of new business, which is the VNB, also saw a good uptick of almost 21%. This has come in higher than what we were expecting, and that bodes well for the company, because the VNB margin as well, seeing an improvement of around 150 basis points. The VNB margin now stands at 15.37% and has come in higher than what we were expecting. So overall, a good set of numbers coming in from LIC, the stock reacting to those as well.
Absolutely, it is. It's surging away 4.5% this morning. Thank you, Vamakshi, for joining in with that quick recap of the LIC numbers. Let's bring in a market master of the morning. Krishna Sanghvi, CIO Equities at Mahindra Manulife Investments, is with us. Krishna, great to have you on. Thanks for joining in. So many headlines, so many moving parts, geopolitics, tariffs and whatnot to digest, and then, of course, earnings. Not easy to make money in this market anymore, right? So what's your recipe, or what's your what's your formulation for making money for the rest of the year? Because it's down to very, very specific stocks now.
Yeah, I agree, it's stock specific, but I think the broad recipe is simple. Can we avoid the noise and look at next 18 months, 24 months, which is typically the investment time frame? We look for companies and to that extent, once you go ahead, some of this noise possibly will come down. Economy keeps on, its own track, which is a reasonable growth rate in the current atmosphere. 6.5, honestly, is not something we should be, worried about. It's a nice growth in the overall context of the world. So that's a real recipe. Keep your time frame right, which is essentially, maybe 18 months, maybe 24 months from now, when some of this noise will go away, earnings will keep on coming. Noise are maybe detracting the valuations right now. So hopefully the combination of earnings and multiples will support the investment hypothesis.
Looking inwards, and we've been seeing this K-shaped recovery for a while now, Krishna. So what are the subsectors within consumer discretionary or staples which look attractive to you over the next 12 to 24 months?
Yeah, this K-shape clearly has supported higher end consumption, within which, something like travel and leisure can be one, nice spot, maybe upper end, discretionary products, maybe durables, maybe automobiles. I think those are, the typical beneficiary of high-end consumption, and we do believe, that stays good. At the same time, let's look at the other side of K-shape. We believe things have improved substantially over last 12 months into that segment of economy, and going ahead, even we expect something like staples also to do reasonably better vis-a-vis their own last 12-18 months history on business performance front, because staples is a place where now the rural economy is picked up far better than what it was 1 year back. So something like that is going to help consumption pattern even in the other side of K-curve.
All right, just hold on to that thought. Now, just keep an eye on Divi's Laboratory. The stock is lower. Overnight we had Eli Lilly's experimental oral weight loss drug. Out there, the average loss was around 12.7%, which is a little lower than the 15%. Now, the street believed that, if this drug did well, it would be a potential opportunity for Divi's in the time to come. So, may not be as big as what was estimated. So, I think that's why a bit of a sentimental knockback with regard to this stock, because of Eli Lilly's oral weight loss drug wasn't, as successful as what earlier expected. So let's see how that goes. And the other one is Ramco Cements. The numbers were a little bit disappointing, and the stock has already had a good run. Volume degrowth higher than expected. That's why that stock is under some pressure in today's trade. But let's get back to our chat with Krishna. Krishna, I wanted to ask you about the real estate space. We were just highlighting some IPOs. And in Lotus, I saw that y'all were one of the anchor investors. What is your view on real estate here in Mumbai? And if you want to talk about the rationale behind this one, it had a phenomenal listing.
Yeah, let's look at real estate. And if I go back to the previous question, that's clearly one more name on the discretionary consumption space, especially higher end. So real estate is one more discretionary space, and yeah, we do own quite a few stocks across, in terms of real estate there.
What else do you like, Krishna? Are you seeing value anywhere?
Value in the current market, honestly, is slightly challenging. It's not that it's not there. It's just that, there are certain pockets which are value, unfortunately, not able to spot a catalyst for a quick, realization or monetizing that value. That's where the idea is, again, to keep slightly more longer term focus. That 18-month, honestly, to my mind, is right time frame. Let's face it, markets are pretty much at same level for last maybe 12 months or, this roughly 25,000 Nifty is what we were a year back. Today we are. So in a way, value is emerging partly from, time correction. At the same time, we need little bit more earning support. And that's where, value, I think, is little bit one has to wait for that value to be monetized rather than upfront. Other side of the market, clearly slightly more momentum, which is also, it's one more way the market plays out right now.
Okay, I just wanted to clear that point. In real estate, you're positive, right? I mean, when I asked you about Lotus and the money you'll put there, real estate is one of the sectors you're positive on?
Yeah, as I said, real estate is one of those, discretionary, K-shaped beneficiary of India is earning more, Indians are spending more. It's maybe combination of lifestyle as well as, earning growth combination.
Okay, all right, Krishna, appreciate you stopping by and giving us those, your take on the markets. For the time being, the markets have moved to the low point of the day. We're down close to 60 points. till yesterday's close protected, I don't think the street will be too worried about. But I'll tell you what, a couple of these good numbers are getting sold into. And Kalyan Jewellers, just take a look at that stock. It's corrected close to 8% from the high point of the day. AU Small Finance Bank, very, very good news coming in there. But from the highs of the day, the stock is up less than 2% the last time I
But
checked.
NSDL has gotten stronger.
Yes.
I think it was up 10% when you spotted, now up 15%.
Yeah, I think that the float factor as well will play a role out there, because those that took in the pre-IPO, I don't think they can sell, and the float as is will be limited. But that's a 50% return from its IPO price.
The SC's also slipped, by the way.
All the good earnings.
All the good, where it wasn't a blockbuster, but good number.
Yeah. It also tells you something about the market's mood and overall sentiment, right? Till this is resolved, this whole 50% business. Because wherever there is a pop, people are rushing in today to take profits. That's the psyche of the market. Look at the mid-cap index. It started with a small positive flash, but now the mid-cap index itself is down about 0.4%. Nifty is at the morning lows as well. So, yeah, it's still weighing on sentiment till we have some more clarity.
All right, let's focus on Uno Minda. We have Sunil Bora, the Group CFO of the company, who joins us on the show. Hi, Sunil. Good morning. Good to have you as always. Before we get to your numbers, let's talk about the crucial issues. Trump's tariffs, how are they impacting business? Have you got some feedback from customers? I think 11% of your total mix comes in from international market. How much of it is from the United States? And have you received feedback from your customers?
Absolutely. So in terms of the exposure to US of our total revenues, it is less than 2% as we speak. So definitely it's not a significant quantum if we look at the top line perspective. And also you asked in terms of customer feedback. So definitely customers so far have been very positive in terms of the total revenues. In fact, our sales in the last quarter has actually been better than what they were. And we are all, I think, in the wait and watch mode as to how things will eventually pan out, because the businesses cycle we are in, it is, auto industry is something where when you have to get into a business, it's a long cycle. And I'm sure at the same time when you have to sort of replace your suppliers. So it's not something which you can switch on and switch off overnight, because there's a long time to develop the product and then get into a new model launch, and then you are part of that entire life cycle. So from that perspective, I think from auto perspective, specifically from tier 1 perspective, it's very difficult to say what will be the immediate impact. As I said, it's a long cycle.
Yeah, but Sunil, having said that, can you just tell us right now, exports as a percentage of your total top line annual revenue, what would that number be?
Yeah, so that's what you just said. It is roughly around 11%. And when you say
11%,
it is export plus our international revenues. So we have some assembly operations or manufacturing operations outside of India. So as an overall pie, it is roughly around 11% of our...
11%, got it. So now, given that there are, big shifts happening, supply chains seem to be realigning because, and for us, maybe there's still a negotiation on, and we'll see if we settle at 25% tariff. But it seems that 15% between the EU and US, etc., those things seem to be fairly settled. And the ASEAN tariffs, they seem to have settled. There's no further negotiation there. So because of all of this, can you give us some more perspective on what you're expecting from your overall international business, exports plus international? Are you getting more inquiries? Will you have to make any kind of shifts in terms of, the areas you're manufacturing at?
No, absolutely. Actually, our exports are actually doing, if you see in absolute terms, doing much better than what they were on a year-to-year or quarter-to-quarter basis. In fact, at ASEAN, if you remember, last year we commissioned a new plant in Vietnam. As we speak, there is a new plant under construction in Indonesia. So our ASEAN business is actually doing pretty well. Europe business is stable. And there are some exports which are happening from India to Europe, ASEAN, and to US. And as I said, US is definitely a very small number, and there is not much of export from other geographies to US. So from that perspective, we are quite insulated.
It's not a big impact, 2%, but you still don't want to lose 2% also, right, Sunil, of your overall revenue?
That's what I said. So as I said, as of now, our numbers are actually looking better than what they were. And when you see auto tier 1, it is not something which I'm maybe repeating, switch on, switch off to one supplier to other supplier. It's a long cycle. So even if the customers for a moment, if we think has to maybe look for some other source, it's a long cycle. And things are so volatile
Assuming you have the order, Sunil, there could be some margin pressure. It's ultimately a very large tariff burden to be shared by one entity. To be taken up by one entity, it will have to be shared. So in that context, do you see any kind of margin pressure? Because your reported margins ex-incentive was also about 10.7%, not close to the 12% that you reported.
Yeah. So as I said, it's little early to comment on the cost pressures. Our numbers are actually better. And to whatever indications we have, our customers as of now have not even sort of came up and said, how can we sort of share this? So because I think they are also in the process of digesting the impact and how this can be sort of panned forward. And they will, I'm sure, also look at other options. So it is not that only India is impacted. There are other geographies also. There is a tariff. Yes, there might be a differential, which we all know will kick in from 27th of August. But still, I think there is some optimism that something might come out of this discussion.
Okay. What is your content per vehicle for ICE? Last time it was 12,000. What is the number in Q1?
No, for ICE, if you are referring to a PV or a two-wheeler.
Two-wheeler.
So two-wheeler is ICE content is same. We have not added any significant number. So we disclose the numbers on annual basis. So the number which we declared in the last quarter remains the same.
Got it.
Let's talk overall growth and margins as well, Sunil. So in the first quarter, you've done about 16% consolidated top-line growth. Margin is at about 10.7%. What's the outlook in terms of how pricing is moving in the domestic market and, of course, raw material and costs, etc.? What can you tell us about the future of margins for the rest of the year?
Yeah, absolutely. So as we have guided, our annual margin range guidance is roughly 11% plus minus 50 basis points. And we are within that guidance range on an annual basis. So quarter to quarter is very difficult to comment on. That's why we give a annual margin, because normally whatever price discussions, etc., are happening with the customers, normally they get close towards Q3 and Q4. And that's why if we see our trend for many years, normally Q3, Q4 tend to be a little better than Q1, Q2. And that's why on an annualized basis, it is 11% plus minus 50 basis points. In terms of cost pressures, as you know that large part of our commodity businesses, commodity cost is actually passed through to our customers. It's upcycle also is shared with the customers, and even downcycle we don't tend to gain anything. So from that perspective, we have tried to insulate the business as much as possible from the commodity price volatility.
And what can you tell us about revenue visibility, considering you're saying, I mean, your international business is absolutely not impacted by what's going on. So that's pretty steady. What about the growth in the India business? So total top-line visibility, can you share some sort of a guidance for us for the full year?
Yeah, so absolutely. As you would have seen in past also, we have been very clear. We never give a headline number in terms of revenue, because we are completely dependent on our customers. So we have been consistently saying whatever market grows, we grow at least 1.5 times of the market growth. And if you see even the last quarter, the large part of the business, which is our 92% of the business from two-wheeler and pass car segment, which has grown 3% and 1%. On average, 2% is the industry volume growth, whereas our growth, as you just said, is roughly around 16%. So that clearly demonstrates the outperformance. And if you plot that for past many quarters, many years, I think we have been consistently outperforming the industry growth, and we're quite optimistic we should be able to continue that in the near future as well.
Okay, all right, Sunil, we'll leave it on that note. Thank you for joining in today. Good luck for the rest of the year. And we look forward to more conversations in the future. I have to take a quick break. The market, Nifty is down about 80 points as we speak. The mid-cap index is down about 0.4%. We have an eye on the screen, but after the break, we come back and get chatting with the management of Titan. Mr. Ashok Sonthalia will join in. Welcome back. Well, we're looking at the market, which was a little subdued this Friday morning, but we've got plenty of earnings to go over. And another good set that came in was from actually Titan. In fact, if we talk about the Q1 performance, it was a pretty decent quarter. Margins have been looking stellar, and the watch business is also growing. In fact, if you talk about the overall revenue, then an increase of about 21%. EBITDA margins at 34.8% coming in, improvement in the gross margins as well. We have Mr. Ashok Sonthalia, Chief Financial Officer at the company, joining in to take a couple of questions. And Mr. Sonthalia, thank you so much for joining in. So, first things first, let's get, your pulse check. Now that we're entering festive season, we were just discussing this, right? It starts off with Raksha Bandhan, then Ganesh Chaturthi, and then the full-blown season. What's your sense of demand, sir? I mean, let's talk pure jewelry business. What are you gearing up for as we enter the festive phase?
Of course, Surabhi, we are quite excited and looking forward to it, but we cannot ignore the kind of volatility which gold prices are exhibiting, and if you have picked up today's news again, that the whole global supply chain from Swiss to US has been, so every day there is a new thing, happening, and which keeps buyer growth for gold jewelry under check. They are quite flattish, and that's a little bit concerning for us, that while we are doing everything to experiment with 18 karat, 14 karat, and carat lane, even doing 9 karat gold to keep the price point for end consumer more affordable. But this volatility has to stabilize, because any volatile environment keeps consumer sentiment.
No, sir, could you complete that point? Are you saying that demand is subdued so far in the second quarter? Are you expecting it to be a slightly more subdued season then because of the volatility? And you're saying you're doing everything. You're experimenting with even 14 karat, etc. But are those experiments working?
So of course, through the price point and ticket size, we are able to deliver growth. And on that, we don't have doubt. We would, of course, like buyer number also to grow, which is not happening, which is happening in the studded. And July month, because we had our diamond festival started early. So July month has been doing well as far as diamond jewelries are concerned. And to that extent, gold is still finding favor from the investment point of view and adornment point of view. But buyer growth is muted at this point.
So if I ask you like to like, as we get into, because Q3, there's no point saying Q3 or Q2 because the season keeps moving. Yeah. As of now, the visibility that you have, like to like, festive season to festive season, how much growth are you expecting? 15, 20, less, more? We're just trying to get some sense.
Mid-teen seems to be okay. It can be slightly better. We don't know yet. But we think mid-teen should definitely be possible.
Mid-teens. Okay. What about margins? You expanded your jewelry margins to 11.5%. What led to that? And going ahead, given all that we spoke about in terms of uncertainty, what is the expectation on how margins will play out? Because even the buyer growth in gold, you said, has been a bit subdued.
Yeah, so margin performance had one-time benefit in quarter one. We called out 50 basis point, which will reverse itself in quarter two and quarter three. But as far as overall margin is concerned, our guidance on jewelry domestic business has been 11 to 11.5 for Titan standalone basis. And that guidance we are still maintaining. But at the same time, I must point out that growth, market share gain, customer acquisition is at this point of time highest priority. And for that, if some tactical call have to be taken, we would not hesitate in taking that. And if that means that margins slightly go, instead of 11, 10.8, that's okay.
So there could be a downward bias to your margins. Your guidance is, aspiration is 11 to 11.5%, but given the focus
has to be taken, we will take some calls because growth is far more important at this point.
Okay. So focus on growth over margins.
All right, Mrs. Sonthalia, hi, good to have you, Ben. Tell us about the acquisition of Damas. You'll have done 67%, I think, for a value of around 2,400 crores. The last year did close to around 3,400 crores of revenues. What is the scaling up of this business, say in the next 2-3 years? Where do you see this revenue number headed? Point number one. And when you purchase the remaining 33% stake, at what valuation will it be at?
Okay, so the 67%, yes, we have purchased, and we are kind of repivoting the brand to more Arab customer focused brand. Right now, it has both Arab as well as Southeast Asian, Indian, and kind of so that repivoting, Nigel, for next 12 to 18 months, some restructuring of the network, etc. Will kind of after that this should grow. Currently, they have high single digit to low double digit growth rate in the past. But next 12 months, I see some readjustment happening. But beyond that, double-digit growth should come. UAE as a territory is doing pretty well. Saudi Arabia, where a lot of social reforms and economic developments are happening, that's the another important market for the mass to grow. Yes. And we believe double-digit growth should be coming. As far as next 33% after 4 years is concerned, it's a profitability-linked complex formula, will completely depend on performance. So at this point of time, very difficult to kind of put a number to it.
What EBITDA does it do?
Right now, it is just low single-digit number. Just has positive territory. That's it.
Okay, and obviously you'll be looking at scaling it. As you grow in this double digits, you'll have an aspiration to take the margin to double digit.
Certainly high single digit to low double digit. It's some work has to be done, Nigel, and I think we have a lot of synergy on the sourcing, merchandising, retail operations. So in a combined ecosystem between Tanishq and Damas, we see a lot of value accretion possibility.
Next 3 years, Damas could be nearly 5,000 crores of revenues with high single-digit margin. That could be the aspiration, right?
Okay. Yeah, we have not yet finally penned that down, but that seems to be very reasonable.
So your watches division margins were quite high this time, 22%. But I believe there is some one-off inventory gain. What are the adjusted margins? And do you think you can, you're given a guidance, I think, of 18 to 20% on margins for watches. Does that stay, or do you think you can push it higher?
So adjusted margin for quarter 1 for watches is about 18%. 400 basis point one-timer is there. We had guided about 12.5 to 14.5, Sonia, if you remember. But we think that FY26 will be slightly better than that, maybe mid-teen. Because again, this 4% will reverse in quarter 2, quarter 3, and quarter 4. Because when this inventory gets consumed for sales, this kind of will hit P&L. But it's not a very, very large number. So we still mid-teen EBITDA number from watch division is certainly possible.
Okay. All right. So we'll leave it on that note for today. Thank you so much for joining in and giving us some perspective on the business. And we look forward to more conversations down the line. Well, on that note, let's quickly do a check on the market. And the market is turning for the worse now. 24,500 is in question. Let's see. We need to see if we can protect, of course, yesterday's lows. Right now, it's a 100-point cut on the Nifty. And the mid-cap index is also down about 0.6%. So the color seems to be red this Friday morning. Rima.
All right, let's move on. We've got lots of companies to chat with. So Metro Brands, they reported a steady quarterly performance this time. Nissan Joseph, CEO at Metro Brands, is now with us on the show. Thank you very much for joining in. You've clocked in about a 9% kind of a top-line growth in the current quarter. You'd spoken, the aspiration, sir, has always been sort of a 15% revenue CAGR over the medium to long term. For FY26, what kind of growth can we expect? And how is the consumer sentiment and the same store sales growth for you?
Yeah, I think, good morning and thanks for having me. I think as we look forward, we see the quarter starting to maintain the momentum and maybe build a little bit towards the back end. But I think what's important to note here is if you go back to the pre-COVID quarter of 2019, we were up 101% over that quarter, and that is a 12% CAGR if you look at that period of time. And I'm also including the COVID year in this. If you pull that out, it's definitely coming into our guidance of 15%, the mid-teen range. And I feel confident that, whether it's this quarter or next quarter, we will start getting back to that 15% gain.
Okay, so you should build on the momentum and get to 15% kind of a revenue growth. I'm presuming that's the festive season push also. So Q2, Q3 should see a 15% revenue run rate?
No, that's not what I said. I said, we will get back to that 15% CAGR growth. But we remain quite confident about what's happening with the economy, what's happening with our business. We've had 2 quarters where we've had almost double-digit growth. In an environment that hasn't been the same for a lot of our peers. So I think we'll continue that momentum trend and we'll start building back towards it.
All right. And the long-term margin guidance of around 30%, you can hold on to that mark?
I think we've always guided to a long-term CAGR of 15%, Nigel, and that's something we're very comfortable with.
Now, on the margin parameters, what I'm asking you.
On the profit margins, we've guided to mid-teens on the PAT margins, and last quarter's a good example of that. We were well into the mid-teens in
Yes.
profit margins, and that's a guidance that we're very comfortable with in the long term. Would it go a little bit left and a little bit right as we make investments into new businesses, into marketing initiatives, into people investments? That it might do a little bit, but overall, that's what we have guided to.
How many stores are you planning to add, sir, in FY26?
So last quarter, we added 23 new stores, though we closed 3 stores. And we're starting to see momentum build up on the new store front. And we're pretty confident that we'll get back to a decent run rate. I think what's exciting in there, though, is that last quarter, we opened 4 walkway stores. And, it's a chain that we haven't been doubling down on a lot. The previous year, in the full year, we only opened 4 walkway stores, whereas in the last quarter, we opened 4. So we've already matched what we've done the year before. And we intend to quite grow that channel quite well as well, on top of our Metro Mochi and our Crocs. And of course, we now have the Foot Locker chain and soon to come Clarks.
Okay, all right. Give us a few more details. When does Fila break even?
Fila is breaking even. We've gone through the cleanup phase of Fila. We're now in the repositioning phase of Fila. And the only reason it may not is, we're going to distort quite a bit of our marketing investments into Fila, as you have to when you reposition a brand. It's not a cheap exercise, but it has long-term benefits to it. So, Fila, if I pulled out the marketing spends that we plan on doing, is definitely a break even already. Now, the question is, how much of the marketing spend do we do and when do you get it? And there's always a little bit of a lag, Nigel, between when you spend and when you get. So we're quite comfortable with that. And that's what I alluded to earlier. You might see our profit margin blip this way or that way, left or right of the mid-teen mark, but it would only be because we're starting to, make investments into technology or people, or more importantly, into marketing.
Interesting. Let's, Fila, we'll keep an eye out on that journey. But Fila, Foot Locker, New Era, they're still small, right, in your scheme of things. What do they contribute right now? And where do you see that number headed?
Yeah, so as you said, they're very low single-digit contribution if you add them all up together today. However, when we look to the future and we see what's happening in the athletic space, when we see what's happening in the casualization space, the athleisure space, we feel pretty good about all those 3 businesses being a substantial part of our revenue as they grow, albeit it'll come in stages. It's not going to be an overnight thing happening because we don't intend to slow down the other businesses as well, right? It's not like we're stopping everything else and we're growing this. We plan on growing everything quite aggressively and quite equally.
Okay. Correct me if I'm wrong, but I think your quarterly sales per square foot has declined in Q1 by nearly 3%.
Yep, that's absolutely correct. And what you're going to see is that number is also going to blip. So, for example, the more walkway stores we open, that number is not as strong in the walkway chain as it is in a Metro chain or a Crocs chain. It is really more a reflection of the mix of stores that we have as opposed to, the actual sales per square foot. If you look at the top line numbers, we have been growing, so that is not a major concern on our part. But that's a number that is going to seem a little erratic from time to time, simply because it's heavily weighted towards what the stores do in terms of new stores opening and which one of our chains is having which one of our banners is having a little bit more of a accelerated growth versus the others.
So does that mean that your top line growth is largely going to be driven by an increase in the retail store addition that you do?
No.
Is that going to be the driver of growth?
I think we have a 3-pronged strategy for growth. One, of course, is same-store sales growth. And as you know, the same-store sales growth for all of our industry has been a little challenging these last 2 quarters. But I must tell you, though, don't forget, we've had a 15% CAGR growth, even with last quarter's number, over since COVID. It was 12, but if you pull out the COVID year, it'd be closer to 15, right? So it's not like, and that 15 would have an element of same-store growth in there. So it's not just new stores. So it is same-store sales growth, it is new stores, and it's of course new banners as well.
Always a pleasure having you on the show, sir. And your first quarter, what was important was also your e-commerce business did return to the growth path. Thanks a lot for joining in. We'll track you on some of these numbers. Well, let's get back to the markets. The Nifty has moved to the low point of the day. Mitesh Thakkar is back with us. Mitesh, is this the breakdown, or would you be brave enough and say we held yesterday's low? So maybe, in fact, go in there, buy it and put a 100-point stop loss. Or do you think we're going to break down?
Nigel, initially the idea was that I was looking to buy a 30-40 point kind of a dip, but then there was no recovery happening. And we are back to this weekly average of around 24,420-25 zones. So maybe around those levels, you would want to take a long with a 50-odd point kind of a stop. I believe that that's an important level. Good chance that we could see some kind of a bounce back from there. And on the stock side, I have a buy on LIC India with a stop at 902. For targets of around 945 to about 950. While on the selling side is Nykaa with a stop at about 209.5 and a target of 200 is what I would look for.
BSE, Mitesh, is there any trade on BSE? Stock has slipped about 4% from highs, and this is despite seemingly good numbers.
Yeah. So there were two things. One, I think, BSE I'm watching very closely. On the last two occasions, if you look at the 2-hourly, 3-hourly charts, the stock made a closing bottom around this 2370 mark. So if it starts breaking below 2370, 2360 zones, good chance that we will see this decline kind of accelerate and head towards levels of around 2175. So my advice to traders, if it breaks 2360, take a 35-point kind of a stop loss and play for another about 150, 160 points.
Kalyan Jewellers, the fall is uncanny. Look at it, 7.5% down on Kalyan Jewellers. On numbers that seemed optically very good, 30% plus top-line growth, margins inching a couple of basis points higher, and that's what the stock has done. Total reversal from the opening. Mitesh, we discussed this stock, and at least in terms of the chart structure, at that point you were saying it was looking good, but now something's gone off. Just a quick level check again and what people should be doing, those who are holding long.
So in the morning, I said 610, 615 is the earlier high, and we could see the stock head towards that. In fact, opened around 615, and then from there has been a clear case of profit booking. It's broken a key support around these levels of 575, 570 zones. So if you are stuck, if you get a pullback to about 570, exit. Otherwise, I believe that with this kind of a candle which is forming today, this could suggest a retest of levels of around 520 to about 510, which is where the stock had bottomed out in June.
Okay. Got that. Thank you very much for that, Mitesh. We'll reconnect. Let's move on and talk about State Bank of India. We'll be reporting numbers today, big one. Gaurav joins in with the key expectations. Gaurav.
Well, yes, when we talk about State Bank of India, now loan book growth is expected to be in the range of around 12% on a year-on-year basis, while deposit growth may remain somewhere in the range of 10%. So definitely there are expectations that State Bank of India will actually outpace the system level growth. And as a result, when we talk about net interest income, we may see an increase of around just 1% on a year-on-year basis. And we may see a little bit of decline on a sequential basis because of the pressure on cost of funds now that repo rates have been cut down. When it comes to operating profit, we may see an increase of around 3% on a year-on-year basis because operating expenses are likely to remain muted. But as a result, when we talk about profit, we may see a decline of around 2% because credit cost that may inch up a little. When we talk about net interest margins, 10 basis point of fall is what the street is expecting in this quarter because of the rate cut impact. And for credit cost also, they're expecting credit cost to actually normalize somewhere in the range of 0.5%. And this is because when we look at Q1 specifically, it is usually weaker for agri segment. Talking about the other aspects, we will be watching out on how the commentary is going to be on net interest margins, because earlier management had said that they will be trying to keep net interest margins in the range of 3%. Other than that, any kind of commentary on the loan book growth is also going to be a key thing to watch out for, and any commentary on the asset quality is also something that we will be watching out on. Although the earnings season is almost over, it is very crucial as how SBI sees asset quality spanning across, because it is the largest bank of India. So definitely these comments will be important. But for now, numbers are expected to be muted in this quarter on a year-on-year basis.
Okay, all right. Thanks a lot for that, Gaurav. We'll keep an eye out on that set of numbers. Well, for the markets, We are holding onto that cutoff around 110 points. The Nifty Bank is well 150 points lower. The breadth of the market isn't as bad, actually. You still have close to 1,000 stocks that are advancing. Well, let's focus on Crompton now. They reported a weakish set of numbers in the first quarter. Revenue growth was impacted by weak performance in ECD segment. We're joined by Kali Swaran Arunachalam, the Group CFO and Head of Strategy at Crompton. Hi, sir. Good morning. Good to see you in. Well, the first quarter was a little bit subdued, but are there signs of green shoots coming back now? We're close to halfway into the second quarter. Obviously, the second half of the second quarter should be far better because it'll be pre-festive. But are there signs that demand is improving and you'll return back to your growth ways?
Hey, hi. Even before looking at the second quarter, I also want to throw some color on how did the first quarter go. It's important to note that we are a company that relies on season, on categories like table, pedestal, wall fans, and on air coolers. These categories had a very weak summer due to unseasonal rains that we had to go through. That led to drop in the business of these categories. But what is very exciting is that categories that are not impacted by that, our growth rate continues to be excellent. We doubled our solar pumps business, our small domestic appliances, which we have been consistently talking about in the last few years, continues to grow at the rate of 18-20%. We are also seeing our categories which we wanted to revive the growth, whether it is lighting or butterfly, is back on track with both growth and margin improvement coming in. All in all, we see that the business is moving in the right trajectory. It's also important to equate this with market share. We have seen, in spite of impact due to unseasonal rains, market share in our core categories have also gone up, which means that the direction is right. We know that we are set for a good full year, and we can already see the momentum picking up for festive in kitchen categories already, with very strong growth coming through.
So that's the important aspect. Kali Swaran, thank you for joining us this morning. So yeah, let's put Q1 behind us. I think it was an industry-wide phenomenon. Everybody faced that pressure of the unseasonal rains. But now this is a huge business for you. I mean, it's over 1,500 crores of revenue, your electrical and consumer durables business. So what visibility do you have on the growth, on the pickup? Since the first quarter has been so bad, will the full year be flat in best case, or are you hopeful for at least some sort of a maybe single digit, if not double digit growth this year?
No, I think we are anticipating a growth in the full year, and we are holding on to our full year numbers at this point of time. The thought process is that while there are few categories that got impacted, the growth momentum in other categories is really, really good. And that should help us to recover and get back to the growth trajectory. And the anticipation is to end the year very strong and go back to a similar growth rates of last 2 years.
So what does that mean? I mean, in terms of, you could just remind us of the last 2 years of growth. And you're talking about particularly the ECD category or overall top line growth? And what can we work with?
ECD. We are expecting ECD to get back to a double-digit growth. And that's what we are looking at this point of time.
And what happens to margins for this business? Again, I'm repeating for the benefit of our viewers, ECDs, electricals and consumer durables, that is the lion's share of the business for Crompton. The margins for this segment and pricing as we get into festive season, what can you sort of guide us towards?
See, interestingly, even in Q1, if you look at it, we held down to our material margins. We took the prudent decision of not discounting significantly when the growth is impacted largely due to unseasonal rains. So that helped us to hold the material margin right. And it's the operating leverage that did not kick in. As we move forward, we wanted to ensure that the same principle gets applied. And our overall EBITDA margin that we delivered for last year should be there for the balance of the year.
Okay. Morning, this is Rima here. So talking about growth and looking ahead, you're also planning to get into adjacencies. I think switch gears is something that you are looking at. You're rethinking your Nirlab business because it's not provided the kind of synergies that you were hoping for. Sorry, I'm making a mistake over here. But I believe you are looking at some sort of, increasing the categories or trying to get into, more, segments. Could you give us an indication of that?
Yeah. See, first and foremost, we have announced already that we will get into solar rooftop. This is something that we made an announcement in the last quarter. This is a very high target addressable market available to us. And considering the kind of success that we have got in solar pumps, we think there's an opportunity to replicate the same here. And today, if you look at it, Indian homes need a brand that is trusted. And a large part of Indian household has grown with Crompton over multiple decades. And if it is going to come from the House of Crompton, a solar rooftop is something that people are really would be appreciating it and accepting it. And we think there is good amount of headroom for us to grow there. Even if I look back at the acquisition that we made on Butterfly, we are into our third year right now, and the business is back on growth track. Margins are improving in Butterfly, and the new launch or the brand refresh that we did in Butterfly recently is also showing us good results. Outside this, we are also looking at few more categories. Allow me to communicate about that in detail closer to date. But yes, fundamentally what we are looking at, is there an opportunity for us to expand our total addressable market by 2 to 2.5x from where we are today. So we are looking at few large categories where we have a right to win. It's also important to note that whenever, wherever, whichever categories that we enter, we are not going to operate as one more player. Our endeavor is, can we become a top 3 player in these categories over a period of time? The success on this has been demonstrated in the past. Today, we are a market leader by a mile in fans, and so far.
Just very quickly, sorry, I'm cutting you because we're running short of time. On Butterfly, the performance has been improving, like you said. Can you give us some sense on, aspirational margins? Eventually, as things settle, at the EBIT level, not EBITDA, I have the EBIT margin number here. I think you're at about 4.2%. Where would you like to see, or where do you think Butterfly margins can settle by the end of the year?
I'll start with EBITDA first. Our EBITDA margin has been on a continuous improvement trajectory. Step one is to hit a double-digit EBITDA margin in the next 2 to 3 years, and from there move on to a double-digit EBIT margin also. So business is going to be very, very strong performance in terms of revenue growth. And once the operating leverage kicks in, we do see that will help in expanding the EBITDA margin also. So the idea is to hit a double-digit EBITDA first, and then move towards EBIT also being a double-digit.
Okay, all right. We will leave it on that note. Thank you very much for joining in, and good luck for the rest of the year as well, especially the festive season. Thanks for being with us. That's a word from Crompton coming in. We do have to take a very quick break on that note. Come back on the other side, and we'll have Manisha joining in, focus on the commodity space. Welcome back. Let's look at the commodity markets now. Lots of headlines coming in there as well. Let's go across to Manisha. Manisha, it's Friday. What are you tracking?
Well, I'm looking at gold and it's at all-time highs, but for all wrong reasons this time around. You know, it's tariffs yet again, and that really seems to be leading to disparity now in case of gold. So when you look at the COMEX December US gold prices, they hit a record highs above 3,500. When you look at the charts, we can see those prices at 3,550 as well at one point in time. But when you look at the spot gold prices, this is where London looks at it. It is trading still at around 33.80 or thereabouts, while COMEX is now trading at 34.90. So the discount or a premium, depending on which market you're looking at it from, now stands at $100 an ounce. When you look at the Indian gold prices, well, we are trading at all-time highs. Now we are looking at 1,02,000 rupees, and this is just for 10 grams. So clearly, 1 crore and 20 lakh rupees when you are looking to buy 1 kgs of gold there. What has happened overnight is, and markets are really reading into the fine print here, US has imposed tariffs on import of 1 kg and 100-ounce gold bars. Now, much of this import that US does comes in from Switzerland. And remember, there is a 39% tariff that you have on Switzerland right now. Now, 1 kilo gold bars are the most traded form on COMEX and is the reason that you have seen that very big disparity come in for gold prices, the run-up that we saw as well. And let me remind you that we were talking not too far back on how US seems to be importing record number of gold. January was such one month. Feb was okay. March again, we saw very strong imports coming in. So the first quarter of the calendar year has seen very strong imports into US. Now, from where we stand in sense of numbers is that you could be looking at an increase in sense of tariffs that the US consumers clearly will have to pay. When you look at 2024, well, the US imports gained up by almost 5.5%. Value-wise was at around $16 billion there. When you look at volume, well, that of course has seen a decline because the way the gold prices surged up. So 12% decline in volume, but a near 6% of gain in value is what we are seeing in gold. It has been only a day, 24 hours to be exact, that we've seen this kind of a move come in for gold. It would be interesting to see today on how London opens and then how US opens in sense of gold and how do we really work the maths when it comes to the global gold prices therein. But that's about gold. I also want to quickly make a point about crude oil prices because we are heading for a weekly decline of 5% into this one. It's trading at a 1-month lows right now. $65 an ounce is where we are looking at WTI crude prices trading at this point in time. And this has been a worst weekly decline, pardon me, that you have seen in case of crude oil prices since the month of June. So the US and Russian presidents could be meeting in days to come, and that has taken some premium off the prices there. Interestingly, with the kind of OPEC production increase that we have seen, that seems to be weighing onto the prices too.
Thank you very much for that. Market sliding at the day's low now. 150 points gone in the Nifty. The Nifty's at 24,450. A level to watch will be yesterday's intraday low of 24,344. We're 100 points away, but that will be a key marker. Get into a break. On the other side is a special segment. Lata will speak to Mukesh Kumar Surana, former chairman, managing director of Hindustan Petroleum, to understand the dynamics of Russian crude versus US crude.
Welcome to It's the Economy. The root of India's standoff with the US is that India is buying Russian crude and thus supposedly fueling the war. That's the allegation. Now, why is India preferring Russian crude? What is the price advantage? What are the other sources India can buy from? Will it be too expensive to buy more from the US versus Russia? For a 360-degree perspective on India's crude import economy, I'm joined by the best in the business, Mr. M.K. Surana, former chairman and managing director of HPCL. Mr. Surana, good morning and thank you very much for your time. What I'm getting into is, a masterclass on how we should understand crude. So the first question really is this: how much cheaper is Russian crude? I did elementary research from that PPAF, the site you said, the Petroleum Producers Analysis Cell. It says Russia is our top supplier as of the first half of 2025.
Good morning to you, Lata, and to your viewers. If we go back slightly, we were hardly importing anything from Russia, let's say around 2-3 years back. It was only 1 to 2%. But slowly, gradually, because of the economic advantage, because of other concerns to have the total demand-supply balance of the crude supply from Russia increased to India. And right now, it will be somewhere around 35%. Initially, when the Ukraine-Russia war started, there was a reason for the suppliers to dispose of the crude which they were already having. Traders were having inventories, and there were uncertainty, and the discounts were high. But as of today, those discounts have tapered down, and this may be in the range of, on the landed cost basis, maybe around $2 to $3 to companies, considering all the things.
Okay, so about $2 to $3 cheaper per barrel for the company, for refiners as of today. That is Russian crude, right? Okay, then the next thing I picked up from the PPAF is India's top 10 crude sources. And that is, Russia is the most, of course, at the moment. Russia, Iraq, Saudi Arabia, UAE, US, Nigeria, Angola, Kuwait, Brazil. Now, that list gives the impression that nearer the country, cheaper the crude. Is that a good assumption?
Yes and no. Because when the refiners buy the crude, it is not just the price. Each crude has got a quality, and what we term in technical terms is a gross product value of a crude. So when the refineries evaluate a crude, it is a combination of the price of the crude, the freight, insurance, plus the gross product value, that what that crude will give in terms of products to us. So there is a possibility a costlier crude may give better value products, and that may be a preferable crude as compared to others. So ultimately, it depends on what is the gross value, and that depends on the type of the crude, whether it is sour crude, whether it's sweet crude, whether it is heavy crude, whether it's a lighter crude, and what is the configuration of the refinery. The same crude may give different values to different refineries depending on how complexity they have built in their refinery processes.
Okay. Well, I'm sure you know the HPCL refinery best, but you would know the other BPCL, MRPL, IOC as well. What is the best, how are they configured? Which is the best for us? Is sour best, sweet best, heavy best, light best? And going by that, which is the best destination source for us?
So the question is that if you see just fundamentally, theoretically, a sweet light crude will be easier to process. Okay. And that will be a preferable crude. But there is a arbitrage available, there is a price gap available between sour and sweet crude. So sour crudes are normally cheaper compared to the sweet crude. Now, over a period, Indian refineries have built in processes which can process heavy crudes, which can process sour crudes, and give a better value. So it will be a combination of what is the differential between sweet and sour crude, and what is the processing capabilities available. But given the refinery configuration which we have, and the arbitrage which is available, earlier definitely the heavier crudes were coming much more preferable for Indian refineries, heavier and sour crudes. But over a period, because of that, the demand of the heavy crude started going up. And so the arbitrage between sour and sweet crude also reduced. So it will be depending on the price differential which is available. So month to month, refineries do calculate that which is better. And based on that, they will try to procure the crude. One more important thing will be that the refineries will have the emission norms. And the sulfur content is an important element in that. And the second thing is the end product specifications. As you know, because of the BS 3, 4, and 6 norms which we implemented, sequentially the allowable percentage of sulfur in the end products MS and HSD had been reduced. It has come to 10 ppm now. So we have to see what is the end product specification on sulfur and what is the emission norms allowed for the refineries. And because a part of the crude also goes in burning in refinery boilers and furnaces, so we have also to manage that. And depending on that, the crude diet of a refinery will get decided. A part of it can also be managed by burning, let's say, natural gas in the refinery, which is lower sulfur content.
Okay. Okay. So, now to the heart of the question, India imported 271,000 barrels of crude from the US, from Russia in 2025. I mean, the highest they imported from Russia was in the first half. If we replace that with US, how much more expensive may it be? I mean, ballpark, I know it's a moving figure, as you say, that at certain times US crude became cheaper in the past as well. WTI also went below Brent. But ballpark today, how much more would we pay if all of Russia was replaced by US and others?
But the question also will be whether US will be able to supply all that what Russia is supplying to us today. Because US is producing, let's say, the highest they produced so far was, I think, if I remember correctly, was in May 2025, which was around 13.5 million barrels a day. And the question is, they will have their own requirement also. So that is one question, that whether they will be able to supply to India. That's one part of it. But the second part is that which type of the crude. The US also will have the sweet crudes like WTI. They will also have the sour crudes like Mars Blend, etc. That's the second part. And the economics, as I mentioned to you, will be a combination of the freight plus the price plus the type of the crude and the product value of that. So that will decide. So it will be difficult for me to say that, okay, how much generally it is cheaper or not cheaper. But I can say that if very simplistically going, the refineries are evaluating the techno-economically all the crudes. And if they are able to buy Russian crude to the extent 35%, it means that the Russian crudes are coming cheaper. And what I understand is there will be around $2 to $3 on the end value coming cheaper to them as of today.
Okay. So if we are going to get an export advantage, we will be losing a crude advantage. Let us be very clear about that. So is it, the intent of America seems to be to drive Russian crude out of the market. Now, we don't know. Maybe the talks between Putin and the US envoys succeed, then we may not be in that position. But what is your estimate of how much crude prices can rise, if Russian crude moves out?
So the question is, if there are two parts of this question. One is whether India stops buying, then what happens? That's one thing. As you already mentioned, that we are buying around 2 million barrels a day from them.
Yes. Yes.
And the second thing is, if nobody buys and the Russian crude barrels goes out of the market. So Russia is producing around 9.5 million barrels a day as after they are I think the third highest or second highest crude producer. And out of that, accounting for their own consumption, they may be exporting around 4.5 million barrels a day. If none of the Russian crude is in the market, it means that 4.5 million barrels goes out. Right now, the consumption will be, I think, around 103 million barrels a day, and total production is 105 million barrels a day. So right now, there is a surplus. But over a period, if all of the Russian crude goes out of the market, definitely it will drive up the prices. And I assume that it may make an impact of at least $10 or so. But if somebody is buying, and if India is not buying, then the impact will be lesser. And I assume that somebody will continue to buy because the China is buying, Turkey is buying. So the Russian barrels are there in the market. So just because India doesn't buy, that is not going to say that, okay, the Russian crude inputs, the financial input they are getting will stop. So the total hypothesis on which this whole thing is based itself is slightly faulty.
It's unreal. Okay. Okay. Very quickly, sir, last question. Because the Brazilian president phoned the Indian Prime Minister, and Brazil actually figures as the 9th largest source of supply in the PPAC data. We apparently are importing 73,000 barrels per day from Brazil in the first 6 months. Is this going to be a strategic point that we build on this?
See, the question is traditionally, Middle East had been our traditional suppliers, and they would be the larger supplier for us. So normally the sour crude comes from Middle East, and the lighter or sweeter variety were coming from African countries. Brazil has increased their production. They are almost, I think, producing around 4 million barrels a day. So that is one, definitely an input. There can be one, but no country keeps all its eggs in one basket as far as crude purchases are concerned, because there may be risk involved. There may be technical issues with the supplier. There may be issues related to logistics. There will be issues related to geopolitics. So normally all refineries will try to diversify their crude baskets and have multiple type of crude, multiple countries in their basket. So Brazil will be can be one of the supplier, including all other traditional suppliers as well, which we have, which includes Middle East countries. Saudi, Iraq, UAE had been the major suppliers out of these Middle East countries. Nigeria had been one. Libya has come into picture now. Brazil comes. Kuwait also supplies to some extent. US also has been supplying. There are also Far East countries like Azerbaijan and also had been supplying. So there are variety. India has taken crude from almost more than 40 countries. Almost 100 types of crude India has processed in the in this.
Okay, so the final question, which everybody will want to know, given the realpolitik that Russia crude cannot be forced out of the market for practical reasons, what is your estimate of crude price for the remainder part of the year? Even with a red-hot war, crude did not go above $75. That was the maximum it went. So can we rest assured that the average will be around 70 for the rest of the year?
Okay, everybody who tried to guess the crude prices has been surprised, but my understanding is that the current market is oversupplied. There is definitely demand concerns. OPEC Plus has rolled back their voluntary production cut at a more rapid rate than what was assumed earlier. So I assume that market will be oversupplied in the near future. I also believe that the complete outage of the Russian crude may not be the case, because China is procuring a substantial quantity of the crude. Turkey is also procuring. So I assume that the Russian crude barrels will be there in the market. That being so, I will assume that the crude prices will hover in the range of $65 to $70. Maybe you may get the momentary spikes depending on the news flows and what tweets comes and what the statements made by different leaders of the world and how the geopolitical posturing happens. But otherwise, I believe that the sub 70 range is the most likely in the near future. But if by chance, which possibility is low, if all the Russian barrels are to go out of the market, then it will be a substantial spike. And then we can see 80 range also.
Well, I believe that's also not what the US president wants. Thank you very much, Mr. Surana, for just being the professor and providing us with a textbook to understand the Indian crude economy. Thank you very much indeed for joining us.
Thank you so much.
Well, I think all our questions, or most of our questions, are answered. But now we go back to equities and to results. Godrej Consumer is the stock in focus. The company reported a mixed set of earnings in its June quarter, with EBITDA missing estimates. Mangalam spoke to the CFO of the company, Asif Malbari, and he started off by asking him about the road ahead for normalization of margins and the demand scenario as well. Listen to the conversation.
So I think you're right. I think on our top line, we've seen a sequential improvement, a strong double-digit revenue growth at 10% with a very strong underlying volume growth at 8%. Even in India, we've seen an 8% revenue growth on an India standalone basis. So our top line's kind of now steadily improving and inching to levels at which we would be happy with the top line performance. Profits were flat in this quarter. Broadly in line with what we had guided the street before we began the year. We had talked about sequential improvement, second half being better than first half. That's the kind of guidance we would hold currently also. So definitely Q3, Q4 margins are going to be much better than what we're going to see in first half. Q1, Q2, we are kind of looking at commodity prices in terms of costs being significantly higher than replacement costs. Palm oil had kind of run up a lot, and we were hoping that there will be some consolidation correction in palm oil, which started happening from May, June. July, August has been now kind of stabilizing at lower than the highs which we saw in parts of Q1. So we'll have to wait for consuming costs to come more closer to the current replacement levels. So you will still see the first half margins being below normative, and then second half margins come back in that range.
Let's put numbers to that. The India margins in the first quarter close to around 23%. Your range is 24 to 27%. Same time last year you did about 26%. Where do they go in the second quarter? And the second half, do you expect them to move above that 24 to 27% or in that band?
Yeah. No, we do expect second half margins Q3 and Q4 to kind of come into the band. And hence definitely kind of move up from where they are today and come in the band. At an overall consolidated level, we had guided the street that we should see a high single-digit revenue growth at a consolidated level and double-digit EBITDA growth at the consolidated level for the year. We think we'll be broadly in line with that guidance.
And this despite the 4% decline that you've seen in the EBITDA. I just wanted to understand a little about your international business as well. Indonesia seems to be, impacted by tough macros out there. The revenues have declined. The EBIT has declined a lot more. How long before we see signs of improvement? And where does Indonesia be in, say, the next 3 quarters?
So again, I think the situation in Indonesia is slightly more pricing pressure and macros. The last few months have been to that extent difficult from Indonesia's perspective, but we do see these as temporary factors. It should be a few months of pressure, and then we should be getting back into our growth trajectory, both on top line and bottom line. So again, I think for Indonesia, a second half likely to be, a time when we'll start seeing both top line and profit growth.
What would the nature of this growth entail on a consolidated basis? Will it be household insecticide led? Will it be home care led? Or you think personal wash will be the one on a low base and after many months of weak macros come back? If you could give us a sense on that.
Sure. So actually, if you look at the Q1 performance, Mangalam, in India, looking at the portfolio, apart from soaps, it has been a very, very strong performance. Our performance in terms of the rest of the portfolio has been in mid-teens. All categories have kind of done well, and it has been a broad-based performance. So household insecticides has done well, air care, laundry, perfumes and deos. So we've actually had a strong performance across our portfolio. Personal wash has been a couple of months of a lot of rebalancing, very, very aggressive cost increases in palm, and hence rebalancing happening in terms of grammage changes, and these have been multiple changes which have taken place over the last few months. We do see things stabilize towards end of Q2 on personal wash, and hence from Q3 onwards, again, that part of the business should also come back. So yeah, I mean, the pressure in terms of sales has been only in one category. The rest of the portfolio in Q1 has actually done extremely well.
Do you have a word on competition? Because you have called out some sort of competitive intensity, and now your biggest competitor has a new leader as well. So perhaps, there could be some more aggression in the market. Do you expect that to happen?
So, I mean, we talked of competitive intensity in the context of Indonesia, where we said, listen, it's been a bit of a pressure in terms of competitive intensity and hence pricing. From an India perspective, we have a good innovation pipeline. Most of our innovations over the last year have kind of done extremely well. And hence, we continue to chart our own trajectory and continue to kind of stay ahead in terms of growth.
What about Raymond? How did that portfolio perform in the first quarter, and what's the prognosis for this year?
Yeah. No, so we should be seeing a double-digit growth in terms of that portfolio. It's actually kind of performed well in Q1, and most of the actions which we've taken have been well received by the market.
All right, and final question. Pet care, do you have any quantifiable numbers that you can give us in terms of an aspiration here?
Early days, Mangalam. We introduced the product in Tamil Nadu during the course of this quarter. Has been received well with consumers there. But early days in terms of giving a number. We've spoken in the past that aspiration would be to kind of get to a 500 crore business in a span of 4 to 5 years. So we kind of stay with that guidance.
And double-digit volume growth by the end of this year, is that a possibility on a standalone organic basis?
That remains the aspiration. So that remains a North Star. I think we should start inching closer to that. Definitely we'll see our volume growths inch up from the 5% level as we kind of see the completion of this whole pricing rebalancing in personal wash. So we will see volume growth inch up, and the aspiration definitely remains getting as close to double digit as possible.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam. And it's a weakish trading session because whatever we put on yesterday, most of that has been lost. We're closer to the lower end of the range. We'll have to bounce from somewhere around here. The 24,400 mark is the line in the sand. Hey, Mangalam.
Hi, Nigel. We will continue to monitor, whether there is buying at the lower levels or not. A large part of an up move that we saw in the last hour, short covering, is now reversed. But let's see whether we go into the weekend with some long positions or no positions at all. Be that as it may, we do have a bunch of stocks to focus on. Metropolis Healthcare. The company has seen a steady June quarter. The margin was impacted due to high employee costs. We have Mr. Surendra, who is joining in. He's the managing director, to break down the quarter for us and, more importantly, the outlook for the year. Thanks a lot, Surendra, for joining in. The obvious first question, if you could break down the first quarter performance in terms of volume, pricing, and mix, how much came in from specialty? And on all these three parameters, what's the outlook for the entire year?
All right. Good morning to you, Mangalam, and good morning to all your viewers. And we had a very emphatic quarter. We have opened the year with a very good performance in quarter one with 23% revenue growth and 19% the profit growth. And here the patient volume actually grew by 11%. at a group level. So that's the highlights of the Q1 performance. And on the specialty side, I think our specialty business has grown by almost 39%, largely because of the core acquisition. Otherwise, on a standalone basis, our specialty growth at 16%.
All right, so 16% for specialty business
Yeah.
On an organic basis, 11% volume growth, and the rest is coming from, the mix, price, etc. If you could give us a sense on this entire year, what is it that you're guiding for when it comes to organic volume growth? How much of that will come in from, increased prices that you would take? And what's the overall revenue growth target for this year?
Okay, more specifically, if you're talking about the organic growth this year, our guidance is in the range of 12% plus is the overall revenue growth. Out of the 12% plus growth, the volume growth, the patient volume growth should be around 7%, and the remaining 5% should be coming from the realization. 5 to 6% should come from realization, and of the 6% on realization, about 2% is the pricing benefit of the pricing increase that we have taken during the beginning of this year. But rest is coming from the product mix, which is the True Health and Specialty.
Hi, Mr. Surendran. Good to see you in. This is Nigel on this side. I wanted to ask you about the margin guidance. Since you're saying specialty will be contributing a higher proportion, that could give a bit of a tailwind to the margin. So what's the outlook on that front?
Well, I think we have, on organic basis, our Q1 margin is 24.7% on EBITDA. And I think we have initiated many productivity initiatives during this year. And most of it will start giving results from Q2 onwards. And also, like that our accelerated lab expansion was concluded in Q4 last year. So the drag because of the lab expansion will also come down during this year. So you could definitely expect at 25% plus EBITDA levels on the organic business in the rest of the year.
All right, 25% plus. So that looks good. But more importantly, on core, you said that including core, your specialty business grew 39%. But the first year focus on core was to improve margins. If you could give us a sense on how the operational performance of core has been, what kind of synergies have been realized, and how much more upside can we see in both revenue and margins for core?
So the revenue performance of core diagnostics is largely in line with our planning for the Q1, and it's continued to be so in this quarter as well. We know that when we acquire a new business, some level of corrections will be required from the ways of doing business, right? So hence, in the year one, largely the focus is to ensure we get all the synergies and we improve the margin performance. Like when we acquired margin, it was only at a break even, and in Q1 we moved into early single digit. And by the time we exit this year, we should come closer to a double-digit number. So that's overall, performance of core. But revenues will start getting upwards as we move forward during this year in every quarter.
What about your market share? With regard to your growth rate, it appears you're doing quite well. But what was according to your estimates, what was your market share and where do you see it headed?
See, well, Nigel, it's very difficult to have a market share index in this business because, you know that about 80% of the business is very unorganized, right? And every market you have different competition, and only about 4 or 5 players are listed. So we can only get a, estimate of the markets from the listed players. But I can tell you very clearly that, in the state of Maharashtra, more particularly in Mumbai, we are exceedingly doing well. And our market share is only getting better. And we are doing amongst all the competitions, our revenue growth are one of the best we have here. And also the unorganized sector is really, kind of suffering in this state. And this is one place where we have a complete information at this point of time, but very difficult for me to tell you that the market share at a national basis or a geography basis is so much. And, so we don't have any authentic information available from anywhere in the industry.
All right, finally, before we let you go, True Health, that was about a fifth of your overall sales. You were expecting that to increase in contribution as well. That grew about 20%. What contribution is it likely to have by the end of this year?
So see, for the last 2-3 years, we are growing True Health in the range of 22 to 25% year-on-year basis. And hence the contribution is getting better. We ended last year at 18%. Q1 is at 18%. Our aim is the first, target is to take it to 20%, maybe in the next 2 to 3 quarters, and then, take it upward from there.
All right, 22 to 25% is what you are expecting it to grow, and then thereafter it goes upwards from there. Thanks a lot for joining in. Wish you good luck for the remainder of this year, and margin expansion begins from the second quarter of this financial year itself. Take a short break, come back on the other side. We get you more on the markets and a lot of stock-specific action. Stay with us. The market's trading lower levels right now, and the broader markets have it a lot worse right now. 1,500 stocks in the red for about 1,000 stocks in the green. And amidst all of that, look at some of these defense names. At the bottom of your screen, there's Mazagon Dock. It's down 4% right now as we speak. And giving it company on the way down, we have Biocon, which is lower. And we also have Solar Industries, which has slipped to the low point of trade. And amidst all of this, just keep an eye out on Godfrey Phillips. Reported a very strong set of numbers. Yesterday saw some profit taking, but that has now been bought into as well, and the stock has recovered nearly 5% from the lows, currently at the high point of trade, taking the weekly gain on this stock to almost 16%. So that's a big move coming in on a couple of stocks. What we'll do is let's get you a chat with the management of Escorts Kubota. Our colleague Parikshit spoke with them.
So our growth aspiration and perspective for what we envision for the current year and for the future year is based on the current product line, and also we have a very ambitious product development program. And every year for the next 4 to 5 years, we plan to launch between 7 to 10 products between the three brands for the domestic market and for the international market. So the current year, the monsoons are extremely positive. The government is also giving very positive signals on the minimum support price. And we are also increasing our presence in terms of our representation within the Indian market. Now that we are integrated, now that we are one EKL, the three brands are now converging, and we are also looking at the aspect of how we can leverage our product and the brand positioning for the location and the region. So in the first quarter, while the industry grew by 7 to 8%, we are integrating our channel strategy. So therefore, the geographic growth that we have seen in the Indian market is coming more from south and east, where traditionally Escorts Kubota was weak in its presence in terms of geographic presence for channel representation, and also there were certain product gaps. So once these two are fulfilled successfully, which we are predicting to complete in the next 1.5 to 2 years, we'll have a uniformity growth all across the Indian market and thus achieve the challenger position and the market share growth aspiration that we have set for our company. Right. Now, when you speak about margins, will you maintain the outlook of 12 to 12.5% or will this exceed? So the current margin at 12 to 12.5%, we are confident of maintaining this, and we have also initiated some programs and projects within the company where we are looking at of how we can optimize cost and how we can ambitiously look at of how and what we need to do to improve it basis the aspiration we have set forth. I will refrain from giving you specific numbers, but for the next 4 to 5 years, we have launched two most ambitious projects. One is on the margin, as you asked me. So we believe over the next 3 to 4 years, there's going to be very good improvements on the margin front. So for the current year, we will maintain at 12 to 12.5%. And as the years come by, I do believe there is going to be a very positive growth expectations on the improvement that will come in basis the initiative or project that we have made. The second project is on the channel and on the customer experience aspect of how now Kubota coming in, we want to give a very different experience to our customers. And now that we have the two entities which have merged into Escorts, now Escorts Kubota, now we don't just have tractors, we also have Ag Solution product lines, which is Kubota Harvesters, where we are number 2 in the country, and also the construction equipment products, which is the mini excavators, where Kubota fundamentally is number 1 globally. And in India too, I'm happy to report and share that we are number 1 in the country. And so I think between these two projects, one on the margin and on the growth of market share, these two projects will help us to achieve our objective for the short and the midterm growth aspirations.
All right, that's the management of Escorts Kubota. Meanwhile, just keep an eye out on a couple of these stocks. From the jewelry space, we have Kalyan Jewellers. It's seen a big decline from the top. In fact, from the highs, it's down about 11%. Nothing in the numbers that suggests that, there could be such kind of decline. Neither was there any adverse commentary that has come in from the brokers or the management who joined us on the channel as well. So it'll be very interesting to see what exactly is taking place here in Kalyan Jewellers, because multiple times we've seen the stock see big knocks from the top over a couple of trading sessions, and thereafter there is subsequent recovery. And maybe if there are any doubts, we'll keep an eye out on Kalyan Jewellers. Meanwhile, on the other side, Titan opened mildly in the green and thereafter continues to do well. A couple of triggers in place for them going forward. The fact that jewelry margins will be maintained at that around 11 to 11.5% mark is something that the street likes. There was stellar performance in the watches division as well, which increased their margins from 11% to 22%. The management says even if you adjust for the one-off inventory gains out there, it's close to around 18%, and that is something that is likely to continue throughout this year. By and large, the reported EBITDA has been above street expectations, and that's reflected on the margin performance and the profit performance as well for the company. Gross margins have improved by around 40 basis points, and the watches EBIT margins, like I said, from 11% all the way up to 22.5%. The jewelry business had a one-time gain, which will be reversed in the next quarter, 50 basis points. So the management has maintained that 11 to 11.5% band. Going forward, the studded ratio, which is around 29% versus 30%, along with the buyer growth, is something that the street will be monitoring as we move to the festive season. International jewelry, which is a very small base. The company has big plans out there, which includes scaling up the acquisition of Damas as well, grew about 50% in revenue. They have an overall market share of 8% with their aspirations moving to double digits as well. So Titan holding up well in the green, at a time when other stocks are lower in today's trading session. And as we wrap up on this edition of Chartbusters, just keep an eye out on India VIX with the market moving lower, the Nifty down 160 points. The India VIX has once again moved to the high point of trade, closer to that 12 mark. So we'll watch out for that. In the last hour of trade yesterday, it had seen a bit of a decline. That's a wrap on this edition of Chartbusters. Stay tuned to CNBC TV18.
Hello and welcome to Trading Hour live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always as Hormiz Patakia and Reema Tendulkar. Hey guys, happy Friday to the two of you. And looks like Christmas has come early. Look at our color coordination this day, and definitely the color of today is red. Markets would have wanted some green, especially after that recovery that we saw yesterday. But most of the gains that we saw yesterday from the lows, they have been given up. So Nifty right now down around 170 points as we speak. We have the mid caps which are underperforming
underperforming with a cut of around 1%. And all the sectoral indices, they are in the red right now. The biggest loser being the metal index, followed by realty. And realty has been an underperformer for a long time. Despite that status quo that came in from the RBI, maybe the expectation was there could be a cut which could spur more housing demand. But for now, Nifty Media, which was the sole index in the green, that has also come off sharply from the highs of the day. So definitely a red-looking screen today. A lot of moving parts in terms of broader market movers, especially because of the earnings. But we are towards the fag end of the earnings season now, guys.
And it's been a tough week, right? Like barring the Monday pop and yesterday's little bit of an intraday recovery, markets have been largely grinding lower. From here on, one level to watch will be yesterday's intraday low, 24,344. That was the intraday low from which the market staged a remarkable recovery. So that level we need to see if it sustains. Also, just the market mood is that even where the numbers were fairly decent, good numbers, stocks are getting punished on the way down. So look at a Kalyan Jewellers. Numbers were fine, 30% plus revenue growth, 18% same-store sales growth. Stock is down 7-8%. BSC is another one. Good numbers, but the stock is a bit subdued in trade. And that just tells you the kind of market mood and sentiment that we're currently in. That said, there are two big earnings that we're expecting today. State Bank of India, that comes in market hours, and the other one is Tata Motors, that will be post. Grasim is also there, and a whole host of mid-cap companies. But we'll wait by for State Bank of India to set the tone in the second half.
The stock is already lower right now. Both of them actually at the day's low, but that's what the market mood has been, right? And we've been talking about earnings. There are a lot more other stocks which are on our radar. In fact, Hormuz has gone ahead to the big wall. He's here with us to put the spotlight on the top movers in the market currently. Hormuz, tell us more.
Well, and shades of red. So I'll start out with some green and how as well, right? NSDL, the recent listing, 3 days of listing, and the stock has already popped 60% now from its IPO price, which was around 800 rupees. The stock is now at 1300, 15% higher today as well, following yesterday's 20% move and the listing day pop of 17% from its issue price. We've already had 2.5 crore shares already traded in the first couple of hours of the trading session, compared to 5.1 crore yesterday and around about 3.75 crore on the listing day as well. And because of these 3 days, NSDL, which was earlier at a valuation discount to its peer CDSL, now trades at a premium compared to CDSL. On the downside though, an earnings reaction. Data Patterns is the 4th straight day of losses for the stock. Another 8% knocked off today and now 12% lower in 4 trading sessions on very heavy volumes as well. Close to 5 lakh shares have already been traded compared to a 20-day average of just around 85,000 shares. Another earnings reaction, Talbros Automotive, and after this 6.5%, almost 7% now, the stock has now broken below its 100-day moving average on the downside. It's now declined in 3 out of the last 4 trading sessions. And look at the volumes here. Already we have had over 1.5 lakh shares that have traded compared to a 20-day average of just 20,000 shares. And because of this down move that we have seen recently, the stock has also turned negative on a year-to-date basis. But on the flip side, a stock that is bucking the trend is KRBL, and it snapped a 3-day losing streak today at a time when most of the indices are at the lows of the day. KRBL is up 10%. And look at the volumes here as well. We have had close to 65 lakh shares that have traded already compared to a 20-day average of just 3 lakh shares. And in 2025 already the stock is up almost 40%, and this comes on the back of 2 negative years that the stock has had. So there are stocks that are bucking the trend, but the overall mood of the market though remains on the downside.
Oh yes, it does. That's what we can see in the mid-cap and small-cap index as well. Thank you so much, Hormuz, for joining us with all those details. It's time actually to slip into a break. Up next, we'll put focus on the crypto market with Manisha Gupta on the other side. Stay tuned for that.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back. As promised, we'll shift focus now to the crypto markets. Manisha is here with the latest and some developments for the 401k on crypto, Manisha.
Oh, well, absolutely. Never a dull day here. But as we start our new segment here, and it comes on a positive and a higher note as well, because the U.S. president overnight has signed a very important bill. This is the 401k retirement plan. Until now, the investments could only be done in case of stocks, bonds and cash. But now the 401k funds can be put in real estate, private equity and, yes, in cryptos as well. While, of course, this comes in as a very, very strong positive, the order also directs the Department of Labor to actually look into this as well on how and reevaluate as well on how crypto should be treated by retirement fund managers going forward from here. Well, interestingly, this could lead to crypto integration with broader financial system, bring it mainstream, and that is exactly something that the US has been working on for some time. Though there are experts and commentators expressing concern as well about higher degree risk and volatility that cryptos also brings on the table there. Interestingly, when you look at the last 1 year, we've seen a lot of positive, friendly regulations coming in US. The Bitcoin ETF is a success story that was launched in January 2024, and we've seen billions of dollars or inflows coming in for the Bitcoin ETF. And then it also has been about US, where we've seen the Genius Act go through. Clarity Act and Anti-CBDC Surveillance Act are a couple of acts that the US president perhaps could be signing in days to come. Genius is already on there. And then apart from that, it also has to do with a very strong June quarter that we saw. It perhaps has been the best on record. Remember, Bitcoin hit record highs in the month of April there, and it has been holding above that $110,000 there. Bitcoin volatility also is at its lowest since 2023, indicating that there is a maturing market. Remember, the adoption also comes in from corporates, companies, institutions, etc. And that has been giving much needed credibility to the crypto markets as well. Apart from that, when you look at the overall market capital, that has been on a rise too. $3.95 trillion at the last count. It did touch $4 trillion as well in the previous week itself. The final plate on the screen should come in on your screens that tells you on how the cryptocurrencies really have performed in this year and in the previous 12 months as well. So Bitcoin has given you 92% of returns in the last 1 year, and we've seen very strong gains, anywhere between 50% to 500% of gains. That is what Ripple really brought to the table as well. So many of these are second layer, first layer cryptocurrencies. These are the tokens that actually have established their credibility, are long-term investments, and that's the kind of gains that they have brought onto the table.
Whoa, look at the returns. A literal ripple effect, if we can say that, on the other cryptocurrencies as well. Thank you so much, Manisha, for always bringing these nuggets and interesting updates when it comes to the world of cryptocurrencies as well. That's about the crypto world. Let's get back to the equity world. Century Plyboards, that's the stock on our radar, reported a good revenue and EBITDA growth in its Q1 earnings. Keshav Bhajanga, the executive director of the company, is joining us now to take a few questions. Keshav, good morning. Thank you so much for joining in. You have given us a guidance update for different segments. So let's drill it down further. Let's talk about how the prices of timber and chemicals are currently compared to last year. What is the outlook going forward? Because your margins have been flattish on a YY basis if we talk about a consolidated level. What is the overall margin expectations when it comes to FY26 and FY27?
Good morning. Thank you so much for having me on the show. I think with regards to the expansion in EBITDA margins that you're talking about, if we look at EBITDA without Forex, it has actually gone up by about 29%. So it is quite a big delta. But as you know, the euro and other currencies have shot up. So because of that, EBITDA post Forex doesn't seem to have much of a change. Having said that, in terms of raw material prices, timber prices as far as MDF and particle board have certainly eased up slightly. I think the peak or the highest raw material prices are now behind us. So going forward, I think this should aid margins in the sector. As far as chemical prices are, they are pretty much stable. There isn't a very big delta. There are small changes that keep happening, as is usual with commodities. But I think in terms of margin guidance, what we had committed, 12 to 14% for plywood, high single digit for laminate, 15% for MDF, and steady state 15% for particle board once the new plant ramps up. I think we're well on line to achieve the same.
Okay, so the margin guidance across all segments remains the same. Even your sales growth, 10% plywood, laminates 20%, MDF 20%, particle board 40%. Keshav, these numbers also, you maintain them, this guidance?
Yes, definitely. I think, considering the overall slightly bearish scenario in the industry, our overall growth of 16% on a console basis has been healthy, and we have exceeded the guidance given across segments. Plywood has had a revenue growth of about 15%. MDF has had a revenue growth of 23%. So the miss has been predominantly on account of particle board because the new capacity has not come in. And in laminates, where the execution, finally we are seeing improvements on ground, but the scale up is taking slight amount of time.
So on laminates, do you maintain your 20% consolidated guidance? And on particle boards, the 40% sales growth, considering in Q1 there was a decline?
Yes, definitely. Particle board, the new capacity is actually a 800 cubic meter plant, and our earlier capacity was only 250 cubic meters. So the plant in itself is more than 3x the earlier capacity, and we were hamstrung by capacity. So I think particle board will not be a challenge in laminate.
So what is the capacity utilization on the new plant? Sorry to interrupt. And what would be the incremental revenue?
The new plant, as of now, has just began operations. 27th of June was actually the date of commissioning for the new plant. At peak revenue, the new plant should have a 500 crore plus turnover potential.
Keshav, how has pricing been so far? What about timber and chemical prices? Timber prices have remained at slightly elevated levels. Have they seen some moderation? And if not, are there any plans to pass on those elevated costs to your consumers?
I think I just mentioned slightly earlier that timber prices have moved past peak. They have cooled off slightly, and I think the highest or the peak of timber prices is behind us. Chemical prices are more or less consistent, so I don't think there's too much of a need to increase prices at this point in time. But it's a wait and watch scenario. Going forward, we will see, and we'll play it by how demand and raw material prices pan out.
Got it. Keshav, you do have capacity utilization which is coming in from new plants. Any other capex plans that you have in place? What would the balance sheet look like in that case? What's the updated debt right now?
Currently, our only frozen capex, large frozen capex, is the new plywood plant in Hoshiarpur. That plant will have a capex of anywhere close to 100 to 150 crore rupees, and it is likely to come up within H1 of next year. So that is the only large capex that we have planned. We have nothing substantial that has been approved by the board yet. Yes, there are discussions for other expansions, but nothing has been frozen yet. Having said that, with regards to debt, I think our long-term debt is within 800 crore rupees. And going forward, the objective is that we will deleverage the balance sheet over the course of the next few quarters. As you can see, our cash generation is quite strong, and profitability continues to improve. So I think within the next year and a half, our objective will be to get back to practically zero debt levels.
So from 800 crore, you're saying you will be a zero debt company in the next 1.5 years, purely led by internal cash generation and accruals, not some external. Got it. Thank you very much, Keshav, for joining in. Always a pleasure chatting with you. Get into a break. On the other side, Sheshadri Sen of MK Global will join in, and he's going to give his view and perspective on how investors can weather the current turbulence that we're currently seeing.
से पढ़ें।
Welcome back. Since morning, we've been talking about the sharp decline in Coforge. Just pull up that intraday chart of Coforge, and I think the stock was down about 4-5%. And if you pull up a one-week chart, I think for the last 2 days, stock has been a bit subdued in trade. Well, one factor is that Sabre. Remember, the company had won a large $1.5 billion deal from Sabre. It's a travel and tourism, company. It's listed on Nasdaq. They have slashed their guidance. So they came out with numbers yesterday, and on Nasdaq, Sabre ended with a cut of 35%. And they're now talking about revenue growth guidance, which was in mid to high single digits, has been brought down to flat to low single digits. So stock was under pressure, Sabre. They've slashed the revenue guidance, and for Coforge, Sabre is one of their large clients, and I think that explains why the stock is under pressure. But as promised, let's talk about markets, where we are headed, and how do we navigate the turbulence, this tariff turbulence that we're seeing. Seshadri Sen from MK Global joins in with his thoughts and perspective. Mr. Sen, always a pleasure chatting with you. This is Rima here. Open-ended question. You've had 48 hours to think about this. What is your advice now? 25 plus 25 as we stand now.
Hi, thank you for hosting me on the show. In the short term, my short and sweet advice is do as little as possible. Do not try to trade this news flow because you can get whipsawed in either direction very, very badly. Things could turn on a dime. There are multiple cross currents which could take this the tariff story in either direction. Over the longer term, yes, this is incrementally a negative for India, and there is a potential for some level of derating, but I don't think that this really impacts the longer term story. From a 6-month plus perspective, we continue to be constructive on India as a market, and would additionally, because of this uncertainty, focus much more on domestic facing sectors. Be very careful of investing in globally exposed sectors, not just because of the tariff regime that has come in, but because once all the tariffs settle down, we are expecting a sharp global economic slowdown. So tariff or no tariff, I think it is time to be a little careful about export-oriented and global-facing sectors. As far as the domestic sectors are concerned, the primary driver of that is the aggressive monetary easing by the RBI. I know there was a little disappointment that they did not cut earlier this week, but that's not a problem because they've done enough so far, in our opinion, to trigger a cyclical consumption recovery in the second half of this financial year. It just will take a little more time to percolate through, and we expect sharp improvement in retail credit offtake, driving discretionary consumption. So our focus remains on domestic-oriented sectors like the consumer discretionary and to some extent industrials.
Got it. Seshadri, you're saying even if there were no tariffs, it is not the time to look at markets from a fresh buy perspective. At what level would you be comfortable? How much more does the market have to fall for you to be comfortable in terms of valuations for a fresh buy?
So there are two scenarios here. One, if the market corrects by more than 5% from here, I think that's a time to aggressively re-enter the market, with the caveat that I said earlier, focus on domestic-oriented sectors, or give it a little time. Let's get closer to the festival season. By then, there will be clarity one way or another of how the trade scenario and the tariff scenario works out. And that time, selectively start nibbling again at domestic-oriented sectors.
So Seshadri, you mentioned if there is a 5% decline, you can aggressively enter. But do you see that potential of a 5% decline? Of course, 5% in a market like this, in a scenario like this, may not be too much. But do you see such a potential to happen?
First of all, no, I don't think 5% is small. 5% correction in the broader market would mean that, in the smaller cap universes, you'll see many stocks correct 15 to 20%. So 5% in the Nifty could be a fairly major correction. It's not in our base case. We don't see that happening. All the bad news is already in. How much worse can it get in terms of a scenario? The only way that could happen if there is a sudden sell-off in the rupee, and that would trigger FPI selling, and it could potentially bring the market down. But we've also seen the domestic flows, especially with falling interest rates, will remain robust. So no, not in our base case. It's just a what-if scenario. If you do get more than a 5% correction, that's the time to buy. But most likely is that the markets will time correct from here for the next 3 to 6 months.
Okay, 3 to 6 months time correction, or we could see at best a 5% correction, which would be a time to buy. Why are you so confident that, in the second half of the year, the domestic story is going to stay intact? And secondly, do you expect any sort of, relief coming in from the government? I mean, there is some chatter that on the 15th of August, we will hear something by way of reforms, which have sort of been absent. Are you in that camp? Is that something which we need to revitalize domestic growth?
Let's answer the second question first. I don't think structural reform can be switched on and off. There have been plenty of forward movement on many areas. Maybe some of these could see some acceleration. More likely, if the final tariff scenario does turn out to be very adverse for India, the government may be forced to accelerate a stimulus. Historically, the government has been unwilling to give a large fiscal stimulus. The preferred route is monetary stimulus, and therefore that may get accelerated. But yes, a response to this, in the immediate response to this, is more likely to be a stimulus rather than accelerated reform, because reform takes time. That's not to say that there isn't a case for accelerating reform in many areas and pushing that through, but that's not an immediate solution to the shock that the economy faces because of the higher tariffs.
Okay. So, Seshadri, while we are talking about reforms, domestic facing sectors, of course, have seen a positive impact of that, be it some of the sectors like defense as well, and the ones that you mentioned because of higher domestic demand. What are some of the sectors you're not bullish on? Maybe because of valuations, maybe because of demand concerns, or maybe because there are no fresh triggers from here on for them?
Financials and technology are two sectors that we are underweight on. Technology, first of all, technology, you have to trade the multiples. It is the only time you make money in technology in the post-COVID world is when you have valuations on your side. We still don't, when it goes to say -1 standard deviation, that is a good time to look at technology. One such opportunity presented itself on the day of the Trump pause. The other sector is financials. Large banks, we think, are growth challenged, and valuations do not reflect that. In the shorter term, they are facing margin pressures, which is further, affecting their revenue growth. So we've been structurally underweight on lending financials for quite some time. We remain so. We would look at that sector only in a selective stock picking basis and not as a broad brush overweight on the sector.
Seshadri, pleasure having you as always. Thank you so much for sparing time and joining us today with your views on what next for the Indian markets after Donald Trump's tariff tantrum. We'll take a short break here, but just before we do that, remember to tune in to the all-new CNBC-TV18 Prime, which brings you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at noon for the Global Reset, at 1 p.m. for the Big C, and the Global Lens at 8:30 this evening.
Welcome back. You're still tuned into Trading Hour. It's a good time to get the latest trends from the F&O space. Mangalam is joining us now with just that. Mangalam.
Well, as we can all see, the market's been grinding lower. Yesterday, the last hour, there was a big uptake. A large part of that was on account of expiry-related short covering. And now it was only fair that, once that move was taken out in the morning, first thing that would be unwound, and that's exactly what took place. So you have the Nifty bankers, the mid-cap index, all of them lower. In the last hour, we also saw yesterday the volatility index saw a big nosedive, and now this morning it's come up back again closer to the 12 mark. So that's something which the street is pertaining as or looking at as sustainable from here on. The two data points that I'll be watching out for: one, the advance decline ratio. We have more stocks declining than the number of stocks which are advancing. Does that widen? Does that ratio widen from here on or not? And the second part I will look at is, does Nifty breach today's low and close to yesterday's low as well? Yesterday's low on the Nifty was 24,344. Today's low, 24,408. So that's something we will watch out for very, very closely. And remember, on the way up, you have to keep an eye out on the 100-day moving average for the Nifty. Yesterday, it closed above that, but the 100-day moving average is moving higher, right? So 24,474 mark is something that we need to conquer on a closing basis for the frontline index. Call writers believe that maybe on the way up, there is congestion. That's why the 24,500 call and the 24,600 call writers, these are options that expire next Thursday. Fairly active in trade, 100 rupees premium on the 24,500 call and around 60-70 rupees on the 24,600 call. So around 24,600 to 24,650, there is supply which is likely. But at the lower levels, bulls aren't throwing in their towel. The 24,400 put is fairly, active in today's trading session, along with the 24,450 put. That tells you that closer to yesterday's low, around 24,300 to 24,350, there is likely to be some support for the frontline index. But a couple of stocks that deserve mention. Bharti Airtel, after the large trade, a lot of open interest activity taking place out there, most of that understandably on the short side. But the other one that we're looking at is Kalyan Jewellers, a huge jump in open interest, and the stock has seen a big nosedive from the top. Currently seeing a lot of short build-up, so watch out for Kalyan Jewellers. And finally, yesterday we had pointed out the possibility of RBL Bank looking to cross the threshold after which it will enter F&O ban. It has happened in the first hour of trade itself, so won't be surprised if RBL Bank does go into F&O ban today post-market.
RBL Bank may enter the F&O ban. Mangalam, thank you for that update. The market still remains 160 points lower, and by the looks of it, this could possibly be the 6th straight weekly loss for the index. The level at which the Nifty needs to close above is 24,565 for a weekly gain, and in case that does not happen, this will be the 6th straight weekly loss for the Nifty. And in case it is the 6th straight weekly loss, the last instance of this happening was back in February and March of 2020. Mitesh Thakkar now joins in for a quick chart check. Mitesh, what are the levels that you are looking at? Do you see a retest of yesterday's lows, or do you expect the index to consolidate at these levels? And of course, your stock recommendations for the morning.
So, good morning. I think, very clearly, the Nifty has once again started trading below 24,550. But what is important is that, if you look back on the price action of Nifty in May, there was this big gap at 24,400 to about 24,200 zones. So I think we saw yesterday the market kind of make an intraday low there. That level should still come into play and bounce back should happen. But broadly, this market isn't a strong market or showing signs of reversal, which means that any rallies would be more of a bounce back in nature, and therefore, booking shorts around 24,400 may not be a bad idea. Trying to, see at high levels where we see supply re-emerge. I was hoping that we go to about 24,750 when yesterday the bounce back started, but then with the negative news, the gap down again happened. But as I said, closer to 24,400, try and take profits or short positions. And on the stock side, I have a buy on Fortis. That's a stock which is clearly shown outperformance and strength in this market. So buy here with the stop at about 884 for targets of 930, and a sell on Astral, which I would recommend selling with a stop just above levels of 1,405 and look for a target of 1,340.
Okay, all right. Thank you so much, Mitesh, for joining in with those individual stock names. But the big boy, State Bank of India, will report its Q1 earnings today. What are the key expectations? Gaurav is joining us with that.
Well, yes, when we talk about State Bank of India, now we are expecting 12% loan book growth in terms of a year-on-year basis. Now, remember, State Bank of India has the highest loan book But even after that, Street is expecting some kind of double-digit growth to continue. When it comes to deposit, 10% growth is what they are penciling in. And as a result, when we move ahead to net interest income, they are expecting around 1% growth on a year-on-year basis. And this is because of the cost of funds. Now, the pressure from cost of funds will remain. And as a result, net interest income is also likely to come down a bit on a sequential basis. When we talk about net interest margins, there also we may see a little bit of decline. When we move ahead to the operating profit, now treasury income is something which has been higher for the banks. We have seen it across the PSUs and even in the private sector banks, and that is the reason why the PPOP can actually grow at around 3% with some positive bias. When we look at the provisions, they will be a little high because Q1 is usually higher in terms of slippages for agri, and that is the reason why profit now it is likely to decline by 2% on a year-on-year basis. There also we may see a little bit of positive bias because some amount of surprise can be seen in the operating expenses. So all in all, stable set of numbers is what we are expecting with good growth in terms of loan book for SBI in this quarter.
Gaurav, thank you for that update there. Keep an eye out on SBI. Numbers should be out anytime now, or 0.5% lower on the stock. And has been fairly quiet all through the year. And it hasn't moved a lot as well as SBI. Some life insurance data flashing on your screen as well for HDFC Life and for life insurance players. But we take a short break here. And just before we do that, a reminder for our viewers, unlock a world of exclusivity, expertise and influence. Become a member of CNBC-TV18 Access, a premium member-only experience on CNBC-TV18.com. The membership includes access to CNBC-TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions and masterclasses, and curated lifestyle benefits. Welcome back. Now, in an exclusive conversation, my colleague Parikshit spoke to the management of Escorts Kubota on the company's capacity expansion plans and if the company faces any impact amidst US President Donald Trump's tariffs. Listen into a slice of that conversation.
We are at a very final stage of negotiations with the Uttar Pradesh government for our Greenfield project. Both Katusan and myself are very hopeful that we will have some kind of an announcement out. And therefore, the teams both in India and Japan are right now under discussion to create the layout and the capacity for our construction and our tractor and our agri-solution requirements for the immediate future and for the long-term future. As far as the current premises are concerned of Escorts Kubota at Faridabad, we are optimizing our capacity based on the need of the new products that are getting introduced. So, for example, I mentioned Promax. We are under extreme short supply because we didn't anticipate the demand and the excellent response that we've seen from the market. So we're optimizing on the capacity that is being created for both the domestic and some of the models that are heavily required on the export side. So I don't have any specific numbers to give you as of now, but as far as the capacity for the short and mid-term is concerned, we will adequately take care of that and ensure that we are able to address it adequately.
On the UP plant, there are reports which indicate delays. Could you give us a sense of the status of construction, land acquisition? What are the delays currently, if any?
So one thing I'd like to clarify that any delay that you talked about as for the Greenfield is concerned, firstly, let me reassure our stakeholders and our viewers that this delay is not going to affect in the growth that we envision because those capacity adjustments we have already done in our present premises at Faridabad. Your second question in terms of the timeline, we understand that the land under acquisition by the government of Uttar Pradesh is under final stages. We are now awaiting a confirmation from the UP government that once the land is fully acquired and we will do the due diligence, thereafter we will very, very quickly start the commissioning of what we would like to see come up in this new facility. Because the planning as for the new facility is concerned is happening between Japan and India already. So we will not waste time once we have the infrastructure and the acquisition part of it done with. So we will start immediately and we'll put up the plant in record time.
Right. Mr. Kato, if I were to ask you about what is the percentage of export revenue that is being routed to the Kubota network?
Thank you. Now our export revenue through Kubota network is around 70% of the total export. We have successfully utilized Kubota's sales channel to expand our export volume.
Right. I would also like to ask you about if you can give us any range in terms of export contribution to total revenue in 2 to 3 years.
Now, as I mentioned, we have expanding and we are going to expand the export sales. Our plan is to expand 25% to 30% every year to increase the proportion of export volume.
Right. Also, if I were to ask you about the impact of tariffs on Escorts Kubota, what's the kind of tariff, what's the kind of impact you're envisaging, Mr. Kato?
Okay. Now, since our export volume or proportion is very low, so at this moment it is a not so big impact. And definitely, I believe, I think trade war is a threat, definitely, but I believe we don't need to consider short-term tariff fluctuations. It is uncertain and flexible. So our vision and our direction to expanding export sales by utilizing Kubota global channel, including the US and Canada, we don't need to change, I believe, in the long term.
The management there of Escorts Kubota. Take a short break. On the other side, get your excerpts from our exclusive conversation with the management of HUL to analyze the rationale behind the demerger for their ice creams business and a lot more. Stay tuned.
Welcome back. Let's get you an exclusive conversation now. HUL to demerge its ice cream business and the entity will be listed by this year. CNBC-TV18 Shilpa Ranipeta and Mangalam Malu spoke to HUL CFO Ritesh Tiwari about this and began by asking about the rationale and the details of the demerger.
Ice cream overall has a very distinct business model. It runs in cold change in terms of manufacturing, distribution. It is prone to seasonality more compared to any other business that we have. It also has higher capital intensity compared to other business that we have. This is what makes ice cream very different to the rest of the business. At HUL, it has low synergies because of this very reason with all other categories that we end up doing business with. So that was one reason why we said that we need to have a solution which is very different. So hence, if ice cream is run with a focused management, with different agile strategies which are suited to its own distinctive business model, it can unlock more growth going forward.
Right. So if you could give us a sense, as delicious as the business idea and the potential and the product sound, it's a very tough business as well because supply chains, the capital that it requires for you to have a cold chain across the country, etc. If you could give us basic numbers on the ice cream business, it's about 2 to 3% of your revenue right now. What kind of EBITDA margins does it make? What kind of capital is invested in the ice cream business?
Yeah. So ice cream is roughly for us an 1,800 crore business. And it makes, if I look at last few years of margin, it makes low single-digit margin. This is a business now which is in investment phase. We are a national player. We supply ice cream across the length and breadth of the country. And when you do that, the overall cost of running the business is high, which is why a business like this gets a lot of benefit when it starts to scale up. Our business for the last 1 decade has grown in double digit. And going forward, given the headroom which is there to grow of penetration consumption, we expect this growth trajectory to get even stronger going forward. And which is why today when the business operates at a low single-digit margin on an average, we will get into an investment phase further. So margins will further go a little bit down. But from there onwards, as the operating leverage kicks in, we'll then start seeing acceleration of margin in times to come.
You spoke about low single-digit margins is what you see right now, and then after the investment phase, I think your listed peers does about 5 to 7%, if I'm not wrong. Is that where you would look to get at eventually, or do you think post-investment phase there is scope to expand margins further beyond that?
When it comes to material margin, we make industry-leading margins. When it comes to total margin, when you add variable cost plus fixed cost, our margins are lower compared to the benchmark that you quoted. And the reason for that is because we are a national player and hence our infrastructure is spread. As you start getting more amount of scale further in the business, you start getting operating leverage. So the second component today where we are, let me say, under index compared to market, we'll start getting that component also getting counted in terms of improvement in margin. And once that starts to kick in with further amount of growth and scale, we should be able to reach high single-digit margins.
And what happens to HUL's overall margins, because our ice cream is fairly margin dilutive, and what happens to HUL's own ROC? How much improvement do you see there?
Yeah. So ice cream overall is 3% of turnover. It's 1% of our profit. So there'll be small improvement in our ROC and margin after the demerger, but it is small and immaterial, I would say.
Right. And ice cream as a business, though you spoke about the large scope of growth that there is, it is still seasonal in nature.
Right.
And I think you have spoken in the past, and you've been one of the players that's spoken about how you're looking at de-seasonalizing the business. So how do we look at that? Because if an investor is looking to invest in a company, they would want to be able to reap profits or returns through the year. It cannot be in one season. So how are you looking at de-seasonalizing this?
Now, ice cream can be seen as a dessert, and hence it plays a role in the entire post-meal sweet category. It also has a role as a snacking category. And once you start looking at it a little differently like that, you start seeing that there are many occasions more where ice cream can be center of the plate. We keep seeing 100 to 200 BPS move that keeps happening from season to non-season ice cream with every year of effort that we end up making. So roughly, I would say little less than half the business ends up happening during the peak of the season, and then the balance business is spread across the balance quarters in the year.
Do you have to pay a royalty to the Magnum ice cream? And
so today as HUL, we have a royalty contract, which is for all the categories that we deal with in Unilever. And once ice cream gets separated, our current contract runs till January 28. So we're going to pass on the royalty contract, which is all three components. It is component for the brand trademark. The brands that we have in India today, Quality Walls, Magnum, Cornetto, these brand trademarks are owned by Unilever. So the access and license to these trademarks will be passed on to Quality Walls India Limited under the same existing arrangement that we have. After the demerger is completed in India, and once the global company gets also listed, and they might end up getting into a new relationship of royalty with them later point in time.
When do you expect this entire exercise to complete and shareholders of HUL to get Quality Walls shares in their demat account?
Yeah. We expect by end of this financial year, the business to get demerged and listed.
Right.
And start trading as well.
You believe it can double over the next 3 years or 4 years with better margins?
I hope it does.
Okay. Let's move on.
Let's move on then. Of course, coming to what everyone's been talking about when it comes to HUL, which is a change in management right now. I believe Priya Nair has taken over. It's been a couple of days.
It's been first week for her in the office.
Yeah. Yes, of course. So, a few, initial thoughts once Priya's come over. What's it been like? And also,
how's the vibe changed? Let's put it that way.
Let's start off with that.
Yeah. So Priya is a homegrown talent. It's been 30 years. In fact, we celebrated her 30 years at HUL and Unilever this week. As Priya comes in, of course, she will have her own set of thinking and thoughts looking into the business. Priya in last role, globally she was president for the global beauty and well-being business. And that and we've spoken about it continuously, beauty well-being is an extremely important, strategically important category for us in India and segment for us. The expectation of growth from us for beauty well-being is much higher. And all that experience that Priya has in leading the global business will be extremely important for us as she starts to settle into the business.
This is also coming at a time when the consumer sentiment itself is at an inflection point. We are seeing acceleration in rural demand, and urban is also gradually picking up. So amidst all of this, with the new, wind beneath the sails of HUL, or beneath the wings of HUL right now coming in with new leadership, do you believe that the time is opportune for the company to grow a lot faster over the next 3 years than it has over the last 3 years?
Yeah. See, there are a few important parameters which determines overall consumption climate and FMCG growth. Number one is disposable income that consumers have. And number two is consumer sentiment. These both items are looking better overall as a country today compared to what it looked a year or 2 years before. So we have seen that the MAT trends, MAT trends are stable for FMCG. In the latest quarter, last quarter, we saw overall consumption demand, we saw an uptick. Rural now is growing ahead of urban. Both have improved. Urban is also improved. Rural is also improved, but rural is now growing ahead of urban. Put together, we see that overall macro conditions have improved, and we expect that this to sustain.
Well, with that, we call time on this edition of Trading Hour. That was the management of HUL, an exclusive conversation with Mangalam and Shilpa. By the way, just pull up Subros before we call time on the show. The numbers were just out a few minutes earlier. Revenues were up almost 9%. The margins saw a bit of a contraction on a year-on-year basis as well. The stock is now down almost 6% as we speak. Take a leave from Rima, Sonal and me. Thank you for watching. Halftime report on the other side.
A day after hope of an early resolution on trade lifted stocks, uncertainty creeps in once again, dragging equities lower. Utilities and industrials slip while IT and healthcare eke out gains.
Promoter entity Indian Continental Investment has offloaded a small 0.8% slice of its 2.47% stake in flagship Bharti Airtel for over 9,000 crores. The transaction follows the sale of small lots adding up to 2% since November last year.
AU Small Finance Bank gets RBI's approval to transition to a universal bank in the first such approval in 10 years. The license offers greater flexibility in business and eases capital requirement, giving profitability a fillip.
LIC and Max Life Insurance post strong numbers, beating estimates on value of new business and new margin businesses, and the stock perks up.
Gold prices jump on the COMEX after Trump imposes tariffs of import of 1 kg gold bars, the most traded lot on the bourse. Cryptos to get a boost with Trump allowing 401k retirement plans to invest in them.
Hello and welcome to Halftime Report on CNBC-TV18. Coming from the CNBC-TV18 Motilal Oswal studios, I'm Vinny Motiwala. With me is Mangalam Malu as well as Ekta Batra. Good afternoon, guys, but not a great afternoon shaping up today, or not a great day compared to what we saw yesterday, the second half of the trading session where we saw that green coming in. Today, obviously, some bit of that correction has come in on that front. But a lot of earning movers, at least that's where the positive sign is coming in. Some of them trading in the green. But as of now, the broader end of the market also a bit under pressure.
Same time yesterday, we were at the low point of trade as well, closer to the 24,300 mark, just below that. And then we had the recovery. So bulls are believing that maybe not a lot of open positions would be left by the end of today's trading session, and perhaps some sort of recovery, which is likely. The good part is that today's low is still about 100 points above yesterday's low. So let's see whether we see some buying at lower levels or not.
Today also we could hope for something in the green by the end of the day.
Who knows? Who knows? Yesterday's sharp up move was actually also further aided by the fact that it was expiry and a lot of call writers were caught on the wrong side. So it was only fair that, those positions were unwound first thing in the morning. So that's why we saw a bit of a decline. I'm just keeping an eye out on two things. One is the broader market advanced decline ratio, and the second part is the India VIX. India VIX has spiked up once again today. So where does that settle will be a foreteller of where the market goes.
Well, not too bad for the week at least. We've seen that choppiness come through and that spurts into the green, which has really helped us in terms of averting too much of a loss for the week. So the Nifty at current reckoning is down around 0.6%. The Sensex is down around 0.7% on a week-to-date basis. And the mid-cap index is down around 0.3% at this point in time. So that on a week-to-date basis, we seem to have stemmed our losses. But let's see how the second half pans out and whether there's any kind of buying on dips or the reverse. But nonetheless, let's kick off the show with Jubilant Foodworks. It's opened its first Popeyes food outlet in Mumbai and launched a total of 3 food outlets in the city. Jubilant Foodworks plans to open another 100 stores in the country by FY26 end. Mangalam did catch up with Sameer Khetripal, who's the MD and CEO of Jubilant Foodworks, and began by asking their expansion plans.
So we are rapidly expanding. It's just been 3 years, if you see, and some of the largest QSRs in India, what they've done actually in 10-12 years, we're actually condensing it to 3 years. So we believe great food takes a little bit of a time, but we still are the fastest. And we have a unique supply chain commissary model, which is very, I would say, core to Jubilant Foodworks. And we set up the supply chain, and now we genuinely believe we are ready to scale up. So Mumbai, we are the first time launching with 3 stores. We have another 2 or 3 planned, and we are going to rapidly expand now in Maharashtra.
You've done 60 stores. What's your target for FY26 in terms of store opening for Popeyes? And by when do you reveal those numbers, formally for the overall business?
No, I think so we want to rapidly expand, and I recognize media houses like yourself, investors and broader customers also want to understand the success of Popeyes. So very soon we will hit 100 stores, hopefully by end of this financial year or early Q1 next year. We will start disclosing our numbers for Popeyes. But let me assure you, in terms of average daily sales, store profitability, I think we had a fantastic quarter.
Back of the envelope calculation suggests Domino's you do about 2.5 to 3 crores per year. I suppose this one would be about 20-25% higher, right?
Yes, I think I'm not going to react to the numbers, but materially higher, right? I think from a, firstly, for every Popeye store, we'll have 4 or 5 Domino's. So I think it's an unfair comparison.
Got it.
But standalone, these, as a category, this is meant to be much larger. And I think some of the competition numbers of chicken and burger players should give you comfort.
Okay, have you crossed 200 crore in sales?
I'm not going to answer that, but let me tell you, we are very well benchmarked to the market in terms of daily sales.
And what about the EBITDA at a store level? And if you have to look at Popeyes, is it EBITDA accretive?
So I think Domino's is the benchmark in the country, and so compared to Domino's, it is dilutive for sure. So it's not going to be accretive for a long time. But let me assure you or to our investors that this is how I think. Firstly, we have to expand in the right locations, make sure we get the right average daily sales, and even with 100 stores, be the best in class in terms of gross margins. Once you have that, then you have a scalable model. So all my food that is supplied over here to this Popeye store comes in the same van as supplies to Domino's around the corner. So therefore, I have the lowest logistics cost, highest gross margins when it comes to this category at about 100 stores, delivered by our unique commissary model and logistics supply chain. And not only that, our own delivery, our own tech.
You have revealed your first quarter top line. You've revealed your Domino's like-for-like growth at over 11%. Do you think that is something that is likely to continue going forward as well?
India is a $60 billion market, and pizza as a category is less than $1 billion. So we have to fight for our share. We have to invest back and give more to consumers. So we have literally quadrupled our pace of innovation. So you see cheese volcano pizza, you see cheese burst pizza, launch of chicken, and we recently launched chicken burst. These are all first-time innovation coming into India. We used to take 4 quarters to launch one platform. Now we are launching one product, one platform a quarter. So we have quadrupled our pace of innovation. So we're very happy with the strategic calls we have taken, and I'm proud of my team in terms of day-to-day execution, and I think we are ready to go scale ahead.
So 60 stores per quarter, Domino's continues?
Of course.
All right. Final question. I have to ask you this because you've spoken about Domino's, etc. The target for this year when it comes to overall revenue, SSSG, and also even the margins.
So I think we don't give guidance, Mangalam, but my model is very simple. 5 to 7% should come from SSG. That gives you sustainable margin, at least holding on to the margins or growth in PAT. And if you add 10% store, so about 14 to 15% growth should come in, and that's what I think we are building our business like that. And margins, I think we've always given a guidance like a little earlier that 200 basis point margin should improve in next 2 to 3 years.
And there's no reason for you to believe that this won't happen in FY26. All right, from the delicious Popeye store back into the studio right now. We'll take a short break, come back on the other side. We focus on the commodity space. Manisha Gupta joins in with Sabyasachi Ray, the Executive Director of Gems and Jewelry Export Promotion Council. Stay tuned.
Welcome back, and joining us from DJPC is Sabyasachi. Sabya, thank you so much for joining in. One after the other, there is some new notification or a legislation that hits the jewelry sector. I want to first start with what really came overnight, which we are reading slightly delayed by a week really, on how US perhaps will put tariffs now on gold kilobars and 100-ounce bars as well. This comes in from Switzerland, and this has led to a huge price disparity in the global markets. How have you read into this? Mr. Ray, can you hear me?
Yes, I can hear you. Thank you, Manisha. Sorry. So, this one thing, every day you are doing that what the gold price trends, how it will move, where it will move, etc. This new dimension will put an interesting, dimension into the pricing also. Before, throughout the world, gold was traded. Usually, gold is a raw material. So, throughout the gold was traded with, other than India, etc. The gold bars were at zero duty, throughout the world, including US. So now, after this reciprocal tariff notification, what we had noted, and also we have told to your channel, that there's an Annexure 2 where certain goods have been given waiver of this reciprocal tariff, so duty. However, recently what has happened, in fact, yesterday only or day before yesterday, there's a customs ruling which has come. And US, including Mr. Trump, had also told that they want to be the refiners of the world. Throughout the world, we know that Switzerland holds one of the largest refineries in the world. I think 30 to 40% of the gold refining happens in that country only. US also have refineries, but one ruling has changed. I'll explain to you how it has changed. See, there are two HS codes, harmonized system codes, based on which the customs put the duty. In US, the ruling has clarified that 7108.135500 is the one which will be in Annexure 2. That means which is under waiver. That is other semi-manufactured forms of gold. However, gold has been always exported by Switzerland, including in India. It is imported under the code 71028.1210. So this 1210 now has been put under 39% import duty reciprocal tariff, which is applicable in Switzerland. And that has been clarified by customs. So overnight, the Swiss refined gold in US has become, 40% or 39% higher in price and etc. And because of that, the Swiss refiners had held back their supplies, creating a huge disruption in the gold supply chain in the world. Because the COMEX, COMEX shows one of the largest volume of gold in the world from where it is traded. So this is what has created the disruption.
Mr. Ray, this is clearly the last in the list, really, and thank you for explaining that. And well, if US wants to be the refiner to the world, I'm assuming that it will not happen overnight, and we might be looking at disparities staying on for some time. But the other concern really comes in from the diamond guys. I mean, with this 25% and now 50%, I mean, I remember the previous conversation I had with GJPC that 25% itself was a bit of a problem. The margins were absolutely getting squished and squeezed. With 50% on whether or not that happens, but that date is not too far away. The diamond business, how are you looking at those numbers now? Because loose diamonds, a lot of your members have stores in US. How are you dealing with this now?
See, Manisha, again, just now as you have told, in the world, as I told, that if 30 to 40% of the gold refining happens in Switzerland itself, in diamonds it is around 85% or somewhere around 90% of the gold cutting and polishing, diamond cutting and polishing is happening in India itself. So overnight it cannot be replaced, as you have just told. However, the business will not be viable with a 50% tariff because diamond pricing, as we have already explained, that as it is very high priced good, percentage does not work. Now, if it is equally tariff, like, let's say your food grains or etc., it cannot hold because that is what is the issue, that in the consumer level, it cannot be traded, it cannot be sold with a 50% tariff range or overnight increase in price. So this is where we are right now. And we had calculated with 25% how much business loss, how much level loss, etc. all will be happening. But with 50%, there is no calculation. The business is a no starter. That much I can tell you.
So where we stand right now, and again, July wasn't so great, 50 to 75% of a decline to US export. August, I'm assuming, could be much lower, would you say, Mr. Ray? And what is the sense right now? How are you dealing? How are you talking to your consumers in US? What is the quantum that you see happen for the month of August for jewelry exports?
See, Manisha, give us some time. What I think the first numbers which is coming out, right now I'm not confirming. You give us another 5-6 days. In July, surprisingly, the export has picked up.
Okay.
So where it has picked up, how it has picked up, we're still analyzing. But of course, after this August with 25% after 6th of August, whatever has gone, of course, it has happened the same way it has happened previously. People tried to move in their stocks in US. That is one of the story. But after that, whatever business is there, I do not believe with 25%, other than very select business, it will happen.
Okay.
So the export will, of course, nosedive. And after 21st August, I cannot think about that. I think export may be totally stopping this, in US at least.
Well, we still have time, and there is an expectation that negotiations will happen, and perhaps there would be some commodities that would be exempted, and perhaps diamond could be one of those. But Mr. Ray, as always, thank you so much for joining in.
Absolutely. Thank you so much, Manisha, as well as Mr. Ray, for joining us. An interesting conversation there. But, on that note, we're going to sip into a very short break, viewers. Don't go anywhere. We'll be back with more news and updates, more stock-specific action after the break.
Welcome back. Well, for the markets week, we have the mid-cap index, which is down around 1% at this point in time. Some more details coming in from AUSFB, where they have said they have 18 months to achieve the transition to transfer promoter holding. So that is for the Universal Bank license. As you can see, AU Small Finance Bank is up around 0.8%. SBI will be in focus because it will be releasing its numbers this afternoon. Do watch out for that stock. But let's now cut across to Vamakshi. She's going to take us through all of the stocks that are moving around in trade this afternoon.
Well, absolutely, Ekta. In an otherwise weak market, there are several stocks that are moving around in trade. Take a look at M&B Engineering. This is a very recent listing. In fact, it listed along with NSDL and was overshadowed by some of the other big names. But today, the stock is up almost 16.74%. Keep in mind that it has seen an uptick of almost 23% from the IPO. In fact, this gain is also coming on the back of very strong volumes. Around 53 lakh shares traded so far as compared to 39 lakh shares yesterday. Ather Energy is another big mover. It has managed to hit a record high in today's trading session. The stock, in fact, in the last 5 days, is up almost 21.5%. And today itself, the rise in the share is coming on the back of very strong volumes. In fact, volumes are all up almost 3 times as compared to the 30-day average. GSFC is another counter. The company reported its numbers. The margins expanded by 380 basis points and the net profit was up almost 51%. And this particular stock has seen the biggest single-day gain since Jan 2025. 1.24 crore shares traded in GSFC and the volume is almost 20 times as compared to the 20-day average for this time of the day. And lastly, on the flip side, take a look at Kalyan Jewellers. Despite posting a good set of numbers with the net profit rising by almost 49% year on year, the stock is seeing the biggest intraday fall since Jan 2025. And this fall is coming on the back of larger volumes as well. 2.80 crore shares have been traded so far, which is 5 times higher as compared to the 30-day average.
Okay, Vamakshi, thank you so much for that and thank you so much for highlighting those stocks that are buzzing in trade today. But Nifty as of now is trading at the day's lowest point. 24,400 is what levels the Nifty is just managing to hold on to. On that note, we're going to again step into a very short break, and after the break we have the management of LIC joining in with us to discuss their quarterly numbers.
166 points lower on the Nifty right now, mildly off the day's low, but not too far away from that as well. But a couple of stocks, they deserve mention, and they're moving higher right now as we speak. A lot of long positions added on Cummins India. Remember, the management con call takeaways were flashing for you at the bottom of the screen, and the stock has moved to the high point of trade at a time where the mid-cap index is actually hovering around the lows of today's trading session, and also giving it company on the way up. We've seen LIC, which has moved higher. In fact, as we speak about LIC, let's get in a conversation that our colleague Yash had with the management of LIC after reporting a good set of numbers. We have R. Doraisamy, who is the CEO and Managing Director of LIC, with us.
LIC has been continuously working towards showing a positive growth in every parameter that is being measured. All of you are aware that October last year saw a change in the product circular. The master circular got implemented, and we had to, the entire industry has to respond, and we had to respond with a modification to all the existing products. Some changes had to be brought in only to become compliant with the new regulations. So that had caused a difficulty or a challenge in terms of the number of policies growth after 1st October. So that effect is still is there, but we are working very hard to see that we come back to positive growth over the corresponding period at any given point of time. Current year, we have been able to reduce the reduction in number of sales over the last year because we could not repeat those policies which were sold, the par products at a sum assured of between 1 and 2 lakhs. They are not available anymore, and hence the numbers have taken a negative growth. That is the situation. In terms of the advantages of what we are facing is that the average ticket size has gone up on all the buckets, and we are able to get some high ticket sales premium that is coming up through. So going forward in the current year, we would like to have a decent growth over the entire year's premium, whether it is top line or APE. We are likely to be showing a good positive growth is what I am looking at. I don't want to give any particular number as a guidance or anything like that, but we will be showing a good growth this current year.
Okay, I understand that no particular number, but if I could get some more hint on the number. You said the policies will be lower, but per policy size would be bigger in this year. Keeping that in mind, if we have to consider 3 options, low single digit growth, mid single digit growth, or high single digit growth, which cohort would you be closer to?
I would certainly love to aim at a high single digit. Now, high single digit, it can even touch a double digit. That is what I would like to certainly.
Perfect. Now, coming to the value of new business also, despite the AP being low, retail AP being low in the first quarter, you managed to grow your VNB by about 20%, 21% in the first quarter itself. What helped you get that higher value out of business? And 21% VNB growth in the first quarter, are you confident of sustaining this thing? Because as you said, AP will pick up as the year progresses. Are you comfortable and confident of sustaining 18 to 22% of VNB growth in that range for the year?
I would not like to guess a growth in VNB percentage, but certainly we will be looking at a VNB margin which is above what we reached on 31st March 25. That is something which we are working towards that. There are, as you said, how did we manage? It's not a question of managing. One, there had been a change in the economic assumptions. The interest rate cycle has moved down over last year. So the RFR assumption is the one which has a impact on the VNB margin, which has brought down the VNB margin. But there are other factors. One is the expense ratio, the expenses assumption. We have had a lower expense ratio last year, and we are optimizing on the costs. So that will continue for some time. So that is one assumption which has helped in increasing our VNB margin. And third, naturally, the directional change that we brought over from 2022 of increasing the contribution of the non-par APE. That is, the product mix has contributed for increase in VNB. The expense assumptions have increased our VNB margin, but the economic factors has brought down. So the net effect is a small growth in the VNB margin compared to last year.
Correct. 17.6% was the VNB margin for FY25. You're saying you'll definitely be higher than that.
We should be.
Could this actually go closer to the target which was spelled out long ago of 20% for FY26?
I think we have not given any target or guidance for VNB margin ever so far. We are working at improving our performance, improving the standing of the corporation in the Committee of Insurance Companies has been the focus of LIC, and we'll continue to work towards it. Certainly, as you said, we'll be looking at a positive increase over the last year's entire year VNB margin. Is certainly we are aspiring for.
So definitely it'll be higher than 17.6.
That's what we are working for.
Okay. Now, share of non-par, you also spoke about it. You've crossed 30% in the first quarter in terms of individual APE business and the share of non-par there. The target initially was 25%, it got crossed, now it's 30%, and it's helping your VNB margins. Now, what I want to understand is, what is the target that you have for FY26 in terms of having the non-par share of individual APE business? Because that's something that you'll be able to understand and you'll be able to guide and work towards it through product launches. What is the target of non-par share?
See, in July, we have launched 2 new products which are also on the non-par bucket. Navi Jivan Shri, both on a single premium as well as multiple pay premiums has been introduced. That's also gaining a good traction right now. We will be introducing a few more products during the current year, but this time we can have a combination of both non-par and par in this that we are looking at. We are also looking at, we are an insurer which has nation first as our motto. So we need to cover every person who has to be provided with life insurance cover. That's the idea. And regulator has also come up with insurance for all by 2047, which can be achieved only with a major contribution from LIC of India. So we had to look at products which will cater to the urban and the elite customer needs, as well as to those who are the ones who can be affected by any calamity. They also we have to take care of. So we may have a micro insurance product also we are looking at. We are looking at plugging creating a product portfolio which does not have any product gaps. That's what we are looking at. So we may have a par product or 1 or 2 par products also introduced. We still look at the same trajectory of increase in non-par APE share continuing for some time. It may increase from what we are currently to some more numbers, but stabilize at a maybe higher than the current levels.
Welcome back. Well, for the markets, still weak. In fact, the broader markets are showing further pressure. We have the mid-cap index, which is now down around 1% at the low point of the day. And the advanced decline ratio is also firmly on the declining side, around 2,000 stocks declining to around 1,850 stocks advancing on the Bombay Stock Exchange. Just want to point out that on a week-to-date basis within the Nifty stocks, Adani Enterprises as well as Apollo Hospitals are your top losers on a week-to-date basis. So Apollo Hospitals lost around 3% of its market cap. It's still due to release its numbers, and Adani Enterprises is now down around 7.6% at current reckoning. But nonetheless, let's talk about a couple of more numbers. Biocon is in focus, reacting to what was a weak Q1 performance with the revenue growth below estimates and the margins also contracting. I did catch up with Shrihas Tambe, who's the CEO and the MD of Biocon Biologics, to discuss the quarter gone by. Began by asking him about his thoughts on the tariff situation with regards to pharmaceuticals.
It's very appropriate at this point in time that the negotiations are on between governments to find the right path to get to what makes sense to both countries. And when it comes specifically to pharmaceuticals, I am actually quite relieved that there is a sense that these are life-saving drugs. These are things that interruptions can cause a lot more damage than benefit overall. And there has been an exemption on pharmaceuticals globally. So that does help healthcare and patient care, particularly in the United States. So we're very grateful that that's happened, and we expect that to continue. It's always been the case because there is a humanitarian side to what we do as well, and we expect that that this will continue. Having said that, on the business side, I do want you and your viewers to be aware that that we've been and as a global company in the top 5 biosimilars in the world, we've been very resilient while we are having a large base in India. As a global company, we have a distributed manufacturing setup, including facilities which manufacture close to patients in markets that we supply, including in the United States. So to that extent, we have, of course, been able to balance and de-risk opportunities for us and our investors. But having said that, we're very hopeful that the exemptions on pharmaceuticals will continue, which will then benefit everyone in the chain.
You've mentioned that insulin is going to be a key opportunity for you all. How is the market playing out when it comes to demand and supply globally, given that there is a shift towards GLP-1 drugs? And how is Biocon placed to take advantage of this?
That's a great question, and I think something that is probably on everybody's mind, given the fact that the GLP-1s have captured the imagination of everyone at this point in time. One of the things that I must state is that the Biocon Group is in a very unique position. We are the only company in the world which has biosimilar insulin with an interchangeable status, which also makes GLP-1 or GIP-1 analogs or peptides. That puts us in a very unique position. Other than the originator companies, we are the only company in the biosimilar generic space which has the ability to provide patients and customers with both of these products. That tells you about the synergy that exists within the group. Now, coming to the question that you asked, whether one segment would lose out to the other, we do not see it that way. We, in fact, see them as being complementary to each other. Insulins have been around for a little over 100 years since they were discovered, and they continue to still be very much a part of the therapy regime that is used for glycemic control. The GLPs and the other peptides certainly are an increase in terms of how you control your blood sugars, but also manage weight. So there's an incremental benefit that you see. But there is certainly a lot of opportunity to coexist, and which is why we see an opportunity enhancement and expansion rather than one cannibalizing the other.
All right. Liraglutide, you've mentioned it's a big opportunity. When are you expected to launch in regulated markets such as US and Europe? And could you quantify the opportunity for us?
The liraglutide is amongst the early GLP-1s which have lost exclusivity. We have gone commercial. We were the first to get approval in the UK. And we will now go commercial increasingly in other parts of the world, including Canada and in selective parts of Europe. We will bring that product to the US as well. I won't want to specifically talk about timelines for competitive reasons. Also, in terms of what our guidance would be for any specific asset in a specific country. Needless to say, it's something that we are fully backward integrated in as well. We have the facilities which make insulins and the GLP-1s, so the facilities are the same. The device platforms that we use for our insulins, where we make millions of those every year, are the same that we leverage for liraglutide. So we have the economies of scale that will kick in. So it gives us the competitiveness. And we have the relationships that we have cultivated with customers, given that we have a sizable market share given our insulin's presence. So I think I will stop at that without necessarily giving you a specific guidance on numbers, but we are very well placed on liraglutide.
And are you as well placed on semaglutide?
We would like to believe so, and not just in semaglutide, but there's a series of other peptides that the company continues to explore, which is beyond semaglutide, and we will bring them to the market. If you've seen how focused we have been on the biosimilars front, you know that once we pick a therapy area, then we pursue it so that we can get full integration out of it.
Okay. Quickly, if you could just, give us some guidance on the debt, Mr. Tambe, because it stands at $1.1 billion on a consolidated basis. You have raised money via QIP. But give us a sense in terms of what the timeline would be in terms of debt reduction, what would be a level that you would be comfortable with, and any further steps in order to raise funds.
Ekta, you've known Kiran for a very long time, and Kiran's not someone who's very happy with any amount of debt. So she's always built a company which has been cash positive. That's been our legacy. We've never been leveraged. The leverage that you see and the one that you're discussing was taken up only when we did a very transformational acquisition a few years ago, which transformed Biocon from being a science and ops company, which was focused on development and science, to now being amongst the top 5 players in the world from a biosimilars perspective. So that's a massive opportunity for any Indian company to be on a global stage. And that's when she's made that decision. I think it's really a commendable piece. Now, coming to the debt part, the QIP has been a massive success. It was several times oversubscribed. We were able to raise 4,500 crores. That tells you that there's a phenomenal amount of interest. It was the first time we raised capital after the IPO, which was several years ago, over 20 years ago. And I think that response tells you that there's a lot of confidence in the business that we have built and the story that is going to unfold coming from here on. The proceeds of that QIP has actually gone towards retiring some of the structured investors or structured debt, as Kiran's called them in the past, to see that we get those investors out and we allow more flexibility in terms of how we want to grow the business from here on. We've been able to retire Goldman Sachs. We've seen the exit of ADQ, in the business, and we will see more structured equity investors who've been with us for a period of time during the course of this fiscal. That's where the proceeds could be used for.
Interesting insights there coming in from Biocon Biologics MD and CEO in terms of liraglutide as well as tariffs, what's expected there. But on that note, we're going to step into a very short break. And here's some good news coming in for our viewers. India's business news leader is now a click away. Introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC TV18 app from the Apple Store or the Google Play Store. You can just scan the QR code on your screen. Welcome back to Halftime Report on CNBC TV18. Let's look at some of these names that have seen a bit of an up move in the last 1 hour specifically. Kaplan Point, further up move has come in specifically in the last 1 hour. Sai Life Sciences, that also has seen a bit of an up move, 2% uptick in the last 1 hour specifically. And this is on the back of a good set of numbers that's coming from the company. Other than that, Netweb Technologies, JM Financials are some of the movers, specifically in the last 1 hour. Kalpataru Powers, that is another one that's buzzing in trade. Medanta also managing to hold on to strong gains. Let's not forget, in terms of the markets, we did see, Nifty go to 24,400 during this last 1 hour. Now, where is it going to be headed? We've seen a bit of a 50-point recovery. But Mangalam, what's the FNO setup looking like? What are we watching out for here?
Well, if you look at the FNO setup, it tells you that there is some recovery at the lows. The market is volatile, but it's still in a bit of a range. Why do I say that? Because we're grinding lower. If you look at the Nifty Bank and the mid-cap index, all these frontline indices are at the lower level in today's trading session, though fairly off lows. And that is where the important part is. The India VIX, which actually saw a big gash in yesterday's trading session, has now spiked up once again and just below the 12 mark. So that's something we will consistently watch out for, because the market, while it's moving off lows, the India VIX moving off highs, is typically positive for the bulls. Advanced decline ratio, that's the other data point that we monitor very closely through the intraday. And now as we speak, those lines are coming closer. When we started, in the hour, we had around 1,550 stocks in the red for about 1,000 stocks in the green. And now those lines have come slightly closer. 200 more stocks have been added to the green list than the red list. The other part, the Nifty low today has actually been about 50 points higher than the low yesterday. And yesterday, remember, from the lows, we saw a sharp spike. So can we see another spike in the second half of trade or not? That's what the bulls are betting on. The mark to watch out for on the way up, and that would denote a further up move, is the 100-day moving average on the Nifty. Yesterday we broke that intraday and then closed above that, and today we broke that intraday once again, and now we are hovering just below that. So 24,474 is the mark on the way up that you have to watch out for. 24,500 call writers, they're fairly active in today's trading session. A premium of 135 rupees, telling you that above 24,635 you could see some sort of resistance, but up until 24,600 to 24,635 there is up move for the market if we go ahead and cross the 100-day moving average. At the lower level, strong support seen between 24,350 to 24,400, which is basically today's low and yesterday's low. We're seeing put writing at the 24,400 and the 24,450 mark as well. A lot of individual stocks on our radar. Long positions being added on Cummins and IEX. Cummins, the management commentary in the conference call is something that the street likes. The stock is zooming up around 5%, IEX as well. And on the other hand, we have shorts which were caught on the wrong side for both Titan as well as LIC. Remember, Titan, the street was working with a margin compression. The company went ahead and reported a margin expansion. So those shorts caught on the wrong side. The stock has moved higher and is seeing some short covering. Similar is the case for LIC. But a lot of short positions are added on Mazagon Dock, despite good numbers on Kalyan Jewellers, a big spike in open interest, and Bombay Stock Exchange, BSE as well. Finally, we'll watch out for RBL Bank. Why do I say that? Because yesterday, towards closing bell, we had pointed out that maybe the stock moves into FNO ban. It's coming into that threshold. This morning, it's crossed the 95% mark. And now as we speak, it's well above that 95% mark of market-wide position limits. So RBL Bank enters the FNO ban.
Okay, Mangalam, thank you so much for that. And just in those last 2-3 minutes also, we've seen a bit more of an up move come in. 20 points higher is what the Nifty is now at. 24,474.80 levels is what the Nifty is trading at as of now. But with that, we're going to wind down this edition of Halftime Report on CNBC TV18. Thank you so much for tuning in. Up next, your Business Lunch.
A day after hope of an early resolution on trade lifted stocks, uncertainty creeps in again, dragging equities lower. Utilities and industrials slip, while IT and healthcare eke out gains. Promoter entity Indian Continental Investment has offloaded a small 0.8% slice of its 2.47% stake in flagship Bharti Airtel for over 9,000 crore rupees. The transaction follows the sale of small lots, adding up to 2% since November last year. AU Small Finance Bank gets RBI's approval to transition to a universal bank in the first such approval in 10 years. The license offers greater flexibility in business and eases capital requirements, giving profitability a fillip. LIC and Max Life Insurance post strong numbers, beating estimates on value of new business and new business margins. The stocks perk up. Gold prices jump on COMEX after Trump imposes tariffs on import of 1 kg gold bars, the most traded lot on the bourse. Cryptos too get a boost, with Trump allowing 401k retirement plans to invest in them. Hello and welcome to Business Lunch live from the CNBC-TV18 Motilal Oswal studio. I am Bamakshi Thoria, and let's take a look at what the markets are doing at this point of time. It's a red-looking screen. The Nifty for now is trading with a cut of almost 150 points. The mid-cap index also dealing under quite a bit of pressure. It's down almost 1%, and the advanced decline ratio does reflect that. The advanced decline ratio largely in favor of the declines. Now, as far as sectoral indices are concerned, we only have two sectoral indices which are in the green. We've seen some recovery come in on Nifty Energy, but Nifty Media is the one that is taking the cake today. Saregama, Network 18 are some of the counters that are doing quite well. But on the flip side, it's the metal names that are taking a very big hit in today's trading session. Nifty Metal is down almost 1.5%, and Nifty Realty as well reeling under pressure. But apart from that, there are a lot of stocks that are moving around in trade. Take a look at some of the new listings like NSDL. That stock last I checked was up almost 17%, and this is after reporting a 20% jump yesterday. Apart from that, take a look at MNB Engineering as well. It had a tepid listing, but the stock has picked up momentum. See that, there you go, NSDL up almost 17%, and MNB Engineering is the other one that I'm talking about. It's a new listing as well, and that stock too is gaining momentum in trade today. But moving on then, let's get started with the show. And US President Donald Trump has said that there will be no trade negotiations with India until the dispute over tariffs is resolved, following his administration's decision to double down on tariffs in India. Listen in.
Do you expect increased trade negotiations, since you've announced the 50% tariff?
No, not until we get it resolved.
And in a bid to strengthen ties amid Trump's trade threats, Brazil's President Lula da Silva dials Prime Minister Narendra Modi. Remember, this comes as both countries get hit with the highest tariff rates from the US at 50%. The two leaders agree to enhance cooperation in trade, technology, energy, defense, agriculture, health, and people-to-people ties. They also exchanged views on regional and global issues of mutual interest. Well, separately, Brazilian president also said that he saw no room for direct talks with Trump as US tariffs of 50% on Brazilian exports took effect. In an interview from his presidential residence in Brasilia, he said, and I quote, "My intuition says that Trump doesn't want to talk, and I'm not going to humiliate myself." The leader also said that Brazil is not about to announce reciprocal tariffs. Well, earlier today, we also spoke to Sivaramakrishnan Ganpati, who's the Vice Chairman and MD at Gokaldas Exports, to assess the impact of Trump's tariffs on the textile sector. The management in their Q1 con call said that tariffs will likely impact the volumes in the second half of the year. Let's listen in to what he had to say.
20% is the minimum tariff on most of the large apparel manufacturing nations. So 20 is the new zero in many ways. And 25 was just 5% above. We could have handled it. But an additional 25% is something which we are, watching. We are seeing, how long is this going to be before some normalcy could come in. For Q2, those orders were placed long back, so I don't see any problem as far as Q2 business is concerned. For Q3, those discussions are yet to begin. So we have not seen any customer cancel any order so far, but discussions are on as to how do we deal with it, and it will play over the next 2 weeks, I think, for Q3. As far as the burden share for 25% is concerned, it's also speculative. As I said, our net profit margins are in single digits, net profit margin. So there is a limited room for us to absorb. I think the rest of it will have to be absorbed by the others in the supply chain, including the retailer.
Well, that was the management of Gokaldas Exports. Keep in mind, the stock has taken a hard knock ever since the tariff talks had been announced. But let's hear what Timothy Mole of Goldman Sachs had to say on how the markets is reacting to Trump's 100% tariffs on chips and his take on India's total tariff rate, which is at 50%.
First, there's been a great deal of uncertainty about the tariff environment for reasons, I think, which are pretty clear. The fact that we actually have hard numbers, maybe there's need some fine-tuning, as Lynn was just mentioning, but they're hard numbers pretty much across the board, means that the uncertainty level has diminished. And you can quantify that with publicly available economic policy uncertainty indices. The market really, I think, is wanting clarity, not just the market, but actual manufacturers. Because in an environment where you don't know what the rules of the game are, it's very hard to commit capital and make investment decisions. And that's especially true for the very large, big-ticket investments, such as is the case for semiconductors. Our economists have quantified the risk here that if the full 50% tariffs are implemented, then that could mean an additional 0.3% downside to our GDP forecasts. And we've tried to quantify that in terms of the risk to earnings, which could be in the order of 2-3%, perhaps a bit more, to our MSCI India earnings forecasts against a baseline expectation of 11-12% growth this year. So I think that the Indian market, which is expensively valued, still at 22 to 23 times forward earnings, now faces an additional headwind, and I think that supports our somewhat less immediately positive view on the market, where we're market weight as opposed to overweight China, Japan, and Korea.
Well, moving on then, the Supreme Court is expected to hear JSW as well as Bhushan Power and Steel insolvency case today. Ashmit is here with more details on this. Ashmit, what are you picking up?
Well, this case has been a complete roller coaster ride as far as JSW is concerned. Bear in mind that in the month of May, the resolution plan was scrapped, a huge setback for them. And then just last week, we had a recall of the Supreme Court judgment. The Supreme Court recalling its judgment came as a big relief. And just as JSW Steel was about to heave a sigh of relief, now we understand that the banks have come back with a curveball. They've thrown a curveball, a fresh turn in this roller coaster ride. They've changed their position on two critical issues. Number one, bankers, the COC, the lenders are now seeking the EBITDA for the period of the company was under insolvency. This was a dramatic shift in position as of May 2025. The lenders had been saying that they're comfortable with this EBITDA money staying with the corporate debtor, which happens to be Bhushan Power and Steel. Now, they're saying that there is commercial wisdom that has prevailed on the bankers. They're changing their stance. They're aware of it. And they're going on to say that they want to avoid unjust enrichment, basically saying that JSW Steel, when they come on board with the resolution plan, will be coming on board with their 19,000 crores, as well as the EBITDA for the period that the company was under insolvency. That's only one, however. There's a second curveball. The second curveball is the lenders are now saying that in an admitted departure from their earlier stance, they now want an interest to be paid to them for the delay that has been caused in the implementation of the resolution plan. They want that interest bill to be also footed by JSW Steel. So again, two strong curveballs coming JSW's way, a fresh challenge that they'll have to address when they begin arguments. We understand the arguments will begin shortly at 2 p.m. today in the Supreme Court.
Well, thank you so much for that, Ashmit, and we'll come back to you for more details as well. But moving on then, the Union Cabinet meeting is underway and sources say a proposal to compensate state-owned oil marketing companies for losses incurred on the sale of liquefied petroleum gas could be considered. Now, in the same meeting, the Cabinet is also likely to approve the subsidy payout under the Pradhan Mantri Ujjwala Yojana, which is a flagship welfare scheme aimed at providing subsidized cooking gas to low-income households. Well, moving on then, Ria is now joining us with some of the top stocks that are buzzing around in trade today. Ria, I'm sure it's a long list.
Well, yes, ma'am, actually a long list indeed, and all on the back of their Q1 numbers. First, taking a look at LIC, this one is up around 4% after beating estimates for Q1 numbers. New business premium has gone up by around 5% on a year-on-year basis, and the VNB margins have also expanded by 146 basis points, coming in at 15.37% in this quarter. For Biocon, on the flip side, this one is down by about 3% after a slight miss in its numbers. Revenue growth at around 14.8% versus estimates of 19% growth. However, margins have been strong at 19% versus just about 12% in Q1 of last year. For Schneider Electric, 5% lower circuit for this stock. The net profit has declined by around 15% on a year-on-year basis, and revenue has seen an uptick of around 5% compared to the previous year. Cummins India has seen a very strong performance in this quarter. The stock is up almost 5%. We've seen a beat across the board for this one. Revenue has seen an increase of around 26% compared to the previous year. Net profit also very strong growth of 40% compared to Q1 of last year. For GSFC, the stock is also up around 7%. Margins have expanded by around 380 basis points on a year-on-year basis. Net profit also seeing a big jump of around 51% on a year-on-year basis. Kalyan Jewellers, however, is down over 9% today, even after posting a very strong set of numbers in Q1. Net profit has seen an increase of around 49% over the previous year for this one. The last stock that we're keeping an eye out on is Data Patterns. This one is also down around 7% after posting a very weak set of numbers this time around. EBITDA and net profit have declined by 14% and 22% versus estimates of growth of 27% and 17%. So very weak set coming in here. Margins have also contracted by 341 basis points for Data Patterns.
Well, thank you for all of those details, Ria. But moving on, State Bank of India will report its Q1 earnings today. And what are some of the key expectations? Gaurav is joining in with all of the details. Good afternoon, Gaurav.
Well, good afternoon. When we talk about SBI's Q1 update, we are expecting good growth in terms of loan book, but at the same time muted performance in terms of earnings. So let's understand the numbers first. Loan book growth is expected to be somewhere in the range of 12% despite having the biggest loan book across banking segments, whereas deposits are likely to increase almost by 10% on a year-on-year basis. On the back of that, when we talk about net interest income, they're expected to increase almost by 1% on a year-on-year basis, although there may be a decline on a sequential basis, and that is the reason why net interest margins are also likely to decline almost by 10 basis points to around 2.9%. Now remember, earlier management had said that they will be trying to keep net interest margins around 3% level. So anything and any commentary around that is going to be a key thing to watch out for. When we move on to operating profit, now we may see 3% increase on a year-on-year basis in terms of operating profit because of the lower OPEX and at the same time higher other income. We have already seen this trend across other banks, so there is some positive bias over here. When it comes to credit cost, we may see a little bit of inch up in this quarter because agri is something which is usually weak for Q1, and as a result profit is likely to decline almost by 2% on a year-on-year basis. Now going ahead, any kind of commentary on net interest margins is a key thing to watch out for. The commentary on growth is also something that the market will be keenly watching out for from SBI. And lastly, commentary on the asset quality. Now remember, this is the biggest bank, and even though Q1 is behind us, we will be watching out on how the commentary is going to be from the bank going ahead, which can actually also reflect in the market itself. So definitely these three things we will be watching out for. But in terms of number, stable number is what we're expecting from SBI in this quarter.
So stable stat for SBI this time around. The stock ahead of its numbers is trading with a cut of almost 1% or so. We'll be, in fact, hearing from the management soon as well. But on that note, let's slip into a very short break. Remember to tune into the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and the Global Lens at 8:30 p.m. Well, the Nifty 4 now is trading with a cut of almost 161 basis points, still in the red. The mid-cap end of the market also not doing too well, down almost 580 basis points. The mid-cap end of the market, of course, trading at the day's lowest point. And SBI now just reported its numbers just a short while ago. The stock is seeing a very sharp spike. The net profit has come in much above estimates at 19,160 crores as compared to a poll of 16,664 crores. More numbers will also trickle in. Keep in mind that Gaurav was highlighting that a stable set was expected to come in this time around. We'll get more details on that. And in fact, we'll also be joined by Gaurav, who will take us through the numbers. But for now, we're looking at SBI's net profit at 19,160 crores. Apart from that, let's also take a look at some other names that are also doing too well. It's KRBL also in focus. So we'll keep getting you more numbers from SBI. We also, in fact, have Prakash Diwan joining us to give us his first take on the SBI numbers. Prakash, for now, the net profit has come in much higher than what the street was anticipating at 19,160 crores. What's your first take on how the numbers have panned out?
So honestly, we'll have to wait for some more numbers to emerge, to come out for a real distinct narrative to emerge. But yeah, these numbers on first cut definitely look better than what you would have penciled in. So as of now, that is positive. But what has led to this? Most times, SBI numbers are well understood once the management explains these, because there's so many moving parts to it, and then it's a bellwether, so you would rather understand a bit more detailed nuances of the improvement, and then it's easy to take a call. But yeah, on first cut, definitely very positive.
All right, Prakash, so the NII number has come in at, it'll just come up for you on the screen. It has come in at 41,070 crores odd. It's more or less in line with what the street was. In fact, it's slightly lower than what the street was expecting at 41,650 crores. So more numbers definitely trickling in. Net profit up almost 15% this time around. When it comes to SBI, I think the credit growth will be an important number to watch out for this time around. What are the other factors that you'll be keeping an eye out from the management's commentary then?
So that's what I said, whether it's the NI numbers, whether it's the net profit numbers, they all look positive because of, I think, broadly a change that's happened vis-a-vis last year. And that is, SBI went through a bit of a phase of, a corrective phase of consolidation on its books, sometime in that April, May, June, and there was a setback on the agri portfolios, the MSME portfolio, which probably is what I would love to see has not kind of been repeated this year, because usually April-June quarter is weak on account of those issues, seasonality issues. But if they've been able to broad base the growth, the credit growth has come from other parts as well, then naturally your reliance on just a few sectors that are likely to not do well is less. So I would like to hear that. And in terms of cost of funds, and they've just recently kind of raised capital as well. In terms of cost of funds, if they've been able to keep that under a lid, even in the elevated interest rate regime, that would have kind of paid off somewhere. So we'll and then that's going to help everybody else as well going forward, because cost is coming down. SBI is probably the largest in terms of benefiting from softer FD rates and all of that. So we'll wait to see these 2-3 things and then kind of build some sort of anticipation for the quarters ahead.
Well, absolutely. Thank you so much for that, Prakash. But we also have Ikta joining in. Ikta, is there something you'd like to ask Prakash?
Well, yes, absolutely. Just wanted to touch base in terms of the SBI numbers. The NII, as expected, is absolutely flat this time round. But what has stood out is the profit is up 12.5% on a year-on-year basis as compared to an expectation of a subdued profit. So that actually stands out, and that would be interesting to see what exactly has resulted in that. And one of the key parameters is the other income, which is higher this time round. So that has definitely aided the profits. And the provisions. The provision same time last year was around 3,449 crores. So maybe we can pull up the provisions figure to figure out whether or not there are lesser provisions this time, which is really aided. So as you can see, the net profit is up around 15% in terms of a total this time round on a year-on-year basis. But Prakash, I just wanted to before that, in fact, we have Ashutosh Mishra, who is joining in from Ashika Stock Broking to give us his perspective on the numbers as well. Ashutosh, thanks very much for taking the time out.
Thank you.
What is your sense in terms of the bottom line that we've seen for State Bank of India? Other income higher, provisions we're just waiting by in terms of the numbers.
Yeah. So we have in this quarter, we have seen the bank has given a positive surprise on treasury profits front. So SBI, also having access treasury holding. So definitely that profit has flown to the SBI also. And apart from that, provision also we are seeing that some positive surprises there in provision part. What is important is to look at the loan growth, and that is very important for SBI going forward from here. So what the loan growth will be the most important part for me from here on.
What is your expectation in terms of advances this time? Because FY25, credit growth was probably a shade below the guidance of around 14 to 16%. What is your sense in terms of what they could do in terms of advances this quarter, and how are you extrapolating it for the year as well?
We are taking roughly 14.5% growth in advances, and they have raised the capital. So given the buoyancy which we are expecting in a whole capex as well as retail MSME part, we are expecting the growth will be quite good for this year. Till now, it has not happened. So that will be the key monitorable across the banks. And that the reason for that is that we are going to see NIMS compression across the banking sector. So profitability growth will only come to the banks which are able to deliver healthy performance on loan growth along with managing the cost in the best possible way. And that's why loan growth become very important parameter to look at.
Okay, all right. So you said that 14% is your estimate for the quarter, for the year?
For the year.
For the year. And for the quarter?
Yeah. It is 1.6%. First quarter is normally soft in the terms of loan growth.
Okay, Prakash, what's your estimate in terms of advances this time for SBI?
So I honestly, it's difficult to put a number. The estimates that we are looking at doing is it's more of the overall credit growth in the system, and SBI could probably do about 200 basis points better than that. So right now the credit growth in the entire system is just about 8.59. So SBI should be in that 11% odd zone. But, that's what I think one point that Ashutosh also mentioned, I just want to reiterate that. Credit growth is also a function of the cost of funds that you can manage. And SBI probably stands a better chance than all the other banks on that count. So we've seen corporate loans being where they are, but it's the combination of MSME and large corporate loans which will probably help SBI outperform the industry. So let's wait for the commentary to give some sort of a semblance on this.
Absolutely. And I think the commentary would be crucial in terms of the asset quality as well, because the gross NPA and the net NPA on as of now don't seem to have any sort of huge change on a sequential basis. They're quite stable even in terms of the ratios. It stands at around 1.83 versus 1.82. So no real big surprises which have come in terms of the gross NPA as well as the net NPA. That would be crucial in terms of commentary. Just on that point, Ashutosh, wanted to bring you in terms of asset quality. What are you expecting in terms of, say, any kind of surprises from larger, chunkier accounts as well as smaller accounts this time?
Normally, first quarter, they witness a higher slippages from the agriculture and MSME part of it. And banking sector has also witnessed a similar type of thing. So, sequential increase in slippages may be there, but that is not to worry any sign. This is a seasonal phenomena which we have seen in a multiple year SBI doing in first quarter some stress recognition and which get corrected in the subsequent quarter.
Okay, Prakash, quickly then, the press conference is going to be in half an hour from now. Expectations and what should we keenly hear in terms of SBI management?
So, it's, I think the most awaited parameter, while it's loan growth, advances growth, it's the mechanics of how they're going to be bringing this growth in, and any kind of a asset liability mismatch. The transmission is a challenge, and you still can't reduce borrowing costs very, very quickly. So how do they manage that is what I will be very happy to hear. And then, of course, growth is a function of the overall economic cycle. But if they're ready for it, then they stand a better chance to get allocations from investors. So that's what I would like to hear.
Okay, all right, Prakash as well as Ashutosh. I'm sure the devil really lies in the details, but as of now, SPI is just about lower by around 1.4%. NII absolutely flat, profit better than expectations. Other income has aided in terms of profit this time. Gross NPA, net NPA ratios absolutely flat and maintained. We'll wait by for details such as advances as well as what they do in terms of asset quality. Vamakshi, over to you.
Well, thank you so much for that, Ekta. You know, SBI definitely saw a small spike after the company reported its numbers, but for now, down and out in trade today. But with that, that's all the action we have on this edition of Business Lunch. Don't go anywhere. Midcap Radar comes up next.
Good afternoon. You're watching Midcap Radar. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Hormas Patakia. With me is Mangalam Malu. And well, every recovery on the Nifty is getting sold into right now, Mangalam. And we are on course for a 6th straight weekly loss.
6th straight weekly loss. The only solace that we keep giving ourselves every week is that today's low is not as bad as yesterday's low. That's what's taking place on the Nifty right now as well. But it'll be very interesting to see, how SBI reacts to, what was slightly subdued, but now you do have the slippage data coming in at the bottom of your screen as well. Slippage ratio at 0.75%, slightly higher quarter on quarter, but has seen some moderation year on year as well. We'll get to more details on SBI and, the numbers that come by as the presentation gets uploaded and some granular details do get displayed. The stock hovering with a cut of almost 0.7%. Let's talk about all the top stories that we're tracking this afternoon. A day after hope of an early resolution on trade-lifted stocks, uncertainty crept in again, dragging equities lower. Metals and realty slip, while IT and oil and gas did manage to eke out some gains. It's the mid-caps which are dragging.
AU Small Finance Banks gets RBI's approval to transition to a universal bank in the first such approval in the last decade. The license offers greater flexibility in business and eases capital requirements, giving profitability a fillip.
Cummins India surges after reporting their first quarter numbers. Exports see strong growth for the third straight quarter, which, while margins at the highest since the fourth quarter, management commentary in the conference call even better.
LIC has reported strong numbers, beating estimates on the value of new business and the new business margins. The stock is up over 4%.
Biocon under pressure after its revenue comes in lower than estimates in the first quarter. Margins and profits miss estimate. Management tells CNBC-TV18 they're hopeful the exemption on pharma will continue. Data patterns, on the other hand, slips as revenue, margin and profits, all of them declined in the first quarter. Ramco Cements too is among the top mid-cap losers due to a sharp volume decline. Speaking about the markets right now, 24,450 is where the Nifty is at, about 50 points away from today's low, though we have SBI, which is currently lower, and that's taking the Nifty bank lower by about 0.02%. On the way up, though, we have BPCL, NTPC, some of these old economy stocks doing a lot better. And on the other hand, we do have, IEX and Cummins as well from the broader markets doing a lot better as well. We do have Crompton, which is now spiking right now from the lows. So watch out for that stock. Still sitting with gains of almost under 1%, but it has seen a recovery from the red, the red pack. The stock that is surging right now and with good volumes and on the back of good numbers is KRBL. A 15% up move is what we're seeing on that counter. So watch out for that one. And on the way down, we have Godfrey Phillips, which has been extremely volatile, did well in the morning, recovered from the lows, but that recovery, just like the market, has been sold into, and currently it's back around flat terrain. But all the movers and shakers, we do have Hormas, who's moved to the big wall to tell us about those stocks. Hormas.
Well, interesting list. We start off with the losers then in the broader markets today, considering the tilt of the market. Ramco Cements is one such loser. It's sprung up to the lows of the session now, 6.5% lower on that stock. Chambal Fertilizers is the other one as well. And Jindal Stainless, after yesterday's move, is down another 5% in today's trading session. You spoke about KRBL as a positive earnings reaction. That definitely features as one of those. But look at Kalpataru Projects, look at Cummins India after some strong management commentary as well in the earnings call. And LIC, well, is given up some of those gains, still holding on to a 3.5% advance. Well, on the flip side, though, not so pleasant earnings reactions coming in from Subros. Slight recovery from the lows of the day, still down around 6%. Data Patterns is a defense stock that has recovered from the lows. At one point was down almost 9%. And Birlasoft too, trading with losses of around 3.5% today. On the volumes front, the stocks that are bucking the trend, some of the healthcare names, Global Health is one of them, 6% higher here. Sai Life Sciences are a choppy trading day, but still around 5% higher today. And GIC-RE has also moved back to the day's high, 4.5% higher on very strong volumes. And lastly, some newsmakers today. Coforge, after one of its key clients cut its guidance, is now down 5.5% down to the lows of the day. And Kalyan Jewellers, what a sharp fall that stock has seen since the morning, now 9% lower here. And Talbros too has now turned negative on a year-to-date basis, 5.5% lower on this stock as well.
All right, Hormaz, thanks a lot for that. With that, let's go across to a note that we have for our viewers. You can unlock a world of exclusivity, expertise, and influence, all of them by just becoming a member of CNBC TV18 Access, which is our premium members-only experience on CNBC-TV18.com. This membership includes access to CNBC TV18's flagship events, interactions with our journalists, all of us, and curated studio tours as well, which gives you e-learning sessions and masterclasses along with some lifestyle benefits too. Welcome back. Look at some of the Adani Group stocks. They are, specifically lower in today's trading session, and the entire group actually. If you look at the Adani End stock, down about 3.5%. Adani Ports is lower by about 2% as well. In the broader markets, we have Adani Total Gas, which too is currently at the lower end of today's trading range. So we'll watch out for this group. Typically, stocks of this group move in tandem. So we'll watch out
as the day progresses from here on. But the stock on our radar right now is Greenlam. The revenue growth for the company was good, 11% odd. But the EBITDA was impacted by one, the forex loss, and the second part is that the new plant which came on stream, which meant that capacity ramp up is yet to happen, while expenses have been taken on board already. On the bottom line, they reported a loss, again, because of higher depreciation and higher finance costs. We have Mr. Mittal, who is joining in to detail the numbers, but more importantly, give us an outlook for the remainder of this year itself. Thanks a lot for joining in. Always a pleasure speaking with you. First quarter, 11.5% revenue growth. No different from what you did in all of FY25. But I remember you had said that you wanted to, see the revenue growth come by around that 18 to 20% mark. 25% of this year is over. Do you think you will get to that 18 to 20% mark by the end of this year?
Well, thank you first for having me on your show. On the growth, if you see the Q1, the domestic business actually has grown at about 22%. It's the international business who struggled a bit in Q1, and I'm fairly confident this will catch up, in the coming 9 months of this fiscal. So we still maintain we should be aiming at we are aiming at a 18 to 20% kind of a top line growth, considering the new plants, new capacities, and the markets we have. So yes, I think to answer your question, that's what we're looking for. Yeah.
So, Mr. Mittal, what are the capacity expansion plans that you have on the anvil? And for your chipboard plant, do you envisage any margin improvement going forward?
So on the capacity expansion for this financial year, we have no further capacities to be added. In fact, over the last 3 years, we have invested nearly 1,500 crores and built 4 plants in 3 locations. So at this moment, we are sitting pretty on capacities across all the product offerings. So FY26, we have no plans of adding more capacities. Our entire focus is on execution and ensuring the capacities we built over the last 3 years, they convert to revenues and profitability improves and cash flow improves. So that's the focus. On the chipboard, our sense is because last quarter, Q1 was the first full quarter we had of chipboard production. The plant's doing very well. The product quality, the quality norms, the acceptance of the market, I think is best in class already in the market. And as we move ahead, we think revenues will keep growing up and operating losses at the EBITDA level will keep reducing. Although on a full year basis, we still expect we'll not be able to be EBITDA break even in FY26. But we think as we move ahead, we'll keep improving that part of the business also.
Could you give us a sense on what kind of margins are you targeting? Because I remember the last time you joined in, you did say that laminates and plywood margins will improve or the losses in plywood business will reduce.
Right.
Veneer, which is very close to breaking even, will continue to improve. And you have, panels, which the chipboard business, which is currently loss-making. You think it'll take some time before that breaks even as well. So by the end of this year, taking care of the fact that we don't have control over forex, what is the kind of margin that you're targeting? First quarter, you did about 6.5%, including the forex loss.
So on the forex, I want to say that we've had about nearly 18.5 crores of notional forex loss, which if you see the PBT, at the PBT level, and depends on how the euro moves versus the rupee. On our operational business, which is procurement and sales, we actually export more to Europe than we import. So this is only on the new chipboard plant, the loan which has been, the debt which has been funded by a German bank where there's a notional forex loss. On the margin, if you look at Q1, if you exclude forex, we are nearly at a 55 crores of EBITDA. And then if you go segment-wise, laminates is shy of 14%. And there are losses in the chipboard and the ply business. The plywood business losses have reduced and revenues have grown at about nearly 30% in Q1. So I think as we move ahead, I expect laminates margins to improve, ply losses to reduce, and losses at the chipboards to also reduce. On a full year basis, it depends on where we close revenues, but considering the growth targets we have, my senses will be more like this year will be more like 11-12% kind of a blended EBITDA margin across businesses. Raw material costs at the moment look stable. So if that does continue, it depends on how revenues go. And, so I think that'll determine where the margins are and how we close this financial year.
What about debt, Mr. Mittal? Your debt figure has gone up slightly from last year and from the previous quarter as well. Where do you see that peaking out? And do you see that peaking out this year? And are there plans to take on more debt? When particularly because you mentioned you don't have any capacity addition plans this year.
No, so we have no plans to take on more debt. This is already at the peak. And because of the Forex loss, some of the debt increases actually because of the accounting. So about 18-20 crores of debt has gone up because of the euro currency movement versus the rupee. So we don't need to take on more debt. And I think as we move ahead, the cash flow should help us, reduce some debt. And there's no plans to take more debt. So this debt level is nearly at the peak. So that's where we are in the debt position.
And what about, the thing that I wanted to understand from you on working capital, it's been disciplined despite the sort of uncertainties that we're seeing. 59 days. Do you maintain this 55 to 60 day range, or do you see any improvement from here on? And the second part is on exports. There is a fair amount of uncertainty. You had said that you're shifting focus to domestic versus exports, and the mix should be 60-40. Where does that stand at, and what's your prognosis for any sort of improvement in exports?
So your first question was on the
working capital.
Okay, yes, on the working capital, you have to appreciate that over the last 3 years we've had new businesses, new plants. So despite that, working capital has been reasonably well managed. I think more or less best in class in our industry. And I think going ahead with with our focus on only execution, we don't expect any lumpy inventory or range to come in to the working capital. So as revenues go up, our sense is the number of days will keep improving the working capital. So that's the story on the working capital. On the exports versus domestic, we export to nearly 100 countries globally. And with the uncertainty in US is hardly 2 to 3% of our overall revenues. So our sense is that export business will also grow, although the shift between domestic and exports in terms of mix will happen, but that's not because exports will not grow or will slow down. It's because the chipboard business and plywood business is largely domestic oriented. So that will alter the mix between domestic and exports. But exports will also continue to grow, and we see a positive way forward for us in the international markets too.
All right, Mr. Mittal, pleasure having you as always. Thank you for sparing time and joining us. Wish you good luck for the rest of the year as well. Numbers continue to trickle in. ASAF Small Finance Bank, a net loss this time around compared to a profit last year. The stock is down around 4%. Just pull up SBI before we go into that break. And the slippage number for SBI was higher on a sequential basis. And the stock, though, has recovered from the lows of the day, still 0.5% lower. Take a short break. More on the markets on the other side. Stay tuned. Welcome back. Time for our special segment, Crypto Corner, where Manisha tells us all about what is happening in the world of the digital currency. Let's go across to her and find out what is fueling the crypto rally.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Oh, well, absolutely never a dull day here, but as we start our new segment here, and it comes on a positive and a higher note as well, because the US president overnight has signed a very important bill. This is the 401k retirement plan. Until now, the investments could only be done in case of stocks, bonds and cash. But now the 401k funds can be put in real estate, private equity and, yes, in cryptos as well. While, of course, this comes in as a very, very strong positive, the order also directs the Department of Labor to actually look into this as well on how and reevaluate as well on how crypto should be treated by retirement fund managers going forward from here. Well, interestingly, this could lead to crypto integration with broader financial system, bring it mainstream, and that is exactly something that the US has been working on for some time. Though there are experts and commentators expressing concern as well about higher degree risk and volatility that cryptos also brings on the table there. Interestingly, when you look at the last 1 year, we've seen a lot of positive, friendly regulations coming in US. The Bitcoin ETF is a success story that was launched in January 2024, and we've seen billions of dollars or inflows coming in for the Bitcoin ETF. And then it also has been about US, where we've seen the Genius Act go through. Clarity Act and Anti-CBDC Surveillance Act are a couple of acts that the US president perhaps could be signing in days to come. Genius is already on there. And then apart from that, it also has to do with a very strong June quarter that we saw. It perhaps has been the best on record. Remember, Bitcoin hit record highs in the month of April there, and it has been holding above that $110,000 there. Bitcoin volatility also is at its lowest since 2023, indicating that there is a maturing market. Remember, the adoption also comes in from corporates, companies, institutions, etc. And that has been giving much needed credibility to the crypto markets as well. Apart from that, when you look at the overall market capital, that has been on a rise too. $3.95 trillion at the last count. It did touch $4 trillion as well in the previous week itself. The final plate on the screen should come in on your screens that tells you on how the cryptocurrencies really have performed in this year and in the previous 12 months as well. So Bitcoin has given you 92% of returns in the last 1 year, and we've seen very strong gains, anywhere between 50% to 500% of gains. That is what Ripple really brought to the table as well. So many of these are second layer, first layer cryptocurrencies. These are the tokens that actually have established their credibility, are long-term investments, and that's the kind of gains that they have brought onto the table.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Thank you for that, Manisha. We take your leave on this edition of Mid Cap Radar. Your stocks on the other side.
Hello, good afternoon. Welcome to Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in as always. And markets, they saw recovery. And again, we're back almost near the day's lowest point as of now for the Nifty. 24,419 is what the Nifty is trading at, down 0.7% in today's trading session. But AU Small Finance Bank, that's what we're keeping an eye out on because that opened up with sharp gains. Now, why is that so? AU Small Finance Bank became the first small finance bank in almost a decade to get an in-principle approval for universal banking license from the RBI. The move is likely to improve the bank's brand acceptability and aid customer growth for the bank as well. My colleague Ritu caught up with Sanjay Agarwal, the MD and CEO of the bank, and began by asking about the plans that they have ahead. What should we be watching out for the bank going forward? Listen in.
Never imagined when I started 30 years back that we'll get to this level, So I think the credit goes to the Government of India, our RBI, the customers, the board, my employees, my friends, family, what a journey. So again, I wish I can be in that zone forever, right? But I think to be very precise, we are already a bank, right? And we are doing as a bank, many things, raising money, lending money, right? So much not will be changed immediately. Okay. This transition is, this approval is in principle. I think will take some time to really become universal. We have to do some formalities around our structure. But I would say the momentum will be so strong in our favor because if the validation has done by the regulator, then I think there is much curiosity around people that, what is AU, what they do, so it will be much easier working for us. I believe we can have a better growth numbers this year too. Okay. We can actually look for a better cost of money in immediate also because if people start believing in you, they can park the money with us. We were giving them little higher rates in comparison to our mid-sized banks. Yeah, sure. So that can also be addressed, So I think slowly, the whole benefit will come. Okay. But the immediate focus is on to really do that transition in terms of universal bank.
Okay, the transition period that you've been given, this 18-month period that you spoke about, why has the regulator to begin with asked you to transfer the entire promoter stakeholding of 22% to this non-operative financial holding company structure?
You have to appreciate that we just got the approval last night. Yeah. So we haven't got in touch with the regulator as of now that what is the reason behind it. Yeah, okay. But I would say on the face of it that it benefits me personally because my structure around holding is with me, my personal name and my family name, which is not that great in my opinion because it does not free me up, right? So I think the structure is quite progressive in my opinion, but the only challenge would be that how my whole tax angle will play out, right? So let me figure out. Okay. But for me, whatever regulator asks me, I will do that because we have an attitude of bank first, organization first. Okay. Yeah.
Well, your current shareholding at, a little over 22%, you have headroom to take it up to 26%. Is there something, if not immediately, in the near term, you would look at increasing your stake?
Ritu, I'm good enough, because I'm a first generation entrepreneur. And I think God is kind enough, that I've been irrationally rewarded till now. So there is no plan to increase my stake.
Okay, you said immediately some of the benefits, of course, will come from the stronger brand, but, you get this avenue to expand diversify your loan book as well. Corporate, for instance, is something you could do more of. PSL will come down from 60 to 40%. Give us a sense of what AU Bank will look like in 3 to 5 years from now.
Okay, so I think good question. So I would say that corporate finance is not in our immediate agenda because the corporate finance meet a lower lending rates, So we need to figure out our cost of money first has to go down. We are close to 7%. Our mid-sized bank, which is close to our size, is around 6%. So I think 100 basis point we need to come down first, which will not be easy so much, right? Okay. We need to really work hard to get to that level. So the focus would be more on that first. Okay. Second, I would say that in next 3 to 5 years, ideally, I want to be in retail only because there is much scope and space available. Idea is to remain competitive to NBFCs for lending.
Okay, that is the management of a small finance bank for you all. But let's talk about Walmart because that just reported its numbers. We're seeing a bit of a slide that came in the stock further after the numbers. We're seeing revenue have remained flattish on a year-on-year basis. There is a loss which is widened. Now, there is a one-time loss also that's come in, a one-time cost that is there of around 97 crores. And that is why the loss is much sharper this time versus last year. EBITDA is also seeing a fall this time. So we're seeing a bit of a fall coming in here. As of now, the stock is trading with cuts of 3%. Keep an eye out on Walmart and its numbers as well. On that note, let's slip into a very short break. But here's a reminder for our viewers. Unlock a world of exclusivity, expertise and influence. Become a member of CNBC TV18 Access, a premium members only experience on CNBC-TV18.com. The membership includes access to CNBC TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions and masterclasses and curated lifestyle benefits. Welcome back to your stocks on CNBC TV18. Nifty as of now still at the 24,420 levels is what it's trading at. But Let's bring on board our experts for today. We have Shaina Mukaddam, independent market expert, as well as Vaishali Parekh, Vice President, Technical Research at Prabhudas Leeladhar, to answer all your stock-related queries. Good afternoon, ladies, and thank you so much for joining us on the show as always. Let's get started with the first query for today. This is coming from Vinish Gupta, who's writing to us from Jammu. He's holding 300 shares of Anant Raj. This is at a price of 590 rupees per share, making a loss on this one. And other is Sterling and Wilson. They're holding 500 shares. They bought it at 320 rupees per share. So here also they're making a loss. Now he wants to know the long-term story for both this Anant Raj as well as Sterling and Wilson. Shaina, good afternoon, and what's your view?
Yeah, good afternoon. Yeah, so basically he's making, I think, a bit of loss on both, but it makes sense to continue to hold. Anantraj, and the numbers of both the companies were pretty good, first quarter numbers, they both have reported. Now, Anantraj actually, residential revenue over the next 2 to 3 years will, remain more or less stagnant or marginally decline. But you have the data center that will actually, start contributing in a big way to revenues, which actually, as of now, is minuscule. So to that extent, you can hold for the long term. Valuations, I think, if you compare it with, let us say, solar, with the Sterling and Wilson solar, is slightly more expensive. So if you want to hold one of the two, I would prefer holding the SW Solar. SW Solar now, as you know, is part of the Reliance Group, and they have done well. They have got a very good order book position of 9,000 crores. So I would hold it for the longer term.
Okay, you would hold SW Solar for the longer term. That's the view coming in there. Vaishali, good afternoon. And on the technicals, which is looking better? And he's okay to hold both the stocks as well. Does it merit holding both of them?
Hi, very good afternoon. I think it makes sense to hold both these because they are showing signs of, I guess the worst is over because both these stocks are coming out of its oversold zones. And talking about Anantraj to start with, I think 500, even the long-term chart is good, and we are seeing a bounce coming from the retracement. The previous high that we've seen is 1,000 levels, and now it's nearly 539. So keep a stop loss of 500 because we are seeing a cluster of support levels at these levels, and wait for it to bounce. The stock would gather more strength once it sustains above 650. And now talking about SW Solar also, I think it is an attractive level probably to average out at these levels and hold for a better bounce back.
Okay, hold for a better bounce back. That's the word coming in there. Let's move on to the next query. This is coming from Prasanna Kumar, who's writing to us from Chennai. He's holding 100 shares of Spandana Spurti. This is at a price of 460 rupees per share. This is average price. So currently the stock is at 249. Now he's asking if he should average further or wait for what should he do right now? Is the current level to average? Wait for a further correction? What should he be doing? Shaina, your view on Spandana Spurti. They're not asking if they should sell. So I think they're willing to hold. But is that a suggestion that comes in?
See, he has to take very urgent, immediate action. There is a rights issue which is ongoing. The price is at around 220 rupees per share. And I think today, Monday would be the last day for application for the rights. So either he sells the rights entitlement today, or I think latest Monday if he gets that opportunity, or then, I would not advise him to do anything as of now in terms of the rest of his holding. He can look at it post the closure of the rights issue next week. But I would say, it is better to switch from Spandana Spurti even at a later stage. While valuations are not expensive, the results are not out. They're making losses, continue to make losses. So I would say there are better opportunities available, but at least rights issue, please take immediate action.
Okay, rights issue is at least something as an immediate action that you can take right now. Spandana Spurti on the charts, Vaishali, any respite or any bounce back that's expected here, or, it's better to just get out of the stock? What's your suggestion?
I think it's better to give it a miss and shift to the other stocks.
Okay. Better to give it a miss and shift to other stocks. That's the word coming in on the technical front as well. But let's move on to the next query then for today. This is coming from Kunal Rao, who is writing to us from Jaipur. He's holding 145 shares of Lakshmi Organics. Average price is 460 rupees per share. Again, one more stock where they're making significant loss, right? So he's asking if you should stay invested in this one for the medium term or exit at these levels. Even is average an option for this as well? Shaina, your view?
Yeah, I wouldn't advise to average. while valuations are not expensive, it's about 1.5 times revenue. But at the same time, we have US now with the tariffs, the uncertainty for chemicals, agrochemicals. So I would say that it is better to, not add now. You can look at any bounce to actually exit.
Okay, look at bounce to exit. Don't add more. That's a word coming on the fundamentals. On the technicals, Lakshmi Organics, what should we be keeping an eye out on now? When you're looking at the share price also, in the last 1 month, the significant we've seen a 4-5% fall. Last 6 months also not done anything exciting, Vaishali. So now what's the strategy here?
Actually, even technically, I would say it's not showing any signs of improvement, whether it's on the daily chart or even on the weekly chart. So, unless and until the stock moves above 200 levels, I can say that yes, expect a bounce up to 220 or so to start with. But if one has to hold, keep a stop loss of 180. It's close to the crucial support of 180. So, keep a stop loss of 180, and if it breaks, then it could witness further selling pressure. So I would suggest hold with a stop loss.
Hold with a stop loss. That's a view coming in on the technical front. But we have Grasim that's reported the numbers as well. Losses seem to have widened. Revenue seems to have increased. We'll wait and see if there's any one-off that's in the loss as well. But as of now, revenues is up 34%. We'll keep an eye out on the numbers. That's Grasim's Q1 FY26 numbers flashing at the bottom of your screens for you all. Stock is, as of now, also trading with cuts of 1.5%. One spike up that you can see in the last few minutes that has come in. But wait out for more details on that number. Let's move on then to the next query for today. We have Alan, who is writing to us from Kerala. He is holding 200 shares of UPL at a price of 689 and 100 shares of Electra Greentech at a price of 1,144. So making some bit of a profit on both these. What is the future prospects of his investment should he continue to hold them? That's his query. Shaina?
I would suggest he takes profits of both, book on both the stocks, UPL as well as Electra Green. Electra Green, actually, there was a lot of news that they are not able to actually meet their manufacturing targets. And because of which, even the Maharashtra government is, I believe there is some news that they have actually cut some orders that they had placed. Valuations are extremely expensive. So take some profits off the table. Stock has performed actually. A similar story for UPL. First quarter numbers were very nice, healthy, and even the guidance for the rest of the year is good. But here again, I think the sword of US tariffs holds for agrochemicals, and US market is big for UPL. So I wouldn't take the risk. I would just take money off the table and then relook at both of them in a couple of quarters down the line.
Okay, better to just get out your profits instead of, seeing some losses. Maybe you can look at it a couple of quarter later, is the word coming from Shaina. Vaishali, your view, Electra Greentech as well as, the other stock that the viewer mentioned was UPL, I beg your pardon. So both these stocks, what should they do? Electra Greentech had seen that very sharp run up also last couple of years, and then these issues that came up which China was also mentioning. On the technicals, does it merit holding? Could they see some more profit in the near term?
I would say so. Actually, long-term trend is very intact. And if I were to talk about the weekly chart, the stock has taken good support of 1,000 levels. And even in the the nearest rally, what we have seen witnessed from 1,100 levels, it is on an upward move. We do see a resistance coming at 1,550, but I would say there is no damage to the trend. So continue holding with the support of 1,300. And if this sustains all this choppiness what the market is offering right now, and if this moves above 1560, 1600, in all likelihood, this can go towards 1800. So 1300 is the level to watch. If my view gets negated if 1300 levels break. So for now, it's a hold in this particular stock. And talking about UPL also, so I would say well-booked partial profit, but this too is showing signs of improvement on the weekly chart. So partial profit booking is suggested, and once you get a dip near 660 or so, I think weekly chart, what it called, one can infer is that yes, if it crosses 730, 740, it's ready for a target of 780 and higher. So I would say hold with a partial profit booking strategy.
Hold with a partial profit booking is the word that's coming on the technical front. Let's move on to the next query, and that is on Eternal or Zomato as we know it. Shashank Bardwaj is writing to us from Noida. He's holding 100 shares of Eternal at a price of 250 rupees per share. Wants to know if he should remain invested in this one. Obviously, China, just yesterday we had the news that it came in that Anfin was also selling stake, and this has happened over a period of time. What are we watching out for now in terms of Eternal's numbers? Good numbers that came in Q1. Should they continue to stay invested?
Yeah, so Vinny, the numbers were very good in the Q1. And while we have food delivery that is showing some bit of slowdown, the management is in fact showing also guiding for lower numbers in growth vis-a-vis what we have seen in earlier years. At the same time, you have the quick commerce, which is actually growing very fast. There is some pressure, likely to be some pressure because of the margins on quick commerce because of the expansion of the dark stores. But I think overall, it's better to remain invested in Internal. And it's not a stock that you trade in. It's a concept stock, long-term positive, continue to hold.
Okay. Let's move on to the next query. Actually, no. Vaishali, your view on the technicals as well.
So the fact that it's maintaining its uptrend implies that it has a good, strong inherent strength. And purely on technical terms, 290 acts as a support. Right now, it's in a retracement profit booking to a consolidation zone. So as long as 290 levels are held on, I would expect a target of 330 to 350 in times to come. So it's a strong stock for now. Continue holding.
Okay, next query for today. Ritu Singh is writing to us from New Delhi, holding 100 shares of City Union Bank at a price of 150 rupees, is asking whether to hold or exit at the current levels, making a profit on this one. Shaina, your view?
I would suggest continue to hold. Valuation, not expensive. Price to book, 1 year forward, about 1.5 times book. If the first quarter numbers were quite healthy, they are showing improved performance across the board. The provision coverage is now pretty healthy. They have got about 60% provision coverage. So it's a hold.
Okay, and Vaishali, your view coming for City Union Bank?
Well, I think it's a strong and a gradual upward move. So I would say continue holding. 200 acts as a support. And if it's for a long-term perspective, please continue holding for a target of 240 and perhaps higher. So yes, it's a hold from my side.
Okay, a hold coming in on the technical front. Let's move on then to the next query for today. This is coming in from Adil Mansoori, who's writing to us from Gujarat. He is holding NetWeb Technologies, 5,000 shares. This is at a price of 1,700 rupees per share. Wants to know whether he should continue to hold or exit at the current levels. NetWeb Technologies, Shaina, a smaller IT company, but overall in terms of numbers also seems like a decent set came in this time. But how should he be placing his strategy given that he's making a profit?
Yeah, Vinny, actually the numbers were very strong. Doubling of profits, very good turnover growth. And they're in the AI segment, which actually is the, I think the future of IT services or even industry. So it is, of course, you can't talk in terms of PE and valuations because they are very expensive. It's a small stock. But the investors got in at a decent price. I would suggest he keeps a very deep stop loss. So just in case something goes really wrong, but otherwise you continue to hold in my view.
Continue to hold on the fundamental front. That's for NetWeb Technologies. Vaishali, on the charts and technicals, NetWeb, what should it be doing? Given that, the last few trading sessions also, we've seen that run up coming for the stock as well. What are we watching out for now?
Chartically, it looks very attractive. We've seen the profit booking coming from 3,000 levels, and now it was showing some base formation at 1,400. From there on, we are seeing the stock making higher tops, higher bottom. So I would say, yes, the stock still continues to show strength. I would say keep a stop loss of 1,800. 1,800 is the level to watch and get into, you can add furthermore if it sustains and look for a target of 26 to 2,800 from here on.
Okay, that's the view coming in there for NetWeb. But that was the last query for today. So thank you so much, Shaina, as well as Vaishali, for joining in with us on the show and giving us those insights. But with that, viewers, we're going to wind down this edition of Your Stocks on CNBC TV18. Thank you so much for tuning in. Remember, you can always email us your queries at the email address that will be flashing on the screens for you all. So do send us your queries, but don't go anywhere. Last hour of trade is still left, and you have closing bell up next for that.
headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
It's a mixed looking screen for now. The Hang Seng is down almost 0.7%.
No, not until we get it resolved.
The FIs, well, they are net short as well on the index.
It's not possible for brands or retailers to move 5 billion out of India to other countries overnight.
Starting a little cautious, 30 points lower, 27 points lower. But like I said, it's not too bad, considering the market defended critical levels yesterday.
Growth, market share gain, customer acquisition is at this point of time highest priority.
Numbers are expected to be muted in this quarter on a year-on-year basis.
We have a very ambitious product development program.
So Nifty right now down around 170 points as we speak. We have the mid caps which are underperforming with a cut of around 1%.
So ICM is roughly for us some 1,800 crore business.
Going forward in the current year, we would like to have a decent growth over the entire year's premium.
The net profit has come in much above estimates at 19,160 crores.
We are on course for a 6th straight weekly loss.
Well, that was the day so far. Hello and welcome to Closing Bell. Last hour of what's been a tough trading week. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar. With me is Surbhi and Nigel. Guys, we haven't seen panic on any single day, but there has been this slow grind down in the market. And once again, we're at the day's low. 24,400 is gone. I think the only silver lining is that yesterday's intraday low has not been breached.
That's exactly what I'm watching out for. 24,345. That was a low that we had hit yesterday. We're at 394, 395 as we speak. Let's see, next 1 hour, whether the bears pick up more momentum on the way down or if we pretty much amble around this zone. Very, very critical next 60 minutes.
Well, that's right. But it's a disappointing trading session, right? Because, any kind of shallow, any kind of bounce is being sold into. So those recoveries are very, very, meager, not able to take the selling. And the problem is the Nifty bank, because on the way up, that one was dancing away to 57,500 odd. That's lost its way. And I think that's at a very crucial juncture. Yesterday, it bounced off this 55,000 odd mark. It seems to be in this range of around 55,000 to around 56,000. And for the time being, we're at the low point of the day. So that's a bit of a problem pocket for the markets.
Absolutely. I just want to pick out some stocks, actually, just to talk about what's been happening with the broader market. The Nifty is down about 0.8% right now. Mid-cap index is down almost 1.3%, and the advanced decline ratio is negative. So just let's pick up some stocks to give a sense of where the sell-off is happening. Now, it's definitely visible in defense stocks for sure. Even names like Masgao Dock, Data Patterns, you can still argue that it was a bad earnings or weak earnings, and that's why the stock's down. But that's one pocket of the market which is definitely seeing selling pressure. Stocks like Kalyan Jewellers, I mean, after a good performance, good commentary, 30% growth, yet the market is choosing to quickly book in any profits that happen. So 8% down over there. Coforge, Rima will mention, there are some company-specific issues with Coforge that seem to be triggering the fall, but it is a big fall, 5% on Coforge as well. And then more names, there's Radico, there's Schneider, so plenty on the downside. However, the good thing is that wherever the market seems convinced with either news flow or numbers, it's willing to, pleasantly reward companies as well. Example would be a Global Health, Medanta, 5% up, Kalpataru Projects, rate gain. These are stocks that have done really well on earnings today. And then the recent listing, Lotus Developers, Sri Lotus Developers, it's running away. And KRBL, the rice exporter. So even in an environment which is very, very bleak, you still have some of these sparks which are managing to find lots of buyers today.
Okay, all right. Well, we've got a lot of stock-specific news to track for you over the next hour or so. So let's get to AU Small Finance Bank. They've received the in-principle nod from the RBI to become a universal bank. Move makes AU's first bank, the first to receive this nod. What are brokerages making of this bull versus bear analysis coming up on the show? Biocon delivers a miss across parameters in the April to June quarter. The stock is languishing in trade. A fine print of those numbers coming up in just a bit. And in other earnings reactions, we have divergent reactions on the likes of Cummins India, Kalyan Jewellers. we'll get you an analysis on their performances in the past quarter. All of this and more lined up on the show. Well, just one note though, just keep an eye out on the bottom of your screen. You have PG Electro Plus, one of those big value creators over the last few years. Surprise, surprise, they have gone in there and they've cut their growth guidance, revenue growth guidance on the electric business, and the consolidated sales guidance as well, they have cut. So that's clearly come as a shocker. And at 15%, it's actually hit the temporary circuit. So just keep that stock on your radar. That one's up for you. But I think we have the SBI, chairman, Mr. Sethi, who's addressing the Q1 results. So let's hop across.
Shri Kumar Tiwari sir, Shri Vinay M. Tonse sir, Shri Rana Ashutosh Kumar Singh sir, and Shri Ram Mohan Rao Amra sir, along with our Deputy Managing Director Finance, Srimati Saloni Narayan. I also extend a very warm welcome to the other Deputy Managing Directors and senior officials of SBI who are present with us this afternoon. We sincerely appreciate your presence and look forward to sharing key insights about the bank's performance. Without further delay, I now invite our Chairman Sir, Shri C.S. Setty, to address the media and present a comprehensive overview of SBI's financial performance for Q1 financial year 26. Over to you, sir.
Good afternoon, ladies and gentlemen. Thank you for joining the press meet post announcement of Q1 FY26 results of the bank. The results for Q1 FY26 highlight robustness of financial numbers, continued excellence, consistency, and SBI's significant long-term strengths. I would like to start by thanking all our stakeholders, including our customers, shareholders, employees, and the broader ecosystem for their support and helping us in creating sustainable value for the economy. Let me now start with a brief description of the present global and domestic economic scenario and then discuss bank's performance. The global macroeconomic environment has remained fluid since June till now amidst geopolitical tensions and tariff policy uncertainties that have increased. Central banks in many advanced economies kept policy rates unchanged, except of course Bank of England, which has reduced the rates, as the last mile of disinflation turned out to be stickier than expected, while also awaiting clarity on the trade tariff front and its implications for inflation. Domestic economic activity held up in June, with high-frequency indicators pointing to mixed signals of improving prospects of Kharif agricultural season and continuation of strong momentum in the services sector on one hand, and deceleration of tax collections, industrial activity, and vehicle sales on the other. RBI estimates GDP for FY26 a growth rate of 6.5% and inflation at around 3.1%. The MPC in its latest meetings, as you're all aware, has kept the repo rate unchanged at 5.5% and maintained a neutral stance. Coming to SBI, the results for Q1 FY26 demonstrate the bank's continued ability to operate profitably at scale due to our substantial core strengths. These advantages stem from our institutionalized framework, which is guided by continuous improvement in processes and a commitment to fairness for all stakeholders. The total deposits have grown by 11.66% year-on-year to 54.73 trillion rupees. Term deposits have grown by 14.23% year-on-year. Our current account deposits have grown by 30.69% year-on-year. I'm sorry. And CASA deposits have grown by 8.05% year-on-year, with a CASA ratio at, I'm sorry, at 39.36%. Importantly, the current account growth has continued to remain strong for the bank during the year despite competitive market environment. Our foreign offices deposits have grown 10.42% year-on-year. I'm glad to share that the credit growth continues to be good with segments like SME, agriculture and retail retail personal banking posting healthy double-digit growth at 19%, 12.67%, and 12.56% year-on-year respectively. The corporate sector has grown by 5.7%. Our foreign offices advances have grown by 14.81% year-on-year. The domestic credit deposit ratio was at 68.88% at the end of Q1 FY26, indicating sufficient headroom to address future growth requirements of the economy. The bank continues to demonstrate industry-leading asset quality at this scale. The slippage ratio for Q1 FY26 was 0.75%, while the credit cost for Q1 FY26 stood at 0.47%. The net NPA ratio improved by 10 basis points year-on-year and stands at 0.47%. We have a well-provided NPA book with PCR at 74.49%. The asset quality of the bank has continued to remain strong over the last 5 years, which demonstrates the quality of our loan portfolio, the robustness and improvement in our underwriting processes, and improved collection efficiency. The bank remains well capitalized, and our capital adequacy ratio has improved by 38 basis points sequentially and by 77 basis points year-on-year, and stands at 14.63% against 14.25% as on 31st March 25. CET1 ratio has also improved by 85 basis points year-on-year to 11.10%, and both the ratios are well above regulatory requirements. Based on the current profitability and growth trajectory of a bank, we believe we have sufficient headroom to take care of requirements of business growth. Bank has raised, as you're all aware, equity capital of 25,000 crores during the current quarter, which will support additional loan growth of approximately 2.5 trillion rupees. I'm glad to share the progress we have made in the digital banking, which is an ongoing journey, and it continues to be an important customer acquisition engine for the bank across asset as well as liability products. The share of alternate channels in total transactions increased from 98.2% in Q1 FY25 to 98.6% in Q1 FY26. More than 9 crore customers have registered on YONO, with 66% of regular saving accounts opened through YONO in Q1 FY26. Our subsidiaries are consistently performing well and continue to create significant value for all the stakeholders. Most of our subsidiaries are leaders in their respective segments. We will continue to nurture these subsidiaries and maintain leadership position in the respective businesses. The bank continues to report ROA and ROE greater than 1% and 19% respectively at the end of Q1 FY26. We reported total assets worth 67.69 trillion, total advances at 42.55 trillion, and total deposits amounting to 54.73 trillion. SBI continues to be the leader in all the risk-adjusted profitable lending and liability pools in India. Consequently, SBI's ROA above 1% is derived from the scalable fundamentals of banking, that is, improved business growth, controlled operating expenses, and maintaining robust credit quality. The bank's ROE profile is currently higher than its credit growth, implying CET1 accrual in the future. From this strong position, our goal is to consistently achieve a ROA of over 1% and ROE over 15% through the business cycles. To conclude, I thank you all for your continuous support of the bank. We consider it as a privilege to be able to play a role in driving the progress and contribute towards the growth of our economy. We remain committed to rewarding your trust in us with superior sustainable returns over the long-term horizon. I wish everyone here the best of health and happiness. My team and I are now open for taking your questions.
Thank you, Chairman, sir. We'll now move on to the media question and answer. To ensure a smooth and orderly session, questions will be taken in a sequential manner and individuals will be called by name to ask their questions. We kindly request everyone to follow the format and limit themselves to 2 questions focused on the results. If time permits, you may raise your hand to indicate interest and we will accommodate additional questions. Thank you for your cooperation. We will begin with Hansini from Money Control.
Hi, thank you. So overall, in terms of growth, 11% is very satisfactory. But when we look at corporate side alone, there has been a pullback in growth in particular segments like infra, telecom, road, aviation, tourism, etc. What is your view right now on the corporate lending space, particularly with respect to these segments where I called out? Where are you pulling back because you're believing that there is stress accumulation happening, or avenues are not as attractive as you would want them to be?
So three reasons why the corporate growth looks a little muted in our books. One is there is some shift towards market instruments. We have seen that the utilization of working capital limits, which was 62% in Q1 of FY25, has come down to 58% now.
Mm-hmm.
Which means that, and we also have seen that some of the large corporates accessing the CP market, basically to replace the working capital limits, and that is expected because there's good amount of liquidity, and in the CP a diversified participation what we have seen, not necessarily that it's banks which are lending on the CP market. Essentially the mutual funds are very active on the CP, and the rates are much more affordable than the bank lending, obviously. That shift has happened, but I think these shifts keep happening on that. And once the rates stabilize on the bank side, they will come back to utilization. The second thing what is happening is in terms of some of the project, like we have very robust visibility on both on the pipelines in terms of proposals which are under discussion, and also sanctions but yet to be disbursed. We have almost 7 lakh crore worth, both segments together, proposals in pipeline as well as sanction but not disbursed. But the disbursements are taking time, while the repayments are actually actively being done. And in a rate reduction cycle, we also have seen every time the rates get reduced, there is a refinancing which happens. So the pricing, chasing for pricing happens. Some of the reduction also has happened because of the prepayments. We had a significant prepayments. Either they have got access to the market through equity markets, or the pricing what they expected probably we were not able to match. So there has been some movement there. But I believe that we are still thinking that, hopeful that we will be coming back to the double-digit growth in the corporate advances.
Perfect. In continuation to the question on pricing, cost of deposits are at 5.2% in Q1. Do you think that cost of deposits have peaked? And yields are also coming down. It's in the lower side of 8.9% now. Whatever has to be passed through in terms of repo rate cuts, has SBI done all of that? You see further scope for transmission of repo, and where do you see cost, yield and NIM settling? So NIM is also just a little over 3 now.
Repo gets immediately passed on. Anyway, this external benchmark linked loans are all getting repriced immediately, maybe in a couple of days after the repo announcement. That transmission has happened. What takes time is the MCLR, recalibration, which is dependent on how overall marginal cost on the deposits will move up. And some of the fixed deposits will take some time to get repriced. So from that angle, MCLR will take some time. Repo is completely passed on. You see the cost of deposits slightly moving up because of a lot of people rushing to lock in on the fixed deposits, number one. Number two, the costs are slightly coming down over the last quarter, which is generally Q4 is a better quarter. But on the overall cost of deposit management, I think we have done fairly well on that. As far as your question in terms of NIM, I mentioned earlier also, the NIM trajectory will be a U-shaped trajectory. Q1, Q2, it will probably moderate. And as the deposit gets repriced, and also we have some benefit of the CRR cut, which will come from September onwards. So I think the terminal Q4 NIM probably would come back to what we have on the Q4 level, basically. Yeah,
It will
about
be
3%.
similar to Q4 of last year.
No,
Thank you.
Q4 of this year. I mean, the last FI, last financial year.
Okay, thank you.
Next is Siddhi from Bloomberg.
Hi sir, Siddhi here. First of all, I just wanted to ask you, in the global macro sense, we've seen the tariff news that has hit. You being the largest lender, I just wanted to get a sense of commentary from you. What is the kind of impact this is expected to have on the credit growth for SBI and for the sector as a whole? Once you answer this, I'll ask my second question.
The tariffs, of course, there are two areas which we have to look at the tariffs. I think we have had enough discussion across the media and policymakers. One is the impact on our books. That is a limited impact because most of these 4 or 5 sectors which are directly exposed to the exports to the US, which are predominantly exposure to the US markets, overall exposure from the banking system on these sectors is very limited, and SBI also do not have much exposure on these sectors. But the second factor what we have to take is the uncertainty in terms of how these tariffs are going to play out, how quickly this is going to be addressed. So that uncertainty is something what I believe that a lot of investment decisions may be delayed and people will postpone their spending. So this is the second order impact of the tariffs, so to say. So our assessment is that while the direct impact on the sectors, industries may be limited, the sooner this issue gets resolved, the better. And I'm sure the government is working on that. And I don't see. And another thing is that Indian exports are broad-based. I think we did mention earlier also that both in terms of basket of exports as well as the geographies which the exports go to is broad-based. To that extent, I think the impact will be limited. As I mentioned, the narrative is more, the uncertainty is more damaging. I think that needs to be addressed.
Okay, all right. We'll keep cutting back, as and when we get some further important statements from the SBI chairman. For the time being, let's welcome Deepan Mehta, Director of Elixir Equities, onto the show. Hi, Deepan. Difficult market for the bulls. We're going sideways to down. That big pop is not really coming about. And I think till we hold below the 24,750, odds are that the bears will be in control. That said, SBI's numbers are more or less in line. What do you make of the numbers and commentary?
Good afternoon and thank you for having me on your show. I think great set of numbers from SBI. And now I think the divergence between private sector banks and public sector banks has come down significantly on the financial front, on the qualitative front, and even on the technology front. And I was quite impressed with the technology improvements done by SBI. Yet valuations are significantly lower than some of the private sector banks. So I think the investors will try and shift away from the private sector banks into the PSU banks. And this trend has been noticeable for the past several quarters or so. In my opinion, I think PSU banks are very attractively valued. And if they continue to deliver on the earnings front and keep the NPAs low as they have been doing, then certainly the Ps can get re-rated higher. So within the banking space, I think there could be one pocket of outperformance. And I think SBI is the type of company you can make as part of your core holding.
PG Electroplast, Deepan, I don't know if you caught the guidance, but the company has sharply lowered its guidance. I think last year, the previous guidance was 40% plus, and now they're talking about...
we'll get the number.
Just get that number up for you, but I think
tell you
it's
what's
up 20%.
the problem, Rima. The problem is the management has been very, very optimistic. Yeah. They went ahead, they raised money from the market via the QIP. And then you come out and you cut your guidance like this. That's why the street is so disappointed, and that's why there is this kind of selling, because that's been a big, big value creator. In the last 3 or 4 years, everyone talks about Dixon. In fact, this has created even more money. But now just take a look at the fall, because out of nowhere you've gone ahead and you've cut the guidance. So clearly the street is very, very disappointed. I think we'll get some of those numbers.
The 3-year stock CAGR, CAGR, not return, is 100%. That's the kind of wealth it's created. But numbers up until now were very strong.
Yeah.
So in FY25, revenue growth was 77%, FY24, 27%, prior to that, 94%, the year before that, 58%. So it was fast growing. It was just the projection that that pace is going to continue is where the miss seems to be. But Dipan, raised money, promised more, doesn't look like they're able to deliver on those high growth estimates. Your thoughts on PG Electroplast, and is this going to be the precursor to what we might see from the rest of the EMS pack too?
Yeah, good afternoon. You should have also added very high PE multiple to it. So this is a deadly combination that you have a very high PE multiple, so you're trading at expensive valuation. In a way, the stock is slightly overowned because of the QIP and the way the stock has been rallying. And then, although results are okay, stock market tends to discount the future, and if the future is going to be stagnant for whatever reason, then that correction is going to take place. But I don't think it's a signal for rest of the EMS players, because PG Electroplast was largely into air conditioners, and we know that weather has caused havoc with all of the air conditioning companies, and their customers therefore could get impacted by that. But by and large, I think if you see Keynes, if you see some of the other EMS players, their results have come out to be pretty decent. And I think valuations also have come down because the earnings have gone up. So I don't think that's a reflection on the entire EMS space. But yes, I think it's a company-specific issue. And I think the management is being a bit too conservative, because end of the day, there are cycles, and there's perhaps a down cycle in the air conditioning side, which can certainly improve over the next 2-3 years or so.
Okay, all right. Just trying to confirm this, but besides raising money from the market, the PG Electroplast promoters as well, I think they had sold some stake. If I look at the shareholding from March to June, actually the shareholding came down from 49.3% to around 43.7%.
Was it the QIP dilution?
No, I think that QIP was earlier, right? So at that point of time, between September 2024 and December 2024, the dilution of the promoters holding came down from 53.4 to around 49.3%. And from there, in the past quarter, we have it come down by another 4-5% or thereabouts. So that's why I think, the street is very, very disappointed. You go in there, you raise some money, and then in fact, you guide for a particular number, and then you come. Actually, I found that, on 26th of May, the promoter entity went ahead and sold 5% via the block trade. Okay. And that's why I think the street is extremely disappointed on these numbers as well. So a confluence of factors, high PE multiple, you go ahead, you give a big guidance, you don't achieve it, you raise money from the market, and then in fact, you sold some stake ahead of very, very poor numbers. So street is not not pardoning the stock right now.
Dipan, we're running out of time, but just a quick word on Kalyan Jewellers. Prima facie, everything looked fine. Stock is down though, 8%.
Yeah, I'm trying to search what the main reason, but I think pretty decent numbers. So maybe some knee-jerk reaction or something which we don't know, which may have taken place in Kalyan Jewellers. Could be some concentrated selling as well, but nothing wrong with the numbers per se. There's no negative news flow as far as I'm aware.
Got that. Out of time today, the SBI presser, we were listening to it for a while. Thank you very much for joining in. Enjoy your weekend. Here's a quick reminder for all our viewers. Unlock a world of exclusivity, expertise, and influence. Become a member of CNBC TV18 Access, our premium members-only experience on CNBC-TV18.com. The membership includes access to CNBC TV18's flagship events, interactions with a journalist, along with curated studio tours, e-learning sessions, masterclasses, curated lifestyle benefits.
best.
Welcome back. Still looking at a cut of about 200 points on the index. For the week, the Nifty has actually not fallen much. I mean, it's just a 0.6% fall. The small cap index is down about 1%, mid cap index about 0.8%. So by themselves, the cuts are not bad. The issue is that they've come at the lower end of the trading range, and the market has constantly been drifting lower over the past about 6 odd weeks or so. And that's been a little painful for investors to watch. By the way, I just want to put up the FPI flows picture on the screen because that remains the single biggest concern for the market. As these tariff issues are dealt with and, whatever comes out of it, we'll have to wait and see. And that's the picture. In July, it was the first time that we started seeing outflows after the whole tariff issue, which started in April. July was the first month of outflows, almost 18,000 crores. So far in August, as of the latest numbers this afternoon, our outflow is about 12,400 crores. And for the year as a whole, of course, we are negative in a big way, over 1 lakh crore going out of the market in terms of FPI outflows. This is, of course, the cumulative data, net of all blocks, all action, total FPI inflow, outflow, and right now we are in outflow territory. So that remains a bit of a niggling worry for the market. Let's discuss that and more with Sanjay Parekh, founder and CIO, Soham Asset Managers. Sanjay, good to have you on. Let me actually start right there. So the hope lies with fund managers with you, in your peer set in the mutual fund industry, PMS managers, that you folks will keep drawing in the big money because these FPIs have been leaving. Do you think domestic liquidity will keep supporting the market, or is there a risk?
I think, fund managers will also, one is the flows that they get, and the second is where do they invest. So I think we are in an environment where there is global uncertainty. Q1 was weak. Q2 also looks weak. So we don't see a big upgrade cycle right now. Having said that, clearly all the balance sheets are in place. And, the rate cut benefit should show up from third quarter onwards. And rains have been good. I mean, monsoons have been good. So there is surely a possibility that third quarter onwards, things should get better as the busy season starts, So that is a hope, but clearly, valuations are rich. So our strategy is, be selective. There is value, but, you still need to have higher margin of safety. And there is some more downside possible in the markets. And maybe some more time correction, and then we're done. So we're not so bearish, but there could be some more bias on the downside.
Sanjay, you've always believed in growth at a reasonable price or valuation, but you said there is value still in the market. Can you tell us where you see value? What are the opportunities? Which stocks have you all bought at Soham?
Yeah, so, what we own, normally some of them we own for very long term. And so there we see value in, let's say, Adani Port. I think it's come to a reasonable value now. Or in the energy space, which we already own, is JSW Energy, where I think there could be some more risk. And these are all where results have been quite good. And there would be certainly some impact on the port volumes if the trade slows down. But in a tough environment, Adani Port has done quite well. JSW has been absolutely a top-class result. Part of it was because of the acquisitions they did, but so that also structurally, I think, looks good, and we like them. So there are pockets where, there is value. Earlier, we had bought Oswal Pump in the solar pump, which again has done well, and results have been good. So we look for those pockets of undervaluation and selectively invest. And that's our strategy.
All right. Hi, Sanjay. Good to see you in. What about the flows that you're getting? As good as ever, your clients are calling up and saying, Sanjay, take another check? Or is there some resistance? Tell us.
No, sir, actually, all the family offices and all, they have actually given us mandate. And some of them, of course, mandate, the volume could be very different. For mutual fund, it could be larger. But they have actually said that you tell us and we can draw down. So there is no panic. People understand that this year could be slow. They have a long-term thought process. And even our distributors have been very, very mature on this. So I think, at least the large family offices would want to increase their exposure. They're still underinvested into equities. And at least for larger cap funds like us, where luckily we've delivered well on alpha and 3-year basis. There is clear appetite for increasing the exposure. But then we always handle them saying that, this is how the scenario is, where earnings this year will be like 1130, next year will be 1300. We think that India should be not getting more than 20 times. So if these earnings are not downgraded, which I think that it will not be downgraded from here, then you're talking of 26,000, which is a reasonable upside from here now. So that is where I think a little more time correction, a little more price correction, some clarity on global front on this tariff issue, and then we will surely bottom soon.
So, but the lows of the year have been done, you think? Or will we revisit 21,700?
Yeah, at least I mean, you never say never, but at least I think the next 2-3%, and then we're done. And despite earnings being slow, only thing is, things at the global front. I mean, if you have 50% duty, it's certainly not a good environment. So hopefully we have some sanity on the global front. And I think then we will bottom out not only on the markets, but also on the economy. And I think the economic indicators should start looking better from third quarter.
One good thing is with Trump's tariffs, 25% became 50%. Now, anyway, it's, that's out of the window. Beyond that, you can raise it to 1,000%. Anyway, that, there's nothing going to happen on that front. It's unviable at 50% odd. So at least that Trump tantrum scare, at least that's out of the way. That said, I think metals is something, a couple of them you've liked out there. Vedanta, now is the time for them to deliver, right? But unfortunately, the globe is in a bit of a flux. Do you think the stock is currently an ad? Because you've been quite bullish on the prospects.
Yeah, we've been owning it. I mean, we've added at 318, we added at 440 also. And we have our patience. There's serious value in this. The EBITDA will be more like 45, 47. I mean, on a console basis, it will be more like 50,000 crores. But even if you take attributable to there, it will be 40, 42,000 crores. So it's like 4.5 times the EBITDA for a company which is going to expand in each of the verticals. And zinc and aluminum is fairly benign. I mean, the prices are not collapsed. So we think it's a very good play on aluminum, zinc, and silver. And they're deleveraging at a parent level. And also leverage is not going to go up. So I think it's a seriously deep value. You will see dividends coming in the last 15 months. We got 50 rupees dividend. This year again, we already got 7. We get another 25 rupees. So it's a good dividend play plus growth. And hence we like it and we're going to hold on.
Okay, deep value seen in Vedanta. Sanjay, great conversation. Thank you for joining in. Enjoy your weekend. Look forward to the next one. Now it's time to get a handle on what dealing rooms are doing, saying it's D Street Chatter. Nimesh joins in.
Hi, Rimano. Another choppy day of trade. We just given up most of the yesterday's gains, and it looks like yesterday was more of a short covering and a technical pullback rally which got sold into. But again, today the feedback is that the flows are quite muted from large institutions, so there is not much depth in the market, and that's the reason why even the mid-cap index is sharply down. But again, the volume seems to be on a lower side across the board, including the broader markets as well. So that's something to take a note of. The sector which is seeing a big cut is the defense sector. For second day running, there is selling, is what I understand in defense names. The defense index is down more than 2%. A lot of individual stocks are down 8-10% as well. So that's where the big crack has come. In fact, it started from a sharp fall in the European defense stocks yesterday, and it's playing out across I guess, across markets, and it's impacting Indian defense stocks as well. So that's something to track on from here on. But as I said, while markets have gave up most of the gains, today it lacks depth, and there is a lack of buying as well from large institutions in the cash market.
Okay, absolutely. It's just getting lackluster. It's almost sulking. Don't have the expiry impact at all helping today. Nimesh, what about stocks though? I mean, there are some little specks of green here and there. You tell us. Anything interesting?
So the first on my list is EPAC Durables. We saw a sharp recovery in that stock after a large block. Nearly 5% equity got changed hands in the afternoon trade, and after that you've seen a bit of recovery. So I understand the PE investor was a seller in today's block. The PE owns 10%, so they've sold 5% in the block deal today. And in terms of buyers, some domestic mutual funds are the potential buyers. So the disclosures will be quite interesting in EPAC today. So that's the first name. The second stock is Bharat Dynamics. The entire defense pack is under pressure for the last 2 days, as I've been saying. But Bharat Dynamics stands out, has been under pressure of late. It's sharply off the day of the recent highs as well. And in Bharat Dynamics, there is a strong buzzer indication of a big supply coming in very soon. So the government owns 74% and could be a seller there. So that's the buzz there. The third name is PNB Housing. An odd outperformer in today's market, but remember the stock is still in the F&O band. So whatever happens is the delivery has to be in the cash market. For the last 2 days, I understand there is delivery getting marked, and one leading AIF is a buyer as well. For PNB Housing, the next big trigger would be the appointment of the new CEO, which can come in the next 2 weeks. So that's a trigger there. And the last one is Inox India. Again, in a weak market, that's been buzzing in trade, up marginally up today. But for Inox India, the buzz is that maybe the company is likely to bag a large order very soon. So that's a trigger in Inox India.
Okay, all right, got it, Nimesh. Thanks very much for that. See you in a bit on Editor's Roundtable. For the time being, this is what we're looking at. By the way, PG Electroplast is full 20% lower now after that guidance cut. So another big earnings blow coming in over there. But for the time being, let's go across to the F&O desk. Nigel has the latest in terms of what's happening in the derivatives market. Nigel?
Well, the screen is telling you, right, this market is a little bit jittery. And if you just take a look at, the kind of action that you're seeing, there is lack of buying that is playing out because any 30, 40 point bounces are getting sold into. So the structure in the market itself has got punctured, and that's why the Nifty is down 200 points. Important to note, though, the VIX, that's still not at elevated levels. So normally the markets, the way we have corrected, we've seen the VIX easy over the 15, 16 odd mark, but that's still cooled off. That's still holding at around 12 odd. So that's a multi-week low on that index. And that's giving some kind of hope that maybe, in fact, we see one spurt, the markets may pull back a little bit, couple of 100 points, and then form a near-term bottom. As of now, that's not yet in sight. The other, string that the bulls will be, clinging on to is the PCR. Now, we have seen in the past the PCR dips below 0.7 and you see a relief rally. Now, it's come down to around 0.74. At the start of today, it was more than 1. So that's come down because the call writers, they are back in the game. The kind of writing we have seen on the call side is telling you that the bears believe, they have got this covered on the upside. Just take a look at the open interest build up. The 24,600 call, there's close to around 95 lakh shares getting added. And the premium has nearly halved since morning. So that's the kind of fall that you've seen. 24,500 call as well, more than 90 lakh shares getting added out here as well. And the premium has seen a sharp decline. So these writers, they are pocketing their 150, 200 rupees odd, and they believe that the 24,750 level will not be breached on the upside. What's giving some hope is now in the last hour or so, the 24,400 put. Just pull that one up. Yes, it comes up for you on the screen. The premium's around 120 rupees. In all probability, there is writing out here. So that 24,300 odd level, that's what those writers are hoping will hold out. So on the upside, the 24,750, that's the level that's going to be a resistance. But on the downside, yesterday's low, that will be the near-term support. You don't want to breach that mark. And on the whole, that band of around 24,350 to around 24,450, crucial, extremely crucial band is what we're looking at. Finally, RBL Bank, I've seen a big open interest build up on that one. And, that could probably go into the F&O band. So we'll have to keep an eye out in that one, a possible F&O ban entry. So because of the big open interest surge. Back to you, girls.
Thank you very much for that. We will slip into a very short break with the news that the Nifty is very close to yesterday's low. 24,357. Things are unraveling on the way down very swiftly. It's just like 10 minutes back, we were at 24,400 and we've lost about 50 points. So now very close to yesterday's low. Let's see what the last 15 minutes hold. For now, it's a break. On the other side, BTST calls with Mitesh. Welcome back. Mitesh is now back with us. The Nifty, by the way, breached yesterday's intraday low. 24,337 was the low now. From there, we're trying to claw back, but it's just been feeble. 20 points up from the lows. 10 points. Mitesh is now back with us with a few BTST calls for the weekend. Mitesh, 1% gone. Mid-caps 1.7.
I think the index, is heading into the gap level, but the weekly structure is slowly turning negative. So I would be, very cautious on taking long positions and be more attuned to take short positions till we get some sign of reversal on the Nifty, which would happen in case we start getting past 24,600. So till then, I think, not really keen to take long positions. On the stock side, I have a sell on Shriram Finance, estimated on Shriram Finance with a stop at about 615 for a target of 595. And the other one is REC, which is an STBT with a stop at about 383 for targets of 375.
Okay, all right, got that. Mitesh, thanks so much. Mitesh, actually, before we let you go and before we let you enjoy your freedom, your weekend, PG Electroplast, freedom and weekend actually. The company's conference call details are coming. They're saying that they did not anticipate such severe disruption in the first quarter in their AC business. Stock's been smashed 21%. What's the advice? Any levels on PG Electro?
You can look at levels, but I think the way this monthly chart is shaping up, this will be to corrective mode for quite some time to come by. One, I think on a pullback, if you get it, and typically sometimes you do get these kind of pullbacks like we have in IEX. But on a pullback, if you get it, my advice would be to lighten up, exit anything if you get close to about 640, 650 zones. And on the downside, if you look at the slightly longer term charts, good chance that we are looking at a target of around 465 to about 450 on the downside.
Got that. That would mean more than a 50% fall from its highs. By the way, from the PG Electroplast call, the company is also saying they've cut down their capex guidance. So earlier the company had planned 800 to 900 crore of capex for FY26. That's been lowered to 700 to 750 because the company is left with a lot of inventory and that has impacted the company's cash flow. So it's not just the guidance cut on revenue and margins. The company is also cut their capex plans. But let's talk about Kalyan Jewellers. That took a hit post Q1. Mangalam joins in for more.
Well, Kalyan Jewellers, it's a curious case because the results were not bad at all. 31% revenue growth, nearly 50% profit growth, margins expanding as well. The street would like that. The same-store sales growth of the company coming in at 18%, higher share of revenue coming in from the non-South businesses, and all the factors where the company has been speaking about growth actually playing out. And this despite higher share of revenues coming in from franchise businesses and gross margins coming in lower, the operating leverage has had their margins improve as well. But thereafter, we did see the stock decline. And this is not the first time. From its earlier peak as well, there was a sharp fall that we saw on the stock. And every time there were concerns, or chatter around what the management is doing with the capital, etc., management has come out clean and saying that they are not investing in any non-core businesses or anything which may impact the capital prudence of the company. This time around as well, none of the analysts in their published notes have mentioned any red flag. But then again, the curious case for Kalyan Jewellers continues. From the lows, the stock has already seen a bit of a rally, but from the highs, it had seen a big gash. And now again, after the rally, good numbers, the stock sells off.
Thanks a lot for that, Mangalam. That stock under some pressure. Cummins India, though, that delivered a beat across parameters. The stock is still holding in the green. Vamakshi joins us to run us through the fine print. Vama?
Well, Nigel, a good set coming in from Cummins India. This time around the revenues growth was almost at 26%, and this is largely being driven by good growth in both the domestic as well as the export market. The domestic market saw an uptick of almost 25%, and the exports saw an uptick of almost 34%. The margins also improved by 117 basis points to 21.45%, which is the highest level we've seen since Q4 of FY24. And the net profit too this time around was at a record high, growing by almost 40% on a year-on-year basis. Now, a conference call was held at 12 p.m. Today, and what the management has said is that they remain cautiously optimistic. They're expecting double-digit growth in FY26. They do not see any risk of cannibalization of sales from their new launch, which is the battery energy storage systems, that is BESS. They also highlight that the volumes are now back to the pre-CBCP4 plus level, and the pricing more or less has settled now, given that it's been a year since since the new emission norms came into force. But they have highlighted that there is still a lot of competition across nodes. They continue to work, however, on cost optimization measures. As far as exports are concerned, they highlight that due to a diversified portfolio, the share of exports to the US is not very high. In the last quarter, in fact, they highlight that LATAM, Europe, Africa, Middle East, all of these markets saw good growth coming in, and geopolitical situation is currently changing. That is the reason why they're cautious on exports. But however, they do say that they endeavor to maintain the gross margins at the same level. So a good commentary coming in from the management, some caution on the exports, and a good set of numbers from the company resulting in an uptick in Cummins India.
Okay, all right, got that. Thanks very much for the details there, Vamakshi. By the way, I think we'll just put out a story that our colleague Tim C is getting from New Delhi. Yeah, this is important. I mean, it's a pretty big deal. The Income Tax Bill 2025 is all set to replace the Income Tax Act of 1961, the latest version of the bill, the 2025 bill. That is going to be introduced, I think, on Monday, August 11. And the previous version is going to be repealed. So it's just procedural, but it's a big thing. The Income Tax Act of 1961, as we've known it for well over 50 decades, that makes way for the new income tax. It will be called then the Income Tax Act of 2025. Well, we'll take a break on that note. As we do that, do remember to tune in to the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Okay, welcome back. So that's how the board is stacking up today. It's a whole shade of red, a sea of red, so to speak. Not too many sectors managing green. One of the stocks that's fallen today is Biocon. It's been down 5%. Clearly, the numbers, the investor call, not been enough to spark any enthusiasm among investors. Let's actually listen in to what the management has been saying.
Well, yes, for Biocon this time, the numbers did miss estimates. The revenue as well as the margins and profit was lower than what the consensus was expecting. Now, in terms of a couple of key takeaways, however, from the management included that the generics business, which grew around 5 to 6% this quarter, was in line with expectations in terms of growth. The generics business, however, they do expect will grow in double digits for the entire year. CRDMO segment continues to benefit from demand according to them. Now, the consolidated gross debt stands at around $1.1 billion and they are expecting the interest costs to gradually reduce. Insulin Aspart, which is basically the diabetes biosimilar in their portfolio, the launch will be now and between the end of the year. Now, they are also likely to launch the diabetes drug liraglutide in the US this fiscal. And according to them, it will probably be the biggest growth driver for Europe going forward. Now, lastly, semaglutide, the market will open in 2026 according to them, and according to Biocon, the best case for them to probably launch and get approval for semaglutide will in the Canadian market, which is one of the lucrative markets that the street is looking at, would probably be towards the second half of 2026.
Thank you very much for that. Coforge is another stock which is weak in trade, and this is because one of their key clients, Sabre. Remember, Coforge had won a large $1.6 billion deal from Sabre. Well, Sabre came out with their numbers yesterday, Q2. It was disappointing. The stock tanked 35%. They've cut their revenue. They've cut the EBITDA margin guidance, and quite sharply. And this is why Coforge today is seeing that second order impact, because one of its key clients, perhaps even the top client, is come out with a guidance cut. Birlasoft is the other one. Again, muted set of numbers. In fact, the company said they may not even grow in FY26 in the conference call. So Birlasoft has also taken it on the chin today. But lots of other, losers. You've got Vishal Mega Mart. Despite making it in the MSCI, you are seeing a cut on that. Godrej Consumer is another stock. Street is disappointed with the margin performance. Stock is weak in trade. A lot of defense stocks like Bharat Dynamics lower in trade. Kalyan Jewellers, by the end of it, it's 10% plus. And by the way, on the Nifty, the Sensex, the headline is 80,000 level is gone. That's the headline on the Sensex front.
Absolutely. The Sensex has indeed lost 80,000. Down 800 points today, the grand old index. Tough week for the market. 245 points gone on the Nifty, and not too many winners to count. Across the board selling, banks, financials, IT, nothing really has been spared. Just little specks of green here and there. NTPC, Titan, Dr. Reddy's, count in these 3-4 stocks. But beyond that, it has been a tough Friday.
Okay, well, with that, we're going to take your leave on closing bell. Don't go anywhere. Editor's Roundtable comes up next.
The longest weekly losing streak in the last 5 years. That's what we have seen in the market this week. And it's been a continuing string of losses. The Nifty falling almost 1%. The mid-cap index underperforming. The small cap index down almost 1.5%. That's how the tally stands as we kick off this week's edition of the Editors Roundtable. Lots happening. The biggest headlines are coming in from the US, and 50% is that one number that you would have heard, or that one phrase that you would have heard over and over again. Where does this 50% tariff really leave India, the economy, and more importantly, the market? Are we close to the bottom, or is there a bigger downside opening up? Well, that's what we're going to be discussing on this week's edition of Editors Roundtable. I'm Surabhi Upadhyay. With me, as always, Nimesh Shah and Nigel D'Souza. And to help us make sense of all this tariff chaos, we have with us Ravi Dharamshi of ValueQuest Investment Advisors. Ravi, great to have you with us in our newsrooms. You've picked a great week. You know, the most newsy week I think we've seen since the 2nd of April, actually. So glad you're here.
Yeah, you know what? You said that I'll help you make sense of it. But honestly, nobody can make sense of it. And whatever is there today won't be there tomorrow. So there's no certainty to anything over here. I think clearly these are all negotiating tactics, and they want us to give in on some things. And once we do, it will settle down at a lower number. But until that happens, I think the uncertainty surrounding this whole thing is going to kill the business in the meantime.
No, I know, absolutely. You know, I was remembering this week in the morning, one of the days, Prashant said that if I was a betting man, and he's not, but he said if I was a betting man, I would bet that this 50% is not going to last. But last count, Mr. Trump has said that hame baat nahi karna hai. We don't want to negotiate. So
well, there is 21 days, right? So give some time. Something could come up. But you know, he's working the reverse psyche. After 25, he said another 25. Look what today Gokuldas said. He said, I'm happy with 25%. Had it been only 25 first, he would have said, I've been happy with 15%. So he's really playing with the psyche of the investors. Ki, "Achha, theek hai, aur bolo, to thode kam mein." He'll get what he wants, right? So I guess even 25 is going to be very difficult, isn't it, Ravi?
No,
for a lot of
I think it should be. I would expect, or rather, I would hope that it is less than 25. It should be closer to 15%.
Sure.
See, it's a relative game. We have to be better than the peers.
The peers, exactly.
And for that, we need to be better than Vietnam, China, Pakistan, Bangladesh. Those are the countries where what level they are, and we need to be better than that. So from that perspective, I would take anything more than 20% is a challenge for India, for sure.
You know, on that note, actually just allow me to quickly hop across to the wall, because I was looking at the comparative rates, where we stand, and some of the implications that are out there. Because it's, you know, this 50% on us, and by the way, it's not as if we are running the highest trade surplus with the US, not at all. Our trade surplus is around 46 billion. I mean, China is over 100. I'm not even talking about China. Let's forget China. Let's look at countries like Vietnam. Even their trade surplus with the US is much, much more. But we've gotten the raw end of the deal very, very clearly. Just want to talk about what has happened with respect to geopolitics, because that's become very important for the market. We all remember Thursday, right? The moment that news trickled in of possibly some, you know, meeting between Putin and Mr. Trump, we saw the short covering in the market.
No, so we'll get back to that piece, Surabhi, that you're going to be putting out in just a bit from now. But, you know, for the markets, what's worrying the market? The domestic economy is quite soft. Earnings are yet to pick up. And these Trump's tantrums have now turned into tariffs, you know, because earlier he was, you know, every day you woke up to something. Now, this week, actually, the direction was clear. 25% became 50%, and there's no U-turn. But I would have to bet with Prashant on that one, you know, even though I'm not a betting man. But I think in the next 20 days, there'll be some softening of stance from this 50%. That's the hope, at least. You know, from a technical perspective, what are you hoping for? The PCR has come down to 0.7 by the time we closed up today. The FI net shorts are the highest that we've seen since March 2023. And the India VIX, with a correction from around 26,000 odd all the way to around 24,500. The India VIX is still pretty much okay, well, decently behaved. You know, otherwise, you'd have seen the VIX shoot up to the high teens, which hasn't happened in this case. The problem is we require some kind of good news from somewhere, because that's missing, and on a day-to-day basis, the Nifty is making lower lows. You know, how would you, you know, look at this market, Ravi? You know, if a lot of retail audience out there, they're getting a little bit panicky now, because it became so easy, right? You have some bad news, you buy, it'll recover. Now you're getting follow-through on the downside. This market needs to stop falling first, then we hope for a bounce.
No, I think you summarized it very well. The positioning is very, very extreme right now. So what we need is a positive trigger. I think it's an unfortunate timing from that perspective. The economy was getting soft, and
probably we are at the fag end of the softening of the economy, because the steps have been taken by government as well as RBI, but those steps take time to percolate it down into the economy and into the earnings eventually. So we're probably a couple of quarters away from that, but in the meanwhile this uncertainty has created a whole new dimension to the market, and which has caused the markets to come down. So I do believe we need clarity. It might not be the best deal for us, but at least we need clarity. We cannot afford having this linger on till the end of the year. We want clarity in the next, we need to have clarity in the next 1 month. And we need to now actually really work hard in opening up the other markets, whether it's EU or other market. And it might be so that, you know, because we had a tough deal with US, we might actually be a little lax on the other side. So one action will have its other reaction. But what we need is clarity and opening up of markets so that we can get on with business as usual. And the steps taken by RBI should eventually result into economy picking up by the end of the year, is what I feel.
Ravi, you know, the one big support for the Indian market was the retail money. But you know, now it's not about 1 day, 1 week or 1 month, 3 months, 6 months, almost a year now, we're coming to a negative return or a flat return. Is that a bit of a risk now that the domestic liquidity will, you know, somewhere find it fatigued, and there could be a bit of loss of momentum from that side? Are you getting that sense yet, talking to a lot of...
No, there is clearly a loss of momentum. Yeah. I won't say that... See, we are not going back to the old ways where there will be complete stoppage of SIPs or retail money will not flow in. Yeah, maybe the chunky money might not come in at this point of time. They are more going to be opportunistic. So if they see market performing, they'll come back. But the more sticky one, I think there will be a base at some point of time, and it should support. And even the foreign money, for that matter, I think we are at a 15-year low in terms of the equity holding. I do not believe that they are going to, you know, sell off 2-3% of the equity or something of their holding over here. So technically, it looks like we are at a very extreme positioning in the market. But we need a fundamental positive trigger for us to start moving up. Valuations have become reasonable as compared to the other markets, because we have seen Europe, you know, some Asian markets also perform. We used to quote a 2 standard deviation premium to the other markets. Now it is more closer to the long-term average than it has been in the last 5 years.
So at least, I mean, from that perspective, that's a silver lining, that at least we're not
valuations are far more
expensive.
palatable in comparison to what it was.
What it was about a year back, absolutely. Specifically on pharma, Ravi, and you've obviously done so much work over the last many years on this, right? And again, it's a big question mark. We don't know. He's going to raise tariffs, but he said he'll do it gradually. Eventually, he's saying 250%, but we'll see. Should investors be worried if they have a lot of exposure to pharma?
So, see, first of all, let's understand what US's problem is. They want to bring their costs down in general. It's an economy that has been propped up by debt, and all that debt, healthcare forms 15% of the GDP, and it is growing at double the cost, double the rate at which GDP is growing. So, it's healthcare costs, they absolutely need to bring it down. Of course, drugs is a very small part of it, but still, even that will hurt, and that will hurt directly the consumer. So, India and China are the source of cheap drugs for US, and if they do not, if they put this kind of tariff, it is eventually the US consumer that is going to suffer. Yes, there might be some hit that the manufacturers over here will have to take. And if you're talking about these steps leading to supply chains moving, it's not going to happen overnight. It will take 10-20 years. So in the meanwhile, you'll end up hurting your own economy. So I don't think it's a permanent shift that is going to happen. But incrementally, everybody will say, I'm putting up one new plant. Like Apple said, I'm going to invest over this much. They'll show their intent. And of course, then it will depend on in the next election what happens. They are not going to commit or spend their entire amount right now. But yes, in the meantime, in the short run, it will create uncertainty, and it will lead to uncompetitiveness on the part of Indian manufacturer vis-a-vis other countries. That remains a challenge.
But you don't see an earnings threat or a fear or any sort of further downgrading?
See, the bigger problem in the pharma is the approvals, right? I mean, if they want to buy from somewhere else, there should be a source available from where they can procure it. Sure. If that drug is not available anywhere, they will. What will they do? They have to buy it from
the tariff will be passed on.
It will be passed on, and they will. So it will boil down to how strong the competitive advantage of that particular company is in that particular product, and that will determine their ability to pass on the cost. At a country level, India's strength is very good in pharma. especially in the API and the formulation space. So I do not foresee any country taking away any significant market share. And China also, as I understand, at this point of time, at least it's still comparatively disadvantaged only in terms of tariff. So I don't see a major shift. It's just probably inflationary for the US healthcare cost.
Correct. Ravi, couple of sectors I want to ask you. The first is on EMS. We saw a big accident today in terms of PG sharply cutting down the guidance. I'll just run through the valuations as well. Dixon is still trading at 58 times, Keynes is at 56 times, Evlon is trading at 42 times, Amber is trading at 46 times. You played this theme very nicely in the last couple of years. Stocks are up 8, 10, 15x as well. At these valuations, kind of challenges which are coming across, what's your take on the EMS space? A buy or a avoid?
So we are completely out of this space. Okay. It's been a while since we are out of this space. Stocks have done very well after that also. Okay. But as you rightly mentioned, number one, the multiples are not favorable. Sure. See, when you are looking at the multiples, two things to keep in mind. An absolute 45 times or something might not mean expensive or cheap. But in comparison with the growth, in comparison the stage of the cycle, you have to see where the multiples are. So if these companies continue to grow at 40-50%, those valuations might sustain. But if they are not going to grow, clearly there is a problem. And I do feel that at this stage, if you are entering, then you carry that risk. Sure. That if there is like what happened in the case of a company.
What was the trigger for you guys to sell it out?
I could not justify. See, for me, it's always easy. If I cannot justify a doubler in 3 to 5 years time frame, then I'm carrying more risk than reward in my portfolio. Sure. So the idea is that it was a stage at which stocks had run up. They were factoring in 3 years forward in terms of valuations. You can give it a little bit longer rope when it's a nascent industry. But now it is a well-recognized industry. Everybody, a lot of money has flown into it. Sure. Making money from the next 2-3 years point of view, I feel is going to be a challenge in this space.
Is that going to be the case with the defense stocks as well? Again, a lot of big momentum has seen. We've seen big rallies, but the numbers are not coming
mostly horrible Q1 numbers.
Exactly.
So most of them.
That is a bit of seasonality in defense, but still, from a medium-term perspective, you think most of the good news is price change rally is done with in the defense space?
I am pretty much out of the defense stocks also. Okay. But however, I do feel the problem in defense valuations is to a lesser extent as compared to the EMS space. And that business is far more defensible than the EMS. Okay. See, over here, one customer going here, there can make a big difference in electronic manufacturing. But in defense, in today, there are virtual monopolies. There is only one guy to whom orders for frigates are going to go or light combat aircraft. There are only few guys who manufacture this. So the entry barriers as well as the exit barriers are quite high. So it is probably, over there I feel it will be, the price correction can be to a lesser extent, or there can be a time correction. But these electronic manufacturing companies definitely are, there could be landmines over there.
All right. Ravi, I wanted to ask you about the renewable space. And solar as a theme is something that you're like, right? There's solar cells, modules player, solar pumps as well. Those are a couple of segments that you're like. Tell us the rationale out there, because the street is divided out there as well. You have a very, very bearish view that's coming in there, and you have a very bullish view. Some believe that it's run its course. You believe there's further potential?
See, I don't think it's run its course. It was only in April 24
I'll ask you in a simpler way. You spoke about two sectors you've completely exited.
Yeah.
The third sector which he asked you, you're very bullish on. Are you still holding on?
Absolutely.
Perfect. So that's an answer that you're still bullish on.
Yeah. So
now explain
the simple answer is yes. Of course, we are holding on.
Yes.
The reason I believe we were still at the beginning of the cycle. It was only in April 24 that ALMM got introduced, which is that you can buy only from this list. Now government is coming on with ALMM 2, which is essentially the cell manufacturing part of it, and eventually they will go to wafer and polysilicon as well. So the idea of government is to ensure that these companies make money so that they can backward integrate, and we finally have our own supply chain which can stand up to China someday. So that being the hope, I don't think these tariff and non-tariff protections are going away tomorrow. They are here for at least 3-5 years. So from that perspective, you should not be so worried. Yes, theoretically, if they were to go away tomorrow, there is a risk to the business model. But if you think of it, the energy independence and energy security are two big strategic reasons why we should not, open this sector up. And from that perspective, I think it is well protected.
Okay, so renewables gets a thumbs up from Ravi. We'll find out which are the other sectors that he's bullish on. That after a very quick break. You're with us on Editor's Roundtable. So what has this 50% tariff on India meant for the market and what lies ahead? Let's take a look. Now, first of all, let's look at the 50% number itself. India has been handed out the highest tariffs in the world, next only to Brazil. And it's not as if we're running the highest trade surplus with the US. I mean, look at, that's why I put up this number. These are some of the trading partners of the US which are running very high trade surpluses. In fact, look at China, I mean, 296 billion. Vietnam is at 123. The trade deficit the US has with India is just $46 billion. Despite that, our tariff at 50% is obviously among the highest in the world. So that's point number one. Now let's move on and talk about what has happened, because geopolitics has become very, very interesting and very, very important. What has happened so far? In the last 24 hours, what we've heard is that Mr. Trump has said that there'll be no further negotiations with India till issues are resolved. He seems to be pointing out towards the Indian purchase of Russian oil. Number two, we know for a fact, with confirmation coming in from Mr. Doval, that the Russian president, Mr. Putin, he's going to be making his way to India. Very, very important development as well. Number three, we've seen a conversation, a phone conversation with the Brazilian president and Indian Prime Minister, and talks were apparently covering a whole range of issues, including, of course, tariffs. In fact, Mr. Lula is expected to make his way to India on a state visit in 2026. And number four, Prime Minister Modi himself is going to be traveling to China for the SCO summit. And this is assuming a lot of significance, because in all probability, he will be holding a bilateral meeting with his Chinese counterpart. And this is the first meeting in many, many years. So the voice of the BRICS seems to be rising again. These overtures are very significant and important. Now, the market is in a wait-and-watch mode. It is waiting for a breakthrough. First of all, in that meeting between Donald Trump and Mr. Putin himself, because if that happens, then the market's hope is that at least that additional 25% tariff, that perhaps can be knocked off. But it's a if at this point in time. So what does this mean for the market? Let's look at some numbers. The Nifty is down about 1% this week. The mid-cap index has fallen about 1.5%. Now, what happens if all of India's exports get tariffed at 50%? Morgan Stanley has done an impact analysis, and they're saying is if everything is tariffed at 50%, then the impact on GDP growth is going to be 120 basis points. But if the exempt categories, such as pharmaceuticals and some electronics, if they continue to get those exemptions, then the impact on GDP growth is going to be lesser, only 80 basis points. Now, why is the market so worried if the GDP hit is only 80 basis points? Here, the answer comes in flows, and the picture on FPI, inflows and outflows is not looking very good. In July, we were out by almost 18,000 crores. So far in August, 12,400 crores. And so far in the calendar year overall, we've seen outflows of over 1 lakh crores so far. So that remains the biggest concern. Something highlighted by Novama in one of their notes. I'm just recapping that for your benefits. For instance, this one brokerage says that the capital flight is likely to weigh on the SMID space, in particular small and mid caps, and that remains the biggest risk for the market. And Ravi, that's really my question to you. FPI outflows, is that a new risk? Ravi, yeah, that question to you. FPI outflows, I mean, we'd want to wish it away, saying domestic inflows will counter it, but could it still be a new risk the market has to look at?
No, clearly they have, FPI flows have not stopped going out. And there was for a brief moment, there was a period where it looked like the US exceptionalism was ending and money would flow towards emerging markets. But what has happened is money has flown towards selective European market, selective Asian market, not as an emerging market overall. So India got money in one particular month. I think in the month of April or May, it got big flows.
Yeah.
But after that, again, it's the same thing. And relatively, India's position has worsened in the trade war. So that has led to the outflow. So I don't think we are carrying a huge amount of FPI risk, FPI outflow risk, because their holding has come down from 24% to almost 16%. And can it go down to 15, 14? Sure, it can. But it's not going to be the same as 26 coming down to 15, 16. So I think it's less of a risk, but we are lacking triggers. We are not the most attractive bride out there.
Well, let's talk about what can make the bride attractive. You mentioned one attractive piece, which is the solar space. What else?
I think reforms. Reforms is what is needed. We need to press the pedal on reforms. We cannot be expected to continue on this trajectory. India as a story always has had big bang reforms at a regular interval for it to carry the momentum forward. And I think it's been a while since we have had that. So, and if we are not going to provide a demand side stimulus, at least unclog on the supply side as much as possible and make it attractive for the money to come in. So, honestly, that's what reforms would make it Indian market attractive.
Two, three things that you can mention, that you are looking forward to in terms of reforms, which can really kick, just change the dynamics and put India on a radar.
So on the access to the market side, we need, actually it was our need. So a lot of people say that, the current GDP, not much impact because of trade war. No, that doesn't matter. What matters is we are all counting on us going from, being a 1-2% of the global trade to 5% of the global trade. And if that was to happen, we have to be part of the trade agreements with the largest market, which is US and Europe. So it is the future growth that is impacted, not the current GDP that is impacted. So we need to become part of those trading blocks. We need to unclog the regulatory jam that we are seeing in a lot of areas, and especially the legal reforms that need to happen. I think there is still a lot of scope for infrastructure improvement and making the processes. I mean, I'll just give you one example from our industry, an FPI wanting to come in still has to fill in a lot of
they always talk about that.
Even in a gift.
Even in NRI struggling to invest into India market, there is a lot of regulations and a lot of checks.
There is a lot of scope for efficiency and productivity improvement. I mean, let me not get into the detail of it, but clearly, I think we are not at par with the rest of the countries who are trying to attract capital. We have to be better than them.
Point well taken, well made and well taken, Ravi. But I mean, these are obviously, they'll happen over time, over medium term, or even if they happen now. I mean,
it needs to happen now.
But as we wait for this to happen, right now the market's big hope is festive season. Consumer recovery, rural recovery, festive season recovery. Do you believe all the corporate commentary that you're getting around this?
No, I think there is going to be some pent-up demand. And again, I do feel that what might disappoint is the extent of recovery. There is going to be a recovery for sure. But is that, will we go from being a 6% growth to a 6.2, 6.3, or is it going to be a 7% growth? That can make all the difference in what kind of...
Which one do you think will it be? Will it be meaningful recovery?
No, I don't think so. I don't think it will be a meaningful recovery across the board, not for sure. In bits and pieces, and in some sectors it might be good enough. I think we need to let some more time pass and let some time correction happen before we start seeing a new move in the market.
We didn't ask his favorite sectors beyond solar.
No, yes.
Anything else? Final advice? Any other sectors? Anything interesting you're watching out for?
No, I think the push from the regulator side has to be on increasing the credit growth. And we cannot have 9% credit growth. We cannot have a nominal GDP growth rate of 8%, We need to be growing at 10, 11% in terms of nominal growth. And we need to have credit growth, which is 13, 14, 15%. It will take time. Good thing is the steps have been taken and some more incremental steps should be taken probably. But it is not lost on, whether it is the central bank or the government, it is not lost on them. but it's just that we as a market participant are a little impatient. We want these things to happen sooner.
Yeah, I think to sum it up, given that this week is when India bounced back in the test match, I think the wicket is looking a little bit tricky. We can't go for those big hits. Maybe spend some time in the center, let's see that ball a little bigger. Tug in there the 1 and the 2s, and then in fact, as we're informed, then the big hits will come.
Yeah,
so I think a
your
gradual
chance will come.
Your chance will come. That's what you stepping out to on a green top is going to be very, very difficult. But just thought we'll wrap it up on that note.
That's a good analogy. Preserve your wicket, take in the singles as you get, and then wait for the big hits. Ravi, great to have you in our newsroom. Hope to see you more often over here. Thanks very much for joining in. Well, with that, it's a wrap from this entire team that puts the show together. Thank you so much for being here with us. We'll see you bright and early with the markets on Monday morning. Till then, keep watching CNBC TV18.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. US President Donald Trump rules out further trade talks with India until the tariff dispute is resolved. New Delhi is staring at 50% tariffs with effect from the 27th of August after US President escalated the rhetoric over Delhi importing Russian oil. Sharp cuts on Dalal Street, Sensex and Nifty down for the 6th week in a row. This is the longest losing streak in more than 5 years. Gold prices hit record highs after Financial Times reports the US has imposed tariffs on imports of 1 kilo gold bars, a boost for cryptocurrencies. President Trump signs an executive order clearing the way for retirement funds to invest in cryptos and private equity. India's largest bank, SBI, reports first quarter numbers largely in line with estimates. Profits rise 13% even as net interest income remains flat. Asset quality worsens marginally. Supreme Court hears the Bhushan Steel insolvency case. Banks seek payments of more than 6,000 crore rupees from JSW Steel. This includes the earnings during the insolvency proceedings and interest cost for the delays. Entity linked to the promoters of Bharti Airtel offloads nearly 1% stake in the company worth 9,300 crore rupees. Airtel shares come under pressure as entities linked to the promoters have sold nearly 2% stake since November last year. Leader of opposition in Lok Sabha, Rahul Gandhi, demands the release of voter polls and video recordings from the last 10 years. This after accusing the Election Commission of colluding with the BJP. Election Commission asks Gandhi to sign a formal declaration or apologize. BJP accuses Congress of spreading misinformation. Supreme Court admits a petition challenging the sedition provisions under the new criminal code, the Bharatiya Nyaya Sanhita. The petition alleges government has brought back the sedition provisions which were stayed by the apex court in 2021. Israel's security cabinet approves a plan to take military control of Gaza City, marks a major escalation in the war with Hamas. UK's Prime Minister condemns the move, says it will only lead to more bloodshed. United Nations warns of catastrophic consequences. Right, the top story this evening, US President Donald Trump has said that there will be no trade negotiations with India until the dispute over tariffs is resolved. His remarks come days after Washington escalated the rhetoric against India, imposing 25% additional tariffs over the already prevalent 25% for buying Russian oil. India now stares at a 50% total tariffs, which come into effect on the 27th of August as things stand.
Increase trade negotiations, since you've announced the 50% tariff?
No, not until we get it resolved.
And Brazil and India are facing the highest tariff levies among the BRICS nations at 50% each. However, Brazil is at a lesser disadvantage since United States runs a trade surplus with the country. Indian and Brazilian officials also confirmed yesterday that Prime Minister Narendra Modi and Brazilian President Lula spoke over phone. Ratings agency Moody's has warned the US tariffs to the tune of 50% may hurt India's manufacturing sector. It has also warned that any decision to curtail imports of Russian oil could be disruptive to economic growth as well. Parikshit Luthra joins us now. Parikshit, Moody's raising the red flag for India over US tariffs.
The wider tariff gap compared with APAC economies would hurt India's manufacturing sector. That's the latest analysis coming in from Moody's. The ratings agency says that a 50% tariff rate will widen the gap between India and other economies in Asia Pacific with 15 to 20% rates. Going forward, India's response and outcome of talks will determine the impact on India's growth, inflation and external position. Moody's experts have noted that India's purchase of Russian oil at below global prices has helped insulate inflation from global commodity price movements, and future purchases of Russian oil at 50% tariffs would slow down real GDP growth in FY26 by 0.3% from current forecast of 6.3%. Also, a larger oil import bill on account of non-Russian oil purchases would widen the current account deficit, and weaker tariff competitiveness will undermine investment flows to India. However, Moody's expects India to continue focusing on gradual fiscal and debt consolidation. However, India continues to negotiate with key allies and nations including Russia, Brazil and China. NSA Ajit Doval was in Russia this week and he called on President Putin. PM Modi is going to China later this month for the SCO summit. Just yesterday, President Lula dialed Prime Minister Modi amidst the tariff storm. Both Brazil and India are staring at 50% tariffs. Both leaders agreed to defend multilateralism. President Lula and Prime Minister Modi discussed ways to deal with unilateral tariffs and also discussed closer integration in current challenging environment.
All right, thank you, Parikshit, for that. Moving on, the United States Commerce Secretary Howard Lutnick has said that the Trump administration is likely to extend the China deadline for another 90 days. In an interview with Fox News, he said, "I think we are going to leave that to the trade team and to the president to make those decisions. But it feels likely that they are going to come to an agreement and extend that for another 90 days, end quote. He added that President Trump has also signaled progress on a China deal. On to the day's market action now. The market closed at the day's low with all frontline indices ending over 1% lower. Nifty slipped below the 24,400 mark while all sectoral indices ended in the red. And Sensex and Nifty for the week fell for the 6th straight week, making this the longest losing streak in 5 years. Over 50% of the stocks on the Nifty 50 index posted losses this week. Broader markets also ended the week in the red. Surbhi Upadhyay joins us now with a market wrap.
The main market issue is FPI outflows, Will we see a big exodus of FPIs? Now look at the numbers so far. In any case, July was weak. We saw outflows of almost 18,000 crores. August so far, the outflow number has been 12,400 crores. And so far for the year, including the months of January, we are already at a negative figure, outflows of over 1 lakh crore rupees from the equity market. Now let's talk about the weak sectors. I mean, for the week as a whole, most parts of the market are down. There's nothing that's holding up the bull's case. Nifty Pharma taking the big hit, 2.5% lower. The healthcare index lower. FMCG, high beta sectors like real estate down about 2%. Banks are not working. Financials also on the lower side. And even the IT sector was down about 0.5%. So no place to hide as such. The only sectors that have shown green this week would be the PSU banking index. That's done actually pretty well. The capital market space and some gains on auto, thanks to the rise in Hero MotoCorp this week, and the metals part of the market. Now let me come to Friday. Friday itself was a very negative trading session because the Nifty finally reversed all of Thursday's gains. And in fact, it broke Thursday's intraday low. Thursday was the day when the market was reacting to that 50% tariff announcement. Now, the losers of the day in terms of the Nifty included stocks from across the spectrum. Adani Enterprises, Bharti Airtel, where a large block deal also happened. IndusInd Bank, Shriram Finance from the financial space, Hindalco, Axis Bank, Reliance Industries, Hero Moto itself reversing some of the earlier gains of the week. So you can see it's cutting across sectoral lines. The gainers, some buying in NTPC, Titan after numbers doing well, and maybe some gains on HDFC Life and Dr. Reddy. So not too many places to hide. The mid-cap market was worse off. Big declines coming in over here. PG Electroplast has cut its guidance for the full year. The market absolutely did not like it. Stock was down over 20%. It took Dixon down with it. The names from the defense pack were very weak. Stocks like Mazgaon, Data Patterns down. Kalyan Jewellers, despite a very good set of numbers for the first quarter, sliding 8%. Coforge weak because of some issues with one of their recently acquired companies. And Biocon was down 5%. The gainers, not too many names to count, but some positive earnings reactions on Friday included Global Health, Kalpatru Projects, RateGain, and some of the new listings are still working very well. Sri Lotus Developers, Sai Life Sciences, these stocks managed some gains on Friday. The market is weak, the market is nervous, and it's going to be tracking those global tariff negotiations, geopolitical developments very, very carefully going forward.
All right, thank you, Surbhi, for that. From equities to commodities now, gold futures climbed to a record high. This after the Financial Times reported that the United States had imposed tariffs on imports of 1 kg gold bars. 1 kilo bars are the most common form traded on COMEX, the world's largest gold futures market. Meanwhile, spot gold stayed on track for a second straight weekly gain on tariff turmoil and hopes that the US Fed will cut interest rates in September. US President Donald Trump has signed an executive order allowing cryptocurrencies and alternative assets to be included in the country's 401k retirement plans. The move could unlock trillions in savings for non-traditional investments, a boost for asset managers. However, critics warn that this move may expose retirees to higher risks. All right, let's cut across to the Union Cabinet briefing, where Union Minister Ashwini Vaishnav is addressing the media.
Sanction हुए. I'll take questions now and we'll go. एक थोड़ा सा अलग इस बार लेते हैं. पहले लेफ्ट का पूरा ले लें, फिर सेंटर पूरा ले लें, फिर बाद में राइट ले लेते हैं. ऐसा करने से बेनिफिट होगा कि एक तरफ देखना रहता है, फिर ढूंढना इजी हो जाता है. ऐसा करें? ओके, ओके विद ऑल. दीपक, चलेगा? सुजीत,
थैंक यू सर.
आइए लेफ्ट से चालू करते हैं. लेफ्ट में हम फर्स्ट रो, सेकंड रो, थर्ड रो, फोर्थ रो इस तरह से चलेंगे. ठीक है?
थैंक यू मैम.
वैसे आपका राइट है, मेरा लेफ्ट है.
Exactly. I hope I'm audible. Good evening. This is Sapna from CNBC-TV18. Two questions. One, of course, on the 30,000 odd crore compensation for OMC is also taking care of the fact that the LPG cylinders have been highly subsidized in the Indian market in favor of the consumers. That's one. Second, sir, so just wanted to understand that, there is around 41 to 42 odd thousand crores had been the rough under recoveries OMCs. 30,000 hasn't given any kind of a logic that has gone in onto this number, and when are the funds likely to be released? That's one. And second, sir, a broader question on the Trump tariffs, the 25 plus 25%. Any discussion that was held in the cabinet? Thank you, sir.
Under recoveries का कोई amount है? नहीं माइक की जरूरत नहीं. तो अभी कैबिनेट में what we have decided is 30,000 crore rupees ka, because this is the amount which is attributable to the affordable LPG for households. इसके अलावा this number keeps fluctuating depending upon the market price and many other factors. So this is the number which has been approved. The second part of your question, whatever has been discussed in the cabinet is placed before you. So I'll request that we limit the questions to the points which are presented. ये तो जल्दी हो जाता है.
47.
Right, time for a short break now. Coming up next, Leader of Opposition in Lok Sabha, Rahul Gandhi, demands the release of voter rolls and video recordings from the last 10 years. Election Commission asks Gandhi to sign a formal declaration or apologize. Details when we return. Welcome back. In Earnings Corner, State Bank of India's first quarter earnings were largely in line with estimates. Profits rose 13%, while net interest income remained flat on an annual basis. Asset quality worsened marginally on a sequential basis. An entity linked to the promoters of Bharti Airtel offloaded nearly 1% stake through block deals today. Now, Indian Continent Investment sold 0.8% stake in the telecom company worth around 9,300 crore rupees. The transaction follows the sale of smaller lots, adding up to a 2% shareholding since November last year. Shares of Airtel came under pressure in trade today. AU Small Finance Bank received in-principle approval from the Reserve Bank to transition into a universal bank, the first full-fledged banking license in nearly a decade. The move will allow AU to issue larger loans, serve more customers and set up subsidiaries. The regulator has given the bank 18 months to complete the restructuring. Speaking with CNBC-TV18, the bank's MD and CEO Sanjay Agarwal said that the 18-month period doesn't guarantee his tenure and that he will have to reapply for it on the order of transferring promoter shareholdings to a non-operative financial holding company. Agarwal added that the structure benefits him, but there can be a challenge on the tax front.
On the face of it, that it benefits me personally because my structure around holding is with me, my personal name and my family name, which is not that great in my opinion because it does not free me up, right? So I think the structure is quite progressive in my opinion, but the only challenge would be that how my whole tax angle will play out, right? So let me figure out. Okay. But for me, whatever regulator asks me, I will do that.
Lenders of the debt-ridden Bhushan Power and Steel have sought payments of over 6,000 crore rupees from JSW Steel in Supreme Court. This includes the earnings during the insolvency proceedings and interest cost for the delays. The banks also told the Apex Court that JSW Steel was to blame for not implementing the plan in a time-bound manner. Shares of JSW Steel fell following the news. On to a CNBC-TV18 exclusive. Escorts Kubota plans to launch 7 to 10 products annually across its 3 brands. Speaking with Parikshit Luthra, the company's management also maintained that short-term fluctuations due to US tariffs is not an immediate concern.
We have a very ambitious product development program, and every year for the next 4 to 5 years, we plan to launch between 7 to 10 products between the 3 brands for the domestic market and for the international market. So the current year, the monsoons are extremely positive. The government is also giving very positive signals on the minimum support price. And we are also increasing our presence in terms of our representation within the Indian market.
EV major Tesla has leased commercial space at New Delhi's AeroCity as it gears up to open a retail store. The lease documents show that Tesla will pay a monthly rent of 49 lakh rupees for 8,200 square feet of ground floor space. The deal carries a lock-in period of 36 months and a 15% rent escalation every 3 years. Parliament proceedings were disrupted today as India Bloc MPs staged protests over an alleged voter fraud and alleged irregularities in the Lok Sabha elections. Opposition MPs also continued their protests against the voter roll revision in Bihar. Both houses of Parliament were adjourned for the day. Right, the leader of opposition, Rahul Gandhi, has repeated his allegation that the Election Commission colluded with the BJP to steal votes. Speaking at a rally in Bengaluru, he demanded that the Election Commission release data on voters' list and video recordings from the last 10 years. This comes a day after Gandhi cited an analysis of data from a Lok Sabha constituencies in Karnataka as proof of vote theft. Gandhi alleged that the Congress analysis showed that over 1 lakh votes were stolen in the Mahadevpura assembly segment using duplicate votes, fake addresses and bulk voters at a single address. The Election Commission has asked Rahul Gandhi to submit a formal declaration under the oath or apologize. Chief electoral officers from at least 3 states have also asked the leader of the opposition to submit the names of electors incorrectly included in the voters' roll. Addressing a press conference at the BJP headquarters, Union Minister Bhupendra Yadav said that the Congress is spreading misinformation by fabricating stories and targeting constitutional bodies.
1 लाख वोट इलेक्शन कमीशन और बीजेपी ने चोरी किया। मैं यहां इस स्टेट से गारंटी देके कह रहा हूं, हमारी मांग है कि इलेक्शन कमीशन हमें पूरी देश की इलेक्ट्रॉनिक वोटर लिस्ट दे। सिर्फ कर्नाटका में नहीं चोरी हुई है, पूरे हिंदुस्तान में सीटें चोरी हुई हैं।
कांग्रेस पार्टी एक विशेष प्रयास करके एक परिवार के लिए सिस्टेमेटिक ढंग से फेक नैरेटिव के आधार पे उसको छोटा करने का प्रयास कर रही है और ये झूठ के नैरेटिव अपने आप ही जनता ने 3 बार ध्वस्त करे हैं और भविष्य में भी ऐसा होता रहेगा, क्योंकि 60% मार्जिन रखने वालों की क्रेडिबिलिटी इस समाज में रहेगी नहीं.
And with that, it's a wrap on this edition of Business 360. News and updates continue right here on CNBC TV18.
Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Well, it's been a little over half the year gone now, and it's been a different year, perhaps a difficult year for investors because it's not been a year of straight line equity market returns. So now, as you're assessing your portfolios, what's the prognosis? What's the advice? Not just for the second half of the year, but on a longer term basis. Is this a new normal of sorts that we are in when it comes to markets? Well, today on the show, we are going to get you the Motilal Oswal Private Wealth View. Ashish Shankar is with me on the show to take up a couple of questions that investors really have on their minds. Ashish, thank you so much for joining and welcome to the show.
Yeah, hi Surabhi, always a pleasure to be on your show.
You know, that's where I really want to start because a lot of people got used to very good returns, and returns in quick bursts. But the last couple of minutes, the equity market has been testing our patience. So first of all, you tell us, before we talk markets and portfolios, you tell us what investors are telling you when you talk to them across the length and breadth of the country.
So I feel it is the much needed temperance that has come in, because if you look at the last 3 years, it's been outstanding. I mean, till last October, you felt nothing can go wrong with equity markets. Portfolios were doing CAGRs of upwards of 20, and certain mid-cap, small-cap portfolios are doing 25-30%. If you remember, we were hearing about stocks going up in a vertical fashion on the SME exchange. Yep. Now you don't hear about the SME exchange. So I think this temperance was much required. I mean, as you know, we released a note at the beginning of the year in our publication called Alpha Strategist. And the title this year in January was Opportunity in Adversity.
Yes.
Right? Or Opportunity in Crisis. Because we felt that this year is not going to be as smooth after 2-3 years of spectacular returns. And it's been a very, very testing year, to say the least, so far.
Yeah, I mean, I'm just looking at the returns as well. I mean, at the index level, the Nifty is up barely 3.5-4% for the year as a whole. And even if you're looking at the mid-cap index, and the index level, we haven't seen gains. Individual stocks could have done, of course, much, much better. But Ashish, do you still get the sense of optimism from investors in terms of deployment? I mean, even if you look at flows that are coming to mutual funds, for instance, the SIP flows are intact, but the overall flows are, almost 40% lower from the peak. So what's the sense you get?
So it's a mood of skepticism right now. I mean, if you look at the indices, they don't tell you the full picture, right? Nifty seems to be up 4-5%. The mid cap is also doing fine. But if you look under the hood, right, there have been a lot of shifts. There have been sectoral shifts. There have been stocks which are down 20-30%. There are some stocks which are testing new highs. So the kind of exuberance we saw in September, October is not there today. So people are being a little skeptical about their allocations, especially when it comes to equities. So I think the mood is that of tempered optimism, which means that if you take the medium and longer term, yes, people are continuing to be positive on India, but they're saying, let me make my allocations in a gradual fashion. Absolutely. Because the last 6 months, whenever you've made an allocation into equities, you've got hit by something or the other.
That's true. Right? No, absolutely. And that is where, these are the markets that make you realize the importance of asset allocation and not having all your eggs in one basket, right? And we've seen that. We've seen gold do so well relative to equities over the last 12 months or so. So actually, let's start there. Now let's come to your mid-year call as it stands. Purely in terms of asset allocation, where were you at the start of the year? And have you changed at all between fixed income, equities, precious metals, or anything else?
Right. So same time last year, if you recollect, we had given even earlier actually, we had given a clear buy call on gold. Although we've always had gold in all our portfolios as a hedge. But we gave a buy call on gold because we believe that the future looks good and optimistic for gold as an asset class. So it's done extremely well. Now we are saying that you must have gold in the portfolio. But it's probably not an investment call, right? It's more like a hedge, back to gold being a good old hedge in the portfolio. So about 10-15% gold, I would say. And I'm right now talking about a balanced portfolio, right? Equities, I would say still we are optimistic. But the outlook from a return point of view, you have to temper down. Let's say 12-15% is a good range to expect in equities in India going forward as well. So maybe 50-55% equities. And the rest, you could do it through hybrid funds, debt kind of an allocation, because hybrid funds give you the tax advantage. Obviously, for portfolios which are much bigger, you have things like structured debt where you can enhance the yields on the portfolio. But this is how, I would say you should look at your portfolios. And just to give you an analogy, because we've just had a historic win yesterday, right, over England. Right. So if you actually compare the markets to cricket, this month, the title of our report is called Middle Overs, right? So you have the pinch hitting overs at the beginning, right? And then there is a period where, it's a very boring period, but you should not lose your wicket, right? Those are the periods where you keep adding singles. I think in equity markets, we are at that stage, right? Don't do anything adventurous, don't do anything funny, stick to your asset allocation, do your flexi cap, large cap allocation. And just bide your time in the markets.
So take the singles. Maybe the big hits are not coming right now. Take the singles, save your wicket. It's that kind of time in the equity market. That's so nicely put, very well put. Now, within that, let's dive a little deeper. And actually, let's start with gold, because you mentioned that, right? And I remember our conversation many years ago where you took a very clear call saying portfolios can even go up to 15-20% on gold. Now, isn't the gold rally looking tired to you? I mean, what's the sense? And people are now moving to silver. So people think, chalo, gold chal chuka hai, let's buy silver. What do you say to that trend?
So gold and silver are not the same asset class, because silver also works on, economic growth. It's an industrial, it's a part industrial, part precious metal. So I'm not too sure about silver because globally economic growth outlook has been moderated after whatever has happened over the last few months. Gold, we believe, should continue to be there in portfolios as a hedge. So I would say between 10 to 15%, depending on what kind of equity allocation you have. Because remember, gold is a hedge to equity allocation, right? So 10 to 15% is where I would put gold at. But between gold and silver, I would still stick to gold. I mean, silver is a little more complicated than gold because for silver to do well, you need global growth, you need industrial growth, because silver is a commodity often used, in industrial applications as well.
Okay, all right. So don't sort of extrapolate the wins and the sparkle of gold entirely onto the silver market. Got that. So let's talk equities now. And you're saying, maybe about 50-55% of the portfolio should be direct, full equity.
Yes.
That sounds fairly low, right? Because historically in India, especially people who have the risk appetite, young or middle, sort of middle-aged, they'd want to have a lot more equity. Is this one of your, lowest historic equity allocations in the model portfolio?
No, not really. I mean, basically, I was giving you color on a balanced portfolio, right?
Sure.
For people who are doing SIPs and building longer-term portfolios, I think you can continue to invest into equities and be a little be aggressive as well. It's just that we are saying this is not a time to take a very bold call on equities. Right. So, which means overweight is not a stance that I would recommend. I would say that you should be neutral to all asset classes, and like I said, this is a time to bite through markets rather than trying to be very adventurous and trying to create a lot of alpha in the portfolio. So it's a time to just be careful. That's all.
Fair enough. Now, like I was going back to returns, and the whole question that then next comes for investors is mid cap, large cap, small cap. How to break up that equity allocation? This year, nothing has worked. I mean, the Nifty is up 3.5%. The mid-cap index is flat. The small-cap index for the year as a whole, year to date, is down almost 5%. So it's been tough in that sense. Between the market capitalizations, what's your call, Ashish?
See, it's a classical market for alpha managers, right? Because if you look at Nifty, even in the Nifty, you have stocks which have fallen 30-35%.
Yes.
Right?
Yes.
Take a TCS, which
Tata
is a
Motors,
bellwether
TCS,
stock.
IndusInd Bank. Yeah.
Right. Who would think TCS will fall 35%, right? And then if you go under the hood, right, below the Nifty, there are stocks which are hitting all-time highs. So what is basically happening is there are shifts happening in the economy. So India is going from, let's say, a low-income country to a middle-income country over the next 3 to 5 years. So consumption patterns are clearly changing, right? A lot of money is going into newer sectors like renewables, manufacturing, and then you have the classic sectors like capital goods and defense coming back because of government capex. Now, unfortunately, a lot of these sectors do not have representation in your main index. So I think this is a period for stock selection. I would say I would be agnostic towards market caps. So a flexi cap fund works well. But in any case, a flexi cap fund will have between 50 to 60% large caps. Within large caps also, right, you have a digital platform which is hitting all-time high. And you have a traditional tech company which is hitting, a 52-week low. So there's that divergence. So I think this is a classical pitch for a alpha manager, right, to pick up the right themes and create alpha in the portfolio.
I have to ask you this, and I know you have the 4 C's framework. I think that's what it's called.
That's right.
Since it's all going to be about the fund manager that you choose to back, right? Give us some names. I mean, there's so much churn in the industry as well. There are the old stars.
Right.
But in terms of, say, the top 2-3 fund managers that you have your eye on for the next several quarters.
Yeah, so we have more recommendations in the flexi cap category, as you would have guessed from my view. So there are 4 managers that we've put out there. One is somebody who has a small fund but very, very experienced in markets. Both of us know him well, Samir Arora, the Helios Flexi Cap Fund, excellent stock picker. Then, Naren, again, the ICICI Pru Opportunities portfolio, slightly contrarian bent of mind, but, creates alpha through sector rotation. Then we have the Motilal Oswal Large and Mid Cap Fund, which is a high quality, high growth kind of a fund. And the Nippon Flexi Cap Fund, again, a very experienced manager. I think between these 4 funds, you will get a reasonable diversification in terms of style, and all four have demonstrated track record in creating alpha. If I go to the mid and small cap names, maybe an Edelweiss mid cap fund has done extremely well. A Motilal Oswal mid cap.
Just hold that thought, because what I want to do is dive a little deeper into these funds and some of the fund managers as well. So we'll take a break and come back with exactly that, some of the key fund recommendations and why Ashish likes both the funds as well as the fund managers. Back with that in just a bit.
Let's talk money. Let's talk money.
Welcome back. We're discussing the mid-year outlook and the mid-year perhaps rejig as you're evaluating your investment portfolios. What is it that you should keep in mind? And we're in conversation with Ashish Shankar of Motilal Oswal Private Wealth. Ashish has just told us that it is good to be very well diversified when it comes to your asset allocation, looking at the way markets are shaping up right now. So Ashish, let's now take it step by step. And you've given us a sense that you are going to be market cap agnostic in the equity space. So let's start there. I mean, maybe some funds for what it's worth in the large cap category and someone in the flexi as well, which gives the fund manager the right to move wherever he or she wants to.
Right. So I think the first name that I took was Helios, right? Somebody who's been in markets for close to 3 decades, right? Is an excellent stock picker. Someone who believes that not committing mistakes is a way to create alpha. So I think a seasoned manager like that in this kind of a period will definitely benefit your portfolio, because it's a tricky pitch, right? I mean, you are hit with some news or the other every few weeks. So you need to ensure that your portfolio is positioned in decent quality names. At the same time, you have some earnings tailwind as well going in the portfolio. So that's one name that I would definitely have in my portfolio. Then of course somebody who's again very experienced, believes in valuations a lot, which is the iPro Opportunities Fund, and it has a track record of creating alpha through sector rotation, right? And this is a perfect market for that.
And it's market cap agnostic.
It's again market cap agnostic, but this is a perfect market for sector rotation. If you look at the last 7 months, at the headline level, like you rightly mentioned, Nifty's not done much, mid cap, small caps have also not done much at the index level. But if you look under the hood, right, there are sectors which have corrected sharply, there are sectors which have come back. And just to name two of them, defense has come back very sharply after a deep correction, and you have NBFCs which have corrected sharply. So I think a sector rotation kind of a strategy will work quite well in this period. The third fund that I named was the Motilal Oswal Large and Mid Cap Fund. Now this fund actually blends in perfectly with the first two names, and I'll tell you why. Because of the thesis that a lot of the newer sectors are under the index. So if you look at the index, right, it's got the traditional sectors, and just to name two of them, banks and IT, where I believe that these sectors are fairly large now in terms of representation, plus earnings growth has been very, very slow.
They may not lead earnings
These
growth.
are tired sectors, and they may not lead the earnings growth. A lot of the newer sectors are below the index, right? Whether it's renewables, digital, etc., etc. And Motilal Oswal as a fund has the track record of picking up high quality, high growth stocks and creating alpha. So actually between these three funds, you get a very, very good selection of sectors and stocks, and your ability to create alpha goes up quite sharply.
So great. Those are three ideas where you can be in a more or less market cap agnostic way. You give the flexibility to the fund manager to pick and choose across large cap, mid cap, and even small cap. But let's move on. For a lot of Indian investors, they love their mid caps, right? So they're wondering at some point mid caps have to start firing up, mid and small caps. Over here, which are the funds and the fund managers that you're liking now?
So in the mid-cap space, I think Edelweiss is one fund which has been very consistent in the mid-cap space. They've demonstrated consistency. They demonstrated the ability to pick stocks. I mean, they are basically running as per the GARP philosophy, growth at reasonable price. The quality selection is very strong. And then they also look at the valuation criteria. So that's one fund. The second fund, I would say, has been like the top performer over the last few years, which is again the Motilal Oswal Mid Cap Fund. They have demonstrated their ability to go through cycles in spite of a concentrated portfolio. Generally, you would find that the mid cap portfolios are very, very diversified.
Yes.
But this is a fund which holds 25 to 30 stocks and has managed to create alpha. So between the two, you get a reasonable diversification in the mid cap space. In the small cap space, we have two recommendations. One is the Invesco Small Cap. Again, an experienced manager. Because in the small cap space, what is very important is you don't want mortality. So as you
company is dying out, basically.
Yes. As you go down the cap curve, quality becomes extremely important. Right? So I think Tahir is somebody who brings in that experience and attention of quality to the portfolio. So I think Invesco Small Cap has a good track record, and then you have the Bandhan Small Cap, again experienced CIO at the helm, which is Manish Gunwani. So these are some of the recommendations
on the equity fund side. Got that. So that's pretty helpful for those who are looking to add more money and looking at enhancing their equity portfolios. You have plenty of options to choose over there. Now, Ashish, hybrid funds. And, we've been seeing that. I track the data on a monthly basis as well. Last couple of months, very steadily, hybrid funds are now pulling in as much money as, pure equity funds. So clearly, investors are understanding the benefits of diversification. But how do you choose a hybrid fund? It's a very vast category, a lot of different types of funds, aggressive hybrid, balanced advantage, etc. So where do you start?
Right. See, generally, the hybrid funds are a stepping stone to mutual funds, right? People who are traditionally bank deposit investors, or people who've just opened a demat account and now want to start investing through mutual funds, they come through the hybrid category, and advisors also often recommend that as the first stepping stone towards building a mutual fund portfolio, right? So in that category, typically people go with tried and tested. Okay, so one of the funds which is the largest fund and still doing extremely well is your iPro Balanced Advantage Fund, right? Which is more aggressive towards equity, but they balance the portfolio also pretty regularly. Then the second one is HDFC. HDFC is more aggressive than ICICI. So these are stepping stones towards getting closer to equity allocation. Then you have the multi-asset category as well, right? Within the multi-asset category, one of the smaller funds that we've recommended is Vitok, right, which is true to label multi-asset. It's got gold, it's got equities, it's got debt, and even the debt portion, what they've done is partly, they've done it through the arbitrage strategy. So you get a taxation which is better.
Okay.
After 2 years, it's long-term capital gains. So these are few of the hybrid categories that we like. And then if you wish to be even more conservative, then you have the equity savings category, where the equity portion further goes down.
It's more like debt-like returns.
It's more like debt-like returns.
Okay.
The risk is debt-like. The returns are debt plus.
Okay.
So that's also a good category. So
and any specific AMCs you like here?
So again, I think there, you go with the bigger ones like an ICICI or an HDFC because they have track record in that category. So these are, and these funds actually come very handy in these kind of markets where the volatility is extremely high and you don't want to stomach that kind of volatility. For somebody who's not experienced and starting off investing, so on and so forth.
Speaking of debt-like returns, I wonder what your view is on REITs. It's a new asset class and again promises to be fairly steady but more tax efficient than even debt funds, which lost the pure debt funds, which lost that tax advantage. Is this an asset class you're liking?
Yes, for portfolios which are larger in size and people who can access, the exchange, REITs definitely make a lot of sense. The only thing to take care of in REIT is the volatility in the near term can be much higher than, let's say, a conservative debt fund like a equity savings fund.
Sure.
Because the asset, the prices move almost like equity, right? So you have to take a 5-year call.
Okay.
Over a 5-year period, you will be fine because you get the rental income on a regular basis. Plus, the asset value also stabilizes over time.
Correct.
But in the near term, based on supply demand, right, the prices can vary quite a bit.
So if you look at the REITs price on a daily basis, trading on the
can be very
exchange,
volatile.
then it could be.
It trades almost like equities, albeit less volatile than equities. So if you do not have the stomach for that, then REIT would not be the first category that I would recommend.
Sure.
Probably you come into equity savings or balanced advantage funds, and then the next step could be having a REIT portfolio. And if you take a 3 to 5 year view, you'll be fine. I mean, you'll get returns higher than equity, and you'll also get the tax advantage.
Understood. So this is really helpful, and now we have ideas to choose from across all the different asset classes. So let's recap then. What is the final advice? And what would you say would be perhaps one or two of the big mistakes that we as investors need to avoid as we navigate these rather confusing markets?
Right. So every time, we say the markets are different, but they teach the same lessons.
Yeah.
So if you look at last year, right, everybody was super bullish on small cap, mid cap, and a lot of people started investing in SME. Many people started going to IPOs, right? So ultimately, when it comes down to equities, it's about buying good funds, good stocks, staying for a longer period of time, having that patience going through volatility. So I think one big mistake that people probably would have committed, and now they are wiser, is going down too much on the cap curve, right? And buying these stocks directly, because a lot of these stocks don't have coverage, you don't have hand holding. So that's one mistake. Second is, going overboard on any asset class, right? So when equities were doing extremely well, people tend to load up on equities. They tend to go overboard. And then in markets like these, right, then you get a, rude shock on how your portfolio is performing vis-a-vis expectations. So I think, ensuring that you don't go down too much on the cap curve, take too much risk in frothy markets. Second is, sticking to your asset allocation. And in these markets, right, currently the markets we are in, I think the best thing to do is stick to the basics.
Keep it simple.
Yeah, things are tough. They will continue to be tough because I don't think this entire, challenge of what's happening globally on tariffs, etc., is over as yet. So we will see more of it.
Hunker down, stick to the basics, follow your asset allocation, and don't take on too much risk. So it's great advice. Thank you very much for putting it out so simply and beautifully for us, with some ideas, of course, of where we can be investing. Many thanks, Ashish. Great session as always. Thank you for joining us today.
Thanks, Surbi.
All right. Well, with that, we're out of time on this edition of Let's Talk Money. Keep sending us your feedback, comments, and queries. We will see you again next week.
Let's Talk Money
Hello and welcome to Global Eye. I'm Parikshit Luthra. The top story we are tracking this evening: Indian and Brazilian officials confirmed yesterday that Brazilian President Lula da Silva called Prime Minister Modi yesterday. The Indian government said that the two leaders exchanged views on regional and global issues of mutual interest. However, President Lula said in a social media post that the hour-long phone call focused on the imposition of unilateral tariffs. Lula also said that the leaders reaffirmed the importance of defending multilateralism and the need to address the challenges of the current situation. This comes after Brazilian President Lula da Silva said that he saw no room for direct talks with Trump as US tariffs on 50% on Brazilian exports took effect. In an interview from his presidential residence in Brasilia, he said, and I quote, "My intuition says that Trump does not want to talk, and I'm not going to humiliate myself." The leader also said that Brazil is not about to announce reciprocal tariffs. US President Donald Trump has hit Brazil and India with the highest tariff levies among the BRICS nations at 50% each. Furthermore, President Donald Trump has said that there will be no trade negotiations with India until the dispute over tariffs is resolved. His remarks come days after Washington escalated the rhetoric against India, imposing 25% additional tariffs over the already prevalent 25% for buying Russian oil. All right, let me go across to our guests. We're told Shashi Tharoor, Congress MP and chairperson of the Parliamentary Committee on Foreign Affairs, is with us right now. Can I go across to Mr. Tharoor?
Hello, how are you, Parikshit?
All right, let me go across to Pramit Pal Chaudhary. Till that time, Pramit, how do you see the situation as a result of tariffs? And what happens to BRICS now? Do you think India and BRICS nations have enough levers in these negotiations with Donald Trump?
Well, Mr. Panda, what happened? See, we were saying hello.
All right, Shashi Tharoor, Congress MP, is with us right now. Mr. Tharoor, thank you so much for joining us on the program. Let me begin by asking you, 50% tariffs seems very imminent right now. Do you think India will be able to come up with some sort of negotiated solution in the next 20 days?
Well, that's precisely what we have to trust our negotiators to do, Parikshit, because the truth of the matter is that's going to be an impossible position to find ourselves in. But there's something terribly unjust and unfair about this entire proceeding at the moment, because, as you know, on the 27th of August, if we have 50% on our goods, the Chinese, who are buying far more Russian oil and gas than we are, and trading on a larger number of other items besides, will only have 30%. So what happened to the great strategic partnership with India? What happened to their alleged competition with China? It seems very, very bizarre that the Americans are in the process of jettisoning a relationship they've spent a quarter of a century cultivating and building up for apparently some very petty short-term gains. I don't understand it. But our negotiators should definitely go in a spirit of saying where we can make reasonable concessions, we will, but we will not be dictated to. There has to be give and take on both sides. And certainly we're not going to accept a situation where it's, you take it or leave it, it's my way or the highway kind of thing coming from Washington. If that happens, I think we'll take the highway. And we should.
Right. You know, when it comes to having some sort of options in the diplomatic toolkit, now this is a very old relationship that we've invested in over the past 2 decades, Mr. Tharoor. Is it really possible for India to let this relationship go down as a result of a trade deal going sour?
But listen, Parikshit, it's not us who've done this, right? I mean, the entire sourness in the relationship has come from the extremely insulting language of a highly transactional negotiator. Now, if this had been conducted differently, it might have been a different story. But the way in which this thing has been done, the way in which the gentleman has spoken of us, a sovereign, self-respecting country, becomes very difficult for any Indian political leadership to swallow, number one. Number two, you can't have a relationship which one side values more than the other does. If America values us so little that they're prepared to throw us overboard so quickly over relatively trivial amounts for an economy the size of America's, then I'm afraid we may have been wrong in assuming our relationship was that important to them. Whereas previous American presidents have made it very clear that they valued India in India's own right as a significant presence in this part of the world, as an alternative pole to the Chinese, as a democratic ally with shared interests, no particular strategic lack of convergence, a population, I think almost 4 million Americans are of Indian descent. We had so much in common, and of course the shared values rhetoric as well. All of that kept us going as partners. Now, if all of this can be tossed aside with this kind of somewhat demeaning and belittling language by the American president, then we do also have to ask ourselves, what was all this worth? I'm still hoping that it's purely just a negotiating tactic and that the real work that's happening between the actual professionals, the negotiators from our Commerce Ministry, the negotiators from the American Trade Negotiators Office, that they are talking in a much more practical and constructive way, and they're getting things moving. And Mr. Trump's rhetoric was just sort of the accompanying soundtrack in order to put some pressure on the negotiation. That could well be it. Mr. Trump is fairly famous for having a very idiosyncratic negotiating style. And I think it may just be that. Let's not overreact. I'm always in favor of keeping a fairly cool head on these matters. But come 27th of August, if we are at 50%, let me be very clear, the bottom is going to drop out of a lot of our exports in the American market. No one is going to buy items from us at 50% tariff when even China is 30%. Our competitors like Vietnam, Indonesia, Pakistan and Bangladesh even are between 19 and 15%. Why would anyone buy anything from us at 50% premium? It's simply not. Even 25, the original tariff imposed upon us, puts the onus on us to somehow make up that 6 to 10% differential with our competitors. With 50%, we're out of the game. We're not even in the race. So we have to understand that in those circumstances, we have no choice but to look for other markets, to look for other outlets. And there will be creative things happening. I mean, I wouldn't be at all surprised if there aren't some smart Indians in the UK, where we now have an arrangement with the FTA where 99% of our goods are going without any tariffs to the UK, who will figure out a way of importing all the things from India that America used to buy, repackaging them as made in UK and reshipping them to America for a tidy profit. Anything like that could happen, who knows? But I mean, that's unfortunate for both Americans and Indians, but that seems to be where we might be heading if we don't manage to pull off a decent negotiation in the next 3 weeks.
Right. Mr. Tharoor, you spent a lot of time in the United States, in Washington, D.C., meeting think tanks, meeting members of the diaspora and the U.S. government. What do you think has gone wrong in the India-U.S. relationship? It's clearly not just about Russian oil.
Well, when I was there was no inkling of any such negativism. On the contrary, we found tremendous receptivity, tremendous support. I met, God knows, 50, 60 people, top influential people in Washington, not just think tanks and media, but also, frankly, a large number of senators and congressmen from both political parties, the Deputy Secretary of State and the entire establishment in the State Department, the kind of reception we got, and then Mr. Vice President Vance himself, totally positive, totally supportive, very keen on strengthening relations with India across the board, very keen on the success of the trade talks, very keen on cooperation in technology and artificial intelligence. I came back thinking this relationship was in great shape. So I am utterly stunned that the president seems so out of sync with what everybody else we met was conveying to us. It's true that I wasn't there to do trade negotiations. I was there to talk about Operation Sindoor and our political relationship. But the number of conversations I had, they couldn't all have been in the direction of positive relationship with India, when the president apparently is alone on a completely different track. I don't get it.
Right. What do you think can be done now? If I ask you to put on the hat of a diplomat, and someone who is a seasoned politician over decades, what can be done right now? Here you have a president who is trying to put pressure on Russia and wants India to stop purchase of Russian oil because he thinks that will hurt the Russian economy. What can India really do? How do we balance out trade relations and also a strategic partnership with Russia? Can we afford to cut off oil purchases from Russia altogether?
Look, that depends on market conditions. And if the differential is significant, we won't cut it off. I mean, we have every reason to look after the interests of Indians who need energy. I mean, it's as simple as that. We have said we'll always act in our national interest. If there is a continuing differential between the world market price that anybody else will sell oil to us and the price at which the Russians are selling to us, why shouldn't we buy Russian oil? I'm sorry to say, until and unless there are sort of United Nations approved global sanctions, we are not obliged to accept any country unilaterally dictating to us who we can and cannot buy from. The same, by the way, applies to the others. The Chinese are buying far more than us. If the Americans don't have the guts to sanction the Chinese but will sanction us, then I think we have to draw our conclusions from that. Look, our self-respect matters, Parikshit. After 200 years of colonialism, we are not a country that can be talked to this way, taken for granted or pushed around. We will stand up because we have convictions, and what is more, any Indian government would have stood up to this kind of pushing around. So I will say to you, I hope our negotiators go with courage and clarity, with a good sense of where we can make concessions. Remember, we made very sensible concessions in the first Trump term when he made this big fuss about Harley-Davidson motorbikes. It didn't hurt us at all. Instead of selling 83 Harley-Davidsons a year to India, they now sell about 280 or whatever. It didn't affect anything because the reduction of tariffs only affected a very small market and a very small elite segment of Indian consumers. There may be other items like that the Americans are making a fuss about, where we can give in because it will not hurt our market. But when it comes to something like, for example, dumping a large quantity of American agricultural grains, which, by the way, are heavily subsidized in America, on the Indian market at a time when 700 million Indian farmers and people living on the farms are dependent on agriculture for their survival, when farmers are committing suicide every year in many states of our country, that's unthinkable for any Indian government. We are not going to permit that to happen. We will have to have a red line. We are a democracy. We are accountable to our farmers. We're accountable to our voters. But as a democracy themselves, America should understand that. If our negotiators can explain why some things are not feasible and explain it convincingly enough, I would think that an American negotiator will go back to Mr. Trump and say, look, it's not possible. We can't get them to give in on this. On the other hand, they gave in on that. That's how negotiations work. If we can do that kind of negotiating, Parikshit, I'm not at all, I wouldn't be entirely unhappy or entirely surprised if with some concessions, we come out with a win-win. But if we don't, if the Americans dig their heels and say, you will do exactly what we want, it's my way or the highway, then I think we should take the highway because the highway is open to us. We have plenty of other countries we can turn to, and we have plenty of other options on the horizon. I don't think...
What is the concession? What are those concessions we can give, Mr. Tharoor?
I'm not a trade negotiator, and I'd be foolish of me to put myself in the seat of all these very well-briefed colleagues from the Commerce Ministry who are sitting and talking to their American counterparts. Let them do their work. All I'm saying is they should know where there's...
One more thing that I ask you... One more thing that I want to ask you is that... Right, since Operation Sindoor, Donald Trump has tried to take credit for the ceasefire 24 to 25 to 30 times. There is also a view that perhaps India could have just told the US and Donald Trump that we appreciate your role in stopping Pakistan and warning Pakistan and making them stop the war and, and standing up for India against terrorism. Do you think the situation could have been handled better? Because as a president who wants things acknowledged, who wants things acknowledged on social media, we should have given him that victory?
Look, I think that is possibly what he had in mind, is that he must have put pressure on the Pakistanis. You remember that the Prime Minister said to the Indian public that Mr. Trump didn't call me and there was no pressure on me. And not only was he justified in saying that, but the Indian signal from the day one of Operation Sindoor was clear and unambiguous. If Pakistan hits us, we will hit them back, but otherwise we are only retaliating against terror. We've done our job and we're done. So if Pakistan hits, we hit, but if Pakistan stops, we'll stop. So we didn't need persuading by Mr. Trump or by anybody else. But maybe when we hit the Pakistani air bases on the night of the 9th, 10th of May, I beg your pardon, of May. And when we did that and we caused devastation to the Pakistani air bases, maybe at that point some hotheads in Pakistan were contemplating some deeply irresponsible escalation, and maybe the Americans got wind of it and lent on them, and Trump said, don't do this, I don't want to have a nuclear country going to war with another nuclear country, whatever. And the Pakistanis then gave in to Mr. Trump and said, fine, we'll sue for peace the next day, which they did. Now, if that is what happened, then we should certainly have considered thanking Mr. Trump. I might say that when I was asked in Washington about this, that's exactly what I said. I said, we didn't need persuading, but if Mr. Trump has persuaded the Pakistanis, I'm sure we're all grateful for it. That was the kind of language I used. And perhaps we could have telegraphed that at a higher level. Maybe at that time, a call to the president might have flattered him suitably. I don't know. But you know, for two big sovereign nations to be worrying about the offended egos of individuals is somewhat unusual in terms of global diplomacy. And perhaps we should have to sort of relearn some of our core approaches in dealing with a somewhat unusual president.
Right. Mr. Tharoor, my final question to you would be, there is, of course, concern about the impact on the Indian economy if we were to stop buying Russian crude at discounted prices, if we have to buy crude at market prices globally and we have to buy them from other sources around the world, that could create inflationary pressures on India. There's a report by Moody's which has said that this is going to impact the growth in India. There will be a hit to the GDP as well. India will become more uncompetitive compared to other economies in Asia, which have a 15 to 20% tariff rate. We would have a 50. What's the larger worry, and how important is it for India to salvage this situation?
It is important, but, you know, look at the invidious choices you're confronted with. On the one hand, you lose a substantial market or a large portion of it because $90 billion is at stake with America. Some of it, by the way, is not affected, at least not yet, by the 50%. That's pharmaceuticals, because the Americans are dependent on us for about half their pharmaceutical supplies, and they don't want to make that unaffordable to the American public in the drugstores of America. So our pharmaceuticals will probably continue being sold to America at prices that they are happy to pay. But so we won't lose the entire 90 billion, but there will be some large portion that will simply be lost to us. By comparison, if we want to save that 90 billion, what do we have to do? If we have to now take a major hit on our energy supplies from Russia, buy more expensive things and drive up the cost of everything across the board, we will have to do some very sensible calculations as to which hurts our economy more. If we are going to lose a bit of the American market, what will we lose? Maybe 0.5% of GDP. If we're going to have much higher energy prices, what will we lose? Maybe 1% of GDP? I don't know. Some econometricians and statisticians far more qualified than me should work out the pros and cons. And I'm sure that Mr. Piyush Goyal would be very happy to know which is the more cost-effective option. But there is also, as I said, the question of our self-respect. And I think, frankly, it is very unlikely that India will simply surrender to people who are kicking us around. So that's the other thing. Right. I think we are going to stand up for our own pride, our own place in the world. And if it means cocking a snook at somebody who's being rather insulting and behaving in some respects like a schoolyard bully, insults about, you know, your economy is dead and I don't care if you take it down with the dead economy and so on. This kind of stuff is like a schoolyard bully telling a smaller kid your mother is ugly. I mean, it's really belittling language. It's meant to demean the other person, but it's not to be taken literally. However, it does have to be taken seriously because of the costs involved. And I will say to you frankly, Parikshit, at the end of the day, we will and must preserve the right to walk away. If we can get a fair deal, a balanced deal, where we're not making unreasonable concessions, we should probably take it. If we can't, then to my mind, we should say to the Americans, thanks, we thought you valued this relationship. Clearly you don't. We're going to find other places to go and play. And I think that those places are available to us. And we will have to try and completely reorient not just our economics and trade, but even our geostrategic approaches to the world. But if we are forced to do it, I think we have the capacity, the wit, as it were, the capability of doing what we need to do. I just hope it doesn't come to that.
Mr. Tharoor.
We do have a lot of common values with the US, shared strategic interests so far, and of course, this large diaspora descended from India, living in America. I would not want to see all that being jeopardized. But if the worst comes to the worst, Parikshit, standing up for India is what this is all about, and that's ultimately the bottom line for us. Any government.
All right, Mr. Tharoor.
Put India ahead of anything.
Mr. Tharoor, thank you so much for joining us. We appreciate the fact that you took out time for CNBC TV18, talking about tariffs and the tensions between India and US. Let's see what happens over the next 21 days. To take this forward, we're now joined by Pramit Pal Chaudhary, head of the Eurasia Group in India, Rajiv Bhatia, former ambassador, also with us. Pramit, thank you for being with us. Thank you, Ambassador Bhatia. How do you see the current situation over the next 21 days? Do you expect a solution, Pramit?
I would expect it, no. I would expect it to get worse before it gets better. Trump's normal tactic in trade negotiations, the pressure before talks begin as high as they can. In his book, Art of the Deal, he talks about the need to have leverage on the other person. And then suddenly you'll see him strike a deal at a certain point. So it would get worse, and I think his language will almost certainly get worse. The focus will be agriculture. That's the real core of the trade negotiations. Russian oil is an eyewash. India barely makes $1 billion in savings from Russian oil a month. It's not a big deal. But the real issue is going to be soya, dairy, and auto components. Those are the real hard nuggets on which the rocks on which the trade negotiations are on the ground.
Right. Ambassador Bhatia, how do you think India, Brazil would now be working together on this? Both countries have been hit by a 50% tariff. What do you think is the conversation between the leaders?
Thank you, Parikshit. I think I'm very happy that you're bringing in the Brazilian angle and through that the BRICS angle. I think we have to remember that this India-US or US-Brazil difference or dispute about tariffs is a much deeper issue right now. This is not coming to the forefront, but it will. The US seems to have a serious problem with BRICS. And already the word from Washington is that if BRICS were to gain further momentum, then more duties could even be imposed on BRICS countries. So keeping all that in mind, I think it was important when President Lula was advised, when he heard about 50% penalty duty or tariff on Brazilian exports to US, he was advised to call Mr. Trump. Lula said, no, I would rather call Prime Minister Modi. And that was the background in which the call took place yesterday. I think the short, crisp statement put out by the MEA and the Prime Minister's office is revealing enough. It talks about a discussion focused on bilateral cooperation in trade, technology, energy, and the rest of it. But then it adds that they discussed also regional and international issues. And most importantly, they agreed to keep in touch. My interpretation is that these two countries, which represent a very important but moderate pole of BRICS, would try to develop coordination within BRICS. And let us also be very clear that Delhi is not just talking to Brazil. Our NSA has just visited Moscow. So we have to remember that the conversation with Russia is on. There are reports, there's no official statement yet, but there are reports of the likely visit of Prime Minister Modi to China for SCO summit. So clearly India is looking at alternatives. And as to the main conversation with the US, we have to wait and see, because now if the word from Washington is that their team may or may not come, then the immediate future of negotiations becomes uncertain.
All right. Thank you very much, Ambassador Bhatia and Pramit, for joining us. Indeed, a very important time in negotiations. How will India work with Brazil, Russia, China, South Africa? What happens to BRICS? Those are big questions in the days ahead. That's all we have time for here on Global Eye. Thank you for watching. Goodbye.
Mr. Sethi, thank you very much for speaking to CNBC TV18. Let me just start with a broader picture on your numbers for the quarter. Profitability, sure, higher than what the street was factoring in, but it's because of other higher income. Your core income has remained more or less flat year on year, if not slightly lower. How is the macro environment shaping up with everything that's going on globally and in India? Do you expect this fiscal to be better than the previous?
First of all, let me thank you for giving this opportunity, Ritu. On the core income side, I think we need to look at with a slight different perspective. We had one-time gain interest on tax refund earlier, of course, which is not there. If you adjust that, yes, you're right. I think we maintain the NII at that level. But this is despite 30 to 40% of the book getting repriced immediately by 100 basis points, and also the large fixed deposit book what we have. So I believe that I think we have done fairly well on the NII front.
Okay.
And on the margin side, I think we still protected our margins, and I'm sure through the cycle, through the year, we will be able to maintain that 3% advisory. In terms of the uncertainties, I think the tariffs may not, more than the direct impact of the tariffs, I think the uncertainty surrounding the tariff narrative is something what is slightly a matter of concern. Obviously, that needs to be addressed. From a bank asset quality or credit growth perspective, it may not have larger impact, because one is the export basket of India is widespread, both geographically as well as from a point of view, what we are exporting. The 4 or 5 sectors which we are talking about, which have predominant exposure to the US, the bank exposure on them is limited.
Okay.
So that is not really going to impact either on the credit growth or in terms of the credit quality.
So in summary, will this fiscal year turn out to be better than the previous?
I'm sure that I think there seem to be closure to many of the uncertainties, the global political tensions. The tariffs is not unique to India, right? It's not localized to India. It's impacting many other countries. So almost all the countries are coming to the grips with the tariff, which gives an impression or confidence that many of the corporates which are looking at whether to take an investment decision or not to take, I think will come around and move on.
Well, so your loan growth, 11.6% right now, year-on-year growth that you've seen. The corporate book, though, sequentially it has slowed down. Over the previous year, it's in single digits, the growth. What gives you the confidence that you'll be able to get to double digits, sometime in this fiscal on the corporate book, especially when you're noticing this trend of corporates now going to the markets for fundraising, utilizing other sources? What gives you the confidence?
The confidence mainly coming from the fact that we have very robust pipeline. It's, in fact, the pipeline has increased over the last year. Today we have almost 7.2 lakh crore visibility of the corporate book, both in terms of the sanctioned loans but not disbursed, and also the pipeline of proposals under discussion. That is one part. Number two, the dip what you see in Q1 is essentially because whenever the interest rate reduction is happening, a lot of corporates come for renegotiation on pricing. Sometimes it is not acceptable to us, so we let go of them. Some prepayments definitely happened. There are almost 12,000 crores worth corporate loans got prepaid because we were not able to match the pricing or not. We thought that probably the pricing is too low. The second point what you mentioned in terms of corporate accessing the market, yes, that is also one of the reasons why working capital utilization particularly has come down, because they have accessed the CP market, and CP rates are very low when compared to the bank loans. But bank MCLR loans are getting repriced, right? MCLR will get readjusted. I believe that some of this movement which has happened to the market will come back to banks. So the combination of better utilization of working capital limits and better drawal from sanctioned loans, we estimate that we should be able to come back to double-digit growth in the corporate credit.
And overall loan growth guidance for the year?
We are still sticking to 12% credit growth.
So which is not much of an upside from 11.6%, the rate that we're seeing currently.
Yeah, but we want to be, a little more balanced in that. In fact, I did say last time that if things improve, we may even reach 13%.
Okay.
But if you see this 11.6% growth rate, what we achieved is better than what industry has done.
Of course, that's 9.5% kind of rates. On the deposit as well, your guidance was about 10%. Is that something you maintain?
Yes.
And you believe the deposit repricing is done, so therefore margins which have shrunk in the quarter, what sort of headroom do you see, for further improvement, especially if RBI, maybe brings down rates further sometime in the future?
So the margin improvement is coming mainly the repricing of fixed deposit, which is likely to happen. In our books, normally it takes about 8 to 12 months for the 80% of the fixed deposit to get repriced. So that advantage anyway will come in. Number two is that the margin improvement on account of CRR cut. We almost will have 52,000 crores CRR.
Starting September.
Starting September. That means, earlier also I mentioned that the NIM trajectory of U-shape will still we are holding on to it.
Yeah.
It's a combination of the cost of deposits coming down and the repricing of retail loans becoming stable. At least till December, we don't see any further rate cuts. Which means that the retail personal loans, retail home loans will remain at the rate what it is today.
But it's a U-shaped recovery. It's not a,
No, it will be a U-shaped because there's a lag in terms of deposit
so
getting
you'll be able to
repriced.
get back to or defend rather 3%.
So our
kind of
exit NIM probably would be above 3.
A quick word on the asset quality as well. So typically we understand the first quarter does see a spike, but it's a biggish jump for you, from 4,200 odd crores to almost now you have 7,900 crores. Briefly for our viewers, where did the stress come from and other pockets of stress that lenders have been highlighting, whether that is MSME, MFI, is there something you'd like to point out as well?
No, first of all, I think the comparison should never be with Q4.
Yeah.
You should compare with the Q1 of the previous year.
Which is more or less flat. There's little bit of a
200-300 crores and in a book of 42 lakh crores is not
It's
a matter
not
of
much,
concern. And also in the Q1 generally is the gross slippages, right? As we go forward, it become net slippages. For instance, from the 30th June till today, almost 14 to 1,500 crores have been pulled back in the slippages. So there's no great concern in terms of the asset quality. We have not seen any of the segments doing, in our book at least, that any stresses.
On MSME, on MFI, some
we
of these
don't have
pockets.
much of an MFI book, and our exposure to the MFIs also is very limited.
I see.
So it's about 10,000 crores. So I have not seen any much stress there.
So asset quality now that we've covered, for the full year, if you could give us a guidance to close with where your credit costs could end up and what your full year slippage and recovery could look like.
So on the credit costs, we had given a guidance of 50 basis point earlier. I think we're still sticking to that. And in terms of the gross NPA, 2% is something what we have indicated, and we're still sticking to that.
All right, sir, and we wish you the best with those targets. Thank you very much for your time here today.
Thank you, Ritu. Thank you.
Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Well, it's been a little over half the year gone now, and it's been a different year, perhaps a difficult year for investors because it's not been a year of straight line equity market returns. So now, as you're assessing your portfolios, what's the prognosis? What's the advice not just for the second half of the year, but on a longer term basis? Is this a new normal of sorts that we are in when it comes to markets? Well, today on the show, we are going to get you the Motilal Oswal Private Wealth View. Ashish Shankar is with me on the show to take up a couple of questions that investors really have on their minds. Ashish, thank you so much for joining and welcome to the show.
Yeah, hi Surbi, always a pleasure to be on your show.
You know, that's where I really want to start, because a lot of people got used to very good returns, and returns in quick bursts. But the last couple of minutes, the equity market has been testing our patience. So first of all, you tell us, before we talk markets and portfolios, you tell us what investors are telling you when you talk to them across the length and breadth of the country.
So, I feel it is the much needed temperance that has come in. Because if you look at the last 3 years, it's been outstanding. I mean, till last October, you felt nothing can go wrong with equity markets. Portfolios were doing CAGRs of upwards of 20, and certain mid-cap, small-cap portfolios were doing 25-30%. If you remember, we were hearing about stocks going up in a vertical fashion on the SME exchange. Yep. Now, you don't hear about the SME exchange. So I think this temperance was much required. I mean, as you know, we released a note at the beginning of the year in our publication called Alpha Strategist. And the title this year in January was Opportunity in Adversity.
Yes.
Right? Or Opportunity in Crisis. Because we felt that this year is not going to be as smooth after 2-3 years of spectacular returns. And it's been a very, very testing year, to say the least, so far.
Yeah, I mean, I'm just looking at the returns as well. I mean, at the index level, the Nifty is up barely 3.5-4% for the year as a whole. And even if you're looking at the mid-cap index, at the index level, we haven't seen gains. Individual stocks could have done, of course, much, much better. But Ashish, do you still get the sense of optimism from investors in terms of deployment? I mean, even if you look at flows that are coming to mutual funds, for instance, the SIP flows are intact, but the overall flows are, almost 40% lower from the peak. So what's the sense you get?
So it's a mood of skepticism right now. I mean, if you look at the indices, they don't tell you the full picture, right? Nifty seems to be up 4-5%. The mid cap is also doing fine. But if you look under the hood, right, there have been a lot of shifts. There have been sectoral shifts. There have been stocks which are down 20-30%. There are some stocks which are testing new highs. So the kind of exuberance we saw in September, October is not there today. So people are being a little skeptical about their allocations, especially when it comes to equities. So I think the mood is that of tempered optimism, which means that if you take the medium and longer term, yes, people are continuing to be positive on India, but they're saying, let me make my allocations in a gradual fashion. Absolutely. Because the last 6 months, whenever you've made an allocation into equities, you've got hit by something or the other.
That's true. Right? No, absolutely. And that is where, I mean, these are the markets that make you realize the importance of asset allocation and not having all your eggs in one basket, right? And we've seen that. We've seen gold do so well relative to equities over the last 12 months or so. So actually, let's start there. Now let's come to your mid-year call as it stands. Purely in terms of asset allocation, where were you at the start of the year? And have you changed at all between fixed income, equities, precious metals, or anything else?
Right. So same time last year, if you recollect, we had given even earlier actually, we had given a clear buy call on gold. Although we've always had gold in all our portfolios as a hedge. But we gave a buy call on gold because we believe that the future looks good and optimistic for gold as an asset class. So it's done extremely well. Now we are saying that you must have gold in the portfolio. But it's probably not an investment call, right? It's more like a hedge, back to gold being a good old hedge in the portfolio. So about 10-15% gold, I would say. And I'm right now talking about a balanced portfolio, right? Equities, I would say still we are optimistic. But the outlook from a return point of view, you have to temper down. Let's say 12-15% is a good range to expect in equities in India going forward as well. So maybe 50-55% equities. And the rest, you could do it through hybrid funds, debt kind of an allocation, because hybrid funds give you the tax advantage. Obviously, for portfolios which are much bigger, you have things like structured debt where you can enhance the yields on the portfolio. But this is how, I would say you should look at your portfolios. And just to give you an analogy, because we've just had a historic win yesterday, right, over England. Right. So if you actually compare the markets to cricket, this month, the title of our report is called Middle Overs, right? So you have the pinch hitting overs at the beginning, right? And then there is a period where, you know, it's a very boring period, but you should not lose your wicket, right? Those are the periods where you keep adding singles. I think in equity markets, we are at that stage, right? Don't do anything adventurous, don't do anything funny, stick to your asset allocation, you know, do your flexi cap, large cap allocation, and just bide your time in the markets.
So take the singles, maybe the big hits are not coming right now. Take the singles, save your wicket.
Correct.
It's that kind of time in the equity market. That's so nicely put, very well put. Now, within that, let's dive a little deeper and actually let's start with gold because you mentioned that, right? And I remember our conversation many years ago where you took a very clear call saying portfolios can even go up to 15-20% on gold. Now, isn't the gold rally looking tired to you? I mean, what's the sense? And people are now moving to silver, so people think, chalo, gold chal chuka hai, let's buy silver. What do you say to that trend?
So gold and silver are not the same asset class because silver also works on, you know, economic growth. It's an industrial, it's a part industrial, part precious metal. So I'm not too sure about silver because globally economic growth outlook has been moderated after whatever has happened over the last few months. Gold, we believe, should continue to be there in portfolios as a hedge. So I would say between 10 to 15%, depending on, you know, what kind of equity allocation you have. Because remember, gold is a hedge to equity allocation, right? So 10 to 15% is where I would put gold at. But between gold and silver, I would still stick to gold. I mean, silver is a little more complicated than gold. Because for silver to do well, you need global growth, you need industrial growth, because silver is a commodity often used, you know, in industrial applications as well.
Okay, all right. So don't sort of extrapolate the wins and the sparkle of gold entirely onto the silver market. Got that. So let's talk equities now. And you're saying, actually saying maybe about 50-55% of the portfolio should be direct, you know, full equity. That sounds fairly low, right? Because historically in India, especially people who have the risk appetite, you know, young or middle, sort of middle-aged, they'd want to have a lot more equity. Is this one of your, you know, lowest historic equity allocations in the model portfolio?
No, not really. I mean, basically, I was giving you color on a balanced portfolio, right?
Sure.
For people who are doing SIPs and building longer-term portfolios, I think you can continue to invest into equities and be a little, be aggressive as well. It's just that, you know, we are saying this is not a time to take a very bold call on equities, right? So, which means overweight is not a stance that I would recommend. I would say that you should be neutral to all asset classes. And like I said, you know, this is a time to bite through markets rather than trying to be very adventurous and trying to create, you know, a lot of alpha in the portfolio. So it's a time to just be careful, that's all.
Fair enough. Now, like I was going back to returns, and the whole question that then next comes for investors is mid cap, large cap, small cap, how to break up that equity allocation. This year, nothing has worked. I mean, the Nifty is up 3.5%. The mid-cap index is flat. The small-cap index for the year as a whole, year to date, is down almost 5%. So it's been tough in that sense. Between the market capitalizations, what's your call, Ashish?
See, it's a classical market for alpha managers, right? Because if you look at Nifty, even in the Nifty, you have stocks which have fallen 30-35%.
Yes.
Right? Take a TCS, which
Tata
is a
Motors,
bellwether
TCS,
stock.
IndusInd Bank,
Right. Who would think TCS will fall 35%, right? And then if you go under the hood, right, below the Nifty, there are stocks which are hitting all-time highs. So what is basically happening is there are shifts happening in the economy. So India is going from, let's say, a low-income country to a middle-income country over the next 3 to 5 years. So consumption patterns are clearly changing, right? A lot of money is going into newer sectors like renewables, manufacturing, and then you have the classic sectors like capital goods and defense coming back because of government capex. Now, unfortunately, a lot of these sectors do not have representation in your main index. So I think this is a period for stock selection. I would say I would be agnostic towards market caps. So a flexi cap fund works well. But in any case, a flexi cap fund will have between 50 to 60% large caps. Within large caps also, right, you have a digital platform which is hitting all-time high. And you have a traditional tech company which is hitting, you know, a 52-week low. So there's that divergence. So I think this is a classical pitch for a alpha manager, right, to pick up the right themes and create alpha in the portfolio.
I have to ask you this, and I know you have the 4 C's framework. I think that's what it's called.
That's right.
Since it's all going to be about the fund manager that you choose to back, right? Give us some names. I mean, so much churn in the industry as well. There are the old stars.
Right.
But in terms of, say, the top 2-3 fund managers that you have your eye on for the next several quarters.
Yeah, so we have more recommendations in the flexi cap category, as you would have guessed from my view. So there are 4 managers that we've put out there. One is somebody who has a small fund but very, very experienced in markets. Both of us know him well, Samir Arora, the Helios Flexi Cap Fund, excellent stock picker. Then, Naren, again, the ICICI Pru Opportunities portfolio, slightly contrarian bent of mind, but, creates alpha through sector rotation. Then we have the Motilal Oswal Large and Mid Cap Fund, which is a high quality, high growth kind of a fund, and the Nippon Flexi Cap Fund, again, a very experienced manager. I think between these 4 funds, you will get a reasonable diversification in terms of style, and all 4 have demonstrated track record in creating alpha. If I go to the mid and small cap names, maybe an Edelweiss mid cap fund has done extremely well. A Motilal Oswal mid cap.
Just hold that thought, because what I want to do is dive a little deeper into these funds and some of the fund managers as well. So we'll take a break and come back with exactly that, some of the key fund recommendations and why Ashish likes both the funds as well as the fund managers. Back with that in just a bit.
Let's talk money. Let's talk money.
Welcome back. We're discussing the mid-year outlook and the mid-year perhaps rejig as you're evaluating your investment portfolios. What is it that you should keep in mind? And we're in conversation with Ashish Shankar of Motilal Oswal Private Wealth. Ashish has just told us that it is good to be very well diversified when it comes to your asset allocation, looking at the way markets are shaping up right now. So Ashish, let's now take it step by step. And you've given us a sense that you are going to be market cap agnostic in the equity space. So let's start there. I mean, maybe some funds for what it's worth in the large cap category and some in the flexi as well, which gives the fund manager the right to move wherever he or she wants to.
Right. So I think the first name that I took was Helios, right? Somebody who's been in markets for close to 3 decades, right? Is an excellent stock picker. Someone who believes that not committing mistakes is a way to create alpha. So I think a seasoned manager like that in this kind of a period will definitely benefit your portfolio, because it's a tricky pitch, right? I mean, you are hit with some news or the other every few weeks. So you need to ensure that your portfolio is positioned in decent quality names. At the same time, you have some earnings tailwind as well going in the portfolio. So that's one name that I would definitely have in my portfolio. Then, of course, somebody who's, again, very experienced, believes in valuations a lot, which is the iPru Opportunities Fund. And it has a track record of creating alpha through sector rotation, right? And this is a perfect market for that.
And it's market cap agnostic.
It's again market cap agnostic. But this is a perfect market for sector rotation. If you look at the last 7 months, at the headline level, like you rightly mentioned, Nifty's not done much, mid cap, small caps have also not done much at the index level. But if you look under the hood, right, there are sectors which have corrected sharply, there are sectors which have come back. And just to name 2 of them, defense has come back very sharply after a deep correction, and you have NBFCs which have corrected sharply. So I think a sector rotation kind of a strategy will work quite well in this period. The third fund that I named was the Motilal Oswal Large and Mid Cap Fund. Now this fund actually blends in perfectly with the first 2 names, and I'll tell you why. Because of the thesis that a lot of the newer sectors are under the index. So if you look at the index, right, it's got the traditional sectors, and just to name 2 of them, banks and IT, where I believe that these sectors are fairly large now in terms of representation, plus earnings growth has been very, very slow.
They may not lead earnings
These
growth.
are tired sectors, and they may not lead the earnings growth. A lot of the newer sectors are below the index, right? Whether it's renewables, digital, etc., etc. And Motilal Oswal as a fund has the track record of picking up high quality, high growth stocks and creating alpha. So actually between these 3 funds, you get a very, very good selection of sectors and stocks, and your ability to create alpha goes up quite sharply.
So great. Those are three ideas where you can be in a more or less market cap agnostic way. You give the flexibility to the fund manager to pick and choose across large cap, mid cap, and even small cap. But let's move on. For a lot of Indian investors, they love their mid caps, right? So they're wondering at some point mid caps have to start firing up, mid and small caps. Right. Over here, which are the funds and the fund managers that you're liking now?
So in the mid-cap space, I think Edelweiss is one fund which has been very consistent in the mid-cap space. They've demonstrated consistency. They demonstrated the ability to pick stocks. I mean, they are basically running as per the GARP philosophy, growth at reasonable price. The quality selection is very strong. And then they also look at the valuation criteria. So that's one fund. The second fund, I would say, has been like the top performer over the last few years, which is again the Motilal Oswal Mid Cap Fund. They have demonstrated their ability to go through cycles in spite of a concentrated portfolio. Generally, you would find that the mid cap portfolios are very diversified.
Yes.
But this is a fund which holds 25 to 30 stocks and has managed to create alpha. So between the two, you get a reasonable diversification in the mid-cap space. In the small-cap space, we have two recommendations. One is the Invesco Small Cap. Again, an experienced manager. Because in the small-cap space, what is very important is you don't want mortality. So as you
company is dying out, basically.
Yes. As you go down the cap curve, quality becomes extremely important. Right? So I think Tahir is somebody who brings in that experience and attention of quality to the portfolio. So I think Invesco Small Cap has a good track record, and then you have the Bandhan Small Cap, again experienced CIO at the helm, which is Manish Gunwani. So these are some of the recommendations
on the equity
side.
Got that. So that's pretty helpful for those who are looking to add more money and looking at enhancing their equity portfolios. You have plenty of options to choose over there. Now, Ashish, hybrid funds. And we've been seeing that. I track the data on a monthly basis as well. Last couple of months, very steadily, hybrid funds are now pulling in as much money as pure equity funds. So clearly investors are understanding the benefits of diversification. But how do you choose a hybrid fund? It's a very vast category, a lot of different types of funds, aggressive hybrid, balanced advantage, etc. So where do you start?
Right. See, generally the hybrid funds are a stepping stone to mutual funds, right? People who are traditionally bank deposit investors, or people who've just opened a demat account and now want to start investing through mutual funds, they come through the hybrid category, and advisors also often recommend that as the first stepping stone towards building a mutual fund portfolio, right? So in that category, typically people go with tried and tested. Okay, so one of the funds which is the largest fund and still doing extremely well is your iPro Balanced Advantage Fund, right? Which is more aggressive towards equity, but they balance the portfolio also pretty regularly. Then the second one is HDFC. HDFC is more aggressive than ICICI. So these are stepping stones towards getting closer to equity allocation. Then you have the multi-asset category as well, right? Within the multi-asset category, one of the smaller funds that we've recommended is Vitok, right? Which is true to label multi-asset. It's got gold, it's got equities, it's got debt, and even the debt portion, what they've done is partly, they've done it through the arbitrage strategy. So you get a taxation which is better. After 2 years, it's long-term capital gains. So these are few of the hybrid categories that we like. And then if you wish to be even more conservative, then you have the equity savings category, where the equity portion further goes down.
It's more like debt-like returns.
It's more like debt-like returns. The risk is debt-like, the returns are debt plus. So that's also a good category. So
and any specific AMCs you like here?
So again, I think there, you go with the bigger ones like an ICICI or an HDFC, because they have track record in that category. So these are, and these funds actually come very handy in these kind of markets where the volatility is extremely high and you don't want to stomach that kind of volatility. For somebody who's not experienced and starting off investing, so on and so forth.
Speaking of debt-like returns, I wonder what your view is on REITs. It's a new asset class and again promises to be fairly steady but more tax efficient than even debt funds, which lost the pure debt funds, which lost that tax advantage. Is this an asset class you're liking?
Yes, for portfolios which are larger in size and people who can access, the exchange, REITs definitely make a lot of sense. The only thing to take care of in REIT is the volatility in the near term can be much higher than, let's say, a conservative debt fund like a equity savings fund, because the asset, the prices move almost like equity, right? So you have to take a 5-year call. Over a 5-year period, you will be fine because you get the rental income on a regular basis. Plus, the asset value also stabilizes over time.
Correct.
But in the near term, based on supply demand, right, the prices can vary quite a
So
bit.
if you look at the REITs price on a daily basis, trading on the
it can be very
exchange,
volatile.
then it could be.
It trades almost like equities,
Yeah.
albeit less volatile than equities. So if you do not have the stomach for that, then REIT would not be the first category that I would recommend.
Sure.
Probably you come into equity savings or balanced advantage funds, and then the next step could be having a REIT portfolio. And if you take a 3 to 5 year view, you'll be fine. I mean, you'll get returns higher than equity, and you'll also get the tax advantage.
Understood, understood. So this is really helpful, and now we have ideas to choose from across all the different asset classes. So let's recap then. What is the final advice, and what would you say would be perhaps one or two of the big mistakes that we as investors need to avoid as we navigate these rather confusing markets?
Right. So every time we say the markets are different, but they teach the same lessons.
Yeah.
So if you look at last year, right, everybody was super bullish on small cap, mid cap, and a lot of people started investing in SME. Many people started going to IPOs, right? So ultimately, when it comes down to equities, it's about buying good funds, good stocks, staying for a longer period of time, having that patience going through volatility. So I think one big mistake that people probably would have committed, and now they are wiser, is going down too much on the cap curve, right? And buying these stocks directly, because a lot of these stocks don't have coverage, you don't have hand holding. So that's one mistake. Second is, going overboard on any asset class, right? So when equities were doing extremely well, people tend to load up on equities. They tend to go overboard. And then in markets like these, right, then you get a, rude shock on how your portfolio is performing vis-a-vis expectations. So I think, ensuring that you don't go down too much on the cap curve, take too much risk in frothy markets. Second is, sticking to your asset allocation. And in these markets, right, currently the markets we are in, I think the best thing to do is stick to the basics.
Keep it simple.
Yeah, things are tough. They will continue to be tough, because I don't think this entire, challenge of what's happening globally on tariffs, etc., is over as yet. So we will see more of it.
Hunker down, stick to the basics, follow your asset allocation, and don't take...
Well, some of your most favorite ice cream brands, whether it's Cornetto, Magnum or Quality Walls, are set to get a new home under a new company, Quality Walls India. This, as Hindustan Unilever, India's largest FMCG company, is demerging its ice cream business into a standalone listed entity, hopefully by the end of next financial year. Now, what does this demerger entail? What is the rationale behind that? And what is this cool business going to entail? We are joined by Ritesh Tiwari, the CFO of HUL, to talk to Mangalam and me, not just about the ice cream business, but also about HUL, the strategic reset that's happening here, and the new management that's coming in. Well, Mr. Tiwari, thank you so much for speaking to CNBC-TV18. Let's start off by talking about the reason we're here, which is to talk about the ice cream demerger. Quickly run us through the very basic details of the demerger. What is the, what is Quality Walls India going to entail as a corporate entity, as a company? And what's been the basic rationale behind the demerger?
So ice cream overall has a very distinct business model. It runs in cold change in terms of manufacturing, distribution. It is prone to seasonality more compared to any other business that we have. It also has higher capital intensity compared to other business that we have. This is what makes ice cream very different to the rest of the business. At HUL, it has low synergies because of this very reason with all other categories that we end up doing business with. So that was one reason why we said that we need to have a solution which is very different. So hence, if ice cream is run with a focused management, with different agile strategies which are suited to its own distinctive business model, it can unlock more growth going forward. The decision was that once Unilever globally decided that they will separate the ice cream business and they will end up listing it, we had to, as HUL, take a decision, what do we do with it? The board came to conclusion after a lot of discussion that it is in best interest to separate the business in India as well, and then form a separate company, demerge it, and then list it. Right. This will ensure that all shareholders will be able to participate in the growth story of ice cream in India.
Right. So if you could give us a sense, as delicious as the business idea and the potential and the products sound, it's a very tough business as well, because supply chains, the capital that it requires for you to have a cold chain across the country, etc. If you could give us basic numbers on the ice cream business, it's about 2 to 3% of your revenue right now. What kind of EBITDA margins does it make? What kind of capital is invested in the ice cream business?
Yeah. So ice cream is roughly for us an 1,800 crore business, and it makes, if I look at last few years of margin, it makes low single-digit margin. This is a business now which is in investment phase. We are a national player. We supply ice cream across the length and breadth of the country. And when you do that, the overall cost of running the business is high, which is why a business like this gets a lot of benefit when it starts to scale up. Our business for the last 1 decade has grown in double digit. And going forward, given the headroom which is there to grow of penetration consumption, we expect this growth trajectory to get even stronger going forward. And which is why today, when the business operates at a low single-digit margin on an average, we will get into an investment phase further. So margins will further go a little bit down. But from there onwards, as the operating leverage kicks in, we'll then start seeing acceleration of margin in times to come.
So if you could give us a sense of the capital that has been invested in this business already, because it's housed in Hindustan Unilever right now, I'm sure there are a lot of operational synergies that come by as well, which may not come once it's demerged. So what are the kind of investments that you entail out there? How low can the ROCEs go before they go up, and what are they right now?
Yeah. So the key criteria there is the amount of capex investment. So for a typical FMCG company, let me say Hindustan Lever example, we spend approximately a little less than 2% of our turnover into capital, in capex. Ice cream business operates anywhere from 5 to 7%. Of course, there are years we'll a little more, a little less, but it operates at 5 to 7% capital investment. The point there is you have to further add capacity because of the growth which is happening in the business, and plus the distribution network which you have to set up.
You spoke about low single-digit margins is what you see right now, and then after the investment phase, I think your listed peers does about 5 to 7%, if I'm not wrong. Is that where you would look to get at eventually, or do you think post-investment phase there is scope to expand margins further beyond that?
So if I take margin and make two different components of that, material margin, which is your sales minus all the raw material variable cost, and there's a fixed cost which gets amortized as part of the cost to the entire business. When it comes to material margin, we make industry-leading margins. When it comes to total margin, when you add variable cost plus fixed cost, our margins are lower compared to the benchmark that you quoted. And the reason for that is because we are a national player, and hence our infrastructure is spread. As you start getting more amount of scale further in the business, you start getting operating leverage. So the second component today, where we are, let me say, under index compared to market, we'll start getting that component also getting counted in terms of improvement in margin. And once that starts to kick in with further amount of growth and scale, we should be able to reach high single-digit margins.
Right. That's very interesting, because the variable cost that there is, you said, is industry-leading already. The fixed cost currently is also shared by the large Unilever platform. So just trying to figure out if it is individual, then maybe the denominator would be a lot smaller, and as a result of which it will be amortized a lot more.
So ice cream has a separate distinctive business model. So the entire fixed cost for ice cream is ice cream specific.
Got it.
So when I was quoting the example of a fixed cost, this is all ice cream assets. Because ice cream has separate factories, it has separate distribution system, the ice cream cabinet which are in the marketplace that we end up owning either directly or indirectly. I was referring to all this infrastructure which is all ice cream specific. In fact, the synergy with the rest of the business is very limited.
Got it.
Especially when it comes to go-to market. Our sales force, it has a separate sales force on its own. So there is no dis-synergy, let me say, on such operating costs of supply chain that will happen after the demerger.
And what happens to HUL's overall margins, because our ice cream is fairly margin dilutive, and what happens to HUL's own ROCE? How much improvement do you see there?
Yeah. So ice cream overall is 3% of turnover. It's 1% of our profit. So there'll be small improvement in our ROCE and margin after the demerger. But it is small and immaterial, I would say.
Right. And you know, ice cream as a business, though you spoke about the large scope of growth that there is, it is still seasonal in nature.
Right.
And I think you have spoken in the past, and you've been one of the players that's spoken about how you're looking at de-seasonalizing the business. So how do we look at that? You know, because if an investor is looking to invest in a company, they would want to be able to reap profits or, you know, returns through the year. It cannot be in one season. So how are you looking at de-seasonalizing this? And, you know, even globally, in fact, for Unilever, ice cream, a lot of investors have been talking about how ice cream as a business there, the consumption is actually coming down. Is India an outlier in that sense? Is the scope actually a lot more here?
Yeah. So two, three different angles to this. To start with, our key strategy has always been for the last few years, how can we start de-seasonalizing the business? Yes. Now, ice cream can be seen as a dessert, and hence it plays a role in the entire post-meal sweet category. It also has a role as a snacking category. And once you start looking at it a little differently like that, you start seeing that there are many occasions more where ice cream can be center of the plate. So at Diwali season today, for example, we have our own variant which has gulab jamun into it, and we end up marketing that at length during Diwali season. For East, when Pujo happens, we have Nolan Gur ice cream. So we have now launched flavors which are relevant during festival season to start to ensure we keep de-seasonalizing. I was quoting an example to you earlier. A US market is much more colder than what India is. Yeah. The per capita consumption there is 13 liter, and we have 600 ml. So the headroom that we have for growing is substantial. And which is why for the last 1 decade, the industry has grown at double digit. Our own business as Hindustan Unilever for quality walls has grown in double digit. And once you're able to focus differently and more going forward, we could end up seeing stronger double-digit growth from the business.
Could you give us a sense of how your sales have panned out across the year over the last many years since you've started to de-seasonalize it? Earlier it was obviously Q1, Q4, and now if you could give us that split. Earlier what it was and post your de-seasonalizing it, or your efforts, how much has it moved?
Yeah, so it's always a gradual move. It will never have a substantial impact. But we keep seeing 100 to 200 BPS move that keeps happening from season to non-season ice cream with every year of effort that we end up making.
So what's the current split right now?
So roughly, I would say little less than half the business ends up happening during the peak of the season, and then the balance business is spread across the balance quarters in the year.
How do you see competition? Because, you know, while you're number 2, we have another very large national player, but we're seeing a lot of the smaller new age D2C brands also that are coming in. A lot of money being pumped in by VC investors also into those companies. A lot of focus on health, low calorie, low sugar ice creams, and they're really taking off, especially thanks to quick commerce. So how are you looking at the competitive scenario? And does that then now, with Quality Walls India also having its own business, its own focus, does that also open up avenues for M&A?
So I quoted one of the statistics earlier. So we have our own direct or indirect 2.5 lakh freezer cabinet. Yes. As an industry of ice cream, we have a little more than 1 million cabinet out of the 12 million outlets which are in the country. So more players start to participate and help support and increase the distribution infrastructure. Every player in the market will end up benefiting from that. Given the per capita consumption is so low this point in time, there's enough headroom for multiple players to coexist. Ice cream is a business which also has much higher amount of innovation compared to typical FMCG business. What we have done, we focus squarely on innovation for the last several years. And as and when required and relevant, we keep getting also brands from the stable of Unilever into India. Going forward, same thing will happen with the Magnum Ice Cream Company, which will ultimately be the owners, majority shareholders of the business in India. We will end up having access to the biggest global ice cream company, the brands from them, the tech from them, R&D from them. So innovation will continue to be exciting. That's what will determine the growth trajectory and competitiveness of the business.
Do you have to pay a royalty to the Magnum Ice Cream? And
so today as HUL, we have a royalty contract, which is for all the categories that we deal with in Unilever. And once ice cream gets separated, our current contract runs till January 28. So we're going to pass on the royalty contract, which is all 3 components. It is component for the brand trademark. The brands that we have in India today, Quality Walls, Magnum, Cornetto, these brand trademarks are owned by Unilever. So the access and license to these trademarks will be passed on to Quality Walls India Limited under the same existing arrangement that we have. Today, the R&D is a shared R&D across Unilever globally, and which is why as part of the royalty contract, we also have a royalty contract on technical services that will also get benefited. The Quality Walls India Limited will continue to have access of that as well. And third, importantly, going forward, the innovation and trends So those benefits will be there for the ice cream business as well. After the demerger is completed in India, and once the global company gets also listed, and they might end up getting into a new relationship of royalty with them later point in time. But as of now, we are equipping the Quality Walls India Limited with access to brand rights, technical know-how, with innovation and R&D capability and leadership from the biggest global ice cream company.
And by when do you expect this entire exercise to complete and shareholders of HUL to get Quality Walls shares in their demat account?
Yeah. So our entire demerge is a court-driven process. We have now got the first motion from NCLT. On 12th of August, we have a shareholder vote to review, and we are proposing for approval for the demerger. Once we get shareholder approval, there are other regulatory steps we have to do. We expect by end of this financial year, the business to get demerged and listed.
Right.
And start trading as well.
How big is the industry likely to be over the next, say, 5 or 6 years? It's been compounding at around 11-12% over the last few years. And where do you see HUL's own ice cream vertical be, say, over the next 5 years? You said high double-digit growth. We just want to understand, what are you foreseeing as a vision for this company? Those who might get those shares want to decide whether they want to hold on to it or not.
Yeah. So one of the information which we'll put in public domain at appropriate time, once all the approvals come of shareholders, etc., is an information memorandum in which we'll talk about at length the new management structure, including independent board, which will be part of the Quality Walls India Limited, the business strategy going forward. But suffice to say, very fact the overall per capita consumption is so small this point in time at 600 ml. There's massive headroom to grow. And we've seen this in different parts of the world. As overall the cold chain infrastructure starts developing in the country, ice cream gets benefit from that cold chain infrastructure getting developed. So I won't put a number to it, but we do believe strong double-digit growth is what should be expected from the business going forward. And that should then improve the operating leverage and hence the margin. And for us, it's also very important to ensure this entire demerger is very inclusive demerger. So for example, HUL has overall more than 12 lakh shareholders. We have 1.2 lakh shareholders who own 1 share of Hindustan Unilever. So the way we are doing ice cream demerger, the share entitlement ratio is 1:1. Which means for every 1 share in Hindustan Unilever, the shareholder will get 1 share in Quality Walls India Limited. This will ensure a fair, equitable and inclusive demerger where every shareholder will be able to participate in the growth story of ice cream business.
You believe it can double over the next 3 years or 4 years? With better margins?
I hope it does.
Okay. Let's move on.
Let's move on then. Of course, coming to what everyone's been talking about when it comes to HUL, which is the change in management right now. I believe Priya Nair has taken over. It's been a couple of days.
It's been first week for her in the office.
Yeah.
Yes, of course. So, a few, initial thoughts once Priya's come over. What's it been like? And also,
how's the vibe changed?
Yeah.
Let's put it that way.
Let's start off with that.
Yeah. So Priya is a homegrown talent. It's been 30 years. In fact, we celebrated her 30 years at HUL and Unilever this week. As Priya comes in, of course, she will have her own set of thinking and thoughts, looking into the business. Priya in last role, globally, she was president for the global beauty and well-being business. And that and we've spoken about it continuously, beauty well-being is an extremely important, strategically important category for us in India and segment for us. The expectation of growth from us for beauty well-being is much higher. And all that experience that Priya has in leading the global business will be extremely important for us as she starts to settle into the business. Now,
sorry, any immediate strategic resets also that you're working on putting in place, and again taking on the beauty and well-being, is it fair to then say that that is one category that's going to be the highest focus area for HUL also to sort of capture in India?
Yeah. So in the last couple of years, as part of our strategy, we've been very clear. Driving competitive growth is our first focus. And as part of the strategy, we spoke about Aspire, our strategy to unlock a billion aspiration. We are very clear in India that the portfolio will have to keep transforming. And the effort we've been doing for the last few years continuously on that front. We segment our business into core, future core and market maker.
Yeah.
And future core and market maker is the space where market is growing disproportionately faster, number one. And number two, this is also the space market is more premiumization is happening there. When you look at this portfolio today, at a point in time, a few years ago, we used to have more than 50% business, which was sitting in core. And now we have more than 50% business, which sits in future core and market maker. In fact, in the last couple of years, we made 500 BPS shift between core and future core and market maker. This is heart of our current strategy. That is not going to change as we keep working on. We had spoken about that overall our portfolio as HUL is more premium compared to industry. Yeah. There's one space we are under indexed to industry, which is beauty and well-being. Yeah. We have a very clear stated business objective to improve by 900 BPS contribution of premium in our beauty and well-being portfolio. So the expansion of portfolio, acquisition that we've done recently, bolt-on, minimalist, these are all basically in service of that one strategic reason that we want to dial up the portfolio. So the business strategy rests on these basically important strongholds. That is not going to change. Now, of course, in FMCG, consumers can change, market can change, overall competition landscape can change, channel landscape is evolving. So strategy, like anything else, will have to keep evolving. As Priya settles in, looking into this consideration, of course, she'll end up making her own set of choices. And we keep saying that HUL is a blockbuster book. Every new leader comes and writes an extra chapter, a new chapter in that blockbuster book. That's exactly what Priya will do.
All right, let's hope that happens. This is also coming at a time when the consumer sentiment itself is at an inflection point. We are seeing acceleration in rural demand, and urban is also gradually picking up. So amidst all of this, with the new, wind beneath the sails of HUL or beneath the wings of HUL right now coming in with new leadership, do you believe that the time is opportune for the company to grow a lot faster over the next 3 years than it has over the last 3 years?
Yeah. See, there are a few important parameters which determines overall consumption climate and FMCG growth. Number one is disposable income that consumers have. And number two is consumer sentiment. These both items are looking better overall as a country today compared to what it looked a year or 2 years before. So we have seen that the MAT trends, MAT trends are stable for FMCG. In the latest quarter, last quarter, we saw overall consumption demand, we saw an uptick. Rural now is growing ahead of urban. Both have improved. Urban is also improved. Rural is also improved, but rural is now growing ahead of urban. Together, we see that overall macro conditions have improved, and we expect that this to sustain. Now, coming to Hindustan Unilever, there's two reasons why we had a better outcome and better results and improved results this time. A, because macro conditions have started to improve, and B, the work that we have done in creating a natural tailwind with our portfolio change. The 500 BPS change that we have done from core to future core and market maker, that ends up getting our portfolio into more high growth spaces. And this change in portfolio and portfolio upgradation and transformation is what is further supporting growth.
So how far are we from double-digit growth?
And even when we're talking about volume also, how far are we from like a higher single digit or closer to a double digit volume?
Yeah. So for double digit growth to happen, two things need to be true. Number one, of course, we have to see further acceleration in the market in terms of volume growth. And pricing will also have to come in. If I look at last 5 year, 10 year,
but mix is coming
years,
in anyway, right? You are seeing premiumization of your portfolio. So there is an element of volume, and then there is the element of premiumization. Don't you think together those would be enough for...
It was a couple of quarters of price-led growth. Now slowly volumes are coming back. So
let me unpack this. So typically we do expect 4 to 5%. If I look at last 1 decade, 7 to 8% FMCG growth, market growth, 3 to 4% was volume growth, 4 to 5% was pricing growth. Pricing growth as of now is more like 1%.
Got it.
You saw our latest quarter. So we do expect that in times to come, as commodities stabilize, inflation levels become normative, we should keep getting price growth back, which has been the long-term trend. Now, keeping the price component aside, if I just focus on the volume component, if last 1 decade has been 3 to 4% growth of market, of industry, we do expect that to be better in this decade.
One of the quibbles that everyone on the street has is not that consumption isn't growing. It is that consumption is growing, but a large part of the incremental growth is coming in from, say, some of the premium D2C players, or it is coming in from some of the, at the lower end, coming in from own brands by large retail chains, and it is coming from other places. So yes, consumption is growing, consumers' wallets are, increasing, but that wallet share is not coming to the traditional PCG companies, so to say. What do you have to say to that?
So if you look at post-pandemic last 4 years, HUL has added 16,000 crore turnover to HUL. It's substantial when you compare to the scale of the industry. That's the level amount of turnover we've added to Hindustan Unilever. Consumers are preferring brands which are prestige in beauty well-being with very differentiated proposition. We now have overall 3,000 crore D2C business in beauty well-being. And this 3,000 crore business, in fact, in the latest quarter grew at more than 25%. And the point I keep mentioning about that, it's not only important to grow a business which is digital first, but also to have a sustainable business model. This 3,000 crore business that we have, which grows at more than 25%, which is digital focus, organized trade heavy, it also makes double-digit margins as well. So we have tapped in fully, squarely into the D2C space and created a 3,000 crore portfolio. If I take a step back as Hindustan Unilever, we have 8,000 crore portfolio now, which is in market maker. This portfolio grows in strong double digits. And this is where market is also growing. So we are over-indexing ourselves, and which is why the point I mentioned earlier, the strategy of ensuring that portfolio keeps evolving and moving from core to future core to market maker, that will keep generating the right tailwind that we have in the business.
Well, what about the other categories? So you spoke about D2C, especially in beauty and well-being. But what about personal care? What about food and refreshments? Even those are sectors where you're seeing a lot of new D2C players. Eating habits are changing considerably. People are moving to a lot more, even when it comes to food. That's one of the other wallet share change that Mangalam is talking about, is that, it's not that people are not consuming, but they're consuming different, they're consuming better. How are you capitalizing on that?
So we're seeing in two spaces that the market growth is being above average to FMCG. Number one is beauty, and number two, exactly to your point, is foods. When it comes to food, the way we have done the job in beauty, we have equal job to be done more on the portfolio in foods. Our overall beverage business this quarter grew in double digits. So high single-digit growth in tea, double-digit growth in coffee. That business is very strong and performing. Horlicks, we have a job to do. Boost, part of lifestyle nutrition, is growing, but Horlicks, we have a job to do where we're gaining market share. But we have to start ensuring that consumption in existing Horlicks household starts to increase. We are relaunching Horlicks. The product itself will undergo a change to help further consumption of the category. Now, coming to packaged food, to your point, India is going through the transformation. Unorganized to organized, unpackaged to package. And this is where we will also now keep working on our own portfolio in packaged food as well. We will use Kisan as a brand for Indian cuisine, Knorr as a brand for international cuisine, and we have an amazing condiment brand, which is Hellmann's. And we decided there are 6 different demand spaces in foods that will end up playing. Be it tea, coffee, lifestyle nutrition, our own business, what we call as UFS, the business of selling to restaurant ingredients and for the top dishes, and then condiments, and then mini meals, and overall the job that we have to do in that space. So these 6 demand spaces is what we'll end up getting into, and you will see portfolio transformation from Hindustan Unilever in the space of condiments, in the space of mini meals and accompaniments. Now the job that we have to do out here is to ensure that we don't get into spaces which are more staples in nature. Right. So we have made a strategic choice that we will not get into staples as this change happens from unorganized to organized and then package to package.
You have to look at a headline, HUL is gunning for growth. Let's put it that way.
When it comes to choices between growth and margin, competitive, volume growth, unblinking.
All right. Okay, so let's wrap it up with a final question, because the company is going into new leadership change, etc. Over the last 2 years, what do you think have been the biggest achievements, and what have been, places where things can improve over the next 2 years?
Yeah. If I look at last 2 years, I think in the period of deflation, especially last 5 quarters, we've delivered mid-single digit volume. So our focus on competitive volume growth did not change, and we've seen that getting delivered. Very important, our portfolio has changed. 500 BPS, a substantial improvement in contribution of future core and market maker. This portfolio change is giving us a tailwind to grow further. So it has been a growth which is competitive. It has been a growth which is making the business more future looking because of the portfolio transformation. And it has seen also a resilient business model where we held to our strong margins, but as needed, we have also taken decision to go and invest more by taking some margin down.
But what do you think you could have probably done better?
Place I would say we could have done better is a place in beauty well-being where our premium portfolio could have been larger. And we called it out as part of our strategy that we want to improve there and we want to make a 900 BPS improvement in our beauty and well-being contribution of premium. So that's one place I would say I can call out which could have done better. And hence we have now laid out a very clear strategy how we will improve contribution of premium in our beauty well-being business.
And with Priya coming in, I think that's now going to be a very tough
That's the direction
job.
is. All right. Thank you so much.
Lovely conversation. Always great insights. Thank you so much.
Thank you very much.
On What's Brewing Today, actor and climate advocate Bhumi Pednekar is now turning purpose into enterprise. Teaming up with her sister Samiksha Pednekar, the duo has launched Pack Bay, a conscious, design-forward beverage brand that claims it's reimagining the way India hydrates. And to tell us more about the brand, the vision forward, joining me now are Bhumi Pednekar and Samiksha Pednekar, the founders themselves. Thank you so much for joining us on CNBC TV18. Bhumi, let me start with you. You've been an advocate for sustainability for almost a decade now.
Yes.
What led you to take the entrepreneurial leap into this space especially, and the Indian hydration market? What is the gap that you're trying to fill?
To answer the first part of your question, I think I always had an entrepreneurial side to me. You know, this is something that my mom keeps telling Samiksha and I, that even when we were children, we were constantly like, okay, how can we make a scrapbook and sell it to our neighbors and get that 10 rupees, you know? So we always had it in us. We had various discussions growing up that, okay, apart from our personal goals, for the first part of our lives, for me, which was acting, for her, it was her law, which she loved. Yeah. Starting something together, entering the world of business, something that kind of can outlive us, apart from whatever we do individually as well. In many ways, kind of leaving our legacy behind was always in our bucket list.
Samiksha, let me come to you. From practicing law to launching a beverage brand, you know, how is it different? Tell us what Pack Bay offers and how is it different in this crowded space that we have today?
Yeah. There came a point in my life where I was like, okay, now if I continue doing law, I will always do law. So that's how the jump happened, and we wanted to give people a better option, a better choice, so they can consume safer and consume better. We are not a water brand, we are a beverage brand, you know, and that's how I think the germ of Back Bay started.
Speaking of making consumers doing something that's safer, let's talk about your facility. I think your water is sourced from the Himalayan springs, bottled at a women-led facility in Himachal Pradesh. Talk to us about the facility. Is it contract-based? Do you own the facility? And what are the capacities that we're talking about?
Well, it is our own facility. We have put up our own plant and we are very, very proud of it. And as you rightly said, our workforce is led by women because that's just the kind of value system we wanted to inculcate within our brand. Our capacity is 45,000 boxes a day. A day? A day. Okay. We have a large capacity and we primarily decided to put in our own factories because we wanted quality control.
Yes.
We also wanted to scale with the way our consumers are adapting to our brand. We wanted to evolve with them. And thus we wanted complete control because as Samiksha rightly said, the essence of Back Bay, the value system of Back Bay is that it's better for you, it's better for the planet. And for us to be able to do that, we wanted complete control and thus we made the brave choice of putting our own.
I know, that's a mammoth task that you've taken to
100%, 100%. Like our journey started 2 years ago and over the last 2 years, it's been a great learning to us. You know, every aspect of it from ideation to what our core values should be to the design. As you know, you rightly said in your introduction, we are a design first brand, which I feel is very, very important. And we just didn't want to be a brand that looks good and promises nothing. For us, quality is first.
Okay. So why the name Back Bay and who thought of it?
So I will share the story. We were going through a book and it's an old book of Bombay and there was the map of Bombay in the
1857.
Okay.
And we saw the term Back Bay there. And I loved how I obviously Google mapped it immediately and it's still called Back Bay. So I loved how it was so rooted in Bombay's history and it's still a part of it. And I feel like that's what the city is for us, right? It's our foundation, it's our home. We love the spirit of the city and that's what the spirit of the brand is. We are ever changing, we are growing, we are fast and we are here for you. No matter who you are, what you do, we are going to be here for you. And that's what I feel Bombay means to us and that's what we wanted to give to the world at large.
Also our dream with Back Bay is that we want to create a lifestyle beverage brand. And thus the name Back Bay kind of just fit in there. The moment she called me, I was traveling for shoot. She's like, Back Bay. I said, Back Bay. I said, let's go.
Wow. That's a pretty interesting story. I have to give you that. But let's come back to the brand. You've launched with 2 SKUs.
Yes.
What is the pricing strategy? How have you priced it?
We do realize that India is a price-sensitive market. Thus, for us, we have strategically placed our price right between plastic and glass. So if you look at the most expensive plastic variant available in the market, be it imported or domestic, and the least expensive glass variant available in the market, we are right there because we also wanted our product to be accessible. Look, we are a premium water brand.
Correct. There are 2 SKUs like we just mentioned. There's a 500 and 700 ml bottle.
750.
750. And when can consumers start buying it? How soon are you available?
Actually, we are already available in stores, but like a proper launch is going to happen when your interview would be out.
You know, you've opted for plant-based cartons over traditional packaging. Environmentally conscious, but potentially a costlier choice. How do you plan to balance sustainability and scalability?
So our packaging specifically is called gable top paper packaging. In fact, we've also gone a step further and our cap is actually a bio cap.
And we are the only company in India currently offering that.
You know, because the story of toxic chemicals leaching into our water, into our beverages is where the germination of Back Bay actually happened. And that's why we wanted to go that extra step and make sure that we are giving our consumer authenticity, honesty and transparency. But coming back to scalability, 100%. Look, the Indian market is already used to paper packaging, right? Just not for water. And we obviously have gone for like the best quality available there because we put our carton through heat tests, through various tests actually, just to make sure that the claims we make are completely supported.
There is intense competition, not just from homegrown players, there are global players as well. How do you plan to really carve out a niche for yourself?
I think a lot of it has to do with us just not being a water brand.
Okay.
You know, at the start of the interview, Samiksha very correctly said that we are a beverage brand and we are trying to build a community of like-minded people. We want to build a community of consumers that have complete trust in us, that whatever comes out of Back Bay is going to be better than anything else available in the market. And that's the only way to be. And, you know, especially when you are on the path of sustainability, you know, we aren't a company that greenwashes. And that's why for us, as I even mentioned earlier, quality over anything else.
Okay, so like you mentioned, it's a beverage brand. What more can we expect? You've come out with Back Bay Aqua, which is of course the water brand. What else is in the offline? If you can give us a little sneak peek into what you're working towards.
Well, we have I mean, I'm just like
let it out.
Yeah, we have 2 more product lines in R&D and shelf life testing already.
Okay.
We want to take over the beverage space completely, primarily with the lens of health and well-being. You know, because that is the core of what Back Bay is. You know, also kind of a thought. I'm going to go back to your previous question as well, where competition is concerned, right? Most of our competition is offering different kind of packaging. And we saw a problem in that packaging, and that's why Back Bay was born.
Also the formulations, right? We want to make sure our formulations are clean. Obviously not in terms of water, but in terms of the lines
everything else that we have.
Which we didn't see in the market. There's truly a dearth of clean formulations in the beverage space, and that is where Back Bay is going to sort of champion.
We don't want to give nasties. We don't want to give like any of the chemical filled alternatives available.
Sugar.
And tons of it, right?
Everything in the beverage.
Absolutely, absolutely.
Has sugar in it.
And hydration is a part of your daily being on an hourly level. You know, so how do we make that experience better for you? Back Bay is a very experience-led brand.
Okay, so you know that brings me to my next question. You said you want to take over the beverage space completely, right? While you're not giving much as to what you're working on, but having said that, you know, you're an actor, you're a lawyer. What about who have you partnered with? I want to understand, because this is a space, like you said, owning your own manufacturing facility, getting worked for 2 years before launching this brand. Who have you partnered with, and how does it come naturally to you guys, or what is the story behind that?
We partnered with each other.
That's all.
And we just started on this journey, and there was tons and tons of education,
of course,
gaining knowledge, understanding operations, the business side of it, numbers.
So who's the number crunching one, and who's the one who's more on the creative side of it?
I would say that I think we both do a bit of both. But primarily, Bhumi is definitely more brand-led in terms of she looks at the longer vision for the brand. She's like, okay, this is where we want to go. This is what Back Bay has to be 10 years, 15 years down the line. I'm more of like the day-to-day thing, you know. Okay, now this
Samiksha helps the operations. She's being very like conservative about it. She helps the operations through and through. We obviously have a great team working with us. I can't negate that, but that has also been like rather recent. You know, so from closing distributors to our contracts to everything has been us, and it's been a lot of work. I wouldn't lie, but look, we are made of hustle. Right? If you look at our individual journeys also, we don't come from backgrounds that supported anything where we've reached. In my capacity of an actor, her capacity of a lawyer. And this is the next part of our life where we are hustling, and I think it's going to be like so.
Okay, so let's delve deeper into this partnership. You know, what's it like building a brand, you know, with sisters together? You know, how do your strengths complement each other, and how do they challenge each other?
I think we're constantly challenging each other. First, let's begin with
but let's start with the good stuff too.
Okay, let's start with the good stuff.
That is a very good thing. But I feel the one thing which I found having a sister Bhumi as my co-founder is the trust. You know? Because I feel that often when two people who don't know each other very well come together to form something, there can be a sense of like building that trust, right? We've been building it for over 30 years now. So, you know, that's a great starting point. And from there comes the fact that we respect each other's opinions, the fact that we hear each other out. And that has sort of helped us bring Back Bay to where it is. Because, you know, like you correctly said that, oh, how have we done this entire thing from setting up the factory to getting, our operations sorted, is because we heard each other out. It's because, we established that foundation of working together towards everything.
The beauty of also working together is that you don't ever switch off. Right?
Exactly,
Like usually when I come
yeah.
back from work, when we would come back from work, we've switched off. We literally have to kind of today tell each other, okay, we're going to take 5 minutes out. Let's just like take a step back and not discuss Back Bay. But we love it. We truly are. I also feel that the similarity between Samiksha and I, apart from the fact that we look similar, as they already rightly says, is that we are extremely driven and we are very hungry. And I think that's why we've been able to do this the way we've been able to do.
And you've invested in it. You don't have an external investor. It's both of you pulled in money.
Self-funded.
Self-funded completely.
My final question before I let you go. Looking ahead, what's the big vision for Back Bay? Of course, you've just launched. Any revenue targets that you've set for yourself, let's say 2 years down the line, 5 years down the line? Are there any global plans as well?
Absolutely. I think the export market is actually going to be very huge for us, and we're extremely excited because we are Himalayan premium water. My water is full of minerals and electrolytes that are naturally occurring, which we already have expansion plans within other markets which are very, very active as we speak. Where the final goal for Back Bay is concerned, like one of our short-term goals is we really, really hope that, in the next 4 years, we do hit the 100 crore number. And I think that's the path that we are on.
And in terms of 10 years, 20 years down the line, we want to be in everyone's home.
Well, on that note, it's time for me to wrap up our conversation. Many thanks, Samiksha and Bhumi Pednekar, for your time on Startup Street. Wish you both the very best of luck for all your aggressive growth plans with Back Bay.
Thank you so much.
Thank
We had
you.
a great
Really
time.
appreciate it. Thank you so much.
NASSCOM's latest report paints a picture of fast growth but somewhat fragile foundations in India's Gen AI startup ecosystem. Over the past year, the number of Gen AI startups in India has surged 3.7 times to more than 890, with 83% focused on application layer solutions like co-pilots and domain-specific agents. But funding has not really kept pace. Gen AI funding in India rose 30% to $990 million, which is just a fraction of the $54 billion that was raised globally. Late-stage capital is scarce, and compute and talent remain major roadblocks. So can this early momentum scale, or are deeper challenges holding India back? Joining us to unpack what's really happening on the ground is Aridhni Shah, the co-founder and CEO of Immunito AI, Akhil Ahmed, the co-founder and COO of Eco Ratings, and Sangeeta Gupta, Senior Vice President and Chief Strategy Officer at NASSCOM. Sangeeta, Aridhni, Akhil, thanks very much. Welcome and thank you for being here. Sangeeta, I'll start with you. The idea that 83% of startups in Gen AI are focused on application layer tools. Is this a deliberate strategic focus or a constraint which is more shaped by the lack of access to capital and compute?
I would, it's a great question, Ritu, because the debate about where should India focus, is it about models, is it about infrastructure, is it about applications? I think very clearly we are seeing more and more growth in the application space, which is happening due to obviously lack of capital, constraint on compute. But also, I think the opportunities that exist in the application space. We have a thriving SaaS ecosystem. Now companies are building AI applications on top of it. You're seeing many more point solutions come up where India can innovate with application areas. So I would say it may not be the strategic choice, but I think India is thriving based on the opportunity that applications are hosting for us. But I think it doesn't mean we will not do the models. There is some companies that are doing it, and the India AI mission, etc., is supporting the growth of these few companies that are building out models. But I think as a sector that has always not just built for India but built for the world, I think you're seeing more Gen AI startups in India that are really leveraging models from across all platforms and building on top of it. So I would say, yes, it's a constrained environment because of capital, but we are making the best out of it.
Well, we're making the best out of it. But Aridhni, in a highly regulated sector like healthcare, what does it really take to gain traction today, build Gen AI products that meet compliance, that meet auditability and safety needs as well?
Yeah. Hi. First of all, Rachel, thank you for inviting me here. And so one of the very key aspects in healthcare is to ensure the reliability that we're talking about, right? And the compliance, the regulations, all of that is there. So when we started building an Gen AI-based platform to create new drugs, and these are antibody-based drugs, we had to ensure that we put all checks and balances in place. And therefore, what we've done is we have now built an AI platform that is purely only for internal use, while ensuring that every single output from the AI gets tested in the lab first. We go through that journey of all of the experimental validations, and then only once we have some success coming out of it, that is when we then can put it out into the world. So therefore, it's very, very important that we have all of these balances in place. For healthcare, where there's so much regulation, as you rightly pointed out, we cannot have a solution that can be directly accessible to the public. And therefore, we have to do everything that's needed. One of the bigger challenges that we're obviously talking about has been funding for our company as well. Being very, very deep tech, we are both bio and AI. And so funding has been a challenge for us, but we've kind of survived so far, and hopefully we'll get there where we can now start putting our drugs into the world.
Well, speaking of funding, Akhil, vertical AI specialists getting some of the largest funding rounds in India, and sustainability is also rising as a strategic lens. How have you carved out a credible Gen AI proposition in the ESG space? And is the market really mature enough to value long-term impact over quick demos?
I think I'll treat your question in two parts. The first part being whether there is investment available for ESG Gen AI offerings at all. Luckily for us, over the last 2-3 years, several mid-sized and large investors have got climate tech on their mandates. And what a better offering to bet on than Gen AI for climate tech. So we have actually been able to garner some interest Specifically, I'm talking about my startup here. And we have been able to raise $2 million over the last 2 years, including grants and cloud credits from cloud hosting providers. So that has been good as a start. But at the same time, to the other part of your question, the patient capital, like Sangeeta was also mentioning, is very hard to come by so far in the GenAI space because building serious IP requires significant effort, and the investors need to be patient till that process is going on, as during those years, you don't see much revenue coming out of it. And I think the OpenAI example is in front of all of us, when they were silently working for several years before they started making any revenue.
Well, Sangeeta, let me take that forward with you to get a more, broader picture on this funding gap that we're seeing. Late-stage capital nearly absent. Is this a risk aversion issue at the moment, or are investors signaling some sort of doubts about the scalability or the defensibility of India's GenAI startups, you think?
I think it's a combination of a little bit of risk averseness, Ritu, that, while they understand the application space, they understand the opportunity, the competition in the GenAI startup space or GenAI solutions is very, very high. So will this startup succeed to the level that they can is an issue. I think the second point is really that unlike consumer tech, where we saw a large flow of capital in India because India in itself was such a large market, a lot of these application solutions, while being adopted in India, in a limited way also are looking for global markets, right? So it's not, I think India as a market is still not as attractive for many of these vertical or application solutions where the investor can say, okay, here's the market potential. If it's an agri solution or a healthcare solution, this is the large opportunity. This is how I see investors, how I see enterprises or governments buying it, and hence I will put money in it. So I think the growth of India as a market is also, I think, potentially very, very low. I think the third part I would just say is that it's still early days, right? I mean, ChatGPT and the GenAI stuff really took off in 2022. This is year 3. So you will potentially see some of the startups scaling from here. But it's a very, very, very fast evolving technology environment, right? So it was about GenAI last year. It's about agentic AI this year. Something else will come up next year. So I think VCs and investors are also looking to catch up with what's next and where should they be putting their money and not missing out on what's happening. So I think it's something that will change. Hopefully, I think we're very hopeful that with this new RDI fund that the government is talking of, where they're going to put 20,000 crore for a deep tech fund of funds, that can help fill some of this patient capital gap that is being discussed.
Funding is one part of it, but Aridhni, great AI talent, that is hard to find. Compute is expensive. How do you build strong tech under these kind of limits? I mean, is partnering the only way out?
Yes, I think early days, especially if we talk about compute, we've been lucky that we've gotten credits to the likes of, I think, about $200,000 in total. And that has really helped us, leverage the credit to be able to build something that is so deep tech, it requires so much compute power, etc. I think access is not really a problem. We do have access to all kinds of, cloud compute that is needed for a company like ours. I think the cost is definitely a bigger factor. And so far, we've been lucky to work on credits. However, yes, going forward, we will need to, kind of now start spending a lot on that. So again, eventually boils down to, how much capital you have accessible in order to go for that compute. When it comes to talent, I think AI talent is there. However, the kind of talent that we need, especially our company, we do generative AI, but we don't do the language models that you see. We do something that's very different, which is called as diffusion. And that talent is definitely scarce in India. So we have been struggling to find. Sorry. Haven't been keeping too well. We have been struggling to find good talent in the diffusion, or let's say the graph neural networks. These are some of the architectures that we use, and that is a talent that is scarce, definitely. So we do struggle there for sure.
Well, Akhil, let me take that forward with you, because the report also says 58% of GenAI startups in India lack a formal compute strategy, and these costs have overtaken talent as the top scaling challenge. How are early-stage startups managing this, especially for companies like you, building for thin margin industries?
Yeah, I think this is a great question, and it will continue to remain a challenge for all early stage companies. What we have done on our part, at least that is working for us right now, is we've divided the cost into fixed and variable. So the fixed costs are the costs associated with building the basic infrastructure using which you can service your customers. And the variable costs are the ones that are recoverable from the customers, because even customers are now more informed and aware of the fact that if there is any custom work done for them, they would need to come up with the cost of compute around that custom work. So that is happening. On the talent side, I want to quickly throw the strategy that our startup has been following. See, we have divided half of our tech team into a lab. So what we do is we take some freshers and then we put them into that lab and we create internal expertise around those topics of GenAI, which we need in order to support our offerings to the marketplace. So we follow kind of a two-pronged approach wherein we take some experienced people and some freshers and then let those freshers build up on their expertise while they're still working for the company as part of that lab program.
Thank you so much for candidly sharing your thoughts. It's been a pleasure speaking with all of you. Thank you.
Thank you.
Thank you so much.
Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Well, it's been a little over half the year gone now, and it's been a different year, perhaps a difficult year for investors because it's not been a year of straight line equity market returns. So now, as you're assessing your portfolios, what's the prognosis? What's the advice? Not just for the second half of the year, but on a longer term basis. Is this a new normal of sorts that we are in when it comes to markets? Well, today on the show, we are going to get you the Motilal Oswal Private Wealth View. Ashish Shankar is with me on the show to take up a couple of questions that investors really have on their minds. Ashish, thank you so much for joining in. Welcome to the show.
Yeah, hi Surbi. Always a pleasure to be on your show.
You know, that's where I really want to start, because a lot of people got used to very good returns, you know, and returns in quick bursts. But the last couple of minutes, the equity market has been testing our patience. So first of all, you tell us, before we talk markets and portfolios, you tell us what investors are telling you when you talk to them across the length and breadth of the country.
So, I feel it is the much needed temperance that has come in, because if you look at the last 3 years, it's been outstanding. I mean, till last October, you felt nothing can go wrong with equity markets. Portfolios were doing CAGRs of upwards of 20, and certain mid-cap, small-cap portfolios are doing 25-30%. If you remember, we were hearing about stocks going up in a vertical fashion on the SME exchange. Yep. Now you don't hear about the SME exchange. So I think this temperance was much required. I mean, as you know, we released a note at the beginning of the year in our publication called Alpha Strategist. And the title this year in January was Opportunity in Adversity.
Yes.
Right? Or Opportunity in Crisis. Because we felt that this year is not going to be as smooth after 2-3 years of spectacular returns. And it's been a very, very testing year, to say the least, so far.
Yeah, I mean, I'm just looking at the returns as well. I mean, at the index level, the Nifty is up barely 3.5-4% for the year as a whole. And even if you're looking at the mid-cap index, at the index level, you know, we haven't seen gains. Individual stocks could have done, of course, much, much better. But Ashish, do you still get the sense of optimism from investors in terms of deployment? I mean, even if you look at flows that are coming to mutual funds, for instance, the SIP flows are intact, but the overall flows are, you know, almost 40% lower from the peak. So what's the sense you get?
So it's a mood of skepticism right now. I mean, if you look at the indices, they don't tell you the full picture, right? Nifty seems to be up 4-5%. The mid cap is also doing fine. But if you look under the hood, right, there have been a lot of shifts. There have been sectoral shifts. There have been stocks which are down 20-30%. There are some stocks which are testing new highs. So the kind of exuberance we saw in September, October is not there today. So people are being a little skeptical about their allocations, especially when it comes to equities. So I think the mood is that of tempered optimism, which means that if you take the medium and longer term, yes, people are continuing to be positive on India, but they're saying, you know, let me make my allocations in a gradual fashion. Absolutely. Because the last 6 months, whenever you've made an allocation into equities, you've got hit by something or the other.
That's true. Right? No, absolutely. And that is where, I mean, these are the markets that make you realize the importance of asset allocation and not having all your eggs in one basket, right? And we've seen that. We've seen gold do so well relative to equities over the last 12 months or so. So actually, let's start there. Now let's come to your mid-year call as it stands. Purely in terms of asset allocation, where were you at the start of the year? And have you changed at all between fixed income, equities, precious metals, or anything else?
Right. So same time last year, if you recollect, we had given even earlier actually, we had given a clear buy call on gold. Although we've always had gold in all our portfolios as a hedge. But we gave a buy call on gold because we believe that the future looks good and optimistic for gold as an asset class. So it's done extremely well. Now we are saying that you must have gold in the portfolio. But it's probably not an investment call, right? It's more like a hedge, back to gold being a good old hedge in the portfolio. So about 10-15% gold, I would say. And I'm right now talking about a balanced portfolio, right? Equities, I would say still we are optimistic. But the outlook from a return point of view, you have to temper down. Let's say 12-15% is a good range to expect in equities in India going forward as well. So maybe 50-55% equities. And the rest, you could do it through hybrid funds, debt kind of an allocation, because hybrid funds give you the tax advantage. Obviously, for portfolios which are much bigger, you have things like structured debt where you can enhance the yields on the portfolio. But this is how, I would say you should look at your portfolios. And just to give you an analogy, because we've just had a historic win yesterday, right, over England. Right. So if you actually compare the markets to cricket, this month, the title of our report is called Middle Overs, right? So you have the pinch hitting overs at the beginning, right? And then there is a period where, it's a very boring period, but you should not lose your wicket, right? Those are the periods where you keep adding singles. I think in equity markets, we are at that stage, right? Don't do anything adventurous, don't do anything funny, stick to your asset allocation, do your flexi cap, large cap allocation, and just bide your time in the markets.
So take the singles. Maybe the big hits are not coming right now. Take the singles, save your wicket. It's that kind of time in the equity market. That's so nicely put, very well put. Now, within that, let's dive a little deeper, and actually let's start with gold, because you mentioned that, right? And I remember our conversation many years ago where you took a very clear call saying portfolios can even go up to 15-20% on gold. Now, isn't the gold rally looking tired to you? I mean, what's the sense? And people are now moving to silver, so people think, chalo, gold chal chuka hai, let's buy silver. What do you say to that trend?
So gold and silver are not the same asset class, because silver also works on, economic growth. It's an industrial, it's a part industrial, part precious metal. So I'm not too sure about silver, because globally economic growth outlook has been moderated after whatever has happened over the last few months. Gold, we believe, should continue to be there in portfolios as a hedge. So I would say between 10 to 15%, depending on what kind of equity allocation you have. Because remember, gold is a hedge to equity allocation, right? So 10 to 15% is where I would put gold at. But between gold and silver, I would still stick to gold. I mean, silver is a little more complicated than gold. Because for silver to do well, you need global growth, you need industrial growth, because silver is a commodity often used, in industrial applications as well.
Okay, all right. So don't sort of extrapolate the wins and the sparkle of gold entirely onto the silver market. Got that. So let's talk equities now. And you're saying, maybe about 50-55% of the portfolio should be direct, full equity. That sounds fairly low, right? Because historically in India, especially people who have the risk appetite, young or middle, sort of middle-aged, they'd want to have a lot more equity. Is this one of your, lowest historic equity allocations in the model portfolio?
No, not really. I mean, basically, I was giving you color on a balanced portfolio, right?
Sure.
For people who are doing SIPs and building longer-term portfolios, I think you can continue to invest into equities and be a little, be aggressive as well. It's just that, we are saying this is not a time to take a very bold call on equities, right? So, which means overweight is not a stance that I would recommend. I would say that you should be neutral to all asset classes. And like I said, this is a time to bite through markets rather than trying to be very adventurous and trying to create, a lot of alpha in the portfolio. So it's a time to just be careful, that's all.
Fair enough. Now, like I was going back to returns, and the whole question that then next comes for investors is mid-cap, large-cap, small-cap, how to break up that equity allocation. This year, nothing has worked. I mean, the Nifty is up 3.5%. The mid-cap index is flat. The small-cap index for the year as a whole, year to date, is down almost 5%. So it's been tough in that sense. Between the market capitalizations, what's your call, Ashish?
See, it's a classical market for alpha managers, right? Because if you look at Nifty, even in the Nifty, you have stocks which have fallen 30-35%.
Yes.
Right?
Yes.
Take a TCS, which
Tata
is a
Motors,
bellwether
TCS,
stock.
IndusInd Bank.
Right. Who would think TCS will fall 35%, right? And then if you go under the hood, right, below the Nifty, there are stocks which are hitting all-time highs. So what is basically happening is there are shifts happening in the economy. So India is going from, let's say, a low-income country to a middle-income country over the next 3 to 5 years. So consumption patterns are clearly changing, right? A lot of money is going into newer sectors like renewables, manufacturing, and then you have the classic sectors like capital goods and defense coming back because of government capex. Now, unfortunately, a lot of these sectors do not have representation in your main index. So I think this is a period for stock selection. I would say I would be agnostic towards market caps. So a flexi cap fund works well. But in any case, a flexi cap fund will have between 50 to 60% large caps. Within large caps also, right, you have a digital platform which is hitting all-time high. And you have a traditional tech company which is hitting, a 52-week low. So there's that divergence. So I think this is a classical pitch for a alpha manager, right, to pick up the right themes and create alpha in the portfolio.
I have to ask you this, and I know you have the 4 C's framework, I think that's what it's called.
That's right.
Since it's all going to be about the fund manager that you choose to back, right? Give us some names. I mean, there's so much churn in the industry as well. There are the old stars.
Right.
But in terms of, say, the top 2-3 fund managers that you have your eye on for the next several quarters.
Yeah, so we have more recommendations in the flexi cap category, as you would have guessed from my view. So there are 4 managers that we've put out there. One is somebody who has a small fund but very, very experienced in markets. Both of us know him well, Samir Arora, the Helios Flexi Cap Fund, excellent stock picker. Then, Naren, again, the ICICI Pru Opportunities portfolio, slightly contrarian bent of mind, but, creates alpha through sector rotation. Then we have the Motilal Oswal Large and Mid Cap Fund, which is a high quality, high growth kind of a fund, and the Nippon Flexi Cap Fund, again, a very experienced manager. I think between these four funds, you will get a reasonable diversification in terms of style, and all four have demonstrated track record in creating alpha. If I go to the mid and small cap names, maybe an Edelweiss mid cap fund has done extremely well. A Motilal Oswal mid cap.
Just hold that thought, because what I want to do is dive a little deeper into these funds and some of the fund managers as well. So we'll take a break and come back with exactly that, some of the key fund recommendations and why Ashish likes both the funds as well as the fund managers. Back with that in just a bit.
Let's talk money. Let's talk money.
Welcome back. We're discussing the mid-year outlook and the mid-year perhaps rejig as you're evaluating your investment portfolios. What is it that you should keep in mind? And we're in conversation with Ashish Shankar of Motilal Oswal Private Wealth. Ashish has just told us that it is good to be very well diversified when it comes to your asset allocation, looking at the way markets are shaping up right now. So Ashish, let's now take it step by step. And you've given us a sense that you are going to be market cap agnostic in the equity space. So let's start there. I mean, maybe some funds for what it's worth in the large cap category and some in the flexi as well, which gives the fund manager the right to move wherever he or she wants to.
Right. So I think the first name that I took was Helios, right? Somebody who's been in markets for close to 3 decades, right? Is an excellent stock picker. Someone who believes that not committing mistakes is a way to create alpha. So I think a seasoned manager like that in this kind of a period will definitely benefit your portfolio, because it's a tricky pitch, right? I mean, you are hit with some news or the other every few weeks. So you need to ensure that your portfolio is positioned in decent quality names. At the same time, you have some earnings tailwind as well going in the portfolio. So that's one name that I would definitely have in my portfolio. Then, of course, somebody who's, again, very experienced, believes in valuations a lot, which is the iPru Opportunities Fund. And it has a track record of creating alpha through sector rotation, right? And this is a perfect market for that.
And it's market cap agnostic.
It's again market cap agnostic. But this is a perfect market for sector rotation. If you look at the last 7 months, at the headline level, like you rightly mentioned, Nifty's not done much, mid cap, small caps have also not done much at the index level. But if you look under the hood, right, there are sectors which have corrected sharply, there are sectors which have come back. And just to name 2 of them, defense has come back very sharply after a deep correction, and you have NBFCs which have corrected sharply. So I think a sector rotation kind of a strategy will work quite well in this period. The third fund that I named was the Motilal Oswal Large and Mid Cap Fund. Now this fund actually blends in perfectly with the first 2 names, and I'll tell you why. Because of the thesis that a lot of the newer sectors are under the index. So if you look at the index, right, it's got the traditional sectors, and just to name 2 of them, banks and IT, where I believe that these sectors are fairly large now in terms of representation, plus earnings growth has been very, very slow.
They may not lead earnings
These
growth.
are tired sectors, and they may not lead the earnings growth. A lot of the newer sectors are below the index, right? Whether it's renewables, digital, etc., etc. And Motilal Oswal as a fund has the track record of picking up high quality, high growth stocks and creating alpha. So actually between these 3 funds, you get a very, very good selection of sectors and stocks, and your ability to create alpha goes up quite sharply.
So great. Those are 3 ideas where you can be in a more or less market cap agnostic way. You give the flexibility to the fund manager to pick and choose across large cap, mid cap, and even small cap. But let's move on. For a lot of Indian investors, they love their mid caps, right? So they're wondering at some point mid caps have to start firing up, mid and small caps. Over here, which are the funds and the fund managers that you're liking now?
So in the mid-cap space, I think Edelweiss is one fund which has been very consistent in the mid-cap space. They've demonstrated consistency. They demonstrated the ability to pick stocks. I mean, they are basically running as per the GARP philosophy, growth at reasonable price. The quality selection is very strong. And then they also look at the valuation criteria. So that's one fund. The second fund, I would say, has been like the top performer over the last few years, which is again the Motilal Oswal Mid Cap Fund. They have demonstrated their ability to go through cycles in spite of a concentrated portfolio. Generally, you would find that the mid cap portfolios are very, very diversified.
Yes.
But this is a fund which holds 25 to 30 stocks and has managed to create alpha. So between the two, you get a reasonable diversification in the mid-cap space. In the small-cap space, we have two recommendations. One is the Invesco Small Cap. Again, an experienced manager. Because in the small-cap space, what is very important is you don't want mortality. So as you
company is dying out, basically.
Yes. As you go down the cap curve, quality becomes extremely important. Right? So I think Tahir is somebody who brings in that experience and attention of quality to the portfolio. So I think Invesco Small Cap has a good track record, and then you have the Bandhan Small Cap, again experienced CIO at the helm, which is Manish Gunwani. So these are some of the recommendations
on the equity
side.
Got that. So that's pretty helpful for those who are looking to add more money and looking at enhancing their equity portfolios. You have plenty of options to choose over there. Now, Ashish, hybrid funds. And, we've been seeing that. I track the data on a monthly basis as well. Last couple of months, very steadily, hybrid funds are now pulling in as much money as, pure equity funds. So clearly, investors are understanding the benefits of diversification. But how do you choose a hybrid fund? It's a very vast category, a lot of different types of funds, aggressive hybrid, balanced advantage, etc. So where do you start?
Right. See, generally, the hybrid funds are a stepping stone to mutual funds, right? People who are traditionally bank deposit investors or people who've just opened a demat account and now want to start investing through mutual funds, they come through the hybrid category, and advisors also often recommend that as the first stepping stone towards building a mutual fund portfolio, right? So in that category, typically people go with tried and tested. Okay, so one of the funds which is the largest fund and still doing extremely well is your iPro Balanced Advantage Fund, right? Which is more aggressive towards equity, but they balance the portfolio also pretty regularly. Then the second one is HDFC. HDFC is more aggressive than ICICI. So these are stepping stones towards getting closer to equity allocation. Then you have the multi-asset category as well, right? Within the multi-asset category, one of the smaller funds that we've recommended is Vitok, right? Which is true to label multi-asset. It's got gold, it's got equities, it's got debt. And even the debt portion, what they've done is partly, they've done it through the arbitrage strategy. So you get a taxation which is better. After 2 years, it's long-term capital gains. So these are few of the hybrid categories that we like. And then if you wish to be even more conservative, then you have the equity savings category, where the equity portion further goes down.
It's more like debt-like returns.
It's more like debt-like returns. The risk is debt-like, the returns are debt plus. So that's also a good category. So
and any specific AMCs you like here?
So again, I think there, you go with the bigger ones like an ICICI or an HDFC because they have track record in that category. So these are, and these funds actually come very handy in these kind of markets where the volatility is extremely high and you don't want to stomach that kind of volatility. For somebody who's not experienced and starting off investing, so on and so forth.
Speaking of debt-like returns, I wonder what your view is on REITs. It's a new asset class and again promises to be fairly steady but more tax efficient than even debt funds, which lost the pure debt funds, which lost that tax advantage. Is this an asset class you're liking?
Yes, for portfolios which are larger in size and people who can access, the exchange, REITs definitely make a lot of sense. The only thing to take care of in REIT is the volatility in the near term can be much higher than, let's say, a conservative debt fund like a equity savings fund, because the asset, the prices move almost like equity, right? So you have to take a 5-year call. Over a 5-year period, you will be fine because you get the rental income on a regular basis. Plus, the asset value also stabilizes over time. But in the near term, based on supply demand, right, the prices can vary quite a bit.
So if you look at the REITs price on a daily basis, trading on the
can be very
exchange,
volatile.
then it could be.
It trades almost like equities, albeit less volatile than equities. So if you do not have the stomach for that, then REIT would not be the first category that I would recommend.
Sure.
Probably you come into equity savings or balanced advantage funds, and then the next step could be having a REIT portfolio. And if you take a 3 to 5 year view, you'll be fine. I mean, you'll get returns higher than equity, and you'll also get the tax advantage.
Understood, understood. So this is really helpful, and now we have ideas to choose from across all the different asset classes. So let's recap then. What is the final advice, and what would you say would be perhaps one or two of the big mistakes that we as investors need to avoid as we navigate these rather confusing markets?
Right. So every time we say the markets are different, but they teach the same lessons.
Yeah.
So if you look at last year, right, everybody was super bullish on small cap, mid cap, and a lot of people started investing in SME. Many people started going to IPOs, right? So ultimately, when it comes down to equities, it's about buying good funds, good stocks, staying for a longer period of time, having that patience going through volatility. So I think one big mistake that people probably would have committed, and now they are wiser, is going down too much on the cap curve, right? And buying these stocks directly, because a lot of these stocks don't have coverage, you don't have hand holding. So that's one mistake. Second is, going overboard on any asset class, right? So when equities were doing extremely well, people tend to load up on equities. They tend to go overboard. And then in markets like these, right, then you get a, rude shock on how your portfolio is performing vis-a-vis expectations. So I think, ensuring that you don't go down too much on the cap curve, take too much risk in frothy markets. Second is, sticking to your asset allocation. And in these markets, right, currently the markets we are in, I think the best thing to do is stick to the basics.
Keep it simple.
Yeah, things are tough. They will continue to be tough, because I don't think this entire, challenge of what's happening globally on tariffs, etc., is over as yet. So